We're going to end that war very quickly. They want to make a deal so badly.
US President Donald Trump says the war on Iran will end very quickly and they won't have a nuclear weapon. US Vice President J.D. Vance also says a lot of progress has been made in talks. Iran Foreign Ministry warns of surprises if there is a return to war. Stocks on Wall Street closed Tuesday's trading session lower as rising bond yields weighed on sentiment. S&P 500 and the Nasdaq post their third losing session in a row. The benchmark 10-year Treasury yield climbed to its highest levels in more than a year. Markets in Asia follow suit, mirroring Wall Street moves. Most markets in the region open lower as inflation concerns push yields to multi-year highs. Investors also monitor lingering US-Iran tensions. The gift Nifty is indicating a lower start for the Indian markets. Brent crude prices hold firm around $110 a barrel as investors assessed US President Donald Trump's renewed threat to resume military strikes on Iran if it failed to accept US peace terms. Gold traded below $4,500 an ounce as escalating tensions kept investors focused on inflation risk and the prospects of higher interest rates. And in key earnings today, Grasim is expected to report an 18.6% growth in revenue on a year-on-year basis. However, profit is expected to decline 55%. Apollo Hospitals is expected to report an uptake of 15% in terms of revenues from last year, and margins are likely to expand. Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. Thank you so much for tuning in. As always, in terms of the markets, we did have a lot of commentary that came in from President Trump, J.D. Vance, the Vice President of the US as well. But markets in the US closed in the red. Asian markets picking up cues as well from here. And we are seeing a red opening coming in for the Asian markets. So when you look at the Asian markets, most of them are trading in the red. Whether you look at the Hang Seng, whether you look at the Nikkei, whether you're looking at ASX 200, all of them trading in the red. Slight bit of a green today coming in for Taiwan index, but very mild, right? It's mostly muted. So nothing exciting that's coming in. Everyone's keeping an eye out on those treasury yields. They've moved up higher in the US as well. So that's something that's creating a bit of a fear. Then you have Iran tensions that are still lingering, no matter what the commentaries come in. That's why the Nifty implied open today. What is it indicating for our market? 167-point downtick, right? Yesterday, in terms of the trading session, it was a bit of a volatile day, right? You did see those up moves and down moves. But by the end of the day, we closed 23,600 around that mark. So nothing exciting happened almost in the day's lowest point. So today, furthermore, downtick is what at least as of now we're expecting, and the Nifty implied open is indicating for our markets. Now on to that West Asia update that I was talking about. US President Donald Trump says that the war with Iran will end very quickly. Addressing the annual congressional picnic gathering, he added that a resolution would push oil prices lower and emphasize preventing Iran from obtaining a nuclear weapon remained his priority. Listen in.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down. But even with that, the stock market's at an all-time high. 2.5 months ago, we hit the best numbers that we've ever hit as a country. Jobs, the best. Everything was the best. Stock market, the highest. And I called my people in. I called them in. I said, congratulations, everybody, but we're going to have to make a little journey down to a place called Iran. We have to stop them. They have nuclear on their mind, and we're not going to let them have a nuclear weapon. And we've done a hell of a job, and I think we're going to be finished with that very quickly, and they won't have a nuclear weapon, and hopefully we're going to get it done in a very nice manner.
US Vice President J.D. Vance also backed Trump's comments, saying United States and Iran have made a lot of progress in their talks, and neither side wants to see a resumption of the military campaign that's going on. Listen in.
We think that we've made a lot of progress. We think the Iranians want to make a deal. The President of the United States has asked us to negotiate in good faith, and that's exactly what we've done. So we're in a pretty good spot here, but there's an option B. And the option B is that we could restart the military campaign to continue to prosecute the case, to continue to try to achieve America's objectives. And we could talk a little bit about what that looks like, but that's not what the president wants, and I don't think it's what the Iranians want either. We have an opportunity here, I think, to reset the relationship that has existed between Iran and the United States for 47 years. That's what the president has asked us to do, and that's what we're going to keep on working at. But it takes two to tango. So do I personally believe it? The honest answer is, how could I possibly know, right? And you negotiate with people, and sometimes you feel like you're making progress, and sometimes you feel like you're not making progress. What I think is that the Iranians want to make a deal.
Okay, meanwhile, Treasury Secretary Scott Bessent has called on allies to disrupt Iran's financing networks and said the Treasury would scrub its sanctions list of outdated designations to make it easier for financial institutions to root out more sophisticated terrorist financing schemes. Listen in.
We trust that your participation here today reflects a readiness to stand with us in full. That will require, for example, our European partners to join the United States in taking action against Iran by designated financiers and unmasking its shell and front companies, shuttering its bank branches, and dismantling its proxies. It will require those of you from the Middle East and Asia to root out Iran's shadow banking networks and networks of ship transportation obfuscation. And it will require our partners around the globe to respond with force to the array of terrorists that we face, from Hezbollah to the Sinaloa cartel. As threats move across boundaries, our unity of purpose must transcend every border.
Let's move on. And Russian President Vladimir Putin is in Beijing, where he is expected to discuss economic cooperation and key international and regional issues with his Chinese counterpart, Xi Jinping. This would mark the second visit within a year and also coincides with the 25th anniversary of the China-Russia treaty. Let's go across to Ellen Yu, who's here to give us on what is expected of this trip.
We're counting down to what Beijing has called the state visit that will kick off with a welcoming ceremony and then talks at the Great Hall of the People. And the two leaders are expected to sign documents, and after their talk, they'll give statements as well, both the Chinese and Russian president. There could be a ceremony on education, and later on, Putin will meet a Chinese engineer that he met in 2000. That was his first visit to China, and that is to underscore his long relationship with China. And also, of course, he's been in power for 26 years now. And after that, there will be a tea that will be an informal meeting as well. Now, we were just talking to the former U.S. Deputy Secretary of State, Kurt Campbell, and we were talking about how, the backdrop to all of this is, of course, U.S.-China relations shifting. And he noted that there's a more stable and predictable relationship between the U.S. and China now ahead of this Putin visit, but he said that stability is more on Chinese terms. And he also observed, which I thought was important to note, that Trump was almost fawning in his engagement with Xi, he said, and quite harsh with the U.S.'s closest allies. And it suggests that deep down Trump is more comfortable with authoritarian leaders. And he also said that with Xi, Putin, Trump, he's never seen any other three leaders with as much latitude. So we'll watch how Putin responds to these U.S.-China relations, and also what these three men at the helm of this triangular relationship mean for all these ties.
Okay, key to watch out for from that meeting there as well. But on that note, we're going to slip into a very short break. After the break, we'll talk about how these overnight cues are going to be impacting our Indian market. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's talk about the US markets and what happened on Wall Street. Most of it ended with sharp cuts, right? S&P 500 and the Nasdaq saw third straight losing session in a row. Dow Jones also shed over 300 points in yesterday's trading session, and this is amid the spike that we saw coming in your bond yields, and that is why we saw the pressure coming in on the Wall Street and the markets across the globe. Even Asian markets have opened up in the red. But how have these cues shaped up for us this morning? What is the impact that we'll be seeing on our Indian markets? Let's bring on board a team of research to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, Vivek, important cues that we are keeping an eye out on. We do have earnings that are still going on, but what are the important levels, events that we should watch out for?
Well, that's right. What we're actually seeing is that a very choppy session in the last couple of trading sessions, especially with the Nifty hovering around in a range. We're seeing selling pressure emerge at higher levels yesterday, especially in yesterday's trading session. A quick glance through about how there has been quite a bit of a sell-off or risk-off as far as equity markets worldwide are concerned. US Treasury yields have spiked to the highest in 19 years, which led to quite a bit of a sell-off across all of the US markets in yesterday's trading session. Oil prices now marginally lower, but continue to hover above the $110 a barrel mark when you're talking about Brent. Now, when you're talking about Asian markets, taking cues from the weak overnight cues that we've seen, most of the Asian markets have managed to start off in the negative territory, indicating that the GIFT Nifty 2 is now down a little over 150 points to start off the session. Now, another important trigger that we'll be watching out for, of course, is the Indian rupee. The Indian rupee weakness is something that persists, and we will need to keep an eye out on that as well. Now, in terms of what happened yesterday, market failed to hold on to the opening gains. Sensex and Nifty ended lower amidst significant volatility. The broader markets were relative outperformers, and the key sector that stood out significantly was the Nifty IT Pack, up 6% in the last two trading sessions. In terms of what is it we'll be watching out for, results reactions for BPCL. Hindalco's subsidiary Novelis reported results overnight. Mankind Pharma and PI Industries will react. On the other hand, Apollo Hospitals, Grasim and Bosch will be reporting their results, among a whole host of other names, including Jubilant Foodworks.
Okay, thank you so much for that, Vivek. But let's move on and go across to Ria to tell us which are the important stocks to watch out for in the trading session. Good morning, Ria.
Well, good morning. Starting off with Hindalco first, the adjusted EBITDA is down by around 3% compared to the previous year, and the company for FY27 has said that they expect to return to a free cash flow positive position by the end of the year. For BPCL, the EBITDA has come in ahead of estimates at nearly 10,061 crores versus estimates of nearly 7,000 crores, and margins also above estimates at 8.5% this time around. For Mankind Pharma, we've seen good operational performance in this quarter, and revenue growth has also been in line with estimates of around 11.5%. For PI Industries, it has been a weak quarter, below estimates on all fronts. EBITDA down nearly 26% versus estimates of a 19% decline. Net profit also taking a hit of 39% versus estimates of just a 23% decline for the quarter. For Hudson Agro, the net profit has seen an increase of nearly 18% compared to the previous year. Revenue also going up by nearly 15% on a year-on-year basis. For Orkla Limited, the net profit has come in at 73 crores compared to around 35 crores in the year-ago quarter, and revenue also seeing an increase of around 5% on a year-on-year basis. For Godavari Power, quite a strong operational performance has been seen this time around. The margins are sitting at around 27.3%, the highest levels in September of 2023. And for Ask Auto Limited, the net profit has gone up by nearly 24%, and revenue also seeing an increase of 35% compared to the previous year. For Z Entertainment, this time around, they have reported a net loss of around 102 crores versus a net profit of 188.4 crores in Q4 of FY25. Revenue has also seen a decline of nearly 7% compared to the previous year. And lastly, also keep an eye out on HCG, as they have announced the launch of the new comprehensive cancer hospital in North Bangalore.
Okay, thank you so much for that, Ria. But in the final update, let's go across to Sudarshan, who's here to tell us the important cues you should keep an eye out on in the world of F&O. Good morning, Sudarshan.
Good morning, Vinny. So yesterday it was a pure expiry day play. We saw through the day market closes sharply off highs. And yesterday we told you that in the current environment, it's better to stay away from the market. And we saw what exactly happened yesterday. What about today? So broad range for Nifty remains from 23,400 to 23,900 or say 24,000. If you talk about the indicators, all the indicators are indicating towards a sharp downtick. Crude continues to hold the levels around 110. Rupee has hit the record low, now crosses the level of 96.501 against dollar, and your 10-year yield remains above 7%, and also US 30-year yield yesterday saw a sharp spike. Now if you talk about the FI flows, again they have turned seller both in the index futures and in the stock futures. They were sellers yesterday. They have added long positions, but addition was just 316 contracts. But look at the short side. They have added short positions of more than 6,000 contracts after reducing for 2 straight days. So now longs exposure remains around 12%. On the options front, in the options data put side, 23,700. On the put side also, on the call side, this strike rate was the most active. So it tells you that in immediate term, 23,700 will be the very important level for Nifty to cross comfortably to see any buying returning. On the call side, 24,000 also was very active. So first support for Nifty would be 23,400. Next support comes around 23,300. Resistance remains around 23,900. Two stocks remain in the band. Those are SAIL and Keynes Technologies. Some of those stocks that have been seeing fresh longs or fresh shorts. Zidus Life had come out with a strong set of earnings. Even the commentary for FY27 is strong. Infosys has been seeing fresh longs, and Voltas was seeing short covering.
Okay, so Darshan, thank you so much for that. But let's move on and get some updates coming in the world of commodities as well. Given the commentary that's come in, what are we keeping an eye out on? Good morning, Manisha.
Morning, Vinny. Thank you for that. Well, I'll start with the crude oil prices, where we are back above $111 a barrel. The U.S.-Iran war has entered the 12th week. The U.S. president threatening to resume military strikes on Iran if it fails to accept U.S. peace terms is what has taken the crude oil prices higher yet again. But remember, the nuclear program remains a key obstacle in negotiations between the two countries. In the meanwhile, there also are various reports suggesting that the NATO is weighing plans to escort commercial vessels through the waterway if the route remains blocked beyond early July. So various things happening on ground onto that one. In the meanwhile, the markets will also wait for the U.S. inventories in sense of crude. Last week, they have declined by 9 million barrels versus estimate of 3.2. So while the energy markets have seen some strength, the metals have continued to decline yet again today. You have gold, which declined 2% overnight. Silver fell 5%, and copper is now trading at a 2-week lows. The broader sell-off in equities, the strength in US dollar, the decline in regional currencies, the Chinese data coming in on the weaker side, all of that seems to be weighing onto the markets.
Okay. Manisha, thank you so much for joining in and telling us what to keep an eye out on in the world of commodities. But on that note, we're going to slip into a very short break. And after the break, we'll get you updates from the world of AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech in our segment AI Pulse. We have Rachna joining us as always. Good morning, Rachna.
Good morning. From the world of artificial intelligence, first up is SpaceX, which is moving toward what could be the largest IPO in history. And this comes a day after Elon Musk's trial against OpenAI was dismissed. Now, the company has picked Goldman Sachs as lead underwriter, with Morgan Stanley, Bank of America, Citi and JP Morgan as co-underwriters. The prospectus could go public as early as tomorrow. Target valuation is $1.75 trillion, raises up to $75 billion, and listing is expected on June 12th. At Google I/O, the blue ink era is now over. Google Search is getting its biggest overhaul in more than 25 years. The new experience replaces ranked links with AI conversations, around-the-clock information agents, and interfaces built on the fly. Sundar Pichai also noted that AI overviews now serves 2.5 billion monthly users. There's also wearables play here, as Google also unveiled Android XR audio glasses with Samsung, Warby Parker and Gentle Monster launching this fall against Meta's Ray-Ban line. And a new model, Gemini Spark, a 24/7 AI agent at $100 a month, though this one needs to be studied better and known what is new and how is it better. On talent, Andrej Karapathy, co-founder of OpenAI and former head of Tesla Autopilot, he's also the man credited for the formation of the word and phenomenon vibe coding, has now joined Anthropic to lead pre-training research. OpenAI, meanwhile, launched guaranteed capacity, locking enterprise customers into 1 to 3 year compute commitments at discounted rates. Altman says the world will be compute constrained for some time. And here in India, Microsoft's largest data center in the country is on track for mid-year in Hyderabad. Infosys, Cognizant and TCS are already co-pilot customers. So this is a part of Microsoft's $17.5 billion India commitment that was made earlier, and now it's coming through. That's all the updates we have from the world of artificial intelligence, but we'll keep you updated with more.
Okay, Rachna, thank you so much for that. But moving on to some other updates, we have Prime Minister Narendra Modi, who has arrived in Rome for the final leg of his five-nation visit, where he was warmly welcomed by the Italian Prime Minister Giorgia Meloni, who posted on social media saying that, "Welcome to Rome, my friend." During the visit, Prime Minister Modi is set to meet Italian President to hold bilateral talks with Prime Minister Meloni as well, and talk about the part of key diplomatic engagements. The visit comes as India and Italy deepen ties under the Joint Strategic Action Plan 2025 to 2029, aimed at boosting cooperation across several strategic sectors. Okay, but with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Pasar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios, middle of the week, Wednesday morning. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. So bond prices up, crude prices
bond
up.
prices down.
Okay, so yields are high. Sorry, bond yields are higher, crude prices are up. Question is, equity markets up or down?
Well, that's right. It's going to be an interesting day in terms of equity market. But for me, the sports action was quite encouraging overnight. Arsenal, they are the English Premier League champions for the first time in 22 years since the time I've been at CNBC TV 18, which is very, very long. I've never got a chance to say it on television. So Arsenal's back in the game, and I'm feeling pumped this morning on the sports action.
Well, I know a lot of family groups, there's congratulatory messages going on.
It's been a long while. So far, it's been a long while. When you go for a drink, Prashant, to watch a game in a club, you wear something, and then, if they win, then you open up. Most of the time, we are zipped up. Oh, no. But this time around, here we go. Arsenal all the way.
All right. Well, let's just take it from the top. And, oil's at $111 a barrel this morning. So we are, not very much different from where we were yesterday, from where we were day before yesterday, a dollar here, a dollar there, but basically up. And that's a problem. Now, Trump said that Iran had as long as early next week to come to the table. Well, we've heard this before. By the way, yesterday at the same time, we were reporting that Trump put out on Truth Social saying that, he's held off from striking Iran because of the GCC countries have said that, well, we are talking with Iran, so please don't strike, etc. There is New York Times reportage which suggests that it's not because of the request from GCC countries. It's basically Pentagon's assessment that, Iran has basically rebuilt a fair bit of its capability to wreak havoc in those regions, in the Persian Gulf countries, US bases and whatnot. So, this is interesting. But anyway, rhetoric still, oil prices not impressed. NATO was, of course, said to be discussing helping ships through the Strait of Hormuz if it isn't reopened. And this is the, punchy bit. Early July, they're saying, well, so they're basically saying, well, in all likelihood, it stays shut in June. And if it's not open by early July, we'll come to help. So not encouraging again. S&P down about 0.75%. NASDAQ was down about 0.8%. US equities have been down for 3 trading sessions now, but they're still up quite a bit for the year so far. And this is the bond action, right? So the general assessment has been that that bonds perhaps it's a bullish environment for bonds. But that camp is getting smaller and smaller. And we'll talk more about this in a bit from now. The 5-year on the US Treasury was up 9 basis points to 4.32, which means bond prices were down. 10-year, 8 basis points high, about 4.6. You'd wonder what is the next level? There is no next level except the January 2025 high, which is 4.8, which is not very far away, by the way, from where we closed yesterday. And of course, the 30-year was up 6 basis points to 5.18. And here, the next round number is 5.5%, which is also, by the way, be a 22-year high. So, the unshakable belief has been, and maybe rightly so, and it's still there. Those who believe that it cannot last. The war cannot be very prolonged. It has to end. It has to wind down. So this oil shock and hence consequently inflation shock is transitory. And while that is absolutely the correct belief to have, it's just that it's been 2 months and the clock is ticking on the way to completing 3 months of this conflict, the strait being shut. And I think markets are finally starting to reprice themselves higher. So it's more technical in that sense. It's not a big fundamental shift. It's not a bond buyers strike as the headlines screamed sometime middle of last year. It's none of that. It's not US exceptionalism, which is being questioned again. It's basically simply core inflation plus the energy shock and the market trying to reprice some of that higher, slightly higher. Now, in terms of further cues, NVIDIA will report earnings tonight. SpaceX, by the way, is also expected to file the IPO filing, to do the IPO filing later today. So we'll see. It should be interesting to read. Now, rupee made a new record low at 96.6 yesterday, and that's been the one-way trade, right? Nifty's gone up and gone down, and it's done the round trip, but the rupee, the currency, has just been sliding one way without really too much of a halt on the way. And the yield jump that we saw last night and the dollar strengthening is, by the way, the dollar strengthening, even at the margin, is completely against any expectation out there. The big macro traders all have had the view that dollar is going down, not up. So this is going to cause, I guess, a little bit of change in positioning, posturing, and of course, maybe a view as well. We'll see. Now, but this is not good news. Yields, dollar, both going up, not good news from a macro standpoint. Nifty needs to get past the range, by the way, is 23,800 on the upside and 23,300 on the downside. Basically, the range is just shifted down. And we need to get past 23,800 on the way higher for anything good to happen from here. And support is 23,300, and a break of which will, if you take the equalization level of the last fall, the 23,300, if it goes, then you're looking at about 22,800 or so. GIFT Nifty gives you a quick sense of how we're likely to start. We'll pick it up from there. 190 points lower is the indicative open. Nigel has walked across the wall with the F&O positioning and the cues. Nigel, take it away.
Well, going by the GIFT Nifty fall and the kind of fall that we have yesterday, the Nifty actually will come to a very, very interesting level from where the bulls could be a little bit interested as well, because yesterday was more than 100 points from the top. And today, this morning, in fact, the GIFT Nifty suggesting a big downtick as well. And yesterday, there was clearly an expiry around the 30 minutes or thereabouts. So yesterday's fall, to some extent, will be attributed to the weekly expiry factor. And it appears we're more in a trading market, and it'll be very, very brave actually to take a solid bullish view. With crude oil prices at around this $110, $111 a barrel, and the US bond yields as well spiking up at around 4.65%. Difficult to take a bullish view on Indian markets with yields and as well as crude at these levels. So this is a trading market, and with the kind of downtick that you see today, probably you'll get a bit of a trading rally that could play out from the day's low. The Indian rupee, though, continues to slip, and that's clearly wearing on sentiment. You want some kind of stability. I've been seeing this for many, many trading sessions, but it's falling just one way. Just take a look at that. That's a one-month chart of it. You know, the rupee moving very, very swiftly from around 93 to around 96.5 of thereabouts. And the FIs, after giving some hope in the last couple of trading sessions, they returned to their selling ways. So they sold close on 2,500 crores. The DIs, they bought 3,800 crores. So it's offset that. However, what was positive yesterday is what the previous plate told us. The broader markets, you had the mid and the small cap indices that actually outperformed, though the headline index came off, and you'll want to see more of the same. Maybe the headline index is in a phase of consolidation, in a bit of a range, but the broader markets perform, makes your portfolios feel good. So more of the same will be on the wish list. As I said, the FI sold a little bit in the cash market and they added shorts as well in trade yesterday. So they added close to around 7,000 short contracts, and the short position continues at around that 88% or thereabouts. Moving to the options data. Today we start we start focusing on the next weekly expiry, which is on the next Tuesday, and there appears at times there's a bit of a strategy that's taking place, and this time the strategy appears to be coming in at around this 23,700 call as well as the 23,700 put. So the strategy would be write both those two strikes and look to pocket the premium, which in this case will be around 450 rupees or thereabouts. So then the broad range you're working with is around 23,250 on the downside. On the upside, 24,150. If you're playing that strike, that 23,700 odd level. In terms of levels you're looking at, 50 DMA, we went to that mark yesterday, it got breached. So that's the crucial resistance zone that you're looking at. While on the downside, the recent low will be a bit of a support. But as I said earlier, the headline index appears to be in a bit of a range. And from today's low, maybe we see a bit of a bounce as well. But it appears we're in a trading range. The broader markets is what you would like to track, and you'd like to see more of the same, with the mid and the small cap indices outperforming and higher number of stocks advancing than declining. So let's see how this goes.
It was a good day for the broader markets yesterday. Key indices up nearly 1%. Today, what's on tap is the Apollo Hospitals Grasim numbers. You've got the US FOMC minutes. And as Prashant said, NVIDIA's numbers will be tracked closely. Expectations are high, 80% plus revenue growth, 130% plus growth on the profitability. But let's get back to the updates from West Asia. US President Donald Trump says the war with Iran will end very quickly. Addressing the annual congressional picnic gathering, he added that a resolution would push oil prices lower and emphasized that preventing Iran from obtaining a nuclear weapon remains a priority. Listen in.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. This should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down. But even with that, the stock market's at an all-time high. 2.5 months ago, we hit the best numbers that we've ever hit as a country. Jobs, the best. Everything was the best. Stock market, the highest. And I called my people in. I called them in. I said, congratulations, everybody, but we're going to have to make a little journey down to a place called Iran. We have to stop them. They have nuclear on their mind, and we're not going to let them have a nuclear weapon. And we've done a hell of a job, and I think we're going to be finished with that very quickly, and they won't have a nuclear weapon, and hopefully we're going to get it done in a very nice manner.
Okay, that's Donald Trump for you. Let's invite Adrian Mobat, investor Hong Kong. SAR joining us on the show. Adrian, thank you very much for joining us. Let me begin with the big surge that we're seeing in global bond yields. The 30-year yield in the US at a 19-year high, very high yields in Japan, France, Germany. And in a way, it's unsettled the equity market. So far, there isn't panic selling, no large selling. But what is it indicating? We've got about a 35% chance of a rate hike towards the end of this year, just as Kevin Warsh takes charge as the Fed chair. What's your assessment of the rise that we've seen in gold prices? Bond yields.
Inflation is usually the biggest threat to equities. You know, when inflation moves higher, you're going to get tighter monetary policy, you're going to get higher discount rates. So the tighter monetary policy means less growth, less earnings growth, and the higher discount rate means that P multiples compress. So the market should be anxious about this. The first thing to look at is bond volatility, and we are seeing the MOVE index moving higher quite quickly, not quite at the peak we saw just at the start of the Iran war. But I'm turning quite cautious on global equities because of what we're seeing here. Now, if we think about the inflation dynamics, the headline data is extremely poor. Poor inflation is also poor in most countries, US at around 2.8%. If you look at two-year yields at the beginning of this year, they were around 3.6%. They're now up to 4.1, which is clearly indicating that the risk now is for a tighter Fed policy, not an easing in Fed policy, which was the general consensus at the beginning of the year. Equity markets are high. It is important, though, to look at the details there. The equally weighted S&P didn't make new highs more recently. It's been a more narrow market. Since the start of the Gulf War, the average semiconductor stock is up about 25%. Similar sort of move in tech hardware. You've only got 3 of the major subsectors up since the start of the war with Iran. If you look at the average consumer discretionary stock, it's down by about 13%. So we are within the markets already beginning to see the details of the anxiety for investors. Now, if I go back to the semi story, look, the earnings from these companies have been incredibly good. It looks like a very tight market in terms of supply of semiconductors and hardware relative to CapEx. But then this is now reflected in the share price after very dramatic moves. So I think investors should be cautious until we get some resolution here. Now, you've all heard of the taco trade. The new trade is the nacho trade, which is not a chance Hormuz opens. And at the moment, it's really difficult to see any common ground between Iran, the United States, over what to do with the Straits of Hormuz. It's too much of a point of leverage for the Iranians to quickly give up on it. And so I think there is a risk that we go through the summer months, start to see more and more headlines of rationing of refined products, textile companies having to shut down production because they can't get polyester, plastic supplies interrupting manufacturing because key components are not available. So I think it is a time to be cautious, and the bond markets are raising the flag.
Yeah, but you got to be cautious on things that have done exceedingly well. Adrian, good morning. India has not done well. I mean, it's not done. It's been one of the big underperformers in that sense. But it's a tough situation, right? I mean, the currency is 96 past 96, and now. And by the way, we got to 96 without any big strengthening in the US dollar, and at 96 plus. You got yields which are starting to move higher and the dollar which is starting to strengthen a little bit. So, maybe there is some buffer here because we've already sort of lost quite a bit. But how do you assess the situation for India?
I think there's arguably a technical buffer in the positioning is weak with international investors in India. But I don't see a near-term change in the challenging fundamentals. So the challenging fundamentals are, a deteriorating current account position, real pressure on the Indian consumer because of prices. And when we think about the situation in agriculture, and this is the global issue, today's agricultural prices are yet to be really impacted by what's going on with the closure of the Straits of Hormuz. It's the crop that comes out in the third quarter of the year that we need to start to be concerned about because farmers couldn't either get the diesel or couldn't afford the diesel to run their equipment, and they couldn't afford the fertilizer. And so the risk is that the pressure on the EM consumer that is more susceptible to energy and food prices actually increases as the year moves on, unless there is a resolution of the Strait of Hormuz closure.
Hi, Adrian. Good morning. Good to see you. Well, the FIs have been selling even the Korean market, the Kospi. And the Kospi has pulled back 10% very, very swiftly. But that market went up one way, so, didn't require any big reason, though that strike at Samsung and the other factors are weighing down there. What's your take, though? Why are they pulling out this money? Are they redirecting the money to some market? Wishful thinker would say, hopefully it comes to India because they've been selling India so much. But what is your gut? Where does the reallocation happen to out of the Kospi?
Yeah, I think a 10% pullback after such dramatic rallies is relatively modest. This is a high vol market these days. If I was trying to explain it, it would be back to the comments I made earlier on bond yields. So as bond yields move higher, you tend to see long duration tech stocks being hit by that. So, a little bit of profit taking in a market that really has driven EM performance year to date is probably quite reasonable.
No, you're absolutely right. Let's just put up I think you gave us a headline, nacho trade. We should put the nacho trade at the bottom of the screen. Not a chance, Hormuz opens. That's a nice one. It's painful, but it is what it is. Adrian, just a quick word on the question of what we can do, right? There's been a fair bit of talk around it. So maybe some firefighting will be required because rupee falling currency can be a buffer as well, as many have suggested. But like an out of control falling currency then becomes a problem in itself. So you've got to maybe do a little bit of firefighting here. But, to attract more dollars into the system. But if rates in the US are going up, that becomes doubly difficult, isn't it? Because it becomes very expensive then to attract those dollars.
Yeah, it is. It's a very tough situation. So it's reasonable for EM governments to want to help their population deal with this shock, particularly if it's a temporary shock. But that adds to the fiscal deficit at a time that local yields are having to rise out of reflection of rising global yields. And if you already have weak momentum in your currency, that can often put even more pressure on the need to have a higher interest rate differential. And so this is a very unpleasant squeeze. And I think while this unpleasant squeeze is going on, it's going to be difficult to encourage significant foreign capital to come into the Indian market.
So, Adrian, when you're cautious on global equity markets, turning cautious, what exactly does that mean in terms of downside from here on? Particularly when we look at emerging markets or even top down from the US markets, if you have a view, what's the extent of repricing we should see?
Yeah, so I think we could test the lows that we were seeing in late March, early April, with the move that we've got in bond yields. at the moment, I'm struggling to see the drivers of equities going higher. We've already had a very good results season for the tech space, and that's been reflected in share prices. The outlook looks much more one of a downgrade in GDP growth, and therefore possibly a beginning of a downgrade in what has been a relatively positive earnings revision cycle for the US equity market. And so I think it's the US equity market perhaps leading other risk assets lower.
Yeah. So if you were a global investor, where would you hide?
There's nothing wrong with cash, and it's probably US dollar cash. There's always a great danger when you see a risk-reward environment deteriorating. You think, well, I need to find something else to buy. Well, maybe the best thing is to sell the asset that you think might be going down rather than going up. And if that sits in cash yielding 3 3/4, that's probably okay. It's better than assets that's falling in value. But you think about cash being at the short end. You don't want duration at this point in time. Now, we might see yields spiking even higher. We did go above 5% on the US 10-year yield. UK gilts are already through the 5% mark. You made a comment in the introduction of how 30-year bond yields are at a multi-decade high. At some point, I think I'd probably look for a bit of duration in the US bond market if 10-year yields move above 5%. And I think that's where you would start to put a little bit of risk on in taking on some duration yield when a yield curve is now steep enough to do that before necessarily jumping straight back into equities.
Well, great conversation, Adrian. Thank you very much for joining us. And, you've prepped us to be a little cautious and be a little wary. Bond investors are being wary, and they're not jumping back in yet, maybe at higher levels, as you said. Thank you very much for being here on the program. Okay, all right. Well, let's just quickly run you through what's coming up here on the show. So we'll have 8:35, Harshit Kapadia of Elara Securities with us to talk about BEL's fourth quarter numbers and the overall outlook on the defense sector. 9:20, Sanjay Parekh is a market master of the day. Nilesh Sathe, former member of IRDAI, will join us to reflect on comments from, a top voice in the insurance space. Pranjal Bhandari of HSBC will be with us at 9:40. Macro is very much in focus. We had, a discussion going yesterday morning as well. So Pranjal does that for us today. 9:50, the management of rights talks to us about fourth quarter numbers and outlook. And towards the end of the program, Lata is back. So she speaks with Citi, Samir and Chakrabarti on the rising pressure on India's macros.
The time to slip into a quick break. We've got a lot of stock-specific action tracked tomorrow. We get to that in just a bit in our special Top 10 segment. But I highlight a few of the stocks. We're looking at Hindalco, BPCL, Mankind Pharma, Healthcare Global, Hatsun Agro, Godavari Power and Ispat, as well as, Ask Auto. All of them will be reacting to positive news flow. On the flip side, PI Industries, Orkla India, as well as Z Enterprises will be reacting to negative news flow. Take that break, come back, get into further detail on all of those names.
Welcome back. Let's talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. But Nigel, let me begin with you with Novelis's numbers.
Well, that's right. Let's focus on Hindalco. That stock could react positively because results of Novelis improved on better scrap spreads, though there were some one-offs. The total FRP shipments came down by close to around 12%. That was hit due to the Oswego fire. However, the adjusted EBITDA came in at around $450 million, with the EBITDA per ton at around $544 per ton, as it was impacted by the negative $50 million odd from the Oswego fires and another $27 million due to the tariffs. But that was offset because they got $41 million owing to that insurance, coming in from the floods that they saw just in the past year or so. There were two problems, though, with the numbers, besides a better-than-expected operational performance. One is the fire impact. Now they're talking about the total free cash flow impact of around $1.7 billion. That's higher than the $1.3, $1.6 billion they were talking about earlier. And the second factor is the net debt to EBITDA. That rose to a 23-quarter high of around 4.1 times odd. So that's a bit of a niggling worry because the debt number has swelled up as well. On the plant-specific guidance, they're saying the New York plant will restart in a couple of weeks. That's earlier than what they spoke about earlier. And the Bay Minette plant, that remains on track to come on stream by the end of this calendar year. On the guidance, they expect to be free cash flow positive by the end of FY27. So that's good to hear. So an improved performance, a couple of other factors weighing, but going with a tinge of green on this name for today. Hopping across the Sonal, though, BPCL came out with a set of numbers. Morning, Sonal, how are they?
The numbers were better than what the street was working with, like HPCL and IOCL, because of high inventory gains in the refining segment. Revenues came in at 1.2 lakh crore rupees, lower than the poll. However, EBITDA came in at 10,061 crore rupees. This compares with a poll of 6,980 crore rupees. Margins accordingly higher at 8.5%. Profits was lower than the poll at 3,192 crore rupees because there was a 4,000 crore rupee impairment loss this time for one of the subsidiary that the company reported, and hence the profit slightly lower than what the poll number that came up with. No GRMs were reported in the press release, so we'll have to quiz the management on that in the conference call. However, they did see a marketing inventory gain as well of around 1275 crore rupees, which compares with around 500 crore rupees. There was a huge forex loss as well, around 1,000 crore rupees versus 45 crore rupees on a YY basis. But again, these are backdated numbers. These companies have taken a price hike now. They're still making 750 crore rupee loss per day in their marketing segment. So the future outlook really depends on any further price hikes if they take. That is something that could lower their losses in the marketing segment.
All right, Sonal, thanks very much for that. So that's BPCL for you, Mankind Pharma and HCG in focus. Ekta is here with those. Ekta, morning.
Morning. Well, I'll start with Mankind Pharma. Good numbers. Revenue was up around 12%, which was in line, but there was a better operational performance both year on year as well as Q on Q. So the margins improved and the profit was aided by this better operational performance. So the domestic business, ex the consumer health business, was up around 13%, but the consumer health business was up around 19.8%. So good growth coming in there, and the exports business was up around 4.2%, but that's a minority as compared to the domestic and the consumer health business. HCG, good numbers, so revenue up around 11.5%, margins almost 19%. The West region was up 13%, South was up 9%, East was up 8%, international revenue, which is the Kenya operations, was up 39%. The average revenue per patient was up around 2% for the company this time. The company is also exiting their non-core fertility business, which is their Milan fertility brand. They'll be selling it for around 37 crore to Invigia Healthcare Fund, which is basically owned by the promoter.
Thank you very much for that. PI Industries. Ria joins in to tell us how the numbers look. Good morning.
Well, good morning. It has been a weak set this time around for PI Industries. Overall, for quarter four, the numbers have been below estimates, and this time around a weak quarter was expected compared to a relatively difficult a year ago base for the company. Revenue has declined by around 12%, in line with the estimates that the street was working with. EBITDA declines by 26% versus estimates of a 19% decline, and net profit also seeing a steep decline of 39% versus estimates of just a 23% decline. Margins have also contracted by 400 basis points to just 21.5% versus the estimates of around 23% margins. And even if you look at the full year performance for FY26, that has also been quite weak. Revenue and EBITDA have declined in line with estimates. The adjusted net profit also seeing a decline of around 27%, and margins have declined by 200 basis points to just about 25%. But this is in line with the guidance that the company had given, and a favorable product mix this time around has supported margins. In terms of the segments, agrochem exports have seen a decline of around 19% on a year-on-year basis, with volumes going down by nearly 14% due to a high base effect, and also the overall contraction in the global agrochem industry. The domestic revenue has also declined by 7% for the company this time around, with volumes going down by around 1%, although the pharma revenues this time around have grown by 40% compared to the previous year, and this segment contributes to nearly 6% of the total export revenue of the company. In terms of the outlook for FY27 on the domestic front, the company has said that increase in input costs due to ongoing geopolitical tensions will lead to further pricing pressure for them. On the export front, they remain cautious for the second half of FY27. However, overall, they have said they do have a positive outlook on the overall company's performance for FY27.
Okay, all right. Thanks a lot for that, Ria. Hopping across to Mangalam. He is here to tell us about two stocks, Hatsun Agro and Okla. Hey, Mangalam, morning.
Good morning. So let's start with Hatsun Agro. It's a good set that has come in. Why do I say that? Because, revenues have grown 15%. And remember, across the dairy industry, this time procurement prices were higher. So as a result of which, this company too faced gross margin pressure, which came down from 30% to about 27.8%. But their own cost efficiencies meant that the EBITDA margin compression was limited to just 90 basis points as against 250 basis points gross margin compression. So EBITDA actually grew 5%. And though the margins compressed, not as much as the gross margins. Add to that, the company improved their balance sheet. So finance costs came down by about 15 crore. And the net profit as a result of which grew by 18%. So going with green on Hatsun Agro. Orkla, however, soft revenue growth. Volumes just grew 2.2%. And the EBITDA, as the company says, impacted by West Asia crisis and higher investments that they are currently making. So on a reported basis, the revenue grew about 5%. The EBITDA grew just by 2%. Margins compressed by 50 basis points. But importantly, the reported basis net profit looks like it's a big jump from 35 crores to about 73 crores. But remember, same time last year, there was a 33 crore exceptional loss. So you add that back and the net profit jump is not as much as the reported numbers do indicate. In the segments as well, it was just a little over 6% growth coming in for both the spices as well as the convenience food segments. Spices were impacted by weakness in Kerala as well. So going with red on Orkla and green on Hatsun.
Thank you very much for that. Sudarshan joins in with some stocks which are in the news today.
So we started with Godavari Power. It was strong operational numbers. Margin has come at highest levels that we have seen in last 3 years. Revenue was up 10%. Margin has increased by 560 basis points to 27.3%. Even guidance that company has given for FY27, especially for the volume, is looking strong. Iron ore mining volume growth is seen at 23%, and iron ore pellets volume growth is seen at 40%. Ascoto, I'm going with mild green because revenue has seen a double-digit growth. It was up 35%. EBITDA has seen an increase of 31%. Margin, though, has come down by 40 basis points to 12.1%. Revenue is also aided by pass-through of increase in alloy prices. And for FY27, company is saying it will continue to outperform the industry, and growth in two-wheelers is expected to continue. For Z Entertainment, I'm going with red because core business profitability remains weak. Ad revenue growth was down 4%, while subscription revenue has seen an increase of 4% YOY, and ad revenue was down in March because of West Asia crisis. On the reporting basis, company has reported EBITDA loss due to a change in estimate for premium movie rights, but adjusting for that, adjusted EBITDA was down 51% YOY at ₹140 crore.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Hindalco, BPCL, Mankind Pharma, Healthcare Global, Hatsun Agro, Godavari Power, ASK Auto. Stocks with negative news flow are PI Industries, Orkla India and C Entertainment. Let's talk commodities now. Manisha is joining us with a complete roundup of all the action. Hi Manisha, good morning.
Morning. Thank you for that, Rima. I'll start with the crude oil prices, where we are trading back above $111 a barrel. This is as the U.S.-Iran war enters 12th week, and the U.S. president threatens to resume military strikes on Iran if it fails to accept the U.S. peace terms. We also do know that there are certain reports suggesting that the NATO is weighing plans to escort commercial vehicles via the waterways if the route remains blocked beyond early July as well. So various statements and various events stated in In the meanwhile, you also are looking at the U.S. inventories in the previous week declining by 9 million barrels versus an estimate of 3. So that is also something that is supporting the prices. So while the energy and heating oil and gasoline prices are all trading on the higher side, the metals have seen a decline for yet another session. Gold fell 2% overnight. It's trading at a one-month low. Silver fell 5% in the overnight market, and copper futures are now trading at a two-week lows. There are concerns on rising inflation and interest rates. There's a sharp increase in global bond yields, and then the China retail sales, industrial production, all of that data coming on the weaker side is also weighing onto the markets.
All right, Marija, thank you very much for that. We'll take a quick commercial break here. Up next, Harshit Kapadia of BLS Securities with us to talk about BEL's fourth quarter numbers and the overall outlook on the defense space. Stay tuned.
Welcome back. Hope you're having a good morning. Well, let's turn our spotlight on the defense sector. Bharat Electronics reported a strong set of numbers yesterday. To discuss this, as well as the other stocks in the sector, we're joined with Harshit Kapadia of Elara Securities. Hi, Harsha. Good morning. Good to see you. Well, let's talk about BEL first, and then I noticed that you have a good upside on solar industries, as well as you say, it's firing on all cylinders. BEL first. What's your view on the stock? It came out with a set of numbers closer to the end of trade yesterday. Your view on the numbers and outlook from here on?
I think the numbers were largely in line with our estimates, except the margins came much positive than what we were estimating. The outlook for BEL continues to remain strong. We still expect an order inflow based momentum growth of 25,000 crores even for FY27. There is one large order for QR SAM worth 30,000 crores is expected to be announced in first half of FY27. Since it's a large order, that's why there is a CCS committee approval which is required, and that's where it is pending. So once the meeting happens, we'll see a large order coming to them. The revenue run rate will also be upwards of 15% at least over next 2 years is what we anticipate, because they have a very strong order book of 73,000 crores. With that, large part of that order book still remains to be short cycle orders, which needs to be executed in less than a year's time. So that gives us a very confidence in terms of revenue growth momentum being there, though the base remains to be very high. So we are cognizant of that, but outlook remains to be strong. But it remains to be the most expensive defense PSU stock in the entire basket. And I think the valuation will remain to be expensive on the PSU space.
So Harshit, the conference call for BEL is today, 4 o'clock. So in terms of guidance, you're saying 15% guidance is what the street would be happy with for BEL? And on margins, what is the number that you expect?
So yes, I think Street will be happy with the 15% guidance. If they up the guidance, and given the history of Bell, they've always been conservative. So if you look at the full year numbers, they have done somewhere between 16-17%. So they guided for 15%. So the management idea is always been to outperform their guidance, and so sometimes they also maintain a lower set of guidance. So that's one point. On margins, we think it would be somewhere in the vicinity of 28%. Probably a 30% margin would be a little bit difficult at this point in time, but 28% is easily achievable by the company.
Okay, so 15% revenue guidance with the potential for outperformance, and 28% margin guidance is what you expect from BEL later today. But you said valuations are expensive. So if the company guides for this, and you know that typically they are conservative, how would the market react? What are the valuations and how would it compare with peers? If you could just share the numbers with us.
Sure. So in terms of valuation, they are at around 36 times in terms of my FY28 earnings in the defense PSU space. Hindustan Aeronautics trades at around 27 times. Bharat Dynamics trades at around 33 times FY28 numbers. So in terms of valuation, it is expensive. So, people would add to it, but not in a great quantity unless they raise their guidance either on order inflow front or on revenue front. So those are two key things to watch out for in the call today.
Okay. All right, Harshit, let's talk about the other stock, Solar Industries. What a story that's been, right? Particularly the defense vertical. I was looking at a few numbers. If I got it correct, I think 11 years ago, they did around 10-11 crores from the defense vertical. And in the next year, they're going to do 4,500 crores from the defense vertical. Now, that's some execution from being just a pure explosives company to diversify, scale up the international business, and the defense vertical as well is very good. However, valuations are on the elevated side. What's your take on the stock? You believe that they're still firing all cylinders and you would still be interested?
You are absolutely right with your numbers, Nigel. And yes, we are still positive and we think they are firing in all cylinders. So if you look at global market as well as Indian market, what we are hearing is that there are 4 products which have been used extensively in the war which has happened. First is missile rockets, second is drone, third is counter-drone system, and fourth is ammunition. If you look at post-Operation Sindoor, these are during Operation Sindoor also, these were the major 4 products which were used. So there is a very high demand globally, not just in India for these products. And in India, in terms of modernization, in terms of quantities that is required, these 4 products are very less in India. So there is a huge domestic growth which is coming. Plus, there's also a global growth is coming. And Solar is the only private sector company that we found is completely aligned to these 4 particular products. So like they already have on the defense side, the 4,500 crore number which you mentioned, they already have in the order book Pinaka rocket. They are already executing drones, which is loitering munition, Nagastra. Bhargavastra is a counter-drone system which they are in the final stage of getting approvals. And ammunition is a factory which they soon will be commencing with 155 mm cells. So that is something where we like the stock, though it is expensive.
Okay, and your target price is 21,290, so that's a good 17-18% upside. Is that your top bet right now in the entire defense pack? And talk to us about HAL, because I remember HAL, it came out with the numbers maybe a week back, but it was a disappointing set of numbers. And the company even missed the provisional guidance that they had given a month prior. So what exactly happened? And are you in a way sensing that execution has been lacking? Like even Mazgaon Dock, some of the orders got delayed. If you want to broadly comment on HAL and if we are seeing any delays in orders across the board.
So on the private defense side, Solar Industries remains to be our top pick without any doubt. Specifically on Hindustan Aeronautics, so the revenue numbers were already out. So on revenue terms, they surprised positively. However, on margin, there was a little bit of a mess. But the negative part on the commentary came when the Tejas delivery was postponed to August-September as far as management is concerned. So that was looked a bit on a disappointment side. And so that was a major disappointment. So Tejas, they expected something to get delivered in FY26 at the start, but things did not turn out. Now in FY27, they are promising close to around 15 to 20 numbers of delivery in this financial year. So once the Tejas delivery starts, I think that's where you will see the stock will again go back to its original levels. And that's probably one of the reasons why we have upgraded Hindustan Aeronautics to buy at this point in time.
And the target price here is?
Target price here is 5,500 to approximately.
Okay, got that. Any other stock that you recommend? Solar, HAL is upgraded. Any other? You used to like BML also.
Yes, we still like BML. So that comes under cap goods. So so BML we still like. So this quarter is looking to be decent, but we think the second half of FY27 is where the real story of execution will play out for BML. It has a very strong order book of 17,000 crores, out of which the major order book is coming from Metro and Rail. And large part of that is going to get executed in next 2.5 years. It is Bangalore Metro, Chennai Metro, and Mumbai Metro, all three put together. So that's where the revenue growth momentum is going to see. Addition, defense is going to continue, and there are some large tenders both on defense and on rail and metro side, which are likely to be announced in FY27, where one of the beneficiary would be BML.
Harshit, just two more areas. I don't know if you've you track shipbuilders morning. Anything you like there? Lots of action tie-ups with foreign governments for capabilities, etc. There, you've got a few listed.
Yeah, so we cover GRSC, but we are sell on GRSC because we think there's a peak in the cycle for GRSC. But if somebody has a long-term view, looking at the commercial shipbuilding, then this is the sector to be looked at. And in this particular space, we like Cochin Shipyard and then GRSC in that order. Cochin being it's part of the Ministry of Shipping, and if you look at the tie-ups which are happening, as you rightly pointed out, Cochin has been the front runner of these tie-ups. So a lot of commercial shipbuilding tenders are already out, and we see these are being largely awarded to specifically defense PSUs, and Cochin being one of the major ones here, followed by L&T and Swan on the private side of shipbuilding.
Thank you, Harshit, for joining in. Great conversation. We'll slip into a break. On the other side, Deven Choksi will join in for some fundamental stock talk. Stay tuned.
Welcome back. We got about 13 minutes to go for the pre-open session to kick off. We done 200 on the GIFT Nifty. That's the indicative open. Hormuz is here with the big movers yesterday and the volumes there as well. Hormuz, take it away.
Morning, Prashant. And of course, the one sector that has been keeping the market in check so far has been the IT sector. And it was the moves across the board yesterday, be it large cap IT or mid cap IT, Infosys, TCS, Coforge, all of them doing very well. And across the last 2 days now, all of them are up anywhere between 10 to 12%. And if you take a look at the options as well, yesterday, their call options premiums were up anywhere between 60% for TCS to as high as 200% for Infosys and for Coforge as well for their most traded options. Now you take a look at the volumes, Infosys, and for all of these three names, the volumes in comparison to their 20-day average were anywhere between double or triple that average number for TCS as well. Same is the case for Coforge. Now for the delivery bit, Infosys had almost 70% of their total traded volumes marked for delivery yesterday, and that too was almost 3x higher than its 20-day average. For TCS, close to 55 lakh shares, the 20-day average is only 20 lakh shares, and for Coforge, just above its 20-day average, but was higher nonetheless. Now, a stock that has been declining over the last couple of days has been Jain Resource Recycling, and that's a recent listing. And the stock was down 18% on Monday, was down another 16 yesterday. There's a 2-day fall of around 32-33%. Now, if you take a look at the volumes as well, now in comparison to the average volumes of around 33 lakh, the volumes yesterday were around 2.5 crore shares, and in comparison to Monday too, the volumes were more than triple of what was traded on Monday. Now for both of these days, 26% of the total shares that have been traded were marked for delivery. Even in yesterday's session, 62 lakh shares were for delivery. The 20-day average is less than 9 lakh shares, so it's almost 7x compared to their 20-day average. And lastly, Apollo Micro, now that was one positive earnings reaction that we saw yesterday, the biggest single day gain in over a month. The stock is up in 4 out of the last 5 sessions. Volumes were the highest on record. There was over 11.5 crore shares traded. The 20-day average is only 1.2 crore, and 10% of those were marked for delivery. So around 1.2 crore shares were marked for delivery as well. The 20-day average is just over 31 lakh shares, and in fact Thursday's turnover was 85% of its free float market cap, which is just around 4,500 crore rupees, and it was the second most traded stock in the market yesterday. And from the March 30 lows, from where the markets also began the recovery, the stock is up almost 90%.
Oh, got it. Okay, all right. Thanks a lot, Hormus, for joining in and giving us all of those details. Well, let's get in Devin Choksi, MD at DR Choksi FinServe, who joins us on the show. Hi, Devin. Good morning. Good to see you, Ben. Let's focus on Hindalco. The stock has had a great run, right? I mean, from 700, 750 all the way to around 1,100 rupees odd, and it's pulled back a little bit. Now, the operational performance actually improved, but there are some one-offs there because they've got some insurance for the fire that was seen into 2024. They've also got that negatively hit because, of the fire and also the tariffs. Put everything together, operational performance is good. Problem is debt, net debt to EBITDA, moving up as well. What is your view on Hindalco at this 1,050 level?
Hey, Nigel, good morning. Well, I think no denial of the fact that overall the environment remains quite conducive for the metal commodity, in particular white metal commodity in particular. It remains quite conducive from the business perspective. On one side, we have got a firm commodity prices because of the demand traction that we are seeing from the consumer segments. Particularly, I think now the aluminum's major consumer segment is also emerging very strongly. Could be in the area of even the data centers and ultimately, I think other industries, including the aviation, including the automobile. So from a perspective of looking at, I think, a large level of growth, the demand scenario likely to remain robust. On the other side, the captive power sources, I think, are emerging strongly. So that is where probably I think we are likely to see the drop in the cost of the energy, and that's what is going to be margin positive. So structurally, I guess the business is looking absolutely convincing. Maybe I think the stock prices have run up and probably they are fairly priced at this point of time. So one can't argue for buying fresh in the portfolio. But being the commodity nature, if one gets the opportunity during the corrective phases in the market, would be a good upside move for 15-20% in a year time. Is distinctly possible from the lower levels.
Devin, just in terms of positioning right now overall, I mean, how are you looking for trades here? Trades, or I mean, investing is one, but what are you really doing? Or just sort of, in another context, Adrian Movat was with us in the morning. He was saying maybe cash is a good idea. Just watch. Or what's your sense? Incrementally, I'm saying, what you own, you own. Nobody goes all cash, but just incrementally. What's the thought process and positioning like?
Yes, Prashant. Good morning, and very valid point I think to answer for. The important aspect that we see in this particular quarter, some of the good quality companies are likely to get affected because of the adversity into the business, particularly on the input cost side and logistics side. And as a result of which, I think the market might possibly give an opportunity at lower levels in some of the good quality stocks. Maybe power ancillary sector, maybe banking sector, some of the large NBFCs. I think they are typically showing the character of giving you, I think, the advantage in form of lower price because of the overall condition in the marketplace. Should that happen, I think it's going to be a good buy opportunity. In my viewpoint, irrespective of, I think, whatever is happening around, if the valuation comes down and that is becoming an attractive opportunity, I would certainly think that I think buying would be more appropriate. So appeal to June quarter, maybe in July to September quarter would be the quarters in which I think one would like to consider on buying and building the portfolio at lower levels, particularly good quality stocks where the resilience is extremely high as far as I think the business opportunity is concerned and the profitability is concerned.
Got it. Devin, stay with us. For the time being, we take a short break. We come back. We'll continue our chat with Devin. Our technical experts are also waiting for us. Stay tuned.
Welcome back. There's 18 minutes to go for the market open to come up. Well, let's just put up the Nifty IT index from yesterday. There's 4 minutes to go for the pre-open as well, so you'll see the rate and how we left off. 3% higher, was up more, the Nifty IT index. And in the last two sessions this week, the Nifty IT index has gone up. It was 6%, it's now 5%. But 5 is not bad. 5%, the index that is. And of course, Infosys, TCS, HCL Tech, Wipro, these were some of the largest gainers on the Nifty yesterday. And of course, in the broader market, Coforge went up sharply, KPIT, and the entire list, IT did very well. But this is, of course, after last week's brutal 6% fall that we had for the Nifty IT index. So there's a bunch of reasons we outlined yesterday. But Devin is with us with just his perspective on it and whether this is a bounce. We've seen bounces before and kind of, how to think about it. stocks have come off the lows. I mean, Coforge fell to under 1,000 rupees. It's back at about 1,400 plus. I'm talking about the more like names, Coforge and Persistent, etc. But your thoughts, Devin?
I think excellent opportunities coming along as far as some of the good quality stocks are concerned, particularly in the mid-tier IT companies, where they are typically, I think, using the AI as an enabler for delivering the project faster. And in the process, I think commanding relatively better margins also on every contract. I get to see, I probably, I think, also observe that in some of the large IT companies, under the discussion with the management, we find that their new contracts, that means their AI-enabled services that they are adding into, probably are delivering faster results to the customer, in turn, I think, better profits to the companies. So in my viewpoint, everything is in price. Today, the prices have come down, and I think opportunity is remaining, I think, as high as one would have think. On the contrary, I think opportunity is becoming much stronger. So probably, I think it's a contra-buy opportunity in some of the good quality frontline IT companies. Selective and gradually one should be in the portfolio of these lows.
Do you want to name some IT names?
So we continue to like the likes of Tata Technology, KPIT in the mid-tier space, and I think among the larger ones, TCS looks, I think, more convincing at this point of time.
Got that. So Hormus was just telling us about some stocks where there is a fair amount of momentum. IT, of course, was one, but JN Resource Recycling, on Monday, it was down 18%. On Tuesday, it slipped close to about 16% and very, very large volumes. So, is there a view that you have on JN Resource Recycling? And the other one is Apollo Microsystem, where the stock has been seeing a lot of upward momentum.
So, Lima, I think, unfortunately, don't have any view on this company. It's not having coverage either.
Okay, all right. Devin, let's talk about Grasim then. Grasim will be coming out with its set of numbers. Interesting set of numbers, not just because we look at, smaller part of their business, the VSF business and the chemicals business, but also the paints business. Is it gradually moving towards profitability? And is there some inorganic growth as well? Remember, most of its value comes in from Ultratech Cement. But what's your view on the name on Grasim added on this price of around 2,800 rupees odd?
Well, I think the key trigger would be coming in from the paint business. How soon, how fast, I think this particular business is contributing into the books, I think is something which one will have to watch out for. So they have indicated in past that it's a long haul. It's not going to be so soon, so fast. But we would like to see whether the company is heading into the break-even plus kind of a situation. If that does happen, then certainly I think one can expect some amount of re-rating. Not completely sure about, I think, the volatility involved into the VSF and the chemical business at this point of time. Though the March-ended results are likely to be much better, but the fact remains that I think we are in the new quarter already, new financial year already, and that's where the volatility into the input cost, I think, is going to be affecting many companies, and that's what we would like to be watchful about it. So once I think management commentary is heard, probably I think that will be a better time to take further views on the businesses of the company.
State Bank of India continues to grind lower. If we could pull up a fortnightly chart in State Bank of India, it had one sharp sell-off post the numbers, but after that, the stock has been grinding lower. And now at about 930, pre-numbers, it was closer to 110. At what point, Devin, does SBI become a buy for you?
Yeah, I guess I think it's an opportunity which has already come along, and I think it should be an accumulation stage at this point of time. Any further fall due to the nervous market condition, I think would be a further buy opportunity. But as of now, I think one could accumulate the stock. We see the downside risk practically protected because of the valuations are far more comforting at this point of time. Even if one has to assume the higher amount of interest scenario, still we believe that I think everything is now factored into the price. So buying opportunity is strong, a large book at the same time, and I think higher amount of traction that is being seen. It is in the corporate borrowings, corporate lending by the bank. We believe that I think this is good opportunity probably which is coming along at the current price.
That tells you the thing, right? I mean, we put out a flash saying we've hit a record low at 96.86 and the record low is 96.88. So the direction of travel has been south, down south. And I was saying this, the move in US yields in the last 3-4, actually it's not, I mean it's yesterday, but it's also, we saw a big move a few days earlier as well. It's coming at the wrong time because it makes, you know, what we need is of course dollars, more dollars in, and dollars become more expensive as US rates reprice higher. That's problematic in that sense. So almost 96.90 now on the rupee coming through. Maybe to get a perspective from a rupee market participant, if you're able to get just a quick word in, but this is not looking all that great. 96.88, 96.88.75 or so at this stage. You know, we had Ramdev Agarwal yesterday talking about the currency, the rupee, and the oil conundrum as well. So if we have that lined up, just like to play it for you right now, and then we'll come back with a view.
We have, as you said, worst performing currency from Asia right now. But India, unfortunately, is hit from two sides. One, the energy artificially prices have just shot up by 70-80% from $60 to $110. So that's putting a lot of pressure on the current account. Second is that on top of it is the FI outflow, because for two reasons. One, we don't have AI story. In fact, we have anti-AI kind of situation in India. And of course, we have a pressure on the currency. So, and that is exerting further pressure on the rupee, because there is a sustained selling of almost $500 million every day from FI side. So, twin effect of high oil energy prices and FI outflow is putting pressure on the currency, which the regulators are finding, the banks are finding, or central bank is finding it difficult to handle at this juncture. They are allowing the free flow of the currency till the crisis is over. We have been seeing very sustained outflow out of India. One, of course, because of the very strong local buying, which is going to become even bigger as we go forward. So the government, the policymakers, they have to think in the backdrop of very strong local buying, how do we console? And my local buying is decadal in the sense that next 20 years, 25 years will become even bigger. In that backdrop, what do I do for the FIIs or FPIs so that they have a little more positive view of India? They might be having some small demand about capital gains tax. Worldwide, it is not being charged. Why we are being taxed out here? Why we are being charged capital gains tax? So whatever their demands are, I think the authorities should look at it very intensely, because it's a very changed environment.
Yeah. That's Ramdev Agarwal and Motilal Oswal with some perspective on, I mean, you know, it's all linked, right? I mean, oil is linked, rupee is linked, capital outflow is the problem, the capital account is the problem. And that sustained outflow is what Ramdev Agarwal was talking about. 96.88.50 or so is where we are at right now in terms of the currency level. You know, Devin is with us. Devin, we did talk about market positioning, but in terms of, are the equity folk expecting anything, any action? I mean, the perennial ask, of course, is do something on equity taxation and that kind of thing. But we had yesterday two economists from ICICI Bank and Kotak Mahindra Bank who said, well, the bar for doing something on equity taxation is very high, very unlikely. But there is other stuff which is getting discussed. From the equity market point of view, anything being discussed or any chatter out there?
Prashant, I think the couple of points here, maybe the taxation and other aspects, I think may have its own short-lived outcome as I see it. But more importantly, I think something to do with fixing the derivative market. Derivative market has been, I think, at the root cause of the problem as I see it. Significantly large amount of volume is basically pushing the underlying equity prices significantly in an adverse situation like this. I guess I think the views like pegging the derivative market exposure to underlying equity portfolio should be the ideal approach, I think, that one can possibly talk about, I think, to the regulators. Should that happen, then quite possible that on one side, I think they'll start building the underlying equity portfolio while taking the exposure on the derivative side. Today, the exposure on the derivative side is being taken, I think, with other collaterals. I think that's where probably, I think, the larger problem is. And that is also probably the root cause of having the currency-related situation. that frequent flight is taking place of the currency. So in my viewpoint, I think this problem has to be fixed. Maybe I think we have allowed too much of derivative volume in our marketplace, which requires, I think, some amount of immediate attention, particularly in a situation like this when currency has fallen so badly.
Yeah, absolutely. Devin, I just want to get a couple of technical calls out of the way as well. We are 96.91, so the pressure is kind of one way, and this is what the risk is, which is weakness feeds into more weakness. It kind of becomes a self-fulfilling prophecy. So while yes, I mean a weak rupee helps cushion some of the blow and balances the imbalance, helps exports and all of that stuff, but you got to watch it, as both our economists yesterday pointed out. 96.94. So this is moving. If you have the intraday so far, it's only just been, 8 minutes or so, you'll see what I'm talking about. We started at 96.86 and we're already within the opening few minutes of the rupee market open at 96.93.50 or so. So 96.94, I guess, is the new level, the new low the rupee has hit right now. So how fast those handles are changing, 95, 96, now you're at 97 in just a couple of minutes, a couple of days, basically. Well, Mitesh is with us, and so is Sudarshan with quick trades at 9:10. Mitesh, anything? What's on your radar?
Given the fact that the GIFT Nifty is indicating a lower start, we'll have more of sell calls. So I have a sell on Gas Authority of India Limited. Keep a stop at 159.5. Look for targets of around 150. Then DMart is revenue supermarkets, that's also on the sell side. Keep a stop at 42.80. Look for targets of around 41.70. One buy call, that's Bharti Airtel. That's a buy with a stop below levels of 1890 for targets of around 1955, 1960 on the upside. And the final sell call is Astral. Astral kind of broke down yesterday, so that's a sell with a stop at about 1500 for targets of 1350.
Sudarshan, your 9-10 calls?
Yeah, the Nifty had a narrow range day yesterday. So it's breaking down. There's a trade on the short side for intraday traders. That's for the Nifty. United Spirits is my only buy with a stop on 1215. SRF is a short with a stop above 2685. Tata Steel is a short with a stop above 215. And Nuvama is a short with a stop above 1490.
Got it. Okay, all right. Thanks a lot for that, gentlemen. Let's focus on a couple of top stocks. First, Hindalco is in focus. The stock is opening up on the back foot. Maybe it could be a market sentiment, or it could be a couple of factors like the higher debt that are weighing on. But otherwise, the results for Novelis have improved. Better scrap spreads definitely aided them. Though the total shipments, they were down by close to 12%. That was expected because the Oswego unit, it was impacted by the fire. The adjusted EBITDA, though, that came in at around $459 million, with the adjusted EBITDA per ton coming at around $544 per ton. It was impacted, remember, by negative $53 million from the Oswego fires and $27 million due to the tariffs. But it's offset because they got around $41 million from the flood insurance recoveries that was experienced in 2024. But there are two problems. One, the fire impact is now talking about a total impact on the free cash flows at around $1.7 billion. Earlier, they were talking about $1.3 to $1.6 billion. And the second factor is the net debt to EBITDA. That's risen to the 23-quarter high of around 4.1. So that's a bit of a worry. On the plant-specific action, they're talking about the New York plant restarting in a few weeks. That's sooner than what they spoke about earlier, which is good. And they've also said the full commissioning of the Bay Minette unit remains on track by the end of this calendar year. On guidance, they also said that they will be returning to free cash flow positive position by the end of this fiscal. Net, operational beat, some glitches in terms of the net debt number. For the time being, the stock opens up a little bit in the red. But the one that's taking a harder knock is PI Industries. Ria joins us to help us out with a quick analysis on that one.
Well, yes, it has been quite a weak quarter for PI Industries this time around. Below estimates on all fronts, and the street was expecting a weak quarter versus a relatively difficult year-ago base for the company. Revenue has declined by around 12% in quarter 4, in line with the estimates that the street was working with. But EBITDA has declined by 26% versus estimates of just a 19% decline. And net profit has also tanked by around 39% compared to estimates of a 23% decline for quarter 4. And margins have contracted by nearly 400 basis points to just 21.5% versus estimates of 23% margins. Even if you look at the full year performance for the company, that has also been quite weak this time around. Revenue and EBITDA declining in line with estimates, and the net profit, the adjusted net profit, also down by nearly 27%, and margins have contracted by 200 basis points to around 25%. But this is in line with the guidance that the company had given, and they have said that a favorable product mix this time around has supported margins for the full year. In terms of the segments, the agrochem exports have declined by nearly 19% compared to the previous year, with volumes declining by around 14% due to a high base effect. Domestic revenue also saw a decline of nearly 7% compared to the previous year, with volumes going down by 1%, although the pharma revenue has been strong, growing by around 40% compared on a year-on-year basis, and this contributes roughly 6% to the export revenues for the full year of FY26. But overall, it has been a weak quarter and a weak year for PI Industries.
Okay, let's just put G Vernova as well. I think there was an analyst call yesterday, and some commentary coming through on that one. Stocks up about 1.5%. So I mean, stands out when on a red screen there's some green as well. We've got first rates which will come up in just a bit from now. We can just maybe put up some of the stocks we'd highlighted from the morning. Just about 60 seconds to go for the market open to come up. So it's a broad kind of macro down move with the bond yields higher and the US equities a little lower. Rupee, of course, making fresh lows. Yeah, so it's a tough spot in that sense. BP is down about 1.5%. Of course, reported numbers. Mankind reported numbers. There's a bit of a miss there, about 1/3% higher. HCG was another one which Ekta had highlighted. Hudco and so on and so forth this morning, which will come up. PI Industries, which is highlighted. Orkla India, fairly recent listing. Z is the other one. So first rates will come up 160 odd points lower. Is the pre-open session, and we'll start somewhere around there. 23,450 on the Nifty, 23,400 on the Nifty. So about 0.8, 0.9 lower. Bank Nifty is down about 0.25%. Should not be a quarter, should be more. 1% lower, I think, on the Nifty Bank. Yes, it's down about 0.9. Mid cap index is down 0.8. The small cap index, I think, is also starting in line with what's happening in the broader other indices. So 1,260 stocks are lower and about 550 stocks are higher. So it is a little over 2:1, declines to advances to begin this Wednesday morning. The heat map should be, all red, mostly all red, except Hindalco. Nigel's Hindalco is the only green today, so holding up. On the other side, I mean, it's like BEL and Tata Steel and Nestle and Eternal and Grasim and others, which are all starting with some amount of pressure. We're down 190 on the Nifty. Rima.
Well, no place to hide this morning. It's 23,400. The sentiment has been hit on account of the persistent weakness in the Indian rupee and elevated crude prices, now closer to $111 per barrel. The top loser on the Nifty is Tata Steel with a cut of more than 2.5%. BEL is now hovering around its 200-day moving average, 1.7% down on BEL. Numbers were steady, but stock is under pressure. You can see weakness in consumer names. So Eternal, Nestle under pressure. Auto names like Eicher Motors, Maruti Suzuki. So two-wheelers, four-wheelers, weak in trade. SBI has lost close to about 1.5%. Bajaj Finance is under pressure this morning. M&M is another one in the auto pack where you are seeing softness. The Nifty Bank is underperforming today, and the problem is not just State Bank of India, it's ICICI Bank and Kotak Mahindra Bank, and both these stocks are sliding close to about 1.5%. Now on the way up, well, Hindalco is right on top, 1.5%, but TCS, Wipro and Infosys are flirting with the flat line. TCS for now is holding up in the green. Infi and Wipro are still trying to make up their mind, but it's all red, down 0.7%, and look at that advanced decline ratio. We've got about 700 stocks in BSE advancing for more than 1,500 stocks declining. So you've got an advanced decline ratio well in favor of the stocks declining. So the mood is somber.
Well, that's right, Rima. There are a few stocks, though, though they have the headline index that's down, and that rupee is a big worry out there. Moving to a 97 odd, you want that level to get defended. But let me try to pull up some of those winners. Godavari Power and Ispat, the stock opened up higher, but market sentiment is weak. And it's already a 19-20,000 crore market capitalization company. But otherwise, those numbers look good. Record revenue, record EBITDA as well. Stock's still holding with a gain of around 2%. The other one is Jai Bharat Maruti. It's a smaller name, but it's coming up as one of the top volume movers in today's trading session. It's only a 1,100 crore market capitalization company, by the way, Jai Bharat Maruti, but locked in upper circuit. The reason is that the margins have now scaled to approximately that 12% odd mark. A few quarters ago, if I look at the chart, it was doing around 6 to around 9% of margins. So the street likes that, with revenue at around 770 crores. So thumbs up out there. Karnataka Bank, that's another stock that's done pretty well in today's trading session. It's reacting to its numbers, big green tick on that one. Also pull up dredging. The stock is up close to 22% in this week, putting together even the 5% gain today. So the street clearly likes those numbers that they have delivered, and that one is up and about in today's trading session. So those are a few winners in trade today. What's losing out? Shaily Engineering down close to around 6%. Nephro Care, that stock is down close to around 6%, so big downtick out there. And Borisil Renewables as well, down close to around 5%. Net, the number of stocks advancing are close to around 500. Individual stocks doing a thing of their own, try to name a few of those winners. The breadth of the market negative, but hopefully it pulls back from here.
Well, let's PI down about 8%, right? That's a big one, which is coming through at this stage. Well, let's bring in Sanjay Parekh, who's with us. Markets are starting lower, as was expected. Sanjay is founder and CIO of Sugam Asset Managers. Sanjay, it's always great to see a smiling face. A smile gets out of smile. So, but it's a tough situation, and they say, well, out of despair comes opportunities, etc. I'm not sure we're at that stage with the prices and what the corrections and all of that, right? Because the economic damage perhaps is real. Next 2 quarters, there will be margin pressure and so on and so forth.
Yeah.
But in any case, I know that you are busy with stuff which is sort of, not unaffected, but fundamentally strong, and you continue to focus on those things. I mean, some thematic, but more single stocks across the board. So just run us through what you've been doing.
Good morning, Prashant, Nigel, and the team. So, what we've done is, clearly moved up to large cap, and anyway, our product has large cap mandate, but we moved from 72 to 83% in large cap. Second is, while we can never protect capital when in a fall, but we just said that can we try to insulate ourselves? And we were happy that from Jan fall till now, market has fallen 9%, we have fallen 3%, a little more than 3%. So the third thing is we said, okay, let's look for larger cap leaders, who are in a real dominating situation and can do better in a tough environment. So right from Mr. Mittal in Bharti or Reliance or Adani Group, we have few stocks, or JSW Energy or DLF, or Samvardhan Motherson, or Maruti, Mahindra, Bajaj Finance. These are the large holdings, and they can navigate in this journey, and it will also impact them, but it certainly will be better off. When the things do get over, you are in a far better shape. And also the larger banks, or even Zomato, which is a leader in its space. So that is our strategy, and by and large, it's worked for us, that being large cap, with leaders who can navigate this scenario and take us through this with the least damage.
Sanjay, hi. Morning. What about exporters? With the INR now at 97, are you looking at any export-oriented themes very closely? If yes, which stocks are a part of your portfolio?
So after the acquisition, and just when the Sun Pharma's acquisition was announced, we were apprehensive, but when we really heard them out, we felt very, very positive. So in pharma, we've moved mild overweight with Sun Pharma at a large weight now. This is exactly after the call we added, because we really found it very, very reasonable and accretive. without any dilution, and we didn't see a financial risk. So when we understood the equation, we really felt it is a good positive, and that is where we are pharma overweight with the inclusion of Sun Pharma. So that's where we are. Overall, otherwise, we're not tilted to exporters because IT, as you know, is more going to be more like what is a volume growth rate. And rupee will have some positive, but I don't think, meaningfully you can see significant appreciation because of rupee depreciation. It's always followed volume growth rate, dollar revenue volume growth rate. So that's where we are. We are still underweight there. And then we added a renewable space again, a little small, in a small way, Vari Energies. The near term can be a little uncertain, but longer term opportunity is where we think we are, that could be a good thing. So that is where a small addition we have done.
Yeah, absolutely. There is a large fundraise afoot, right, Sanjay? There, perhaps.
Yeah, and also near term can be a little challenging. So we started in a small way, but the long term opportunity is pretty good. They have a huge ambition of moving up to 1 lakh crore. That looks quite ambitious, but I think they have a right to win. They have got already around 6,000 crore EBITDA. They're targeting the assumption, the projection they have is around 7 to 7,500. But in 3 years from now, we were just looking at it. Can it become more like 13,000 crore EBITDA company or maybe more? And we thought that, yeah, it is. So it has a critical mass size. It's still it's classified as mid cap. So that's where we are. And globally, Chinese, peers cannot be compared because we are going to be protected for a while. And that's been a government stand. So that's where we are comfortable on valuation.
Sanjay, many believe that the earnings growth in the mid and small caps is going to be a lot more than large caps. The large cap growth could be more muted. So don't you think that is good enough to bet on small and mid caps? Or do you think because of the crisis, the elevated oil prices, the earnings growth that the street was expecting from mid and small caps is not going to play out?
Yeah, Rima, so there, see, first, these larger caps are really, so for us, it's not that they have to be leaders, they also have to be reasonably valued. So all the 16, 17 names in larger caps as a basket are like really reasonable. Our average price earning of the portfolio is 14 times on FY28. So first is where we look for reasonable growth at reasonable price in the larger cap space. In mid and small cap, the problem is, you have good names, but at twice or thrice the valuation. So there you need to dig hard. We are very, very open and we will increase our mid and small cap exposure, but at higher price value cap. And certainly we need to give, some of them can get knocked off or get really badly affected. So which are the ones which can navigate in this cycle? We certainly will look at it, but at our valuation.
Is IT a valuation issue for you, Sanjay, or it's a more business model and that kind of issue?
I think it's a growth issue. I think the longer term growth is derailed. So you could have few companies who could be benefiting. You will see volatility. You could see dead cat bounces, but we don't want to be overweight. I mean, we don't want to even cut our underweight right now. Because of rupee, they will benefit. You could see a bounce. But I think secularly, the guidance itself is suggesting lower growth rate. So it's not about us. You see the guidance given by the large, and we own it, right? So we own Infosys. But I think we will continue to remain underweight. And we don't want to preempt this AI-led contraction in revenues.
We were just chatting with Adrian Movat earlier in the morning, and he was talking about, well, the new trade is nacho, not a chance that Strait of Hormuz opens up. And this term has been there now. It's been gaining traction for the last 1 month, and the war itself is now in its 12th week. How much more pain do you think the markets have to endure? Even you said, while you relatively perform better than the downfall we've seen in the market, it's still a contraction in terms of returns. What is your own assessment for the pain? How long will we continue to just grind in this way?
Well, we really think hard on this. So let's start. First, if we did not have a war, our markets would have been 26,500 for sure. But we have this. So we have almost $500 billion knocked off on aggregate market cap. And for a pain, maybe around $60 billion if that lasts for the whole year, right? If we take broadly 5 million barrels into the maths that you all only did it so well. So $60 to $65 billion is the pain purely because of the crude. And then you could have add-on escalation. So there is a lot of damage that has already happened in market cap. And as I said, this has to last for the whole year. And then, of course, the cost of equity has gone up, rupee depreciates. So it's not so simplistic. But I really believe that in the next 3 to 5%, there could be pain, but it will throw up a phenomenal opportunity as a contra. And that's why what we are doing is we are slowly telling clients to accumulate. But with a weak Q1 and with rupee, what it is doing, we can get into a little bit of vicious cycle in the near term, which could be a 3 to 5% fall. That is possible.
Yeah, got that. We'll keep fingers crossed and hope, of course, hope for the best. I mean, you've got to stay optimistic in terms of what happens. Be careful, be cautious, and all of that. But of course, stay optimistic that better things will happen. Thanks very much, Sanjay. Appreciate you joining us on the program and talking to us here on CNBC TV 18. Well, I think what we're going to do is talk about the insurance sector now. And here is a voice right from the top of the sector. We kicked off our 5-episode series, Insuring Lives, Securing India, Insurance for All, which CNBC TV 18 and Kotak Life Insurance are presenting together. The first guest who's really kicked this off for us was none other than the IRDAI chairman, Mr. Ajay Seth himself. The IRDAI chairman touched upon lots of hot-button issues. Let's start with insurance distribution reforms, which the industry is keenly awaiting. On the distribution side, what we understand is that there is, you are working on a consultation paper, which is going to be comprehensive in its scope. As you said, you will travel with the industry in the sense that you will take feedback and then, of course, come up with what is to be done. Is that understanding correct?
That's correct. We expect that in about 3 weeks or maximum 4 weeks, we should be out with a discussion paper.
And it's going to be comprehensive and...
What we propose to do is present a good analysis of the sector as it is now, provide some sort of a framework where the distribution reform should travel, and then elicit feedback from the industry and the public at large.
The public insurance registry is being seen as a Sibyl moment for the insurance industry. Here is the IRDAI chairman, Mr. Ajay Seth, talking about what it can do, what's the aim of the PIR for the sector.
Public insurance registry. And the way we are conceptualizing it, and we are again aiming for that by mid-June, the discussion paper is out. It is a digital public infrastructure for insurance industry. We have put it rightly that what the Credit Information Bureau did for the credit market, or somewhat what the depositories and the stock exchange, electronic exchange did for the capital markets. Of course, PIR is not an exchange per se, but is a data infrastructure. This concept is not only between insurer and the regulator. First, of course, it will help a big way in the mis-selling, preventing mis-selling. It will also make a business sense for an insurer that how to underwrite better and how to prevent fraud. And for distributor, while margins may be lower, but it should mean more business.
Absolutely.
And if all three are happy, regulator is naturally happy.
Well, the IRDAI chairman also told us what he wants to achieve with Bima Sugam, substantially cheaper insurance products for customers. That was the big headline.
Bima Sugam is a platform which is co-owned by all insurers, regulated by IRDAI. This is not a platform of distributors. Two fundamental differences. At the moment, irrespective of the distribution channel, price of a product or return of a product is uniform, irrespective of what the cost of that distribution channel is. Bima Sugam seeks to do it differently because it's co-owned by insurers, the least cost, but same quality or even a better quality. Second, present products in a standard manner, but with substantive value, so that the people can buy themselves. That's the second element which brings in. So moving forward, we see it that as the first phase, starting with term life, maybe ULIP. ULIP is generally considered to be a complex product, but people in this country have learned very well what the mutual fund means. So ULIP in 2026 is not a complex product, it's a simple product. Then moving on to other life insurance product later on, but on a general insurance, starting with motor insurance and also for a health product. So that is what it means. So better product discovery, better price discovery, where insurers compete on their performance rather than letting the distribution channels compete or push products where they get higher commission. So I see it here that Bima Sugam can be a transformative intervention in terms of getting value for the customers.
What would IRDAI's role be? As you said, I mean, regulated by the IRDAI, but owned by insurers. So where does IRDAI come in with regards to the architecture you set? But in terms of, I mean, you know, where would you step in on an operational level?
See, IRDAI's role first is nudging everybody to come to a common platform. And saying that instead of competing on cost, compete on your performance. And this platform should provide standard products with good quality and at the most competitive price. So it's getting everybody together because growth of the industry to meet the economic needs or needs of that large population which we have got is possible only when there are standard products.
If I can just close the loop on Bima Sugam, do you imagine that the pricing on products on this platform, Bima Sugam, compared to I mean others where consumers transact now, etc., through various channels, but there are other online channels, etc. There would be a substantial price difference?
First of all, this is what we hear from the insurers and from the public. Today, some of the distribution channels dictate terms saying that you shall not sell, an insurance will not sell a product at a lesser price on any other channel, which is anti-competition. So there has to be a pricing flexibility has to be available to each insurer based on the cost. And that's the difference. We can walk into a mall, buy a product, it will be differently priced. We can go to an e-commerce platform and buy the same product with the same quality at a discount. So the choice has to be with the customer.
So that's a yes, sir.
Yes, of course.
The answer. So substantially, there will be a meaningful difference. That's the aim, at least.
That is what the purpose is.
That is what the purpose is. We'll catch the full conversation soon on CNBC TV 18. The IRDAI chairman, exclusive right here. The program is called as a 5-part series, Ensuring Lives, Securing India, Insurance for All. It's co-presented by CNBC TV 18 and Kotak Life Insurance. Okay, well, let's talk about this, right? And Nilesh Sathe is someone who's been part of the regulatory body, former member IRDAI, long-time watcher of regulatory environment in terms of how things have evolved. Mr. Sathe, it's good to have you with us here. So you heard it, you heard the chairman. What stood out to you?
No, good initiatives, I will say. Only one thing which I did not understand is why there are going to be only standard products on Bima Sugam. There should be all products available on Bima Sugam. This is one thing. Second is distributors dictating insurance companies that you should not pay more to anybody else other than what you are paying to me is something which is not heard of. It is heard of in mutual fund. In AMCs, there are national distributors who dictate like that. And we know that the smaller distributors, IFAs as are called, the national distributors say that whatever business is booked through us by the IFAs, you should not pay them more than some percentage which you are paying to us. This has happened in mutual fund, but not in insurance, unheard of. But maybe he might have some additional information on that. Bima Sugam is a good platform, no doubt about it. and it may be a game changer, provided the IT infrastructure is robust. Even today, not many buy insurance going online. Every insurance company has got digital online platforms which are available, but the experience is not so encouraging. The experience of Bima Sugam should not only be encouraging, but it should be different than what the present insurance companies are offering to the clients. If at all there is some technical glitch in going through seamlessly, see, let us understand who is going to be the customer for Bima Sugam. Mostly the youngsters. And the youngsters do not have patience. If at all at some point of time they find why I'm spending so much of time, the page is not moving to the next page, they give up and they will not come back again. So this has to be ensured by the owners of the platform, maybe IRDA and the insurance companies, to ensure that the IT platform has to be robust and there should not be any glitch while surfing is being done by the youngsters. Because see, if at all they do not buy online, people of 60s and 70s are definitely not going to venture into it. Initially, at least.
Yeah.
So
got it. Now, Mr. Sathe, the aim from what I could take out, right? And we've heard it from the government also. We've heard from the top finance ministry. Really, I mean, the focus is that we want penetration to go up, and I think the IRDAI seems to be working lock in step with that aim, which is insurance for all by 2047, right? That's the aim. Increase penetration, and penetration essentially. One number which was floating around is the penetration is about, what, 15%? If you look at everything?
Oh, no. It's much less than that.
Yeah. No, I'm saying if you look at new to insurance, right, as a concept. So I'm just saying that and one way to do it is pricing. And I think that came out very clearly with regards to what the chairman spoke about with regards to distribution, Bima Sugam, and of course, even the industry, Mr. Sathe, you would agree?
Yeah, I agree. If there is a substantial price difference between when you buy a product online and offline, then it's a great incentive for public to go online. No doubt about it. But to what extent it is going to be differential, that is also to be seen. If it is going to be 5%, 10%, then probably nobody would venture into it, because all said and done, insurance is a push product and somebody should be there to handhold when you are going through the buying process of insurance and also at the time of claims. So we have seen, in mutual fund also there are online platforms, but even today not more than 8%, 9% mutual fund investments are coming through those platforms.
Yeah.
And insurance is more difficult to buy than mutual fund. You really need somebody to handhold. So I'm not worried about it. It's a good, you should have more options available.
Yeah.
Who likes to buy online? Okay, let them buy online.
Yeah. No, absolutely. Point taken. So we spoke of three things, right? The consultation paper, distribution reforms, the information registry, Bima Sugam. And there are, by the way, other things also in that interview which will be played out in full later when that episode airs, which is lined up beyond this. So, I mean, it looks like we are setting the roadmap for much of this to happen. I mean, the industry will, of course, have to work along with the regulator to make this happen. But the architecture is being set. And maybe, much changed from how it was operating earlier. Would you agree, Mr. Sathe?
Yeah, absolutely. But then, for increasing the penetration, group platform is better, because like PMJJBY and PMSBY schemes which are there, which are operated only through banks, actually, they are not promoted much. Nobody makes any efforts to promote it. And insurance company has no role to play. It is for the banks to promote it. And crores of people can join through this platform directly or indirectly. So this is something which is easy to increase the penetration.
Absolutely. Absolutely. Got that. Mr. Sathe, we'll leave it there. We will talk more as that distribution paper, the consultation paper on distribution reforms starts to appear. As the chairman said, in 3 to 4 weeks, we will have that. I mean, of course, it's a consultation paper, so it gets feedback, discussions, and open to the public, etc. And then the rules will be framed.
Normally, it takes 6 months to actually
finally kind of finalize. Yeah, absolutely. Yeah. Thank you very much, sir, for joining us, and really appreciate it. Thank you. What we'll do is we'll take a quick commercial break here. We'll connect with Pranjal Bhandari of HSBC and the impact of geopolitical tensions in the Indian economy. Rupee, of course, is a focal point, but much more on the other side. Welcome back. I think markets have recovered, and that's a good thing. From the lows, we've come up, and I think there's been a bit of a pushback on the rupee as well. From the lows of about 96, 96, 97 or so, the currency has come up, and from the opening lows on the Nifty, we've come up quite a bit as well. Down about 0.42. I mean, that's like a normal day. And not a 200-point cut that we were looking at right at the open. Pranjal Bhandari is with us, Chief India Economist, strategist, ASEAN economist at HSBC, and she's with us here in our studios. Pranjal, glad you could make it here. Thank you very much for joining us.
Great to be here.
So, it's just the talk of town in terms of what can happen, what will happen, because there is some firefighting arguably which is needed. What will be the shape, form of that firefighting is the question. So how are you thinking about it?
Yeah, sure. So look, it's all about external balances. We're going to be running a very big external BOP deficit this year of about $65 billion. Sort of never seen this kind of a big deficit. And that's what's really showing up on the currency. And what's not helping over the last couple of days is that there is a bond sell-off globally. And whenever we see that, we saw that in 2022, 2023, it's not great for flows into EMs. In fact, you start seeing outflows from EMs. So you already had this energy shock. Now you have a bond sell-off globally. So all of this is coming together. It's not great for the currency. Now, whatever we do on the currency, it should be something that's not just for the short term, it's also for the medium term. Because this is a problem that has been with us for the last 2-3 years. I think continue to allow the currency to depreciate a little bit. Trickle depreciation, not a sharp depreciation. So use FX reserves to soften the pace. Increase pump prices of oil and diesel as much as you can, because back in 2022, when we increased it by 10 rupees a litre, we saved $20 billion over the next year. I think that's very important money for us. all of the trade agreements you finalized with EU, UK, have it to work, get all that FDI money to come in. I think that will be very important. I think these are things that should continue. Everything else has to be thought about a lot more clearly because there will be trade-offs. Things like FCNR, things like a quasi-government bond issuance is something you have to repay in 2 to 3 years. Are you sure you'll get that money back at that point to repay? Because if not, you're just kicking the can down the road.
And also the money is expensive now.
The money is expensive, of course. So everything else will have some unintended consequences as well. So if I were sort of making the policy right now, I would wait on for like maybe a month, continue with what I'm doing, little bit of depreciation, oil price increase, pump price increase, and hope for the Hormuz to open by about 15th June or something. If that happens, I think we'll see a 1 to 2% step appreciation in the currency, which will help us. If not, then I think about all of these other big measures like FCNR, which are not clear-cut, but maybe we need something emergency.
You know, you said we'll allow the rupee to depreciate. That's the first thing you said, and in a trickle kind of a way. What we've seen so far, would you say it's been rapid, orderly?
I think so. I think we've sort of been doing like about 80 paisa to 1 rupee every 10 days in the last couple of months. I would say this is trickle. I think we needed this. We're doing it.
Okay.
It's been about 6% since the war started. It doesn't feel like a trickle if you just think about it.
And that's because the war is so long. So
12 weeks now and counting. What about on the inflation side? Have your consumer inflation expectations gone up because pump prices are going up, and plus coupled with the fact that we've got a very hot summer and a likely weak monsoon. So that's going to compound the problem on the inflation side. And because the war has gone on for so long, are you bringing down your growth expectations? So just give us before the war, inflation and growth, and now what it stands at. And what's the risk if the war lingers on, say, beyond 15th of June?
Yeah, that's right. So right now our house view is that, Hormuz opens around the 15th of June, but it opens gradually. So it fully becomes functional by only end September. And even then we have dollar averaging 95 a barrel. So imagine that gets postponed a little bit. June becomes August. I think average oil can easily be $100 a barrel. So those are the kind of numbers we are working with. My sense is CPI inflation can average 5.6% this year. From September onwards, for 9 months, I think it'll cross 6%. And that's why I think towards the end of the year, we'll see rate hikes, maybe in the December quarter, and then again in the March quarter, I'm penciling in 2 rate hikes. The inflation increase is because of energy shock, but also because of an El Nino. And that's something we're going to be starting to talk about a lot more in the next couple of weeks, because if it sets in, this time it's likely to be a super El Nino. And it's not just about rains. I think we think too much about rains. The bigger problem is temperatures and heat waves. Every time we have a heat wave for even 10 days, we feel the repercussion for the next 6 months. Because for rains, we have irrigation facility to help us if there's a bad rain season. For temperatures and heat waves, there's no magic wand out there. So that's the part I'm worrying about at this point of time. I really do include a normal El Nino in my forecast, and I have a 5.6% number.
And on growth?
On growth, we grew about 7.5% last year. For this year, I have it at 6%.
Okay.
So I do think in a few quarters, it'll fall pretty sharply.
Okay, but so inflation expectations have gone up 6% by the end of the year. Growth has come down to 6%. So it's a tough balancing act for the RBI, but yet you're going to go with the fact that we're going to see 2 rate hikes before FY27 comes to an end.
That's correct. A lot of people ask me, why not more rate hikes? The OIS curve is actually pricing in close to 6 rate hikes at this point of time. But my sense is not more rate hikes, simply because even growth will fall a lot. So the RBI will have to be sensitive to growth as well. And when I go back and see El Nino years in the past, actually RBI doesn't really do aggressive rate hikes because it has to take care of growth as well.
All right. Hi, Pranjal. Good to have you in the studio. The last 3 months or so when we have spoken, you've pulled down your growth estimates from 7% to around 6.3%, and now you're talking about probably a number of 6% or sub that. What is the Brent crude prices you're factoring into these calculations?
Yeah, so it's about $95 a barrel for this year, about $85 a barrel for next year.
All right. Okay. Now, you spoke about various measures that can be taken, like, going ahead, increasing the pump prices as well, which could bring some kind of relief because the government doesn't take the hit then, and then it slows down the economy a little bit. I wanted to ask you, what about gold? One school of thought is gold imports are 70 to around $100 billion, very, very approximately. You could give me the exact number out there. Maybe go a little bit, harder at this. They have increased the import duty to around 15%. Maybe go the whole hog, because that doesn't impact anything directly. And that could be a temporary measure where you hike the import duty on gold and then in fact you see things shape up pretty better. Do you agree with that, or would you think, no, that's too harsh a move?
I feel oil price increase will get us more bang for the buck than all of these measures on gold. And I'll tell you why.
Yes.
Every time we increase import tariffs on gold, it goes into the smuggling channel. Yes. There are many, many ways to get around it. And the system knows how to work around it a lot. So you just basically increase smuggling and all of that. In 2022, we increased gold import tariffs. The gold imports fell, but all other imports rose sharply. I think some invoicing, misinvoicing and all of that was happening. And I see that all the time with gold. So I'm not sure how much it will help. But oil, I must say, it does help. Because as soon as pump prices increase, everybody becomes a little careful. They start doing carpooling or whatever. And we always see our oil imports fall. So I'm a bigger fan of oil than of gold.
Let the gold, not let the gold come in, but use less oil. And that's perhaps the way to do it. Pranjul, just on the point of, there are lots of measures being discussed, right? One is the equity guys always say, reduce equity capital gains taxation. And that's the big signaling effect. Even if you do withholding tax, I mean, 5 went to 20 on bonds and 20 goes to 5. I mean, the amount of bonds owned by foreign investors is not that large, right? $35 billion. So will that really make a big difference? But with regards to equity taxation, and the signaling could be large. But is it possible? What are the numbers in terms of revenues, the current revenue shortfall, and is it feasible?
Yeah, I think the revenue department will have to consider it very closely because it has been an important driver of revenue collection and fiscal consolidation over the last couple of years. My sense is that we've been collecting capital gains tax of about north of like 1 trillion rupees a year at this point of time. So that's a lot of money that you will be getting rid of. I would agree from a market deepening perspective, some cut in taxes for equity and bond market will be great for inflows over the medium term. But at the end of the day, you also have a fiscal target to meet. So I'm not really sure if the government officials will be very keen to cut all of these taxes. And then there are lots of other issues as well. You don't want to do it only for foreigners. Then there'll be pressure to do it for domestics as well. And as soon as that comes in, then it's a lot of revenue loss.
So you're saying the bar to do that, and that's basically been the view from others as we spoke about, is quite high. I mean, you'd imagine that that's not...
Capital gains tax, I think the bar is high. Maybe there can be something extra on the tax on fixed income investment, especially if it's steps you take to have India included in some of the new bond indices that India is being considered in. For example, the Bloomberg Barclays Global Aggregate Index.
What I'm hearing from you, Pranjul, is there's no imminent need for to jump in and do something here. You're saying it's orderly, 8-10 paisa every 10 days is what you said on the currency. So it's...
I've been seeing that, but the worry also is that if Hormuz remains shut, every day is sort of aggravating the problem even more because inventories are being run down. So, I won't say it's kosher. I think there is a crisis-like situation in the currency right now. But my sense is we don't have too many options. At some point, we have to just basically get used to an orderly depreciation as long as the strait is closed.
100 is coming on the rupee?
I won't go that far. I'm still sort of working with 96, 97, and then I'm hoping by then the Hormuz opens and then we see a 1 to 2% appreciation, and then we start this depreciation again.
All right, Pranjul, appreciate you coming down to the studio and giving us all of that. For the time being, we hope that Hormuz opens, but as of now, Nacho is getting a lot of, not a chance that the Hormuz opens. So let's see how that goes, but appreciate you joining in. Thanks.
Thank you.
Great to be here.
Well, let's go across to our next management rights. That's the one that we're focusing on. We reported actually a mixed set of numbers in Q4, strong revenue growth, margins under pressure. We have Mr. Rahul Mittal, the Chairman and Managing Director at Rights, who joins in. Hi, sir. Good morning and good to have you on the show. A quick word first in terms of the West Asia crisis. How is it impacting your business in terms of revenues, in terms of exposure, if you could quantify it?
Good morning. You see, there would be some impact on, the increase in travel costs, etc., being a consultancy company. But I think that's the only.
There would be some impact on, the increase in travel costs, etc. But I think that's
infrastructure projects, construction projects. All of them have.
That's the only thing which you have to keep a watch out on.
Okay. All right, sir. Let me just come back to you in just a bit. I think we're having a bit of a technical snag out there. But the markets have shown a good recovery, which is good to see. As I mentioned today as well at the start of the show when I did my morning chat, yesterday we fell close to under 120 points from the highs of the day. And there was an expiry-related factor today. And today, given that we were down close to 200 points in the first tick itself, the bulls will find reason to see a bit of a trading bounce. Remember, the global jitters still persist. Bond yields have moved up globally, crude oil prices are higher, and the rupee is still weakened as well. So a trading bounce wasn't ruled out. That seems to be taking place as of now. But what is heartening to see is, yet again, the breadth of the market is improving. When we started today's trading session, you had only around 450 stocks that were advancing. That number, in a matter of 45 minutes, has quickly doubled. They're getting closer to each other. Maybe a bit of a kiss is what we could be looking forward to. So number of stocks advancing is giving some hope that there is still some participation in the broader markets, and that's actually good for portfolios. Individual stocks that are doing well, Hindalco, that's the stock of the morning actually. There was a bit of a buzz there was some buzz that, that numbers could be a little bit weakish coming in from Novelis. But actually what happened in yesterday's trading session was Novelis's numbers actually were quite good.
All right, let's just run through some of the mid-cap action. Z Entertainment is a stock under pressure. That's down nearly about 5%. The ad revenue growth was under pressure. And the stock report, at the EBITDA losses, there were EBITDA losses at the bottom line. There was a loss. Stock is under pressure. So that's down nearly 5%. PI Industries has been weak. We've got Orkla India also a little subdued in trade. And on the way up, Prince Pipes is making a big move. I think yesterday as well, post the numbers, stock was higher. And today it's added on nearly 7%. Dredging is another one reacting well to its numbers. GE Vernova, Zidus Life. There is a conference call which is taking place in Zidus Life where the company is talking about a $300 million kind of a quarterly run rate. That's a stock which is up. But I think we managed to reconnect with Dr. Mittal of, not Dr. Mittal, but Rahul Mittal, Chairman, Managing Director of RITES.
All right, just one more stock, Welspun Corp. I think we should pull up the intraday chart out there. That stock opened on the back foot and that's recovered. And another one is Shaily Engineering. Big uptake is what we are seeing on that one as well. The stock started off lower. The numbers, I think, were a little bit softish, but the street is willing to look ahead. So it's an 8% recovery is what we're seeing on Shaily Engineering. Let's get back to the conversation we're having with Mr. Mittal, though. Mr. Mittal, we have you back on the show. Tell us, quantify the impact. As you said, since you're a consultancy company, it's impacting some part of your cost owing to travel. Tell us a little bit more.
Yes, primarily an impact on the travel expenses, which we'll have to keep a close watch on. As far as our consultancy fee on the construction projects are concerned, the executing agency contracts have price variation clauses in them. And our fee is based on a percentage of the execution cost. So that's not a matter of concern. Yes, we'll have to just keep a watch on the travel costs, both domestic and international, because we have a lot of international projects also.
Okay. Exports were about 25% of your revenue. What's the supply pipeline for exports and what is the growth that you expect on exports for FY27?
See, the biggest key takeaway of this FY was that we had an export revenue of about 300 crores plus after a gap of about 2 years. And that's the revival of our export business, as I said, after this gap. We have an all-time high order book of about 2,100 crores for our international business, which includes project consultancy and export of rolling stock. So I see this figure only growing by at least minimum a double digit in this FY. So our international business, which is a good margin business, will continue to contribute in the coming FY also.
Got it. All right, Mr. Mittal, tell us about your order book. I think it's close to around 9,400 crores approximately. Tell us about the updated book, the order inflow, and if you could break it up for us segment-wise as well.
Yes, we touched again an all-time high order book of 9,400 crores. This was despite a heavy execution of 750 plus crores in Q4. Despite that, our order went up from by about 150 crores in this quarter. As I said, an all-time high order book. We continue to be a one order a day company. We got 120 plus orders this quarter, totaling to about 958 crores. So our order inflow, our track record, which we maintained throughout this financial year of one order a day and one export order a quarter, we continued that even in this quarter, and I see this trend continuing in the coming year. In fact, in the entire year, we got about 580 orders in this FY.
Got that. So on the turnkey side of the business, things are a bit subdued. What were the challenges that you've seen in the turnkey side of the business? What is temporary? What would be structural? And what can you guide going ahead?
You see, turnkey business, if you see the breakup of our order book, is about 4,500 crores. And substantial part, about nearly more than 2/3, is a very young order book. It's about a year old. And that's why you see this jump in order book in the last 1.5 years. So the earlier projects, they were finishing, they were in the final stages. And this young order book of turnkey has started, the execution has started. So this FY will see a much larger contribution from the turnkey segment of business.
Would you want to put a number? Because it's been a couple of quarters of weakness.
Yeah, so as I said, this is because of the mix of the age of the turnkey order book. And I see at least a growth, at least a 10 to 15% growth in the turnkey contribution in this FY vis-a-vis the last FY.
And I missed the number. Did you give a number on the order book?
Yes, our order book is 9,416 crores, which has a consultancy element is about 2,750 crores. The export is 1,750 crores. The turnkey is about 4,500 crores. And leasing and our subsidiary RMCL is about 330 crores. So that is about a total of 9,400 crores, which, as I said, is an all-time high for us.
No, what I wanted to know is what would the number look like? When do you cross 10,000 crore? Do you cross it as soon as Q1 of FY27 with this order a day target of yours?
You see, we will continue to get an order of day. That's the signals that we are getting. But this year, we are going to step up more on the execution, more than a double-digit growth on the top line. So we will definitely reach 10,000 crore. It's a question of the fresh order inflow and the increased execution. But during this FY, we will definitely cross 10,000 crores.
Thank you very much, sir, for joining in. A pleasure speaking with you. That's the management of rights. But now let's talk about the futures and options space. Mangalam is now joining in to get us a check on the Sensex derivatives at this hour.
Well, if you look at it, there is the Sensex weekly options expiry that takes place, and one day ahead of that, we start seeing some action in a lot of the options. Today, the markets recovered from lows as it did yesterday as well and day before yesterday, though yesterday we saw some supply at higher levels too. The important part, it's the IT pack which is doing extremely well. The BSE is off today's lows by about 250 odd points, and a large part of that could be attributed to BSE IT. And what it also tells you, today's low, is that there is important support around the 74,500 mark. Why do I say that? May 14th, low was 74,526. Today's low, 74,529. If you go below that, then around 74,150 thereabouts are important levels to track on the Sensex too. But at higher levels, there is some supply coming in, and that level is basically both the 50 and the 20-day moving average, 76,345 to about 76,725 are those two levels on the way up that we will be tracking. And option writers are placed for that as well. Given 74,500 as an important support, we are seeing some writing at the 74,000 put, at the 74,200 put as well, telling you that between 74,000 and 74,200 there is support for the Sensex. But at higher levels, the 74,900 call writers are extremely active in trade for a premium of 400 rupees, telling you upwards of 75,200, 75,300. We might see some supply come again as well. So it's about a 1,000-1,200 point range that we're tracking on the Sensex.
All right, Mangalam, thanks a lot for giving us that quick update. For the time being, we slip into a short break. But on the other side, Manisha Gupta is waiting for us. She'll focus on the heat wave as IMD warns of a severe heat wave conditions for this week.
Welcome back. Manisha is now joining in and she's going to focus on the heat waves as IMD warns of severe heat conditions this week. Manisha, over to you.
Well, absolutely. When you look at the month of April and May and much part of June as well, the IMD has been constantly suggesting and telling us that the heat wave condition this time around seems quite bad. And I want to take you through some numbers as well. Well, the conditions from 18 to 22nd of May are expected to be of severe heat wave is what the IMD has said. But in the month of April and May, we've seen some very, very high temperatures already. Banda in UP has already recorded 47.6 degrees Celsius. And when you look at Maharashtra as well, Akola has seen 47 degrees as well. So we have seen very high temperatures already. And there is an expectation from Skymet and IMD both that June perhaps could be looking at higher temperatures as well. There are various international reports which suggest that 95 of the world's 100 hottest cities are actually in India. And that's a bit of a concern coming in there. IMD also has advised alerts for various states and cities in Rajasthan, in Punjab, Haryana, Delhi and UP as well for this week, and you could be looking at extended severe heat wave conditions continuing for the month of June as well. The nighttime temperatures also have been unusually on the higher side. 2 to 3 to 4 degrees higher than a normal is what we have been dealing with. Why is it so hot this time around? Well, one, of course, it is the climate change. We've all been talking about that. Second, it is El Nino conditions developing in equatorial Pacific that has led to more heat and, of course, will lead to lower rainfall as well in the Indian markets there. It also has to do with the long-term anthropogenic warming. Anthropogenic is when you're looking at deforestation, when you have more industry activity happening. This is clearly man-created, and that is yet another reason that has led to more heat wave. Third is urban areas are hotter than the rural areas. That is because of dense infrastructure, vehicles, air conditioning, industries, etc. So you will see 2 to 3 degrees higher in the urban areas than what we see in rural. And then apart from that, the frequency in India in sense of heat waves and hotter climates has been put consistent upward trend since 1961 there. We also are looking at lower than monsoon this time around. IMD and Skymet have given their initial projections, and IMD talks about 92% of rainfall, while Skymet at 94%. This is both below normal monsoons there. When you look at the India water woes, that really is a concern going forward now. Kharif perhaps is something that we could still see fine, but we are still struggling with soil moisture, and Rabi going forward could be a bigger problem as well. This is the data from CWC which says that 13 major reservoirs in India are below 50% right now. Major water level decline is what we are looking at in south and eastern part of India. When you look at the overall number, and this is the CWC data from 14th of May, it says that of the overall capacity, only 34.45% of water capacity is available to the country at this point in time. Also, when you look at the river basins, well, that has been declining as well. Ganga stands at 43%, Godavari at 36.5%, Narmada at 34 or 35%, and Krishna at a concerning levels of 19.3%. Also, when you look at the southern and the eastern part of country, the water capacity right now stands at anywhere between 20 to 30%. There are concerns on drinking water supply, irrigation, and power generation going forward as well. So various concerns coming in. And the major concern, of course, also comes in the fact of Kharif crops. The sowing would begin from the month of June. You have important cereal crops like rice, maize, bajra, jowar. You also have oil seeds like soybean, groundnut, sunflower, sesame, and then cash crops like cotton, sugarcane, jute. And then you have major pulses as well like tuar, moong, urad. Almost all of them are slated to be sown in the month of June therein. Remember, most of these crops are rain-fed. Irrigation is 55% of India, but 44 to 50% is still rain-fed, and that is where the concerns are coming in from.
Thank you very much for that important topic, and we'll keep coming back to it. For now, it's a break. On the other side is a special segment. It's the economy. Lata's back, and she speaks to Citi Samiran Chakraborty on the rising pressure on India's macro. Stay tuned.
Welcome to It's the Economy. Welcome back, rather. In a week, the Iran war will complete a quarter. By next weekend, crude oil prices will have prevailed over $100 per barrel for over a whole month. However, so far, India's consumption CPI, Consumer Price Index, for April has come in at a very benign 3.48%. But the wholesale price index, WPI, has shot up to 8.3% in April from 3.8 just in March. 3.8 became 8.3. Also, the government has raised petrol and diesel prices in May. So how much may inflation spike here on? And, of course, what about interest rates, growth and the rupee? For all these macro questions, I'm joined by Samiran Chakrabarti, Chief India Economist at Citi. Samiran, good morning. Thank you very much. Let's start with inflation itself. WPI shooting up and government has raised fuel prices. How do you expect CPI to pan out here on?
So, Lata, the way we are thinking about it is that we have to make some assumptions out there. So our baseline forecast of 4.6% average CPI for FY27 is based on a 5 rupee petrol diesel price hike, which we're almost there. The second critical assumption is with respect to the monsoon, where in the baseline we have assumed monsoon to be normal because we don't know as yet, but we have put out a very detailed report arguing that if there is an El Nino condition developing with a deficient monsoon, then there is 40 basis point upside risk to our 4.6% CPI forecast. That's primarily because in deficient monsoon years, it's not so much the food grains, but more the pulses and vegetable prices, which tend to go up. The third issue is that, as you mentioned, the WPI number has gone up quite substantially. We are less concerned about the headline WPI, but more concerned that the core WPI, stripping off the effect of oil prices and food prices, that bit has gone up quite sharply in the month of April, 1.1% month-over-month increase. So with a lag, this can feed into the CPI. That's what we have observed in the past. And the last one, which is the most difficult one to take into account, is to what extent all these inflationary pressures finally feed onto inflation expectations and through that channel start impacting the overall headline inflation number. So that's what our current assumptions are. Based on that, we are projecting 4.6 with upside risks.
Oh, well, 4.6 looks very benign, but look at the benchmark yield. That has already hit 7.12 as I speak. This is probably because there is a rate hike fear given the high inflation, but the Reserve Bank is actually keeping liquidity plentiful. So do you expect a rate hike anytime this year? But more importantly, where do you see the yields headed, say, in the next 3 to 6 months?
So it's probably too early for the RBI to start thinking about a rate hike in the June policy itself, because, as you rightly mentioned, as of now, RBI is keeping liquidity plentiful. There is no signal for tightening things, and rightfully so, because the headline inflation is still below the RBI's target of 4%. So there's probably no hurry on RBI's part to tighten things up immediately, especially because now in the April policy, RBI has clearly indicated context of both the energy shock as well as the weather shock. They can look through some of this headline inflation increase if it happens. So we think that the rate hike will also get willy-nilly connected to this core inflation view. If core inflation stays above 4.5% on a steady basis, then the risk of rate hike would come in. Having said all this, I think the market pricing seems to be not just based on inflation, but also with an expectation that there would be some sort of a defense of the currency through rate hikes. We think we are still quite a way off from that sort of a scenario where RBI will take that route. This is definitely not the same macro backdrop as 2013, which warrants that. But yes, in the market pricing, especially the swaps, that sort of very steep rate hike expectations are getting built up. for bond yields, apart from this whole discussion about possibility of RBI rate hikes, I think increasingly this awareness is coming that if this conflict lasts longer, then there would be pressure on the fiscal as well, additional borrowing, etc. So that's the part which is unclear and market is trying to slowly price in. And last but not the least is this factor that globally bond yields have gone up quite substantially everywhere almost. So there is no surprise that in sympathy of that, in India also there has been a tendency of a slightly higher bond yields.
Absolutely, Samira. 19-year highs in US yields. But now at 7.12, is all the bad news of fiscal deficit, US yields, inflation priced in? Or do you see our yields much higher in the next quarter?
So this is where a bit of a dichotomy is there, that while swap markets have probably priced in more of the bad news, I don't think the bond yields have priced in as much of the bad news. We still don't know to what extent the RBI dividend is going to come for this year, whether that's going to offset some of the other fiscal slippage pressures. We still don't know how long this conflict is going to last, and to that extent, how much inflationary pressures are going to come in. So there is still quite a bit of uncertainty that's ahead of us, which is why I think the bond yields might not have priced in everything. Whereas when I look at the swap rates, it seems to me that the swaps have priced in quite a bit of rate hikes, which will be a surprise to us if all that happens over a one-year period.
Oh, okay. Yeah, I know. 5-year swaps, 1-year swaps, all heading towards 6. I agree with you. Well, next week we get the Jan-March GDP numbers, which will be impacted only 1 month by the war. What will be that number itself, the Q4 GDP number? But more important, how do you see growth pan out for FY27?
Yes, there is going to be some impact of this Middle East conflict to be felt in the data for the month of March and can distort the quarterly GDP data to some extent. But I think the bigger picture is that to what extent the FY27 whole year GDP is going to be impacted by this crisis, because the first quarter number is clearly now in the rear view mirror for most people. And there the challenge is that till now the government has been very conscious about not hurting the growth prospects through explicit policy actions. Now we are slowly moving into a phase where some of the actions being taken, like the petrol price hike, etc., will have its knock-on effect on growth also. Let's say, for example, a 5 rupee increase in petrol price would imply that the consumer will have to cut back expenditure worth about 0.2% of GDP on all other items in a very mechanical way. So that's one channel through which the growth headwind will come. The second headwind will come from simply the whole petrochemical channel and its whole downstream industries where it is used, because there has been a significant increase in prices for these petrochemical items. And then you could have impact coming through the disruptions in the maritime traffic, which can affect our exports, the Middle East problem affecting remittances, etc., etc. So all these factors will come together, and our sense is that we have taken off about 50 basis points on our FY27 GDP growth. From 7.1, we have brought it down to 6.6 for the time being. And we'll have to now observe how quickly this resolution happens and whether the oil prices come off in the near future or not.
6.6 is good, Raviran, but rupee at 96.88, 96.89 is not good. Clearly, the worst hit macro is the current account and BOP. Tell us how this may be impacted.
Right. So, in fact, this is the problem which almost predates the Middle East conflict. Yes. We were having 2 consecutive years of BOP deficit in FY25 and FY26, primarily because of some challenges on the capital account side. The current account has been pretty benign for a while now, primarily due to the service exports being very strong. Now, what this Middle East conflict is doing is that For us, we have raised our current account deficit forecast from 0.6% of GDP to 2% of GDP now. So that has become an additional headwind to the overall BOP situation. So given the already existing challenges on the capital account and now a 2% of GDP current account, our overall BOP forecast for FY27 is now $50 billion, which is a pretty large BOP surplus in the BOP deficit in the Indian context. But what we are difficult to factor in right now is that this is almost assuming that there will be no policy intervention of any kind. But if there are suitable policy interventions, then it's possible to imagine that this number actually can turn out to be even lower than what we are forecasting. But that's difficult to bring in to our forecast at this moment, that what future policy action would be.
Actually, I wanted to ask you just that. What are the policies you're expecting to shore up the rupee? Also, if you can give us where you see the rupee in a quarter.
So, in our view, steps on the current account side are more difficult to take because most of the reaction in the current account is simply because of the Middle East conflict, and it's a price effect, not so much the volume effect. Yes, you can tinker a little bit with gold import duty or some import duty on electronics products, etc. But the bigger question to ask and a more medium-term question to ask is that what can we do on the capital account front? And there the policy dilemma really is that if you take measures to encourage capital inflows, that might take time to work through the system. Whereas if you take measures for capital controls, controlling the outflows, those will be immediate impact, but might not be best for investor sentiment. So how do we balance between the two? I think that's the biggest policy challenge. It is possible to think of measures which can do some lump sum inflow type of thing, right? Like say, for example, if we are able to get into another bond index, then that can potentially bring in some lumpy debt inflows. It's possible to provide certain concessions to Indian companies or banks to encourage them to borrow abroad temporarily and swap them into rupees. Those kind of things can also bring in lumpy inflows. But definitely the situation is somewhat different from 2013, where global rates are not anymore close to 0% or 1%. They're more like 4-5%. So that interest rate arbitrage argument, which worked in 2013, may not be as attractive today. So that kind of FCNRB scheme that we did in 2013, today it might be a more difficult one to implement.
Yeah, sorry, actually out of time. Just a last question. Do you think we will get into the Bloomberg bond index in June?
I mean, some of these things that are getting discussed about of reducing taxes on foreign debt investors, withholding tax, etc., one can think of these things as potentially enablers for that Bloomberg bond index inclusion. But we are of the view that whatever is required for that might be a good idea to implement, because what this crisis has demonstrated is that the bond inflows are much more sticky than the equity inflows. We've got barely $1 billion of bond outflow vis-a-vis almost $20 billion plus of equity outflows after the conflict started.
Yeah, that's true. That discussion for another day. Thank you very much, Samay and Chakrabarti, for joining us. Currency in a tight spot. It's among the worst performing currencies today, rushing down as it were. Wrap up on Bazaar Chartbusters coming up.
Rupee extends fall to hit a record low of 96.86 to the dollar. The global bond yield rise amid lingering geopolitical concerns take the markets lower. But we see some recovery from the lows led by IT and Pharma.
Worse than anticipated Q4 results drag shares of PI Industries, a 12% drop in the top line, 26% fall in EBITDA, and a 400 basis point contraction in margins. The company flags caution ahead of on account of inflation-led pricing pressures.
Zee Entertainment turns loss-making in the fourth quarter. Ad revenues take a hit on account of tensions in West Asia. Changes in movie rights amortization policy pushes the company into EBITDA loss of about 270 crores. Shares see selling pressure in early trade.
Zidus Life delivers a beat in the March quarter. The India business leads the way with a 14% growth on a year-on-year basis. We also had the formulation segment that posted a sharp 45% growth. Promoters will also participate in the 1,100 crore buyback that was announced.
Strong turnaround for fourth quarter in Dredging Corp. Company swings to a profit of 87 crores versus a loss of 25 crores. Prince Pipes too, EBITDA doubles over 100 crores, while profits also more than double to over 55 crores.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the markets are down close to 60 points odd on the Nifty, but it's a big recovery of more than 100 points on the lows of the day. And even on the Nifty Bank, we're seeing a good recovery. So Mangalam, we're down, but not yet out. And I think what helped was yesterday was the weekly expiry. So the last tick was at the lower of the day, and that was expired related, weekly expired related. So with today's gap down, it put it close to around 300 points down take, which has led to this trading bounce, so to call it.
Trading bounce indeed, Nigel. You know, 23,300 at lower levels, we're seeing some buying, and as soon as the market moves towards 23,800, we are seeing some sell-off, news or not news. We have been in this zone of 500 points for the frontline index. The broader markets, however, today will have nearly twice as number of stocks which are in the red as compared to about 1,100 which are in the green. But there too, things are improving and they are slightly on the mend. A lot of results are fairly strong. IT and Pharma have been doing extremely well as well. So let's see how things go. But in a market like this, let's get you some ideas of profit. Our teams at Money Control Pro, our colleagues, are standing by. Madhu Chanda Day joins in with a stock. Madhu.
Hi, we are talking about Muthoot Finance, India's largest gold financing NBFC that recently came out with a decent set of numbers thanks to the strong growth in its core gold loan portfolio. Gold loan, which is close to 91% of the consolidated assets, grew by a strong 54% in FY26 thanks to the rally in gold prices. In Q4 as well, the growth was largely driven by realization as there was a sequential drop in tonnage as well as customers. The management alluded to heightened competitive intensity and the company losing some low-ticket borrowers. Net interest margin, however, showed an improvement thanks to the expansion in yield on advances. There was a stagged weakening in the asset quality, but this was largely due to a shift in recognition of NPA from loan level classification to borrower level classification, although the underlying asset quality remains strong and fully collateralized. Gold financing is a structural opportunity for India, given Indian households' large holding of gold, firmness in gold prices, and prevalence of unorganized sector, especially in the rural areas. We remain confident about the medium-term outlook of this company, and the correction in the stock price has made the valuation reasonable for this high ROA entity.
All right.
Okay, all right. Well, thanks a lot for that, Madhu. Well, by the way, Reliance Industries, that's a stock I think that's seen a big recovery from the day's low, and that's the one that's leading the fight back as we speak, Mangalam.
Take that point. Reliance has cut the Nifty's deficit to just about 50 points, up at the high point of trade. And we have ONGC as well, which has seen a bit of a spike. Oil prices holding at around 111. Good for all these upstream companies. And Reliance is the one big boy which is fighting. What we'll do is we'll shift focus to earnings now. Zidus Wellness, that's the stock that is on our radar. Saw decent growth in revenue and EBITDA, obviously driven by acquisitions. But internally, some parts of their portfolio impacted by seasonality as well. Tarun Arora, who's the CEO of the company, now joins in. Tarun, a large part of your fourth quarter revenue was impacted by unseasonal rains, which is basically the Glucon-D portfolio, which saw a decline of almost 10% odd. But we are now in a heat wave. Has the first quarter seen a strong pickup in that portfolio? And in light of that, what can we expect for the first half of this year?
Good morning, Manglam, and pleasure to be on your show. I think we are overcoming a very good start last calendar year, where we had a very good summer starting off, and then it tapered off, and we had early rains. Now, this year seems to be going absolutely opposite of what we saw last year. So till mid-April, there was a bit of lower temperatures. After that, the temperatures have got better from a seasonal point of view, and it's a heat wave. So we should see some recovery from that. Now, very hard to predict how this will pan out, but of course, we have going forward a lower base because we had a difficult summers last year. And we hope that we can recover some part of it, what we've lost. So that's the nature of the beast that we deal with in seasonal brands.
All right. We understand that, but I wanted to know whether you've seen signs of that in the first quarter so far or not. But be that as it may, organic like-for-like growth in FY26 for India, what was that and what is it likely to be in FY27?
So, like-for-like at an overall level, India growth was more like a 2.5, 3. But if you segregate the if you segregate the seasonal and non-seasonal, the non-seasonal was almost about 16, 17%. So it just reflects that our overall portfolio is on a very good trajectory. We are delivering on double-digit growth that we've always talked about. It's just that there are external factors which are temporary by nature, and our view is that, over a period of 3 to 4 years, typically you will see that even the seasonal portfolio delivers a double-digit growth. There are years when it is doing better and years it's not doing so well. But over 3-4 years, medium term, it delivers well. But the underlying all seasons business is on a good mid-teens trajectory last year. So we're quite happy with whatever we've been able to deliver last year.
All right. Hi, Mr. Arora, and good to see you. What proportion of your revenue and margins synergies with Comfort Click have been achieved? And what's the way ahead from here on?
So Comfort Click, I think, is a very different level of business, and the way we are looking, or the thesis of acquisition is, first of all, it's in a high growth space. So we want to focus on the growth aspects of the business, and we've talked about on a constant currency about 27-28% last quarter growth, and including the currency benefits, more than 31% growth. Now, the focus is clearly on driving the growth. The synergy benefits is not what we are chasing. Of course, there are benefits. We are looking at, can we take some of our protein portfolio or some other nutrition portfolios into European markets under the Weight World brand. And those are explorations we are doing. We're also working with the team at the back end in Hyderabad and other places and see what we can do together, bring in some capability and processes from a Zidus group and Zidus Wellness in particular perspective. But I think it's a separate business, and I will not chase so hard on synergy, at least in the P&L terms, but processes and culture, yes.
I suppose, what Nigel wanted to know a lot more were not just margin synergies, but also revenue synergies because of the cross-selling opportunities that are there. These businesses are in geographies where you're not present. So obviously you would want to scale some revenues there too.
Yeah, so that's like I mentioned. So we're looking at our protein products range, and some other nutritional portfolio, which we could take there. We're also trying to learn something on the VMS side, which at some point in time we could consider bringing back in India. And there are a couple of other options. Early days, it's just been 6-7 months since we acquired it, and we're working with the team very closely to see what we can take from here and what we can bring from a global knowledge to India perspective.
Right. What has gone right for you this time around has been the currency depreciation, which has actually aided your Comfort Click's business by about 3%. But I also wanted to know how much more of that benefit will be visible in the quarter that we're currently in, because the rupee is at a record low. And the debt on your books, how much of that is denominated in non-rupee? Could that be an impact as well?
So very interestingly, I think rupee
the currency gain is not what we are fundamentally relying on. Though, of course, there may be continued 3 to 4% benefits which may come depending upon how the rupee performs. Having said this, we are focused on like-for-like, constant currency growth, which is, I think, in sync with what our aspirations are. They have delivered a 27, 28% kind of growth on a constant currency, which we'll continue to build. The currency gains sit on top of it. Having said this, when you look at the loan, we took about 2,800 crores of loan when we acquired it, which was pound denominated. Now we've converted into a euro-based loan, which is a tad cheaper. And I think the business itself, the acquired business itself is capable of paying for it. And we have, at overall business, we should be able to only get better at it. And the arbitrage, because we are earning in euros, substantial portion, and therefore the payment, the loan is also in euros. So there is no major risk sitting there in terms of currency issues on the loan.
All right. Can you break up your revenue down for us category-wise? Beverages, nutrition, protein, if you could break it up?
We don't really work on terms of breaking down revenue, but I can just give you a sense of how the business is, how the growths are. So international business has grown at about 31, 32%. And the remaining business for the last quarter grew about, about 13.5%, 14%, and for the year at 16%. But if I really, seasonal being about -9.5%, and for the full year about -18%. That is domestic all-season portfolio. If I further break it down, we have the food and nutrition and skin and hair care. The skin and hair care has been a fantastic journey for us, where we continue to grow at more than 39% for the quarter and about 21, 22% for the year. Right. Even the food nutrition also has been a good journey. We have about 10% and about 15.5% for the full year.
I understand you don't, again, give the breakup, but, just basis the acquisitions that you've made earlier and the kind of growth rates that you're doing, just correct us if we're in the ballpark or not. RightBite could have crossed about 250 crores in FY26. Is that, are we close to that ballpark?
Difficult for me to give you specific numbers, because if I don't share it with others, why would I? But having said this, yes, we are very happy.
You can make an exception, sir. You can make an exception.
And we're doing the hard work of doing the back calculation, so you can just tell us whether we are off or not on that, right?
I think Mangalam deserves that reward.
So I will stick to our stated line. Having said this, I think one of the things we've talked about is the business was growing at 25% CAGR for 5 years before acquisition. We acquired for FY24 at 130. 130 crore was close, likes of that in FY24. Post that, it has grown more than double of that. You can do the maths.
So I just did the math and I came to that 250 crore number, because 130 crore into 1.5 into 1.5 over the next 2 years, growing 50% each, gets you to that number. Anyway, I understand your point. And finally, on the skin and hair care portfolio as well, you said that it's doing extremely well for you. Some numbers suggest that it could be about a 350 to 400 crore rupee portfolio. Is that growth run rate that we saw in the fourth quarter, is that likely to continue?
Fourth quarter has been phenomenal. I think I would say that we continue to remain focused on a high growth trajectory. I would rather go with an annualized growth, which you've got at closer to 21%. I would love if every quarter went like the last quarter, but we are really focused on growing at a good double digits. Anything above teens is great, but creating expectation based on only one quarter will be...
All right, we take that point. So you target double-digit growth for the full year for the company on the whole, and seasonal portfolios, seasonality, non-seasonality notwithstanding, you will continue to do well. Comfort clicks, there is still a long way to go for growth, and you are expecting, the growth in RightBite to continue as well. We'll take those points on board and leave you, for now to speak to you after how summer has panned out and the performance of the Glucon-D portfolio then. And for now, we'll take a short break, come back. On the other side, the management of Ratnamani Metals, Tubes and Company joins in.
Welcome back. You're tuned in to Chartbusters. You're on CNBC TV 18. As promised, let's get straight to the next management of Ratnamani Metals and Tubes. It was a weak quarter, but are things improving? That's the first question that we're going to ask the management. Mr. Manoj Sanghvi, who joins as the CEO of the company. Hi, Manoj. Good to have you in. Last quarter obviously was a bit of a washout. Are things improving on ground? Because the geopolitical tensions persist. And give us a revenue contribution coming in from the Middle East on the whole.
Yes. Hi, Nigel. Thank you for having me. So last quarter, yes, things, because of the conflict in Middle East, about 150 to 200 crores of material we could not ship out. And still the shipping lines are quite disturbed at the moment. And the first quarter remains the same. We are sitting on inventory for Middle East. However, we hear a lot that new pipelines are going to be announced not only in Middle East but in India. So going forward, once things normalize, definitely there are good chances of good order inflow in future.
Okay. And Middle East contributes how much, sir, to the total mix?
So about 15 to 20% of our revenues is from Middle East.
All right. So that's a large chunk out there, in terms of what is sitting on inventory. But as things stabilize, you can directly start pushing out all that inventory that you're sitting on, right?
Yes, yes. We are looking at ways to ship the material out. But given the situation, it's quite difficult at the moment.
Okay, I'm looking at your order book mix and I noticed that carbon steel is close to 75%, which is actually at, I think, 2-year high of your order book mix. The stainless steel one is the one that is more margin accretive. What is the volume mix as of now in Q4? And for FY27, what will the volume mix look like in percentage terms?
So historically, if you see, our revenues for stainless steel has always been between 30 to 40%. Order book, of course, depending on the project, one project of carbon steel, which are bigger in size, you may see 25-75 or 30-70. But we try to maintain the revenue for stainless steel as well as carbon steel within that range of 30 to 40% for stainless steel and balance for carbon steel.
Got it. Okay, all right. The street is also a little bit cautious on order inflow because the order book is not growing up. What are the triggers in place? What kind of order inflow are you working at, And also there'll be various measures on ground domestically as well. I think the Jal Jeevan Mission could give up something and various other measures. So what is the number you're working with in terms of order inflow?
So as we speak, things, especially in carbon steel line pipes, are quite muted. Yes, both in the oil and gas segment as well as the water segment. Stainless steel, we have a regular inflow of orders, so there is no issue over there. There are new age industries like data centers, semiconductors, which are evolving, which will have a lot of stainless steel tubes and pipes requirement. As soon as we have clarity on the global or the Middle East conflict, we'll have more clarity on the carbon steel line pipe business, which brings the revenue jump as a whole.
Right. Manoj, what about these smaller businesses? There is the bearings business, which did about 380 crores revenue last year. You had pipe, spools and auxiliary support systems as well, which did about 400 crores. Together, how fast can they grow and how big can they be in the next, say, 2 to 3 years?
So both our subsidiaries are growing. Standalone, our results have been not so good. But if we see both our subsidiaries have grown, of course, it was first year for the pipe spooling business, wherein we clocked about 400 crores. And Ravi Technoforge, about the same number, 380 crores. The spooling business has the potential and the visibility to grow at 20%.
Okay.
And the Ravi Technoforge, where we do the bearing business, this year we will see a growth of about 10 to 15%.
Okay. All right. Got that. Very quickly, if you could tell us, you're evaluating a backward integration plan as well, I believe. Could you give some clarity on that front? That's what I hear. Give us some clarity very quickly.
Yeah, so it's been almost a year we are working on that project. Recently, we've been given the approval by the board to scout for the land However, the final numbers are we are still working on it. But, because a big amount of land, water and power. So a perfect resourceful land is what we are looking for. So that approval we have got. So in next 3 months, we plan to finalize the land for that.
And that could be around 1,500 crores of capex?
Yeah, 1,500 in 2 phases.
Okay. Very quickly, your standalone guidance is approximately, I think, 30% revenue growth with margins of 15-16%, correct?
Provided the Middle East conflict normalizes, we plan to reach back at 4,800 crores on standalone basis.
And margins?
Margins mid-teen to a little higher, like 16-17%.
Got it. Thanks, Manoj, for joining in. Quick chat, but effective one. Look forward to chatting up with you rather soon.
Thank you.
Time to slip in a short break. Come back, continue to focus on markets.
Welcome back. You're watching us here on the Chartbusters show. As you can see, 23,550 is where the Nifty is right now. A deficit of about 70, 80 points, led lower by a lot of the names, but also supported by Reliance and ONGC. The broader markets, that's where the up move has taken place right now. They've cut their losses to just about 90 points, but we're out of time on this edition of Chartbusters. What we'll do is take a short break, come back. On the other side, the team of Trading Hour will track the markets for you. Stay with us. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Patakia and Ritu Singh as always. Today we're down about 50 points on the frontline index, but there has been a notable recovery from the lows, led not only by the IT stocks, which have been doing extremely well. The Nifty Pharma index also marginally in the green, but the last 30 minutes or so have belonged wholly and solely to Reliance Industries. The kind of recovery that we've seen on that stock from the lows and the concomitant up move that we've seen has led the Nifty to cut its deficit to just around 48 points as we speak. And this up move is a lot more notable in the broader markets, where it's just about breaking into the green, which is a sharp recovery from the lows, and 1250 stocks advancing for about 1600 stocks, which are lower, a ratio which has improved a lot since the time we opened. Good morning, Ritu.
Good morning, Mangalam. Apart from Reliance and the heavyweights, you also see Hindalco, Bajaj Auto, some of the other names that are helping on the upside for the Nifty. The IT pack, of course, is doing well. But what's curbing that enthusiasm is the banking stocks. The bank Nifty is down again. It's in fact been down for, most of the last week and this week as well. I think 7 out of 8 sessions, we've seen the bank Nifty in the red. Apart from that, what you also have is some of the other packs you mentioned. Pharma, Auto is also doing decently today. The IT pack, of course, and the energy pack. But on the flip side, of course, FMCG, banking, PSU metal, all of that seeing a bit of a pressure. But let's go across to Hormaz as always, who's standing by with the list of stocks that are buzzing in trade today.
You take a 50-point downtick with both hands, considering what the GIFT Nifty was implying early in the morning. And the currency, though, although it has recovered from the record low levels, it is still very close to that mark of 97. So now at 96.81, it plunged to levels of 96.96 at the start of the trading session. So there's some recovery on the currency as well. Look at the yields. With the bond yields all over the world are rising to multi-decade highs. The 10-year here as well has now gone up to 7.12 as we speak. And as Mangalam was highlighting, the stock that has been leading the recovery for the last few minutes has been Reliance Industries. You take a look at the move that you have seen from 10:30 onwards, and the stock is now up close to 1%, back nearing levels of 1335, 1340 as we speak. Now take a look at the earnings reactions that have come up today. And Jai Bharat Maruti is locked in a 20% upper circuit as we speak. BLS International will hear from the management shortly. That's up 6%. Zidus Life is doing well for itself as well. But on the flip side, PI Industries has not had a very good quarter, and that shows up in the price as well, 7% lower. Also for Z Entertainment, although some of the brokerages continue to remain optimistic, the stock though down 6.5%. And PTC India, the biggest fall in nearly 2 years after the results that it delivered, weak on the operational front, 8% lower on the stock. Electric mobility names continue to do well. Ola Electric, of course, is going to be reporting results today. It was supposed to report results on Monday. We're coming out today. JBM Auto is now up 3.5. Electra Green Tech 2 doing fairly well for itself. And lastly, of course, stocks that are at 52-week lows in today's session. Keynes Tech, another low for the stock today, but the stock continues to remain in the F&O ban. Pine Labs is extending its losses from its issue price, and Jyoti CNC 2 is now at a 52-week low today.
All right, Hormaz, thanks a lot for that. Let's go across to Nigel now, who joins us to tell us the takeaways for Novelis's numbers for Hindalco, which is doing well in today's trading session.
Well, that's right. Novelis's numbers actually were a little bit better. It was improved on better scrap spreads, though there were a couple of one-offs. Let's run you through the numbers first. On terms of shipments, it was down by close to 12%, but that was expected because the Oswego fire hit production out there. The adjusted EBITDA, though, that's the number you look at, that came in at around $459 million. With the EBITDA per ton, this is the adjusted number, came in at around $544 per ton. Remember, it was impacted because there was the negative $53 million from the Oswego fires. There was a negative $27 million due to the tariffs. But it was offset because $41 million of flood insurance is what they recovered. Remember, the flood was in 2024 itself. But there were two problems. One is the fire, they had earlier guided that it will impact the free cash flows by around $1.3 to $1.6 billion. Now, that number has swelled up to around $1.7 billion. The second factor is the net debt upon EBITDA. That swelled up to around the 23-quarter high at around 4.1 times odd. On the plant-specific guidance, they expect the New York plant to restart in the next few weeks, which is sooner than expected. They're also expecting the full commissioning of the Bay Minette project by the end of this calendar year. On guidance, they also went on to say that they expect to return to free cash flow positive number by the end of FY27. Put everything together, the positives outweigh the negatives, which explains the stock price move.
All right, Nigel, you know, the Hindalco metal detector keeps finding gold even in this market. Thanks very much for joining in with that. Let's move on to our next guest. Shikhar Agarwal, the Joint Managing Director at BLS International Services Limited, is with us now. Mr. Agarwal, thanks very much for your time here today. You know, let me just start with what's happening in terms of the conflict in West Asia and the impact of that that you're already seeing. You know, in Russia, Ukraine on one hand, there's renewed tensions there. Of course, the Middle East conflict drags on. As far as volumes are concerned and contract renewals are concerned, any fresh concerns there?
We have been operating in the industry for the last 20 years now, from 2007, 2008. We have seen multiple conflicts, multiple geopolitical scenario. But having said that, you know, we are now in 70 plus countries working with more than 40 client governments. So these scenarios have short-term impacts, but on an annual and global basis, you can see our revenue has grown up by more than 36%. Our EBITDA, you know, and PAT has grown by more than 35%. To 800 crore plus this year. So, you know, all these impacts are quite short term, but on an ongoing annual basis, we continue to grow. Even if you see our volume has grown by more than 10% to around 11 lakh applications for the quarter. And for the full year basis, we have done around 45 lakh applications in the visa business.
Right, so let's take that point forward. Shikhar, also along with that, if you could give us a sense on margins and realizations, right? 45 lakh applications is what you did in FY26. What is it that you're targeting in FY27? And realizations per application, because of the value-added nature of some of these applications increasing, you've been focusing a little on that as well. What does that mean from you know, the revenue standpoint, and how does that impact your margins? Because your margins saw a bit of a decline with the digital business being a bit of a drag.
So if you see our, you know, margins in the visa business, they have grown to upwards of 40%, you know, compared to 34% or last year. But if you see our margins in the digital business have gone down because of the acquisition of RD Phillips, which we had said is on higher revenue, and only 3% of the margin comes as a profit to us. So definitely because of the digital business margin down, the consolidated margin is stable at 25%, the same level as last year. But, you know, we see the margins maintaining, you know, in the visa business. We have said that margins have gone up from, it was used to be around 20%, then it grew 30%, now it's 40%. So we expect the margins to remain stable. You know, if you see our growth, last 3 years, our profitability growth, EBITDA growth has been more than 50% CAGR. You know, now with the increased base, we said that this year also we'll do around 20 to 25% growth, but we have surpassed that and we have done around 35% growth. Next few years also, our target is to maintain 20 to 25% growth, but with the increased adoption of this business outsourcing model with newer governments, new tenders coming in. If you see this year itself, we have won a lot of new tenders with the Indian government in China, with Cyprus government, Slovakia government. We won an Aadhaar tender, etc. So we continue to ramp up our new tenders, etc.
Shikhar, if you could give us a number on the revenue per application, and where do you see that going in this year?
I don't exactly remember what is the revenue per application number that we've achieved this year, but it is in our press releases, but it has definitely grown, you know, compared to last year.
So you've mentioned the fact that there are many contracts that are coming up for renewal as well this time around. So there are contracts in the $1 to $2 billion range that are up for renewal over the next couple of years. Could you specify some of the contracts that are coming up for renewal, and what kind of competitive intensity are you facing for renewing these contracts?
See, if you see this, the revenue that has grown in the company, the profitability, 35% increase that we have seen from last year is because of the new contracts also that we have won. There is a volume growth because we have won a lot of contracts from Slovakia, Cyprus, Indian government, Italy, Poland, Portugal. We also won the UIDI contract. So then at the same time, since it's a tender business, you know, many European governments, many governments in North America continue to come out with tenders wherein we feel that we can win certain market share that will lead to further volume growth, and we can continue our growth trajectory with that.
You know, what about the Schengen area? I mean, there's been some tightening of the visa process, especially for Indians in the last 12 months there. In that particular market, are you seeing some softness? And if you could also provide us an update on your UIDAI contract. You know, have you booked it this year? When do you expect it to accrue?
So if you talk about the Schengen area, we obviously policies keep on changing. I can't comment on a particular policy, but we have seen steady growth in demand from customers who are traveling to Europe from all across the world, including India. The demand is more than last year, what we can see. Obviously temporary because of certain geopolitical scenarios, demand could change, but on an annual or quarterly basis, we have seen growth in demand, in the Schengen area. And in terms of the UIDI contract, yes, we have the deployment was supposed to happen in phases. So we have already deployed phase 1, in which we have opened more than 50 offices across India. So some revenue has started to come in, but full ramp up will happen in the next 6 months. So full revenue of the contract will take 6 to 7 months to start accruing.
Right. Just a final question from my end. Shikhar, what are the other applications which are opening up in terms of business opportunities for you? What other countries are looking at opportunities in the next, say, 2 to 5 years? And also wanted to understand the global market share. How has that shifted versus VFS for you?
See, I don't know about the market share of a company, but I can comment on our market share. I feel when we started, 5, 7 years, 8 years back, we were at 5 to 7% market share. But if you see in the last 10 years, we have grown to upwards of 15 to 18% of global market share in the visa outsourcing industry. And we feel that with the acquisition of new contracts that we have won this year, that we have already announced, our market share should go up further. And the new tenders that are coming up for renewal from the outsourced governments, definitely will lead to an increase in market share. Multiple governments in Latin America, Africa, etc., are outsourcing for the first time. New categories of applications like passport renewal for foreign governments is being outsourced. So definitely that will lead to an overall increase in the industry. And as you have seen, we have delivered consistent numbers over the last 5 to 7 years. And this year also we have declared the highest ever dividend of 100 odd crores. We delivered 250% of the face value, as dividend of more than 100 crores of dividend we have declared this year.
Shikhar, thank you for sparing time and joining us today on the show. Wish you good luck for the rest of the year as well. And that was the management of BLS International. The stock doing well for itself, 6% higher as we speak. It hasn't done much over the last 1 month, but positive earnings reaction nonetheless. But of course, the big talking point all through this week has been the currency. Another day, another record low, although it has seen some recovery from levels of 96. Now, dealers are saying that oil prices remaining above $110 a barrel remains a key sentiment negative. Lata is here with more on the currency. Lata.
Well, it has been falling for the past several days, weeks and months. But this sudden rush towards 97 took people by a bit of a surprise. 96.96 in the first hour of trading was a bit of a shock. That makes it about a 0.5% fall in one day and made it one of the weakest EMs at that time. Now, the reply of dealers, comment from dealers is that Reserve Bank was not there for a goodish bit. And then when it came in, the rupee recovered. They alleviated the pressure. And the main talking point is really, as long as BOP is so wide, why is the balance of payments deficit? Now, balance of payments deficit is just a combination of the current account deficit and capital account deficit. Together, we used to have a capital inflow, although a current account deficit. But since that capital has become an outflow, the whole BOP deficit for a third year running looks very bad. That is the talking point. And crude remaining over $110 for a third day in a row, remaining over $100 for 3 weeks in a row, from May 1st. All this is eating into the market's calculations about the rupee. The other factor is expectation. Because there's so much chatter in the media, the rupee has entered even white papers. It has even entered general news channels. So the expectation that RBI will do something, government will do something, and nothing major happens. I mean, how much can they do? That also feeds on the market's patience, according to dealers. If it crosses 97, the record looks bad because it crossed 96, guess when? May 15th. So, we are barely on May 20th and we are already looking at the next big number. That's a bit of a concern in the market.
All right, Lata, thanks a lot for that. That is a bit of a concern in the market. We will obviously monitor the rupee as we go along. Has an impact on the way the equity markets trade as well. Important news at the bottom of your screen with regards to Ashok Leyland. BSE and NSE have approved the merger of Hinduja Leyland Finance with the company, NDL Ventures, that is. So we'll, talk about that as well. We'll take a short break for now and take the rupee story forward in a special big segment big story. This time, reasons run deeper than just the dollar. What's happening here? We will break that down. And also, Kanika Pasricha, who's the Chief Economic Advisor, Union Bank of India, joins in to give us more.
Welcome back, and as promised, let's shift focus to the bond market action. Manisha Gupta joins in with the latest. Manisha, take it away.
Well, thank you so much for that. There's just so much happening into the markets right now. And when it comes to bond, we seem to be looking at what the global markets also are doing. So it's an upward pressure, really, when it comes to yields therein. The benchmark 10-year government bond is now past 7.10. In the earlier part of 2026, we were holding around that 6.77% of a mark. So clearly, a lot has changed since then, and we've seen international yield also continue to surge there. Well, it is basically because of the escalating geopolitical tensions in West Asia, where markets haven't seen any resolution come in from. And then you have the surging Brent crude oil prices holding above that 110 mark. And today is the fourth day of that happening as well. And then domestic inflation fears is yet another thing that the street is looking at. The RBI recently has auctioned 34,000 crores of a new 10-year government security at a cutoff yield of 6.94%. If you look at this new paper, that seems to be really setting floor for the corporate borrowing rates as well. The other thing that the street is looking at is the state development loans. The cutoff yield onto this one is as high as 7.6 to 7.8%, and this is because of the heavy supply pressures that we have seen into the market there. Also, to support the market liquidity amid all of this foreign fund outflows that we have seen, RBI also has raised the annual trading targets for 21 primary bond dealers for the country there. The high sovereign yields that seems to be spilling into the corporate debt market. The state-backed financial giants like REC and NABARD cancelling almost 19,000 crores of corporate bonds is yet another thing that the institutional investors are watching out in sense of cues here. The rupee has constantly continued to decline as well today. After hitting an all-time low, we seem to be trading slightly off those numbers, but not too much. So all of these concerns keeping the yields on the higher side.
Manisha, thank you for that update from the bond markets. 7.12 is where the 10-year currently stands at. Take a short break. On the other side, we get you Rajesh Palve of Axis Securities for a quick chart check and, of course, some trading ideas as well. Welcome back. We are almost on the verge of turning positive on the index now. We're nearing that 23,600 mark. So the recovery continues from the lower levels. It's an almost 150-point recovery now from the opening lows, where we opened around with cuts of close to 200 points. And now there is a recovery. Look at Reliance Industries now over 1% higher, and aiding those gains along with Reliance Industries are Hindalco, Axis Bank, Bajaj Auto, ONGC and Larsen and Toubro. So the index continuing to recover from the lows of the day, even as the banking stocks, barring Axis Bank, remain a little sluggish as we speak. Rajesh Palvia from Axis Securities is joining us now for a quick chart check. Rajesh, good morning. Thank you for joining in. Every time there has been this dip towards that 23,350, 23,400 zone, there has been buying interest that has emerged, yes, but there is still this lack of conviction about the 50-day moving average close to that 23,800 mark. So what do you do in a market like this? Your call on the index and your stock recommendations as well for the morning.
Yeah, hi, morning. So in last 3-4 trading session, what we have seen, 23,600 is acting as a magnet level. Even in the gap down opening, we are again moving back towards 23,600. And again, even if market moves higher towards the 50-day moving average, again attracting the supply pressure and closing around 23,600 plus minus 30-40 point. So this is happening since last 4 trading session. Looking at the broader market, we do believe that market is trying to digest the negativity which is there from the geopolitical, from the rupee depreciation and all other factors which is looming around in the market. I think any positive news can trigger good buying interest in the market, as broader market is giving sign that market is poised to give breakout of 50-day moving average. And looking at the data setup also, again, there is a confidence on the put writers at 23,500, 23,400 strike. So whenever there is a dip in market, put writers are aggressive around these strike, and they are trying to defend this lower level. So I think at this juncture, those who wants to trade in Nifty, so they have to wait for the levels to play out. When you get opportunity around 23,400, 23,350, you can buy with stop loss of 23,300, and on the higher side 23,550 or 600 is the level where one can book profit also. So this could be a possible trade strategy one can deploy in these kind of volatility. But yes, any breakout about 23,800, one can add on more position, and I think then we could see a good amount of short covering action to play out, and then Nifty can scale up to the 24,200 level also. So 23,800 is the a major threshold for the market on the to take this further higher. But Bank Nifty is still struggling to cross major supply zone, which is placed at around 53,600, 700 zone. This is very important and critical for Bank Nifty to take out. Once we able to take out these level, then here also we could see some support to the market from the banking stocks also. Till the time sell on rise is the structure for Bank Nifty until we are not able to take out 53,800. Some of the select pockets are showing sign of strength. Pharma, metal, even in today's session, automobile is also contributing to this up move. So I think one can focus on these 3-4 pocket where continuity of uptrend is there. Even capital market theme is also looking attractive. So 3-4 pockets are looking attractive on the long side of trade at this juncture.
All right, they are looking positive at this point in time, and there's been a stellar recovery from the lows as well. Individual stocks, what are you backing this time, Rajesh?
So I think first stock where we are focusing is from the automobile, and Bajaj Auto is looking attractive as overall structure is bullish. In this volatility, stock able to defend its near-term, short-term moving averages, and the kind of recovery which we are seeing from the support area of 10,250. I think this stock has potential to extend gain. Projecting target of 10,650 to 700. On the downside, 10,250 needs to keep as a stop loss. Another stock where we are focusing is from the pharma space, and I think overall pharma basket is looking attractive. Zidus Life is looking attractive. The way stock has managed to give breakout of previous swing high. I think if it's continues to trade above 1,040 level, the upward target for this stock would be around 1,095 to 1,120. So buy and accumulate would be the strategy. On the downside,
1030 needs to keep as a stop loss.
All right, we take that point. Thanks a lot for that. Rajesh, meanwhile, good time to get in a perspective from the F&O space as well right now. We've seen a fair amount of recovery from the lows for both the Nifty Bank, as well as the mid-cap index. In fact, the mid-cap index has been the best performing over the last few minutes or so, currently sitting with practically negligible cut, just about moving into the green as we speak. Alongside that, if you look at the kind of recovery that we've seen from the index heavies, we have Reliance, which has led the up move on the frontline index. Hindalco has been doing well right from the word go. Then we've seen some traction from TCS as well. After a big move over the last 2 trading sessions, IT continues its up move. And Maruti, today the auto pack has also come into the picture. So all these stocks doing well for the frontline index. We have, the market breadth as well, as you see the lines coming very close to each other. An hour ago, where there were sub-1,000 stocks which were advancing, and now that number's moved closer to 1,300. So that's a positive. But all said and done, despite the recovery, the market's still in a broad range. The Nifty is 23,600 right now, but where we are looking at in terms of a range is day before yesterday's low and yesterday's high. 23,300 at the lower level to about 23,800 at the upper level is where the market has been oscillating between. And that's what the option writers are positioning themselves for as well. 23,500 put is fairly written today at about 200 rupees in premium. Remember, these are ones that expire next Tuesday, so that's why the premium's higher too. So 23,100 thereabout is an important support that these writers are hoping for. Also, the 23,400 put writers equally active. On the way up, 23,500 call writers are fairly active too. They are playing for some sort of supply to come by closer to yesterday's high of around 23,780 thereabout. So 23,800 is where supply is. Short point, 23,300 to 23,800, the range continues. Fresh longs seen on Zidus Life after strong commentary coming in from the management post their numbers yesterday, and they announced a buyback too. So that's about the F&O space. What we'll do is take a short break, come back, market fundamentals with Jyoti Vardhan Jaipuria from Valentis Advisors.
Welcome back. We have Jyoti Vardhan Jaipuria from Valentis Advisors, who's joining us now to discuss market fundamentals and his sectoral picks. Jyoti Vardhan, thank you very much for joining us here. As Mangalam was also just pointing out before we went into this break, the small caps, they've been doing very well in what has been a very, volatile, choppy market. Today again down, but, over the next, medium to short term, do you see a further upside from here? And, where particularly within the small caps, are you seeing the best opportunities now?
Yeah, so, we've been bullish on the small cap. Last year, we were negative on them, and we changed our mind at the early part of this year. There are 3 main reasons. One is, I think, earnings are going to pick up in general in India. We have had 2 years of single-digit earnings growth, and I think, we'll see a recovery over the next 2 years, in spite of, what the war has done and what oil prices up. And in the earnings recovery, generally small caps tend to do better than the mid and large cap. If you see the last 2 quarters, also earnings for the small cap are growing at close to 25%. So that is one of the main reasons why we like small cap. The other is if you see the balance sheet of the small caps, just like the large cap transformed over the last decade, we've seen small cap, balance sheets have become much better. Debt equity levels for the small cap as a whole is only 0.3% now. So this whole boom bust cycle we've had in small caps probably will get a little better now as we go along. And third is obviously they've underperformed a lot over the last 18 months. There's, no euphoria now. There was a lot of euphoria 18 months ago. So small cap has become the hated category, which I think will do well over the next 2 years.
Indeed. Jyoti, the other theme that has been the big talking point all along the last couple of months has been electric mobility. And you've seen these stocks go up one way, be it JBM, Electra, and an underperformer like Ola Electric too has gone up from 20 rupees to almost 40 rupees now. Whereas that electric mobility as a theme, the stocks have run up significantly, but do you further see a runway as the adoption kicks in even further among consumers?
Yeah, so these will be themes which, will keep playing out over the next many years. What is 10 years later, EV vehicles will be a much bigger percentage share of the total vehicle population than what it is today. The ways to play it, of course, can differ. And for us, we prefer to, focus on some of the ancillary people who will benefit from, who gains market share could be a moot point here. But as long as the trend is up, a lot of the ancillary guys will benefit much more. And that is the way we tend to play them.
Take that point. Jyoti, you did say that you are getting bullish on small cap, and I see some outperformance that took place for your PMS earlier as well. I'm reading your note, and you said that valuations are still richer than what we've seen earlier in the small cap space. So do you reckon this up move will be led more by earnings than multiple re-rating? And if it's earnings, then what sectors are likely to lead it forward?
Yeah, Mangalip, so you're right. So in the note, we highlighted that, valuations are not as cheap as they were in the previous cycle. So, and this is, true across the board. Like even if you look at the large cap or we look outside India also, valuations over the last decade have relatively elevated compared to what they were in the previous decade. One reason for that is really the interest rates, which are, much lower than what we've seen. But when we look at, the small cap valuations, it is higher than what it used to be in the past based on a PE basis. It is more or less equal on a price to book basis. We are more or less at, long-term averages. And if you look at PEG, and it's not something which I'm very fond of, but if you look at a PEG ratio, then, the small cap trades at like 1x PEG ratio, and which is cheaper than what, the large caps and the mid caps are. Now, a lot of the growth here will be led, I think, by operating leverage. It will be led by companies which have actually put up capacities which were running at low utilization because, the demand environment has been weak. And so if we look at a lot of our companies, if we look at the next 1 year, we have earnings forecast of close to 30% for our set of companies which we have in the portfolio, which would be a really healthy growth. A lot of that is being driven by operating leverage.
So, Jyotivardhan, simply put, for investors that are looking to deploy cash in the current market with the kind of correction that the markets have seen, what would you say, apart from some of these sectors we've discussed, would be your top picks?
So, I would say one is the banking space and the whole BFSI space, which has not done too well for the last many years. That is last few months. And that would be one area which looks attractive. The second is pharmaceutical, which is very interesting. It's like a secular story. They gain from the rupee depreciation. So I prefer this over the IT, which, is probably a short-term buy, but is something which we have longer-term concerns about. The third would be, playing things which will benefit from probably, growth in spending. So cement is one area which we like. And in cement, what we've seen is a lot of consolidation which has happened in the sector. The sector has not done anything much for the past 2 years. And now we think it's time that, the sector starts to see pricing power going ahead in the next couple of years.
Jyoti, pleasure having you as always. Thank you so much for sparing time and joining us today on the show. Take a short break. On the other side, continue our conversation on the currency and what is leading to this breakdown that you're seeing towards record lows. Kanika Postricha, the Chief Economic Advisor of Union Bank of India, joins in on the other side. Stay tuned.
Welcome back. You're watching Trading Hour, and the rupee's record-breaking slide showing no signs of easing is our big story for today. The currency has now hit a fresh all-time low of 96.96 against the greenback in the trading session, extending its losing streak to an 8th straight day. The rupee is now down more than 7.7% so far this year, making it one of Asia's worst-performing currencies for the year. The pressure on rupee has been building for more than a year now, but even more rapidly since the escalation of the West Asia conflict because of the rise in oil prices. And now the currency has weakened by nearly 6.5% since late February. What's to blame is the spike in oil prices, the stronger dollar, the rising yields, persistent foreign outflows, the risk aversion generally with the geopolitical conflicts, and an increasing worry about our widening current account deficit. All of that, Mangalam and Hormaz, is playing out and pressuring the currency.
Indeed, Ritu, you spoke about some of these factors. Let's go over each of them one by one.
Well, Mangalam, no doubt, the big one, of course, is the oil prices. Brent crude has surged above $110 a barrel. It's up more than 50% since the, West Asia conflict began. And for India, which imports the bulk of its crude requirements, that translates into a sharply higher import bill and a much stronger demand for dollars. The oil shock is also, of course, raising worries of imported inflation, which economists on the channel have also been talking about, and a wider current account deficit. Both are negative for the rupee. But, it's not just oil. While that is a big factor, global investors have also been moving towards safe haven assets. So a stronger dollar, higher US bond yields, the rise in gold prices, all of that reflects this risk-off environment. Treasury yields, especially in the US, they've surged. The 10-year yield in the US is now at a year high, a 12-month high, and the 30-year yield is at its highest level since before the global financial crisis. So markets are even beginning to price the possibility of another Fed rate hike, which is putting further pressure on emerging market currencies, including the rupee. And of course, as we've been talking here on CNBC TV 18, foreign flows, they've been negative. That's adding pressure. With foreign investors have pulled out nearly 19,000 crore rupees from the Indian markets just in May so far, taking the total outflows for 2026 at over 2.07 lakh crore rupees. That is more than $22 billion. And of course, higher US yields are making dollar assets far more attractive for these global investors.
Oh, they indeed are. And Ritu, now finally tell us, how does this weaker rupee pressure the macros, and what steps are the government and the RBI taking for this?
Well, there are, of course, several macro implications here for India. The import cost rises, that's the first one. The pressure builds on fuel prices and sectors, like your aviation, chemicals, paints, all these import-dependent industries, they face higher input costs as a result. There's also concern that a persistently weak currency can also push up inflation and widen our current account deficit. Of course, the RBI and government have taken several measures so far to ease some of this volatility, prevent more dollar outflows. For instance, fuel prices have been hiked twice now. The import duties on precious metals has been increased. RBI has been intervening in the spot and forward currency markets. They've also capped the net open position for banks at $100 million a day to curb any speculative positions. And for the markets now, the next psychological level to watch out for is 97 rupees per dollar mark, and we're not too far off from there. Investors will also, of course, track the direction of, the oil prices, US-Iran developments, moves in US bond yields, Fed, rate expectations, and whether RBI's intervention intensifies and how all of this impacts the outcome of the June MPC meeting. So far, the consensus has been for that of a pause. But I wonder, if there is also, some parts of the market that are talking about a potential hike. Actually, on that note, let's invite Kanika Pastricha, the Chief Economic Advisor at Union Bank of India, who's joining us now. Kanika, let me put that question to you. With all that's happening on the currency, and so far RBI has been very hands-off in saying, it's a shock absorber. They don't target any particular level. They only ease volatility. I wonder if the pressure to, hike rates sooner than perhaps the end of the year, the chances of that are going up now.
So Ritu, thanks for having me on the show, and you've beautifully laid out the framework of the currency at the current juncture. See, frankly speaking, the driver of rate hikes at the current juncture in this year, while rupee may be one of the reasons, I would still want to focus more on inflation risks, driving risk of rate hikes sooner rather than later. See, frankly speaking, we all, in our base case scenario and even MPC at 4.6% inflation for the year, has penciled in average oil price of $85 per barrel. In case numbers move closer to $95, which we think can happen even after the war ends tomorrow because of the kind of supply disruptions we are bracing for, the inflation forecast for the year moves from 4.6 to 5%, even as per RBI's monetary policy report. So in that scenario, the possibility of a rate hike, which we are penciling in Q3 of the year, later part of 2026, can shift towards the August meeting as well. So a close watch on that. I would still say, since we are in an uncertain world and we are all waiting and watching for what really is the end game of the war in the very near term, when does the Strait of Hormuz opens. June meeting is not live, though the guidance will be on watch. But maybe August can be the next live meeting if oil prices stay above the $100 per barrel mark. That's one. Second, do we think rupee is a shock absorber? Yes, partly, but I would still not at these levels when rupee is a beacon of macro stability, overall market stability as well. Though yes, in an uncharted world where the US 10-year is at 19-year highs, we can see overextended moves in the currency. But using the currency as a shock absorber is not our view. We think as part of the policy package, consistent intervention to limit overextended moves in the currency is also needed to protect market sentiment. Thanks.
But, Kanika, this persistent intervention you're talking about, the RBI has burnt almost $40 billion just since Feb, to stem this sort of, the steep fall that we've been seeing. But the, decline seems inevitable from the kind of, levels we saw at the start of the year, down more than 7.7% or so. Are the measures not proving effective because of the current macro situation we're in? And to your mind, apart from what's already been done, what is the next best measure that the government or RBI could take, or the more likely one to your mind?
Frankly, Ritu, you're absolutely right. RBI has burnt reserves, but reserves are for rainy days, right? Now, even today, at $695 billion, if I don't adjust for the short, even if I adjust for the short dollar forward position of more than $100 billion, the reserve cover is still close to 9 months of imports. At the time of taper tantrum, it had actually slipped to 6.5 months. Of course, we would not want to get to that situation. We would want that RBI is able to cushion the currency, even though protecting the reserves as well. And a delicate balance is sought at the current juncture. Now, in terms of policy measures, some of the measures that have already been taken by the government to protect dollar demand, like, at least advocating work from home, with some companies, some states have already started to undertake fuel price hikes. These measures, and even gold import duty hikes, gold import volume curbs. Now, these measures are just a starting point. I would say more aggression in terms of follow-up to reduce dollar demand via, slightly, extended fuel price hikes in order to curb oil consumption demand may be needed. Today, we have done close to 4 rupees per litre. Maybe this needs to go towards 10 rupees per litre, even though the approach is gradual. I would still say non-essential imports are also being discussed, like electronics. Some more curbs on non-essential imports may also be looked at. But on the dollar supply or to curb dollar outflows, like LRS-related outflows, some sort of tightening measures can be looked at there. ODI outflows, maybe case-by-case basis, may be looked at. Dollar supply measures, like a repeat of FCNR from 2013, may not be advocated in the immediate near term. It may not be a dividend because of the way yields are, global conditions are tight. But once the Strait of Hormuz opens, maybe when conditions ease, global financial conditions ease, a concessional swap scheme to attract flows via FCNR or bonds is sought in the later part of the year, maybe in the next 3 to 6 months, on an immediate basis, because a structural part of BOP problem is capital account. Thanks.
Kanika, run out of time, but just 30 seconds on what's happening globally with the bond yields. There's worried about, inflation spike from the higher crude oil prices. And so the longer end of the yields, the 10 years, the 30 years are spiking up. Quickly, do you think we're entering the structurally high, yield regime? And how long, can India hold the floor then?
So you're right, globally as well. After an extended decade, I would say extended period of low rates, high dollar liquidity, we are moving into a period of high inflation and fiscal concerns also coming back. That's likely to lead to higher bond yields. Now in the US itself, the market is pricing in a December rate hike, even if it happens next year. But if oil sustains at $100 per barrel, even after the war ends tomorrow, oil sustains, in our view, at $90 to $95 per barrel, there is a case of rate hikes globally. And of course, a spillover impact will be seen on India as well. While the Fed may be in a wait and watch mode, given the kind of regime change seen, other G4 central banks are likely to hike sooner rather than later. And the spillover impact in India, currently our projection is Q3, which is December quarter. We have got to see where oil prices settle to see if there's a case for August meeting being live or not. Thanks.
Got that. All right, Kanika, thanks very much for being here and sharing those thoughts. We'll take a short break on that note. Up next, we'll get you more on the markets in just a bit.
Welcome back. The breaking news of the moment is that the Nifty has moved into the green, and as our ticker team is telling you at the bottom of your screen, Nifty Bank is off lows. All marketing companies doing extremely well, and the Nifty too has seen a near 226-point recovery from the lows, currently sitting in the green with about 5 points. But global fund managers, they've sharply reduced cash, and they've put their money into equities in May, and that's according to the latest Bank of America Global Fund Managers Survey. Hormaz gives us the highlights. Hormaz.
There's some very interesting takeaways that have come from this survey that was conducted last week between the 8th and the 14th of May. And the survey interviewed over 200 fund managers globally, with managing assets worth over $500 billion as well. You know, the bigger point here is the fact that the fund manager cash levels have now slipped below the mark of 4%. They are now at 3.9 compared to 4.3 in April. What happens generally when it goes below 4%? It triggers a sell signal generally for the market, and the median 4-week returns after such a move is around 1%, and the correction has gone as steep as 29% in some instances as well. Now, the big question that was asked to the fund managers is, where does the global economy go in the next 12 months? Now, from 9% in April, the hard landing group has gone down to 4%. Majority still believe it to be a soft landing, while others still say that there is no landing whatsoever, neither hard nor soft. Now, the biggest macro tail risk right now is not oil, but is inflation. And that is, of course, a byproduct of that. A second inflation wave, 40% of the fund managers believing so. Geopolitics, higher bond yields, which is the big talking point currently. AI bubble and private credit too are some of the other major risks for the market. The other major question is, when does the Strait of Hormuz reopen? Now, 44% of the respondents believe that this happens in June. Now, some of them still believe that it goes into the third quarter, which is, of course, in the July to September period. And some of them still believe that that this may happen even in 2027 or later. Oil prices continue to remain above $100 a barrel, but none of the respondents, or very few of them, only 7%, see that happening over the next 12 months, that they'll remain above $100. Majority of them expect them to be below, between 80 to 90, and some of them continue to maintain those levels at 70 to 80. Bond yields, of course, are the big talking point this time around. The US 30-year yield is now at the highest level since 2007, and 62% of the fund managers believe that over the next 12 months, that figure from around 5.25 right now can go up to as high as 6%, and only 20% of them believe that these yields can fall back below the 4% mark. As a result of this, what does the Federal Reserve do next? The ones expecting a rate hike now are only around 16 to 17%, one hike or two. Majority of them still expect a status quo all through the year, and some of them still are anticipating one rate cut at least to take place. And the others, of course, the big risk to the market, of course, goes of US shadow banking. 42% of them believe so. AI capex, US consumer credit, Japan government debt also is a big risk as well. What is the biggest crowded trade right now? That's the long global semiconductors. That continues to remain the most crowded trade. 73% of those fund managers believe so. Long Max 7, long oil, long emerging markets too form a part of the risk. The other question that we've been asking all along is, are the AI stocks in a bubble? Well, it's split right down the middle. 40% of them say yes, 50% say no. Now, where are the fund managers putting their money? Most of them are in equities, emerging markets, commodities, US stocks, telecom, industrials, healthcare, and they are underweight on bonds, they're underweight on cash, they're underweight on discretionary, they're underweight on the US dollar as well. But the big risk right now is not oil, but emerging inflation that could cause some panic in the markets.
Right, Hormaz, thanks a lot for that. So that was an interesting, incisive analysis into what fund managers did and where they put their money. With that, we're out of time on this edition of Trading Hour. Take the credit for taking the markets into the green. Now the onus is on the team of Halftime Report to ensure that it sustains out there as well. Thank you so much for watching.
Stocks recover a tad after a weak start as uncertainty around the Gulf conflict lingers on. Auto and energy eke out some gains, while FMCG and consumer durables are the drags.
Hindalco's US arm Novelis puts up a better than expected show following 2 fires at its units in Oswego. The company guides for positive free cash flows by end of FY27 after a big cash hit due to the fires. The stock perks up.
In a CNBC TV18 exclusive, the IRDAI chairman, Ajay Seth, says that the insurance regulator will unveil the distribution reform paper in 3 to 4 weeks and the public insurance registry paper by mid-June. The chairman also flags distributor-led pricing concerns and calls Bima Sugam transformative for customers.
The Indian rupee pulls back after slipping to near 97 versus the dollar. Economists back a gradual depreciation of the currency and a continued rise in fuel prices to address the balance of payments issue.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala and Ekta Batra. Recovery, that is the big story that we are tracking for now. On the Nifty, it's almost a 250-point recovery that we saw. We did get sold into from that level as well. But again, there's a recovery nevertheless. So after crossing the 23,600 mark on the Nifty, we did see some selling pressure from the highs. But look at the Bank Nifty, look at the mid-cap index, all of them attempting a recovery from the lows, almost a 500-point recovery on the mid-caps as well from the lows of the day. The Bank Nifty, again, after getting into the green, did see some selling pressure from the highs of the day. But we do have Reliance Industries, ONGC, Axis Bank, these big names which are contributing to the gains from the lows of the day. So yes, some recovery which is underway for the markets, but high crude prices, depreciating rupee, that continues to be the pressure points for now. Hey, girls.
Hi, Sonal. Hi, Vinny. Yes, absolutely. And you know what stands out is the rupee, which has recovered from the day's low as well. So while Brent crude stays at around $110 per barrel, we have the rupee, which is just about recovered from those levels of around over 96.9, which was very close to that level of around 97. Just some data with regards to the rupee as well. If you look at it on a year-to-date basis, the rupee amongst a handful of Asian currencies is the worst performing. It is depreciated 7.2%. Compare this to the Indonesian rupiah, which is down 5.7%, the peso, which is down 4.7%, the South Korean won, as well as the Japanese yen. All of these have depreciated this year, and the rupee has depreciated the most. But if you look at it on a 5-year basis, you'll get a better idea in terms of where the rupee stands. So the rupee has depreciated around 24.5% on a 5-year basis. But if you look at it, the Indonesian rupiah has also depreciated in a large amount. So it's depreciated almost 19%. The Philippine peso is depreciated around 22.3%. The South Korean won 25%. The Japanese yen, which is down 31% on a 5-year basis versus the dollar. So that gives you a perspective that, yes, while the rupee has depreciated significantly this year, on a 5-year basis, there are many other currencies which have depreciated as much or maybe even more than the rupee. Hi, Vinny.
Hi, absolutely. So yes, keeping an eye out on that rupee depreciation as well. We'll be keeping an eye out on where the market is headed. But we have a very exciting lineup for you all on the show as well today. And first up, we'll be focusing on the Q4 earnings, and we'll be putting the spotlight with the managements of these following companies: Borisil Limited as well as Nephro Health, to talk about the outlook of the company going forward. Now, in our What's Trending segment, we will focus on rupee and what's acting as a negative sentiment for the currency. And also, we'll have Vivek, who will join us to take us through all the stocks that are moving around in the trading session. So stay tuned in for that. But Vivek is first up, and he's going to take us through the stocks that are moving around. Vivek, while we're seeing a recovery in the market, a lot of movers because of the earnings and news flow.
Absolutely right. Good afternoon, and what a recovery we've seen. Midday, we are almost in green, and advanced decline ratio
going favorably in favor of the advances. Now, in terms of the individual stocks that we are tracking, especially in terms of news flow and results, Godavari Power and Ispat, one of the top NSE 500 gainers, very strong set of numbers, operationally strong quarter, higher by 8%. Zidus Life Sciences, FY27 guidance, much above what the street was anticipating, especially in terms of top line, and margins too expected about 24%, that stock higher by over 4%. Mankind Pharma is the other name on the radar, this particular stock, operationally strong Q4, that stock higher by 2.5%. BLS International, while the numbers overall optically look subdued, the management says Visa margins were quite strong and expects it to trend higher. That stock higher by 6%. And Dredging Corporation, FY26 Q4 was a turnaround quarter for the company, and the management has a very strong guidance, especially in terms of top line as far as FY27 is concerned, stock higher by 8%. On the other hand, quite a few drags as well. PTC India down 8%. Core margin as well as what the company earns in terms of broking revenues has actually dipped. That particular stock lower by 8% today. PI Industries, an all-round miss. The key molecule of the company continues to drag that particular stock lower by 7%. Z Entertainment ad revenues very weak. That particular stock too under significant pressure. The entire FMCG pack, underperforming in today's trading session. Sharp spike up as far as input costs are concerned. So Britannia, Godrej, HUL, all of them a little bit of an underperformance today. And the entire NBFC pack too seeing quite a bit of selling pressure emerge. L&T Finance, Birla Capital, M&M, all of these stocks that were outperformers in the last couple of weeks, today seeing a bit of profit booking.
Okay, all right, Vivek, thanks very much for that. So a lot of stocks which are buzzing in today's trading session. But let's get talking about one particular company that released its numbers. Prashant Goenka, the group CFO of Nephro Plus, which basically has nephrology centers across for dialysis centers in India as well as internationally, joins in to talk about the quarter gone by. Mr. Goenka, thank you very much for taking the time out and speaking with CNBC TV 18. Well, what I did notice this quarter was that there was margin pressure which came through, 20.2% versus 23.4% both Q-on-Q as well as year-on-year. What were the pressure points in terms of the margins, and what can you guide for in FY27?
Thank you so much for having us. As you indicated, we declared our results today. And just to give you a broader picture, our revenue increased by 32% year-on-year. Our EBITDA improved by 38% year-on-year, and our PAT improved by 75% year-on-year. This reflects the underlying dialysis industry in which we operate. Dialysis is a very recurring, predictable set of treatment. We have the industry-leading position in the country, and the underlying economics reflects the leadership position that we carry. To your point about margin compression, from a year-on-year perspective, our margins have actually improved from 22.9% to 23.9%, so a 100 basis point improvement. Our PAT margin has improved from 9.7% to 12.8%, so 310 basis point improvement. In the Q4, you may have seen some margin compression, where the margins have actually decreased to about 20% odd number. That is predominantly driven by a one-time ECL exercise that we have undertaken. We have a defined ECL model where we look at all the accounts and the aging of the account. And on the basis of the ECL model, we have taken a one-time provision of 10 crore, which has taken the margins down. If we exclude this ECL provision, our margins are around 25%, which is in line with the historical numbers.
All right. Just wanted to understand if you could break up for your investors what exactly growth looked like in terms of the domestic market as well as your international markets, because your international markets seem to be generating higher margins.
Correct. So I think if you look at the international mix, our international mix has gone from 32% of revenue to 42% of revenue this year. As a strategy, we have stated that we would like to grow in international market, and we aspire to open a new market every year. In line with that strategy, we continue to expand our international footprint. Now, in terms of the profitability piece, one thing to remember about Nephro Plus, that it's the India platform that is driving the growth. We have operated in India at a $22 price point for last 16 years. It took us 10 years to become EBITDA positive. It took us 13 years to become PAT positive. Because when you develop a critical scale, that's when the barriers to entry, that's why this industry has very high barriers to entry. But when you reach the critical scale, you create an operating model. And when we carry this operating model to foreign markets, we are able to generate excess return compared to the local competitor. So in terms of our future strategy, we will continue to strengthen our India platform, and we will take this platform to multiple countries. We are currently in 4 countries, and
So,
we will continue to expand in both markets.
Mr. Goenka, so can you tell us what is the differential in growth in the international markets versus domestic markets currently? Yes, you are seeing more growth in domestic. So what was the growth in the quarter gone by and the year gone by in these 2 markets? How much higher are the margins in the international business? Will you continue to grow that to a higher contribution in your portfolio?
Yes, we will continue to grow to a higher contribution from an international market. In terms of the profitability, we don't break it down by the country level because it's a platform play. There are many costs which are sitting in India which contributes towards the international growth. So when we look at the financials, we look at it at a consolidated level, at a platform level. And when you look at the platform level, our margins have actually improved by 100 basis points on the EBITDA level. And on the PAT level, our margins have improved by 310 basis points. It is a dynamic play between the India platform and exporting that India platform to international market. That dynamic is what is driving the higher margins at the platform level.
Sure, Mr. Goenka, just talking a bit more, could you help us with the international market, the occupancy trend that you're seeing overseas as well, especially in markets like Philippines, Saudi Arabia? What is it over there? And what is the utilization there? How is it versus your mature centers in India as well? You're saying growth, but just to understand the trends right now.
So dialysis is a fixed capacity business. We have 3 sessions per day. Each session runs for about 4 hours, including the before and after time, it's about 5 hours. And it's a fixed capacity business. It's very much like an Indigo or an airline industry, where once you use the fixed capacity, the only way you can grow is by adding more capacity. So in our case, in dialysis, the morning and afternoon shifts are preferred by the patient. Patients typically don't prefer the night shift because by the time dialysis is over, it's 10 p.m. in the night, and they prefer to have dinner with their family. So our morning and afternoon shifts are fully occupied in most cases. Our evening shifts are less occupied. Our current utilization rate has improved from 74% to 75%. And that represents the optimal level of the utilization in a dialysis industry. So we don't have that concept of new versus mature center. In most of our center, because of the significant demand out there, we reach this optimal capacity of 70 to 75% fairly quickly. And then there is a gradual improvement in the utilization and the frequency, which drives for the growth.
So, Mr. Goenka, what can we see from Nephro Plus in FY27? If you were to talk about revenue, if you were to talk about margins, as well as your capacity expansion, where are you looking to possibly set up more centers, India, abroad, how much? Take us through what we should expect in FY27 from the company in terms of guidance as well as capex.
So in dialysis industry and in Nephro Plus, there are 3 levers of growth. The lever one is where we have existing capacity in India, Philippines, Uzbekistan, and Nepal. That capacity will organically grow either by improvement in utilization or adding capacity in the existing center. This lever is very predictable. We can predict the growth of this lever month on month, quarter on quarter, very predictable lever. The second lever of growth in our business is adding more capacity, adding new centers in India, adding new centers in Philippines. For example, last year we did about 11 acquisitions in Philippines. We added 52 new centers in India. This part of the lever is predictable not at a quarterly level, but it is fairly predictable at an annual level. The third part of the lever is where we add a new country, where we do a large-scale M&A, or we add a new PPP, a large-scale PPP. This part of the lever cannot be predicted even on an annual basis. This part of the lever typically kicks in every 1 to 2 years. So the guidance that we have given to the market is that we will bring 15 to 20% revenue CAGR over a horizon of 3-4 years.
Okay, all right. Take that point, Mr. Goenka. Thank you so much for joining in today and giving us insights on the business outlook going forward. That's the word coming in from Nephro Plus. They are talking about platform level EBITDA improving by 100 basis points and the outlook on the business going forward. Let's move on now. PM Modi is in Italy as a part of his 5-nation trip. And while visiting Prime Minister Meloni, the Prime Minister brought with him a special gift. Take a look.
Prime Minister Modi brought us a gift, a very, very good toffee.
Melody.
Welcome back. You're still tuned into Halftime Report. Borisil is the second management on the show now. It reported a weak set of Q4 numbers. So basically, their revenue growth this time around was in single digits, 5% up on a YOY basis. Margins, however, came under pressure, down 310 basis points. Shrivar Kheruka, the MD and CEO of Borisil Limited, is joining us now. Shrivar, good afternoon. Thank you so much for joining in. A 5% revenue growth in Q4 of FY26, which compares with an 18% growth that you saw in the quarter same time last year. FY26 revenue growth has come in at 8%. Tell us what the outlook is for FY27 and that margin pressure. Was it largely because of gas availability? What are some of the internals that you would like to talk about?
Yeah, well, thanks for having me. As far as your questions are concerned, the revenue has been impacted mainly because of one of our product categories, which is our insulated steel bottles, which have come under BIS about 12 months ago. The supply chain has been impacted, and our own plant for production of these bottles has just started trial production a few days ago. So the last year we lost almost about 100 crores of revenue because of lower sales of these items. Without which the revenue growth would have been more than 15-16%. So if we look at all the categories, I think we've had a very strong revenue growth in the last year. But this one category has impacted overall revenue. Coming to margins, you're right. I think the biggest impact on margins has been the higher gas prices, which we were hit by at the end of February, early March, as well as the non-availability of gas, which caused a temporary shutdown of our production lines in Jaipur. So there's a lot of unabsorbed fixed costs, as well as the operating costs went up. So we had kind of a double whammy last year. And I think going forward, if I look at it, we've always guided for a 15 to 20% CAGR on revenue growth. We'll stick by that. It's improper to comment every year on year or quarter on quarter, but I think in principle we should recover on the bottles. And as far as margins are concerned, we obviously have taken price increases, but there's a lag effect of impact of that.
So there is a lag effect that comes in. Shrivar, good afternoon. I just wanted to understand a bit more, right? Like obviously we spoke about the impact, LPG shortage and all. You have 3 furnaces in Jaipur, I believe. And in that also you had spoken about to us last time that 1/3 of the production was impacted. Now what is the situation? Because from the West Asia front, everything has not yet eased out. Is that expected to continue in Q1? And maybe at least in Q1, that pressure is something that could continue. What is the on-ground situation currently for you all?
So I think the government of India has done quite a strong job of ensuring availability of supply of LPG. So we today have enough LPG to keep running our operations. We made notifications to the stock exchange of the same. So from April, we've been running the furnaces, all 3 of them. But the challenge has been pricing, which I guess is a market-driven price. Gas prices are fluctuating between 2.5 to 3 times of what they were pre-West Asia crisis. And all of that impact has to be passed on to the end customer, unfortunately. Not much we can do about that. It's too large an impact for us to bear. But there's a transmission lag, which may be 3 to 4 months, I would say. So yes, Q1 will be impacted from a margin perspective.
Okay, so when you say Q1 will be impacted from a margin perspective, you did 10.6% in terms of margins this quarter. So is it going to be same? Is it going to be lower? Is it going to be higher? What's the range for Q1? And if you could extend it maybe to FY27 based on the visibility that you have.
The funny thing is that the gas prices are literally changing wildly day to day. So it's improper for me to give any kind of estimate because whatever I say today may not hold true tomorrow. So our endeavor has always been that our margins, which have been in the 16 to 17%, EBITDA margin has been 16 to 17%. Our endeavor has to be to grow that to the 20s. And that's something we've also stated that in the next couple of years, we expect as manufacturing becomes a larger share of the mix, we'll get to close to 20%, if not cross 20%. Obviously, we've been set back on that journey. So I think overall, if I take a 24-month horizon, I think we're still on track for that. In the short run, I'm sorry, it's hard for me to give you any kind of prediction because the volatility is too high. Yeah.
That's understandable. As you said, gas prices, crude prices have been quite volatile. We don't know what would happen next. But tell us about your inventory levels then. In quarter, the last conversation that we had in March, you were comfortable. Nobody anticipated the crisis to go on for so long. What are the current inventory levels? Since supplies are getting hit, are you seeing working capital getting stretched? What is it currently versus what you saw in the quarter gone by?
So look, as far as inventory, we're perfectly covered. We started drawing down on inventory when the plant stopped production for a few days. But since it restarted, we're back up, and inventory levels are normalized at between 90 and 105 days, depending on product. So that's something where it's not a stress point at all on that front. From a leverage perspective, we have virtually no debt in the organization. In fact, we have almost zero debt in the organization. So we're not worried about that at all. So overall, I think the situation has improved since the last we spoke. Demand, of course, with the price increase is still a question how that demand will kind of be absorbed because there have been cost increases across the board for customers in India. And I assume fuel prices will further go up, in the near future. So the demand is something that we'll need to watch out for. But outside of that, I think we are well positioned from a competitive perspective.
Shrivar, a couple of points that I want to know on. One is the Opal glass furnace. How is the current operating capacity there? What is the expectation going forward in Q1?
Yeah, so the Opal glass has been, as far as operations, we are at 100% operating at 100% operating capacity for Opal glass as well as a borosilicate glass, and that's not going to change unless something dramatic changes. So we expect to produce and sell the entire capacity.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us, Shrivar. So that is Borisil. A little hesitant in terms of providing guidance, at least for the near term, but the guidance is that they would like to get back or achieve 20% margins, get back to the 14-15% margins that they have been historically working with as well. Well, for the markets, absolutely flat, so just about lower by around 20 odd points currently for the Nifty. We have the mid-cap index just about holding its head above the water, but very precarious at this point in time. We'll do one thing, we'll go full tilt on the markets. After a short break, we have Somal Mehta of Mirai Asset who will be joining in, Mirai Asset Sher Khan rather, with some trading calls. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is 23,600, just around that market spot it's trading at, but recovered from the day's lowest point nonetheless. But let's talk about rupee, right? The rupee touched an intraday low of 96.96 per dollar in early trade before recovering a tad. Dealers say crude above $110 remain a key sentiment negative for the rupee. Let's understand more on this, and we have Lata to take us through all of that. Lata, afternoon.
It is a more of the same market. The rupee has been responding to the crude pressure for some time now. But, you can take pain every day, more pain, and there's more loss. But there comes a time when the pain is simply too unbearable. $110 for the last 3 days, for all of this week, and over $100 continuously from May for this entire month. That has quite clearly resulted in the breaking of spirit in the market. So the distance from 96 to 97 seems to have been covered rather quickly. We hit 96 on May 15th. And now, we reached very close to 97 in early morning trade. And we were among the weaker currencies in Asia, at least. The RBI intervention was not there in the early morning trades, and maybe that's why the rush happened. Thereafter, the Reserve Bank selling dollars alleviated the pressure, but not entirely. We can see the rupee dilly-dallying between 96.80 and 96.90 for a better part of noon trades. So really, the pressure is not going away at all. Some of the dealers say that lack of any further announcements is also kind of disappointing. The small number of rupee bulls who think that, okay, rupee has fallen enough and it's time now to sell dollars. That category of people are getting disappointed that there are no announcements. The media is speculating about capital gains tax, withholding tax, ECB announcements. All kinds of things are being speculated. But since nothing has come, that is adding to their disappointment, is one school of thought. The event happens, the rupee falls, and people are looking for explanations. So all these are coming from the chatter in the market. But the important point is that the rupee is falling a little rapidly. May 15 to May 20th, a fall from 96 to almost 97 is not a very happy thing at all.
Okay, all right, Lata. Thanks very much for that. In fact, yes, it has been a rapid depreciation that we've seen for the rupee. It's down around 7% plus this year itself. So recovered from the day's low, but nonetheless still at 96.88. We'll do one thing. We'll take a short break with the news that the Nifty is absolutely flat at this point with a little bit of a negative bias, but the mid-cap seem to be doing better. On the other side, we'll get you a lot more in terms of stocks. Stay tuned. Welcome back. Well, for the markets, like we've been pointing out, it's recovered from the day's low. The advanced decline ratio is still in negative terrain. Just want to point out that there are, however, stocks which are managing to buck the trend. So we have Zidus Life, which has done very well in trade today. It's up around 3.6%. The street likes the commentary from the company with regards to the US business, which they're positive on going into FY27, as well as what they are targeting in terms of specialty drugs. Just watch out for IOL Chemicals as well, because it comes out with its numbers today, and that stock has already rallied 20% this month. So IOL Chemicals is going strong into its numbers, up around 3%. But Manisha is here with us to tell us what she's looking at in the commodity space. Manisha, over to you.
Thank you so much for that. And joining us for this segment is Sandeep Bajoria. He is CEO at Sunwin Group. Mr. Bajoria, hi, thank you so much for joining in. And I really want your first reactions on what the Indonesia President clearly has been saying. While Indonesia, of course, is the largest exporter of palm oil, but it does seem like that they want to now bring commodities under centralized control, do not want others to set their prices. And then it also is about they do not want the palm oil prices being determined by other countries. A lot of statements really coming in from the Indonesian president. How are you reading into it, first of all?
Hi, Manisha. Good morning good afternoon to all the viewers. Yes, there's a very big announcement from Indonesia today morning, and the president himself has been telling the press that the natural resources that Indonesia produces, they want to control them, and they want to control the exports of them. And they are putting up some company called Namtara, which is going to monitor the exports, and maybe some license and permit will be required for first 3-6 months. And then from January 2027, those exports could be routed through that company. This is like, old times we used to have a canalization through STC, MMTC, PEC, or NAFED, So I believe this is a kind of situation. Or recently we had it from India that some of the agri-commodities were National Cooperative Federation we canalized through. So what happens is in international market, this creates some kind of a disruption and uncertainty that government bodies inside, how the pricing will be determined and how the flow will be there. So this, hence the palm oil market is a little jittery and it went up to some extent. But however, at the end of the day, Indonesia has got surplus available to export, and they will need to export whatever route or channelization they adopt.
Yeah.
But,
Mr. Bajoria, the other thing also is about the statement that has come in from Indonesia that they're accelerating production of diesel fuel from palm. I mean, we've been talking about B40 and B50 and now something like this. Where does it keep India, which also is one of the largest importers of palm oil?
For us, the supply chain becomes in quite uncertainty. If they are going to consume such a huge amount, like from B40 to B50 itself is 3.5 million ton additional consumption of the palm oil into biodiesel. And so total consumption in palm oil from biodiesel will be about 17.5 million ton. And they have an annual production of 50 million ton of palm oil. And their own food consumption is also pretty heavy. So 17.5 million ton going in biodiesel, and they are going to consume something around 14 million tons in their food consumption. So for exportable availability remains only maximum up to 20 million tons. And that is a cause of concern. Out of production of 50 million tons, you're going to export only 20 million tons. And India needs to continuously buy crude palm oil. Indonesia is world's largest producer. Malaysia is the second, and Thailand and other South American countries are there. But they are small producers. So we have to, today's time, I think all the supply chains and the supply regularity is a very big question. But anyway, in the world, there is enough soybean oil. There is some sunflower oil also.
But Mr. Bajoria, how much of an impact would it keep put on prices now?
See, the prices in such uncertain situation do go up. And we have to pay the price of the restrictions at the origins. But India has been buying three kinds of veg oil, mainly the palm oil, then soybean oil, and sunflower oil. And there is some interchangeability also available between all the three oils. So overall, veg oil shortage in India will not happen. Prices will go up. That is possible. And we have still a lot of sources in the world from where we can get various kind of oil. So, but definitely, we are in a time of uncertainty. And every country is trying to protect itself by increasing the biodiesel mandate. Every country is trying to put some export restrictions. Every country is trying to control their natural resources. And then on the top, we have this war where the Strait of Hormuz is under kind of a closure. So this is creating, like you have to stand your own feet and you have to consume what you produce, and you have to tighten your belt. What our Prime Minister said, these are the part of some of the measures which as we as a country need to take.
Mr. Bajoria,
essential imports will have to be there, non-essential imports will have to come.
Oh, absolutely. Mr. Bajoria, you listed out a whole list of uncertainties. You didn't add El Nino to that. Is that going to be a concern in the Kharif season?
Yes, Manisha, you have put up the last most important point of El Nino. And for agri-production, this is a very big concern. And Southeast Asia and India. And I think Kharif production is going to be lesser, at least by El Nino years, it has been lesser by 10%, 15%. So I think this year also we're going to have the same kind of situation. Kharif production will be lower. And the hot and dry climate you are seeing everywhere, it is getting 45, 46 degrees. Bandra itself yesterday in Bandra was a very high temperature. And IMD is saying that temperatures can go 3-4 points more. So we can see our temperatures between 46 to 50 degrees. And that's very alarming for a human being as well. So I believe El Nino is a very big cause of concern for India right now. And production is going to be lower. We need to import more. And
with Indonesia coming out like this, I'm assuming it's going to be a lot of jitteriness in the very near term. But thank you so much, Mr. Bajoria, for that. So many concerns when it comes to food prices.
And I think we need to talk about it more, the way things are going on. Inflation is going to be the next worry. That's what the previous guest was talking about as well. Yes, rupee, but inflation is something that we need to watch out for very closely. Thank you, Mr. Bajoria, and thank you, Manisha, for taking us through that conversation. Actually, let me do one thing. Let me toss across to our colleague Mangalam Malu. There's been a lot of updates with the Italy trip. Tell us more. There is a gift, and we, of course, will talk about a company about it now.
You know, the video that is breaking the internet right now is that of Prime Minister Modi going to Italy and meeting Prime Minister Giorgia Meloni and giving her a packet of Melody. Remember, if anyone who's watched the internet social culture, they will know that Melody is what gets the algorithm buzzing every time Prime Minister Modi and Giorgia Meloni do come together. And the leaders obviously played to that algorithm as well, and to a lot of buzz on internet right now. But as an FMCG curious enthusiast, what caught my attention was the fact that Melody is owned by Parle, and that logo was fairly prominent in that video as well. So what to do? Call Parle itself, and we do have with us Mayank Shah, who's the Vice President Sales, Vice President of Parle Products. Mayank, you know, the video went on Prime Minister's Twitter handle just moments ago. Did you have any inkling on something like this actually having been planned, or was it absolutely a surprise for you as well? Mayank, you're on mute. I will just try to repatch. Yeah, go ahead, Mayank.
Yeah. So we were honestly surprised, very pleasantly surprised, nothing planned. And while, you know, every time both the leaders met, we had a lot of memes going around with, you know, Melody being tagged and they being fondly called, you know, a Melody. But this was, I think, you know, really big for us. Grateful to our Prime Minister. I think this is also a nice way of pushing Indian products and probably giving them a global stage.
You know, take that point, take Indian products and give them on a global stage as well. But just out of curiosity, what is the annual sales of Melody? And every time, you know, the internet buzzes with the Melody hashtag, do you see an impact on sales because of that?
Well, I mean, you know, I'm so inclined to bring in the tagline of Melody Khao Khud Jaan Jao. But if you're talking about the sales, yeah, it's one of the top confectionery brands in India today. When you're talking about, you know, confectionery brands available in India, it's one among the top confectionery brands. It's, you know, we don't normally share figures because we are a private limited company. But as I shared, it's one among the top brands, confectionery brands of India today.
Since you call yourself a private limited company and someone who does not share figures, with the Prime Minister actually taking your product to, you know, the European Union, do you want to now turn public? Because our, you know, sources do indicate that you are considering listing. Is that on the cards now? What better moment than, you know, the Prime Minister actually using your product?
No, we are not considering listing right now. We have been a private limited company since years. and we would prefer to be like that. So there's a lot of speculation that keeps going around it. We continue exploring, opportunities, but that's not on cards currently.
All right. How much are you saving on marketing costs just because of this post? And how much are you reinvesting to boost this and increase the sales of Melody because of this?
It would be substantial, definitely. I think, it's all over, as you rightly said, it's breaking internet right now. And honestly, as I shared, pleasantly surprised, thankful to Prime Minister Modi ji that, he has given us the global stage. And while the brand has been doing well, and as I said, it's one of the top confectionery brands of India today, I think this will further accelerate the growth of the brand.
How much can, according to you, it accelerate the growth by? I mean, I'm sure you're getting real-time data on quick commerce and e-commerce. Is there a spike in the sales just immediately?
It would happen. So, it's all going viral right now, and we would be seeing that happening in next 1 or 2 days as we go forward, and it would, further get viral. That happens, with brands. But anyways, as I said, this is one of the top brands of India today.
Just a final question before I let you go. You said that this is one of India's top brands. Do you export this product? And if not, then do you think this is a good time to start exporting to Italy to start with?
Italy should be the next big market. But yeah, we do export, and it's available in more than 100 countries today.
Will this also be benefiting from the India-EU FTA that will come by?
Absolutely. I mean, given the kind of, I was also going through, various posts on internet, and I think Prime Minister of Italy herself has also, posted. So given that, we are very hopeful, and we would be seeing a lot of traction around this brand going forward, not just in India, globally.
All right. Take that point, Mayank. Thank you so much for a quick stop by and joining us, for what is actually an internet breaking moment right now, and of which Parle obviously is at the forefront as well. Melody Chocolates. Prime Minister Modi currently is in Italy as a part of his 5-nation trip, and obviously as part of this trip, he's gone ahead and, met the Italian Prime Minister as well and given her the packet of Melody. Just take a look, come back, and we take a short break.
Prime Minister Modi brought us a gift, a very, very good toffee.
Melody.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back and take a look at the crypto markets right now, where we have seen a decline over the last 1 week. If you look at Bitcoin, that is down 3.5%. Ether fell 6.5%. It was 5 to 6% of a decline coming in for Binance and Cardano. Solana fell 8% and XRP is down 5% in a matter of last week as well. So not a good going when you look at crypto markets, but that is well aligned with what we are seeing in other asset classes as well. The kind of sell-off that we've seen in equities, the bond yields surging, it also has to do with the strength in US dollar index and the war in West Asia not resolved are some of the factors that have continued to weigh onto the crypto markets as well. So we have seen Bitcoin hit a high of 82,000 and then decline to around 76, 77,000 is how that one is trading right now. But the rising bond yields, as I said, in the US markets have one of the reasons for that. And then the leveraged long liquidations to the tune of almost $850 million is what we've seen in the matter of last 24 hours itself. Not just that, when you look at the spot ETF outflows, that has been recorded to the tune of $1 billion in a matter of last 1 week. And that's exactly where the pressure, the liquidation and the price movement is coming in from. But there is so much to watch out for when you look at the overseas market. Michael Saylor's MicroStrategy, for one, has purchased $2 billion worth of Bitcoin. That hasn't moved the market much because of what's happening in sense of macros there. But another thing which went slightly bearish was Truth Social reportedly withdrawing its Bitcoin ETF applications from the SEC. Does not augur well for the market. And then to top it all, it is going to be a very important day and week for the Indian markets as well, because you have Indian Parliament summoning major exchanges like Binance, WazirX and ZepPay for a hearing today. And this is about digital assets really, and markets will be waiting for what really conspires out of that as well. But the market sentiment clearly is cautiously constructive. This is after the Clarity Act that has been passed in the US. Not totally passed really, because it still needs to go to the Senate, and for a final signature in the month of July will go to the US president as well. Traders in the meanwhile are very closely watching the transition of the new Fed chair Kevin Warsh and his policies and his stance towards crypto as a segment, and that would tell us on what the direction is this market taking on.
Okay. Manisha, thank you so much for taking us through what's happening in the world of cryptos as well. But let's actually step into a very short break. After the break, we will put the spotlight on Apollo Hospital ahead of their Q4 numbers. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, for the markets, it's not changed. We've managed to recover, but we've not managed to build on any kind of recovery or build on any kind of gains for the mid-cap, or rather for the mid-cap index, we've managed to build on gains. So up around 0.2%, up around over 100 odd points currently for the mid-cap index. But let's talk about one specific company. Apollo Hospitals will be reporting its numbers today. It is a Nifty company, and the revenue is expected to grow around 15 odd % this quarter. EBITDA up around over 20 odd %, with margins at around 14.5 odd %, which is expected to improve year on year, and a profit growth of around 9 odd %. Now, the growth is expected to be aided by all segments, which is basically their hospitals business as well as their Apollo Healthco business and the Apollo Health and Lifestyle business. The margin range, however, is anywhere between 14.5 to 15%. So the street is going in optimistic with the margins. EBITDA losses for Apollo 24/7 is expected to narrow in Q4, which is expected to aid that margin improvement. To put it into perspective, last quarter there was the lowest ever digital cash loss that they had recorded for Apollo Healthco, which stood at around 29.2 crores. Now, hospital EBITDA, just watch out for that, because that could be impacted by losses from new hospitals. Key monitorables for Apollo: progress on the announced expansions, status of the Apollo Healthco KMed demerger, and the Q4 FY27, Q1 FY28 listing timeline, overall occupancies for the company, 24/7 expenses, and the GMV for 24/7, which is basically their digital arm. So remember that occupancy stood at around 67% for Apollo Hospitals in the previous quarter. So let's see what they report this time round. That's on Apollo Hospitals, but that's all the time that we have on Halftime Report as well. Business Lunch will take all of the action forward.
Stocks recover after a weak start, even as uncertainties around the Gulf conflict continue to linger. Auto and energy eke out some gains, while FMCG and consumer durables are the big drags. Hindalco's US arm Novelis puts up a better than expected show. Following 2 fires at its units in Oswego, the company guides for positive free cash flows by the end of FY27. After a big cash hit due to these fires, the stock perks up. In a CNBC TV 18 exclusive, the IRDAI chairman Ajay Seth says that the insurance regulator will unveil the distribution reform paper in 3 to 4 weeks and the public insurance registry paper by mid-June. The chairman also flags distribution-led pricing concerns and calls Bima Sugam transformative for consumers. The rupee pulls back after slipping to nearly 97 compared to the dollar. The economists back a gradual depreciation of the currency and a continued rise in fuel prices to address the balance of payments issue. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Fatakia, and it's yet another day when the markets have recovered from the lows. We started off gap down, and since then it's been a very swift recovery, but the recovery has stalled. It has not moved further. The index, after breaking into the green sometime around quarter to 12, has almost stagnated at those levels. So even as there is support emerging between that 23,350, 23,450 range for the Nifty, the index is still not finding conviction to move past that 23,600 mark, which has proved to be a bit of a focal point for the index over the last couple of weeks now. And it's yet again at those levels where it still stands. Of course, the principal contributors to this recovery, first off, is Reliance Industries, of course. The stock moving towards the highs of the day, at one point was up almost 2%. Started off in the red as well, and it's continuing to move higher now, 2.5% higher on Reliance Industries. So that's good going. But offsetting that move on Reliance are the banking names. The Nifty Bank continues to remain sluggish. ICICI Bank, HDFC Bank continue to be the contributors to the downside. And IT as well has taken a bit of a breather in today's trading session. Even as the Nifty Bank has recovered from the lows, the Nifty IT has cooled off from the highs of the day. And of course, there are other talking points as well, the currency being one of them. We started off lower, we moved to an intraday low of 96.96, and now we are back at 96.87. So there has been some bit of easing from those record levels. Of course, not very significant, it's still lower for the day. And dealers are now saying that the oil price is above $110. That remains the big sentiment negative. Lata is here with more on this. Lata.
It is a more of the same market. The rupee has been responding to the crude pressure for some time now. But you can take pain, every day more pain, and there's more loss. But there comes a time when the pain is simply too unbearable. $110 for the last 3 days, for all of this week, and over $100 continuously from May for this entire month. That has quite clearly resulted in the breaking of spirit in the market. So the distance from 96 to 97 seems to have been covered rather quickly. We hit 96 on May 15th. And now, we reached very close to 97 in early morning trade. And we were among the weaker currencies in Asia, at least. The RBI intervention was not there in the early morning trades, and maybe that's why the rush happened. Thereafter, the Reserve Bank selling dollars alleviated the pressure, but not entirely. We can see the rupee dilly-dallying between 96.80 and 96.90 for a better part of noon trades. So really, the pressure is not going away at all. Some of the dealers say that lack of any further announcements is also kind of disappointing. The small number of rupee bulls who think that, okay, rupee has fallen enough and it's time now to sell dollars. That category of people are getting disappointed that there are no announcements. The media is speculating about capital gains tax, withholding tax, ECB announcements. All kinds of things are being speculated, but since nothing has come, that is adding to their disappointment is one school of thought. You know, the event happens, the rupee falls, and people are looking for explanations. So all these are coming from the chatter in the market. But the important point is that the rupee is falling a little rapidly. May 15 to May 20th, a fall from 96 to almost 97 is not a very happy thing at all.
Lata, thank you for summarizing that for us. We also spoke to Pranjal Bhandari of HSBC, Samiran Chakrabarti of Citi and Sajid Chenoy of JP Morgan on India's macros. Here's what they had to say.
Be running a very big external BOP deficit this year of about $65 billion. Sort of never seen this kind of a big deficit, and that's what's really showing up on the currency. And what's not helping over the last couple of days is that there is a bond sell-off globally, and whenever we see that, you know, we saw that in 2022, 2023, it's not great for flows into EMs. In fact, you start seeing outflows from EMs. So you already had this energy shock. Now you have a bond sell-off globally. So all of this is coming together. It's not great for the currency. Now, whatever we do on the currency, it should be something that's not just for the short term, it's also for the medium term. Because this is a problem that has been with us for the last 2-3 years. I think continue to allow the currency to depreciate a little bit. Trickle depreciation, not a sharp depreciation. So use FX reserves to soften the pace.
The current account has been pretty benign for a while now, primarily due to the service exports being very strong. Now, what this Middle East conflict is doing is that for us, we have raised our current account deficit forecast from 0.6% of GDP to 2% of GDP now. So that has become an additional headwind to the overall BOP situation. So given the already existing challenges on the capital account and now a 2% of GDP current account, our overall BOP forecast for FY27 is now $50 billion, which is a pretty large BOP surplus in the BOP deficit in the Indian context. While swap markets have probably priced in more of the bad news, I don't think the bond yields have priced in as much of the bad news.
At a time where, you know, capital flows have dried and crude prices have moved up 40%, which is an adverse terms of trade shock for India, any estimation of the underlying equilibrium real effective exchange rate is much lower than what we had thought 6 months ago, 3 months ago, a year ago. And I think we need to guide the rupee to the new equilibrium. If the foreign investors believe the rupee is oversold and overshot, then suddenly capital flows will look at India and say, maybe it's an attractive time to invest. So the rupee is a necessary condition. The question is, is there a sufficient condition to get through the storm? Because as I mentioned, the original pressure point is not the current account. And so demand compression through fiscal and monetary, I think, needs to be a last resort.
That's, of course, the big story, the currency, but shifting focus now to the insurance sector. And here is a voice right from the top. In an exclusive conversation, the IRDAI chairman touched upon lots of hot button issues. Now, here is what he had to say on the insurance distribution reforms, which the industry is keenly awaiting.
On the distribution side, what we understand is that there is, you are working on a consultation paper, which is going to be comprehensive in its scope. As you said, you will travel with the industry in the sense that you will take feedback and then, of course, come up with what is to be done. Is that understanding correct?
That's correct. We expect that in about 3 weeks or maximum 4 weeks, we should be out with the discussion paper.
And it's going to be comprehensive and...
What we propose to do is present a good analysis of the sector as it is now, provide some sort of a framework where the distribution reform should travel, and then elicit feedback from the industry and the public at large.
Now, the IRDAI chairman also spoke about what he wants to achieve with Bima Sugam, substantially cheaper insurance products for customers. Listen into what he had to say.
Bima Sugam is a platform which is co-owned by all insurers, regulated by IRDAI. This is not a platform of distributors.
Right.
Two fundamental differences. At the moment, irrespective of the distribution channel, price of a product or return of a product is uniform, irrespective of what the cost of that distribution channel is. Bima Sugam seeks to do it differently because it's co-owned by insurers, the least cost, but same quality or even a better quality. Second, present products in a standard manner, but with substantive value, so that the people can buy themselves. That's the second element which brings in. So moving forward, we see it that as the first phase, starting with term life, maybe ULIP. ULIP is generally considered to be a complex product, but people in this country have learned very well what the mutual fund means. So ULIP in 2026 is not a complex product, it's a simple product. Then moving on to other life insurance product later on, but on a general insurance, starting with motor insurance, and also for a health product. So that is what it means. So better product discovery, better price discovery, where insurers compete on their performance rather than letting the distribution channels compete or push products where they get higher commission. So I see it here that Bima Sugam can be a transformative intervention in terms of getting value for the customers.
What would IRDAI's role be? As you said, I mean, regulated by the IRDAI, but owned by insurers. So where does IRDAI come in with regards to the architecture you set? But in terms of, I mean, you know, where would you step in on an operational level?
See, IRDAI's role first is nudging everybody to come to a common platform. Saying that instead of competing on cost, compete on your performance. And this platform should provide standard products with good quality and at the most competitive price. So it's getting everybody together because growth of the industry to meet the economic needs or needs of that large population which we have got is possible only when there are standard products.
If I can just close the loop on Bima Sugam, do you imagine that the pricing on products on this platform, Bima Sugam, compared to I mean others where consumers transact now, etc., through various channels, but there are other online channels, etc. There would be a substantial price difference?
First of all, this is what we hear from the insurers and from the public. Today, some of the distribution channels dictate terms saying that you shall not sell, an insurance will not sell a product at a lesser price on any other channel, which is anti-competition. So there has to be a pricing flexibility has to be available to each insurer based on the cost. And that's the difference. We can walk into a mall, buy a product, it will be differently priced. We can go to an e-commerce platform and buy the same product with the same quality at a discount. So the choice has to be with the customer.
So that's a yes, sir.
Yes, of course.
The answer. So substantially, there will be a meaningful difference. That's the aim, at least.
That is what the purpose is.
And you can catch that entire conversation soon on CNBC TV 18, the IRDAI Chairman exclusive, Insuring Lives, Securing India, Insurance for All, presented by CNBC TV 18 and Kotak Life Insurance. Take a short break. Back with more on the other side. Stay tuned. Welcome back. On to updates from West Asia. US President Donald Trump says that the war with Iran will end very quickly. Now, addressing the annual congressional picnic gathering, he added that a resolution would push oil prices lower and emphasized that preventing Iran from obtaining a nuclear weapon remained a priority. Listen into what he had to say.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down. But even with that, the stock market's at an all-time high. 2.5 months ago, we hit the best numbers that we've ever hit as a country. Jobs, the best. Everything was the best. Stock market, the highest. And I called my people in. I called them in. I said, congratulations, everybody, but we're going to have to make a little journey down to a place called Iran. We have to stop them. They have nuclear on their mind, and we're not going to let them have a nuclear weapon. And we've done a hell of a job, and I think we're going to be finished with that very quickly, and they won't have a nuclear weapon, and hopefully we're going to get it done in a very nice manner.
Meanwhile, Treasury Secretary Scott Bessent has called on allies to disrupt Iran's financing networks and said that the Treasury would scrub its sanctions list of outdated designations to make it easier for financial institutions to root out the most sophisticated terrorist financing schemes. Listen.
We trust that your participation here today reflects a readiness to stand with us in full. That will require, for example, our European partners to join the United States in taking action against Iran by designated financiers and unmasking its shell and front companies, shuttering its bank branches, and dismantling its proxies. It will require those of you from the Middle East and Asia to root out Iran's shadow banking networks and networks of ship transportation obfuscation. And it will require our partners around the globe to respond with force to the array of terrorists that we face, from Hezbollah to the Sinaloa cartel. As threats move across boundaries, our unity of purpose must transcend every border.
Now, Russian President Vladimir Putin met his Chinese counterpart Xi Jinping as he began a high-profile two-day state visit just days after US President Donald Trump wrapped up a high-stakes deliberation in China. CNBC's Elaine Yu now joins us with the latest updates.
The Chinese and Russian presidents have discussed the war in the Middle East during Putin's state visit. President Xi said that negotiation is especially important, that it is imperative to end the fighting, and that ending the war will help reduce disruptions to energy supplies. Putin said that amid the Middle East crisis, Russia remains a reliable energy supplier. And indeed, China has been buying more Russian oil lately, becoming a lifeline to Russia's economy through these purchases due to sanctions over the Ukraine invasion, and also allowing China to diversify away from the Middle East. Now, Putin also said that the two countries' economic relations show good dynamics, while Xi said the reason China-Russia relations have reached this level is because they were able to deepen their political mutual trust in strategic cooperation. So observers are watching whether there will be progress on the long-delayed Power of Siberia 2 pipeline. Some analysts say that reliability in the Middle East will be strong incentive for China to overcome those quibbles over pricing. But others say that the Middle East conflict hasn't really changed China's calculus on this because the project won't provide near-term relief. Beijing wants to avoid over-relying on any single source of energy, and it is also prioritizing its energy security and independence and diversification. So we'll watch for any potential updates on any energy deals or cooperation with Russia from this trip.
Elaine Yu, thank you for that update there. Now, a strike involving more than 47,000 Samsung Electronics workers will begin tomorrow after wage negotiations between the company and its union broke down. CNBC's Lisa Kim now joins in with all the updates.
Samsung Electronics labor union will go on an 18-day strike as planned starting tomorrow after the third round of wage talks with a government mediator fell through. The management and labor unions are blaming each other for the failed negotiations. The labor union claims it accepted a plan suggested by the mediator, but that the management did not. But according to a Samsung statement, it accepted most of the union's demands on bonus pay, but that it could not agree to giving out sizable bonuses to loss-making divisions. So the crux of this labor dispute is Samsung's bonus payout. Samsung's memory chip division is credited for the company's blowout performance, whereas its logic divisions are booking losses. The labor union is seeking a more even distribution of bonuses between the divisions, whereas the management wants to distribute a larger bonus to the division that's driving sales. It's sort of a tricky situation for Samsung because Rolf Bulk of Futurum Equities told CNBC yesterday that while the logic chip divisions are unprofitable, Samsung is the only company that does both memory and logic in-house, which in fact gives the company a unique advantage. For now, nearly 50,000 Samsung workers, or nearly 4 in 10 of the domestic workforce, are set to join the strike. It would be the largest ever industrial action at Samsung, and it would likely impact South Korea's economy and exacerbate the global chip shortage.
Well, that was Samsung, and that is having a bearing, of course, on the Korean stock markets as well over the course of the day. Now, shifting focus to other important developments, the European Parliament and the EU Council have reached a preliminary agreement to slash tariffs on US industrial exports entering the European Union. Now, the EU Commission President Ursula von der Leyen welcomed the move today, stating that a deal is a deal and that Europe is honoring its end of the joint agreement struck with the Trump administration last summer. Now, the 27-nation bloc struck an accord with Washington last July, setting levies on most European goods at 15%. Now, the EU agreement puts the bloc on track to meet Donald Trump's July 4th deadline. Now, as per the final text of the document, the European Commission will be able to suspend the trade agreement at the request of either the Parliament or a member state if the US fails to lift tariffs on European steel and aluminum products by the end of 2026. Now, the bloc should also meet Trump's 4th July deadline with a final vote of approval in the European Parliament that is expected in mid-June. As we take a short break, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV18's all-new app, which gets you instant access to breaking news, financial world updates, and in-depth articles as well. You can download the app from the App Store or or from the Google Play Store, or also download the app from the QR code that's up on your screens. Take a short break. Back in a bit. Welcome back. Now, Prime Minister Narendra Modi has arrived in Rome for the final leg of his five-nation visit, where he was warmly welcomed by Italian Prime Minister Giorgia Meloni, who posted on social media, and I quote, "Welcome to Rome, my friend." Now, during the visit, Prime Minister Modi is set to meet the Italian president, hold bilateral talks with Prime Minister Meloni, and take part in key diplomatic engagements. Now, the visit comes as India and Italy deepen ties under the Joint Strategic Action Plan 2025 to 2029, aimed at boosting cooperation across several strategic sectors. Now, on a lighter note, while visiting the Italian Prime Minister Meloni, the Prime Minister brought with him a special gift for his Italian counterpart. Take a look.
Prime Minister Modi brought us a gift, a very, very good toffee.
The video that's breaking the internet right now, and we take a leave on this edition of Business Lunch while I go grab some food and some melody maybe. Midcap Radar on the other side. From me and the team, thank you so much for watching.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. We did recover sharply from the lows, but there was some selling pressure from the top. 50 points off the highs of the day. We did cross the 23,600 mark, but failed to sustain that. Rupee continues to be a pressure point. So does crude oil prices. And no clarity again on the West Asia crisis. And a lot of companies in their commentary are talking about heightened inflation, and that could be a worry going forward.
That's right. Good afternoon, Sonal. Higher inflation is something that we all need to keep an eye out for, especially as far as Q1, Q2 margins across most of the Nifty universe as well, especially in the FMCG universe. But a lot lined up on the show today. We have a couple of important management interactions as well. So let's start off with the top headlines. Volatility grips D Street, but indices pair early losses to climb to the day's high. Mid-caps parked well in the green, while small caps failed to pick up momentum in tandem with their mid-cap peers.
Zidus Life delivers a beat for March quarter results. India business leads the way with a 14% growth on a YOY basis. Company eyes single-digit FY27 growth and 40 to 45% growth in international business. Management believes India growth to be oncology and GLP-1 led.
Strong turnaround Q4 for Dredging Corporation of India. The company swings to a profit of 87 crores versus a loss of 25 crores last year, same quarter. The stock well in the green, but off the day's high.
Zee Entertainment turns loss-making in Q4 FY26. Ad revenues take a hit on account of tensions in West Asia. Changes in movie rights amortization policy pushes company into an EBITDA loss of 270 odd crore rupees. Shares see selling pressure but come off the day's low.
Worse than anticipated Q4 results drag shares of PI Industries lower. A 12% drop in the top line, a 26% fall in EBITDA, and 400 basis points contraction in EBITDA margins. The company flags caution ahead on account of cost-led inflation pricing pressures.
All right, those are the top headlines. We'll discuss some of them in greater detail and also speak to two managements on the show as well. And while we do that, take a look at some of these stocks in the broader markets which are buzzing around on the upside for now. We have Barbecue Nation, which has surged to the day's high. It is up around 18.5% as we speak. Dishman is the other one, which is up around 12%. So a lot of moving parts in the broader markets, and that is something which continues to lead to the outperformance that we are seeing in the mid caps as well. The advanced decline ratio, though, continues to be in favor of advanced declines as we speak. But let's talk about a management now. Okla India is the first management on the show today. Company reported soft Q4 revenue growth and EBITDA was impacted by West Asia crisis. To discuss this and more and on the outlook going forward, we are joined by Sanjay Sharma, the Managing Director and CEO of the company, joining us now. Mr. Sharma, good afternoon. Thank you so much for joining in. Well, if we look at the numbers in the quarter gone by, you've seen a growth of 5% on the revenue. There is an exceptional loss this time around, but profits on, there was an exceptional loss last quarter. So the profits have seen a strong growth this time around. Your spices business has grown a 6% growth. So has the convenience foods business. Getting into FY27, what are the sense that you're getting? How will the revenue growth be? Give us a sense of your EBITDA margins as well. And how are the categories performing?
I think let me first start by saying that, we've been in the last 2 years facing a lot of deflation, almost 30% deflation as far as spices is concerned. And we are now kind of in this quarter coming out of that deflationary scenario. But I think I'm very happy with the performance so far as far as FY26 is concerned. We've had, if you look at us over a slightly longer period of time, I think you see that we have really driven our business through a consumption-led expansion of our business rather than a price-led expansion of our business. So if you look at our volume growth, they've improved from about 1.8% to about 5.9% in terms of volume growth. And I think that is a great level to be in as far as the spices business is concerned. What we are also doing is really investing into the future and in doing some structural changes based on the opportunities that are coming out. One is really around Kerala. I mean, we did the Eastern acquisition in 2021. We are now looking at restructuring the distribution network in Kerala because I think the network that we had out there was one size that fits all. I think the retail environment has changed and therefore there was a strong need to change the distribution network in Kerala. And the second thing we are doing is recognizing the strong opportunity in Project Bolt in the digital commerce channel, we have started something called as Project Bolt, using an external consultant to upskill and accelerate capability creation as far as digital commerce is concerned. So I think these were some of the great initiatives that we've kicked off as far as FY26 is concerned. When I talk about FY27, if you look at it, we are continuing to operate in a volatile environment. I think the input cost inflation is going up. For us, it was, on account of spices, commodity prices rising. But we are also seeing the West Asia crisis come in and bring some impacts as far as packaging material is concerned, and some impacts now coming in as far as logistics are concerned. But our focus is really to clearly drive volume-led growth, supported by calibrated price increases that we need to do. So we will continue to power on. I'm sure we will, with price-led growth coming in, we will see better numbers flowing through as far as the company is concerned.
So I know it is a volatile time, and you indicated there are packaging costs which are increasing. Inflation is on the higher side, and that's happening across the industry. When you talk about volume-led growth or pricing-led growth, what is the target that you have for FY27? Yes, there could be demand, but if supplies are not in place, you'll have to pass it on to consumers in some way. What does that do to volume and pricing growth for you?
Yeah, I think as long as inflation moderates, it's under 10%, we should be able to see. I mean, in the past, whenever we have, last 2 years, we did not have, we had a price decline as far as the business is concerned. So trying to maintain, with the price growth coming into the fray now, I think we will go back to what we have been historically delivering, a good double-digit growth as far as the business is concerned.
Okay, Mr. Sharma, first up, thank you so much for joining us. In terms of the top line growth at the time of the IPO, you had guided for it 10 to 12%. So when you say double digit, is that what you're aspiring towards? Secondly, what will be the volume contribution? What will be the value contribution? We understand Q4 you've taken close to 4% price hikes. What's the quantum of price hikes you'll require to take in Q1 to maintain margins at the current levels?
Yeah, so I think if you look at our P&L, I think we've taken about a 6.5% price increase, price effects coming through. And still, I think the total price effects have not yet flown. So you will see the full effect of pricing coming in Q1 of FY27. I think that will come in. And we don't give forward guidances on numbers, but certainly coming back to double-digit levels will be a momentum that we will continue to drive.
Your GCC business saw revenue growth of 11.8% on a YOY basis despite the crisis. How has it been in Q1 so far? And what has been the revenue mix between spices versus prepared dishes? How has it been internationally versus domestically?
So let me talk about the West Asia crisis. I think that came in very sharply from in February, early March, when the war started, and like every major black swan event that kind of happens and hits you, things we were very. We understand the environment, we understand the supply chains very well. We were able to mitigate and take forward-looking actions to ensure that we are able to continue to maintain the supply into the Middle East. I think that has helped us deliver that 11.8% growth in the last quarter. And like every event, and I think we saw it during COVID also, I think the initial portion of an event is a little bit more chaotic. But as the event starts to balance out over a period of time, supply chains tends to settle down. And what we are now starting to see is that the supply chains into the Middle East are starting to settle down, and we are able to continue to. In fact, there are two aspects that are hitting the supply chain. One is really the cost, which went up, and the second is really the timing, how long it takes to deliver. What was typically between 7 to 10 days is now up to anything between 21 to 45 days. But we are now starting to see that the containers that we are dispatching in the last during the last month are starting to reach faster into the Middle East. So supply chains are kind of settling down. Of course, costs are still high, but we have taken mitigation actions in terms of protecting our margins and sharing costs and taking the relevant price increases that we needed to take.
Mr. Sharma, one last question. So, what we want to understand is two key markets, Kerala as well as Karnataka. We understand Kerala, you saw quite a bit of disruption. You did speak about, you earlier had a one-size-fits-all strategy. So, what are the steps you're taking there to ensure market share gains? And secondly, you spoke about increase as far as packaging costs are concerned. What's been the impact on account of non-supply of LPG and also the rise in prices there?
So first, let me talk about the Kerala distribution piece. I think as I was speaking earlier also that the distribution system that we have in Kerala was kind of structured in terms of the legacy route to market that we had. The retail environment has changed a lot, and there are different customers now, and their needs are very different. So we need to restructure the Kerala distribution. We've been keeping it off for the last 5 years since we built that partnership. But I think it was important now for us to act on that level. So I think there are three key outputs that we are looking out of this Kerala distribution restructuring that we are doing. I think one is really better coverage, expansion of coverage. We are at 70% numeric distribution. So we will be looking at expanding our distribution footprint for the spices and masala market in Kerala. We are already the largest distributed brand, but I think we need to continue to build on that. Right. The second is that a large portion of Eastern's business comes out of spice and masala, and the convenience food portfolio is quite weak. So we are creating a dedicated convenience food channel that will help us build the business in Kerala and build Eastern as a food brand. Okay. And the third is really the regional modern trade and OFO outlets which are there. We were not having the right terms of trade and the right focus in terms of distribution. So having that in place, we will be able to improve our market shares as far as modern trade, the regional modern trade and open format outlets are concerned. So that's really the three objectives behind which we are running.
Take that point, very detailed answer to that. So thank you for explaining your strategy going forward. Thank you for joining us today, Mr. Sharma. That's the word coming in from Okla, India. The stock lower, but a lot of it impacted by input cost inflation as well. We'll now move on and talk about our segment mid-cap movers. We have Ria to take us through the mid-caps that are moving around in trade. Ria.
Well, yes, a lot of stocks moving around in today's trading session. Let's start off with the gainers first. PCBL Chemical is the first one, trading on very strong volumes, up around 6% today, and around 18 times the 30-day average volumes have been traded today. But remember, this stock has declined nearly 30% in the last 1 year. For Nava Limited as well, this stock is also seeing gains of nearly 3% today. Data Patterns also up by around 5%, and in the on a year-to-date basis, the stock is up nearly 47%. Apollo Micro as well seeing gains today, and this stock is up nearly 2.6 times in the last 1 year. This same for GE Vernova as well. The stock also up 2.6 times in the last 1 year, and today the stock is seeing strong gains of around 7%. Moving on to some of the stocks that have hit their 52-week high today, the likes of Godavari Power, Hitachi Energy, Timken India, Zidus Life as well as Manappuram Finance, all in this list, and up almost 5 to 6% for some of these names. Moving on to some of the losers in today's trading session, there's MapMy India again down in today's trading session after reporting a weak set of numbers, and this stock is also down nearly 50% in the last 1 year. Godfrey Phillips as well taking a hit in today's trading session, down nearly 4%. Sapphire Foods as well down 3% today, and this stock has declined nearly 30% in the last 6 months. GE Shipping as well taking a hit in today's trading session, but this stock has gone up by nearly 80% in the last 1 year. And the last stock on this list is PG Electroplast. This stock has nearly halved in the last 1 year, and next week the stock is expected to post a weak set of numbers for Q4, and today as well declining by around 2.5%.
Well, thank you so much, Ria, for joining us, giving us a comprehensive list of all of the stocks that are making the moves in the broader end of the markets. Well, we'll now slip into a short break. Up next, we will connect with the management of Mankind Pharma to discuss their Q4 results and the outlook going forward. Stay tuned. Welcome back to Mid Cap Radar. Well, a couple of stocks from the broad end of the market that are reacting quite sharply to the results, include Dredging Corp as well as PTC India. Looking at the numbers of Dredging Corp for Q4 FY26, revenues very strong, higher by over 70%. See, one thing you have to keep in mind is that Q4 generally is quite strong for most of these companies, given the fact that execution is mainly targeted towards the second half of the year. EBITDA too has jumped up almost a little over 4 times on a year-on-year basis. Margins at 30% versus 12%. Remember Q4 FY25, the management actually had to go ahead and restate their numbers, quite a few of the numbers on account of a few frauds that they had highlighted. Profitability in this particular quarter, so 2 straight quarters of losses in Q2 and Q3. That's been ebbed, and now profitability at 87 crores. The good part is the management has given a top-line guidance for FY27. A top-line guidance of 1,500 crore is what the company has gone ahead and given. And for FY26, on account of the profitability seen in Q4, they've actually gone ahead and reported a profit of close to 5 crore versus a loss seen last time around. On the other hand, PTC India, remember that particular company, good volumes, a strong start, but the core margin, something that the company makes on account of the business, something that is softened. So when you're looking at PTC India, that particular stock revenues higher by 33%, EBITDA, however, down by 7%, margins contracting at 3.7 versus 5.9%. Profitability on account of a one-off in the base quarter down this particular year, and the total volumes, despite being up 4% on account of the core margin going down, that particular stock, PTC India, today taking it on the chin, and that stock has fallen. But one stock that we are tracking today is actually Mankind Pharma. The company delivered an operationally strong set of March results. The top-line growth was in line with estimates, while margins expanded to 27% levels versus 22% same time last year. Let's decode the quarter gone by and the road ahead with the Vice Chairman and Managing Director, Mr. Rajiv Juneja of Mankind Pharma. Mr. Juneja, thank you so much for joining us. Well, the first question that we want to ask you is, the numbers were strong. Stock gave a thumbs up in the morning, and in the just concluded con call, we believe, which was held at 12, post which we've seen another rally that's come up in the stock. Couple of quick questions. We understand top-line growth guidance of double-digit. I want to ask you, historically, you've grown much higher than that. You've meaningfully outperformed the IPM growth, which is expected to be at around 11 to 12%. So moderation in the pace of growth, is that something we will see in FY27? And when it comes to margins, 25 to 26.5% margin guidance is what you've given, slightly lower versus the Q4 exit margin of 27.
See, I mean, in the last couple of years, we have already said that we have gone for certain correction in the working of Mankind. And after few quarters of corrections happening, and we feel that going forward, our growth will be better, because historically, Mankind is the fastest growing company. In 30 years' time, we have become 4th largest company, only because of one thing, that we are very aggressive in taking decisions. And whenever we have seen any flaw in the existing system, we have corrected the system. So certain quarters were spent over there. We put our efforts over there. Now things are done. And hopefully, we expect that we'll be going for double-digit growth. Aspiration is to do better than the IPM. As far as the EBITDA is concerned, we said 25.5 to 26.5. And full year, this year, our EBITDA is 25.4. So we are saying that we'll be doing better than this year.
So you did around 25.4% in FY26, and you're guiding for 25.5 to 26.5%, something which is better than FY26. What are some of the levers for that EBITDA growth that you're talking about? Will it come from the chronic drugs? Will it be for the new acquired Rivotril brand in India? What is it growing at? Also about the weight loss drug. Have you already launched it? Is that something which will start contributing? What are these growth targets predicated on?
See, I mean, one of the major basically focus of Mankind is right now for the chronic side. In the last couple of years, our chronic share in our total sale has grown, I mean, tremendously. Last quarter, it was 40%. And every year, I mean, last couple of years, the growth in the chronic segment is quite good. If you just see in 24, I mean, it increased by 110 bips. Next year, 140 bips. Last year, 190 bips. Full year 26, chronic share is 39% approximately. And we feel that going forward, we'll be focusing more on that because we have understood one thing that if chronic is there, any company which has better chronic sales share has a consistent growth. Right. We have understood this and we'll work on that. As far as the GLP-1 is concerned, there's a mad rush in GLP. So we are just sitting on the corner looking at this mad rush, and we are always been a contrarian company. So instead of going in this mad rush, we basically have a different strategy. We are entering this particular segment along with vitamins and protein and other things as well, because we just want to offer the complete therapy to a patient.
Okay, so Mr. Juneja, what we're understanding is that as far as GLP-1 is concerned, at the current point of time, you're sitting on the sidelines. We also want to understand when it comes to the acquisition of BSV and how that integration has come about. Earlier, you had given a guidance of mid to high teen growth. Where do we stand on that currently? FY27, what kind of growth can we see there?
We basically are calling out the full growth of Mankind, not separately. But if I just talk about the BSV has done a fantastic job in domestic side. In international side, we have done certain changes, and hopefully, those certain changes will just yield better growth in future. We expect from BSV side as well the double-digit growth, high double-digit growth. High double-digit growth is what you have guided us for as far as BSV is concerned. Now, when it comes to the export markets, number one, what is the total percentage of top line that you have over there? What is the kind of growth you're anticipating? What are the key launches in the pipeline? 14% we basically get from the export side. And we've always said that whenever it comes to export, we're always very conservative in that. We don't export vanilla products. We export complex products, difficult products, where we can command some kind of margins. And consistent sales as well.
When you say consistent sales, what would you mean in terms of growth in the export market, Mr. Juneja? Consistent growth means, consistent sales means consistent growth. And that would be double-digit growth. Double-digit growth. Okay, take that point, Mr. Juneja. A lot more questions, but we are completely out of time. But thank you so much for joining us today with your take on the outlook of the business going forward. Strong growth is what they're guiding for, and 100 basis points improvement in the margins as well. We'll do one thing, slip into a short break, get you more on the market, stock-specific action on the other side as well. Welcome back. There's some further recovery which is underway, but the big question is whether that sustains or not. Mid-cap index in the green. Bank Nifty 2 has recovered from the lows, 23,600. That's an important level we'll be tracking very closely and take your leave on this edition of Mid-Cap Radar. Do stay tuned. Your stocks when we return to answer all your individual stock queries.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the markets, we're seeing some bit of that green coming in on the screens for the Nifty 50, but it's flip-flopping between the red and the green as of now. Though recovered from the day's lowest point. In the morning, we were at those 23,450 levels, and now look at the recovery. 23,620, 630 levels. Not complaining in terms of the recovery. 0.04%, so quite flat there. But in terms of the move, but we'll watch out for where it's headed in the last hour of trade specifically as well. Today we have the broader end of the market. Nifty mid-cap also is performing in tandem with the benchmark indices. Slightly better there because now Nifty mid-cap is holding on to more green than we're seeing on the broader end of the market. Let's pull up the advanced decline ratio. That'll be interesting to see, right? Because broader end of the market is still holding on to some bit of a better gain versus the benchmark indices. And like you can see, now seems like it's closing. The red line and the green line are coming closer to each other. So closing by. We'll watch out for where that's going to be headed as well. But yes, that's the market setup for you all. let's move on and get started with all your stock-related queries then. And to do just that, we have Parthiv Shah, Director at Tracom Stockbrokers, as well as Ajit Mishra, Senior Vice President Research at Reliance Broking, to answer all your stock-related queries. Ajit, as well as Parthiv, good afternoon. Thank you so much for joining us on the show, as always. Let's get started with the first query for today. This is coming in from K. Rajiv, who's writing to us from New Delhi, holding 600 shares of Bajaj Housing Finance. Price is 119 rupees per share. Wants to know the future prospects of the stock. So long-term as well as the short-term story, they bought it at a higher price. They're making a loss. Parthiv, first for you on the fundamentals.
Very good afternoon to you all. We like Bajaj Housing Finance. See, it's a very well-run company from the stable of Bajaj Finance, and it is the second largest housing finance company. And that has happened in a span of just 7 years of starting, which is, I think, incredible growth. The current AUM that they manage is somewhere around 1.4 lakh crore, which has been growing at around 20-25% year on year. In terms of its book, I think the home loan segment is around almost 55% of the AUM. The LAP, loan against property, is somewhere around 11%. The lease rental discounting is a very unique business model that they have. That is somewhere around 22%. And the developer financing, which generally the market attributes as a riskier segment of the loan, is less, to the tune of 11.6%. So I think the underwriting standards are extremely strong. The loan average ticket size is very healthy at around 47 lakhs. And I think this company is extremely well placed to grow its book by almost 20%. And that has been the pedigree of this particular group as well. As compared to the higher price to book multiples of almost trailing basis 5 and 6, this company is now available at a trail price to book multiple of 3, which is quite reasonable for a growth oriented company like Bajaj Housing Finance. So for a longer term point of view, I believe this is a good hold in the portfolio.
Long-term point of view, it's a good hold. Valuations don't seem that bad as well. Ajit, on the technicals, how is it looking, right? Because when I'm looking at it, in the last 1 year, it's just seen the declining trend that has come in. It's not seen a big up move, except in the last month where it tried to make some bit of an up move, but then again it gave up those gains. So what is the trajectory looking like? Because they bought it at a higher end of the price. Right now it's just at 82. They bought it at 119. Do you see it coming up to their price levels anytime soon? And the short-term, long-term targets for this?
Yeah, good afternoon, Vinny. So, Vinny, you have rightly mentioned that the trend has been a decisive downtrend since listing, in fact, and it's been almost like, over 1.5 years. We are seeing this trend continuing. Though last month we had this attempt of a rebound where the stock again retested its medium-term averages around 100 EMA, close to around 90-92 rupees mark, but couldn't sustain. And again, we are seeing that the stock is inching towards its record lows. So we no point arguing with the market when it clearly shows that the price action is not conducive, especially for the short term. The price action clearly indicates that on every rise, the stock is facing pressure. Since he has bought it at very high levels, my recommendation is to maintain a stop at 78 mark. Use any rebound towards 88 to 90 zone in case if stock witnesses any recovery. Long term also, I believe that until we break 95, 98 decisively, the trend is likely to remain on the negative side.
Okay, we'll keep an eye out on that level over there as well, Ajit. Let's move on to the next query then. This is coming in from Sandeep, who's writing to us from Hyderabad. He's holding 100 shares of SML Mahindra. Price is 3,700 rupees. Currently just slightly above the level that what he's bought it at. Wants to know if he should continue to hold this for a period of 1 year from now on as well. Parthiv, on the fundamentals, how is this looking like? It's a commercial vehicle manufacturer. It's not that we have a query coming in a lot on this. This is the first time actually we're taking a query on this one. How is it looking like in terms of the trends from here on?
But I think ever since the former management, SML Isuzu, is out and now Mahindra has taken over the stake, I think a lot of good things are happening to this company. Firstly, to start with, FY26 was a standout year. Despite the fact that the benefits of GST came in the later half of the year, it outgrew the industry volume growth. The company grew by almost 17% in terms of the volume, vis-a-vis the industry growth of around 13%. And the operating leverage kicked in big time, and the numbers were very good. So even the cargo volumes for the company were around 28%. The buses segment also grew by 12%, and they have gained more market share in each of the respective segments. And probably, I think during one of the investor meets, I think the management did attribute aspirational target of touching almost 15,000 crore of revenue top line by FY31, and also growth. I think they are penciling anywhere between 12 to 15%, and also increasing their market share. I think these are all good signs, and with backing of a group like Mahindra & Mahindra, which has created a very high shareholder value over time, I would suggest the investor that look for a horizon beyond 1 year and hold such a company for the next 3 to 5 years.
And Ajit, on the technicals, how is this one looking like? Could we see it move higher on from here on?
So Vinny, it seems like consolidation phase after making a new record high in the month of February this year. We are seeing the stock has been gradually drifting lower. The good part is that at least we are maintaining, around the previous swing lows, close to around 3,500 levels. So in case if the stock manages to hold this area, then probably we may see an attempt of a rebound days to come. And for fresh momentum, 4,400, 4,500 is a strong hurdle. So short-term bias looks sideways to me. And in case if the stock fails to hold 3,400 mark, probably we may see a fresh leg of down move also. So in case if the view is short-term, one should definitely maintain a stop at 3,400 and stay put.
Okay, we'll keep an eye out on those levels there. Next query for today. Pushkar is writing to us from Noida. He's holding 250 shares of Phoenix Mills. This is at a price of 1,580 rupees per share. He's making a profit on this one. Wants to know if he should continue to hold or book out his profits. And if he should book out his profits, then which are the other alternate stocks that maybe he could look to invest in for the next 2 years? Parthiv, your view, Phoenix Mills, is that a good bet for the real estate story? Making a profit, so does it merit just booking out profits and looking at some other name?
Yeah, I believe Phoenix Mill has had a very unique business model in the real estate space. It is India's largest retail mall operator, with operating almost 12 properties it manages, with total area of almost 11 million square feet. And it's across 8 major cities. And going ahead, I think they have capex plans where they're developing 4 new malls across properties in Calcutta, Gujarat, Thane, and Coimbatore, which will add another 4.3 million square feet. I think in terms of the track record for this company of how they've been managing the malls and operating, I think it has been very, very good. And more importantly, I think they are very smart capital allocators. Even in the commercial space, I think company offers office spaces to very prestigious clients like Bajaj Finance, JSW Group, Cipla, Hitachi, and they're continuously expanding that space as well. And they're in very strategic pockets like Mumbai, Pune, and going ahead, they're even expanding in places like Bangalore and Chennai, which will be adding almost 4 million square feet. So overall, I think even the hospitality segment, which is almost 17% of their revenue, that has also been doing well, and they're managing very good properties. So I believe that's a very good capital allocator and the real estate space. And by 27 end, I think the company will have a lot more commercial office space and hotel capacity, almost 986 keys. So our sense is such a good company. I think you should hold it for long term.
Hold it for long term. That's a view on the fundamentals. On the technicals, Ajit, what's your view? Would you also suggest a hold or maybe book out some bit of a profit, look at some other names?
So Vinny, in case of the view is short term, definitely I would recommend to exit, because no doubt if we compare it within the realty basket, it has done well. Means if you see that what kind of correction that we have witnessed across the realty space, it has been holding strong. Means it's more of a time-wise correction that we are seeing in Phoenix Mills. So, but yeah, for any momentum, we need this multiple hurdles to cross decisively close to around 1850, 1900 mark. So in case the view is short term, I believe that pharma and healthcare basket offers better opportunities. So stock like Apollo Hospitals, Sun Pharma, Dr. Reddy's, these are some of the names where one can look for fresh long positions.
Okay, that's a word on the technical fronts and some names that Ajit mentioned as well. Let's move on then to the next query. We have Navendu Sharma, who's writing to us from Bihar. He's holding 1,050 shares, and this is of Aster DM Healthcare. Price is 375 rupees per share. Wants to know if he should hold, book full profits, book half profits. What should his strategy be now? Parthiv, your view on the fundamentals for Aster DM Healthcare, and what's the view that you have and suggestion in terms of booking full profit, half profit, or continue to hold?
My suggestion would be to book some partial profits. Gentleman is making very good money here. And I think one key development took place, which was the merger of Aster DM and Quality Care. Quality Care is a chain of hospital which is backed by Blackstone. And post this merger, I think which will be operational from Q1 FY27, I think they'll be managing almost 10,300 beds. And this from day one, this merger is going to be EPS accretive. And probably, I think, thanks to the merger synergies and the size and scale, this becomes the third largest hospital chain in the country. As a result of which, I think the market has really taken cognizance of this and massively re-rated the valuation multiples. Which is why I'm suggesting partial booking. But I think going ahead, they have massive plans. They'll be adding almost 40% to their bed capacity over the next 3 years. And I think they're well diversified in various states. And more importantly, I think the specialties that they cater to, it's a multi-specialty hospital where cardiac, pharmacy, neurosciences, gastronomy, I think a lot of that is covered here. So we believe that this is a good chain. And I think the hospital segment overall, we believe over the next 5 to 10 years can create a lot of shareholder value.
You believe hospital chain can create a lot of shareholder value. So that's a thumbs up coming in on the fundamentals. Continue to look at it. But in terms for the technical front, Ajit, does it still merit holding the stock right now? Given that, we've seen a very good run-up coming in the last YTD performance, if I look at it, right? 25-30% uptick. Do you still think there's room for more up move, wait out before you book out some profits?
So Vinny, you rightly mentioned that the returns has been phenomenal, but at the same time, the sector means we still feel that this entire space, healthcare basket, has potential to do much better to what we have seen in the last 3-4 months. Because if you see that SRDM also, it took roughly around 7 to 8 months to recoup all the losses that the stock witnessed in the recent past, and now it's trading at the record highs. So after this consolidation phase, we believe the stock has potential to test around 890 to 950 levels in next 3 to 6 months. So still, we have decent upside left. But considering that the stock has already witnessed decent gains for the participant, he can consider at least partial booking profit at current levels and hold the remaining.
Okay. Partial profits at levels over there, so keep an eye out on that and maybe you can hold the remaining. But on that note, actually, we're going to sip into a very short break, viewers. Don't go anywhere because after the break, we'll come back and solve more of your stock-related queries, so stay tuned in. Welcome back to Your Stocks in CNBC TV 18. We still have with us Parthav Shah as well as Ajit Mishra to answer all those stock-related queries. But a quick look at the market right now, because when we started the show, it was just flip-flopping between the red and the green. Now it's trying to make that comeback there. Day's highest point, trading in the green, 0.1% of gain for the Nifty 50. 23,650 levels is what it's trading at. Broader end of the market is also continuing to see that up move. And at the bottom of your screens, you have IRB Infra that's reported their numbers. We've seen an up move coming in. Look at the margins, a very sharp up move in terms of margins. Net profits up by 38% as well, and a sharp uptick in the stock as well. So keep an eye out on that. But yes, that's about the market and IRB Infra. But talking about your queries now, this next query for today, let's start with that. We have Sushil, who is writing to us from New Delhi. He's holding 50 shares of SJS Enterprise. This is at a price of 1,200 rupees per share. Wants to know the long-term outlook, 3 to 5 year outlook for this stock as well. He's making a profit on this one. So should he continue to hold this partial profit booking? Everyone's looking at that today. And Parthiv, on the fundamentals, what's your view for this one? Partial profit booking at a time, maybe look at other opportunities. What's your suggestion?
I think it's a very interesting play in the auto insulate space. They are basically one of the leading players in the Indian decorative aesthetic industry. And I think that is something which has been the theme with a lot of OEMs, and they do a lot of design to delivery aesthetic solution providing. And that's why they've been able to tap one of the finest OEM players, whether it is in the two-wheeler space or the passenger vehicle or the consumer appliances space as well. And I think if you look at the results, I think it has come out fantastically well. Last quarter was one of the highest ever quarterly revenue run rate. And I think the free cash flow generation is very healthy. This company has believed a lot in inorganic growth, and their past acquisitions have also turned out well. My only concern here is that a lot of such good positive news and the forward guidance is already kind of factored in big time. And the valuations are a little stretched according to me. So I think it won't be any harm for booking some profits here, only because of the valuations and, maybe the challenges that one can attribute going ahead in the OEM segment with the rising petrol and diesel prices. But nonetheless, I think it's a great company, but I think partial profit booking here is advocated.
Partial profit booking, maybe can look at it as well, right? Because in the last 1 year, the stock has gone up 81%. So coming to you, Ajit, 81% uptick. Would you also suggest partial profit booking here?
So yes, Vinny, at least partial profit booking is recommended, considering that stock has done well in the past. Is still the uptrend is intact, means of late also we are trading at the record highs. There's hardly any change in the structure. But at the same time, possibility of consolidation after this, attempt of a rebound or a consolidation range breakout attempt. There could be phases of consolidation or maybe a dip every now and then. So basis that, at least partial profit booking and maintaining a trailing stop at 1800 because he has already witnessed decent gains in the stock. So that is the right approach to stay put in this.
Okay, right approach, 1800. We'll keep an eye out on those levels. But on the technicals and the fundamentals, partial profit booking is something that you could look at for social. That's the word there. But let's move on to the next query then. And this is coming from Maleswara Reddy, who's writing to us from Bangalore. He's holding 19 shares of MRF. Price is 51,000 rupees per share. So making a good amount of profit on this one. And 19 shares is a good amount as well. So he's got good investments made there. Should he continue to hold or sell at current levels? Parthiv, your view for this one?
I think the demand overall for both the OEM segment and the replacement segment in the tire space for companies like MRF has been very good, especially also arising due to the reduction in the GST rates. And going ahead, I think the management did comment, despite the major headwind that one is facing with the rising crude oil prices, the demand and the volume growth should sustain. And they will be probably in an ability to kind of pass on some of the higher costs. So I think they are also talking about expansion plans across their plants, which is a good, healthy sign. And I think what we like is that the valuations are not very stretched. It's probably quoting at around 18 times forward multiple for a company of MRF's pedigree. I believe that it certainly advocates a hold. And especially the entry price has been pretty low. So I think such good companies should be hold longer for higher compounding.
Okay, should be held longer, though. I believe, given the price that he's bought it at, it's at least COVID or pre-COVID. That's around when that 50,000 was around that level. But on the technicals to you, Ajit, what should the viewer do? Partial profit booking, hold, or sell completely?
Vinny, to my opinion, I believe that the downside seems capped after this correction from the record highs, means from roughly around 1,60,000 to around 1,30,000. We have already seen decent correction from the recent top, and still the stock has been maintaining above the major averages on the weekly chart. So that clearly shows that the trend is still intact. It's just that we are seeing more of correction, which is healthy considering the overall positive trend or the up move that the stock had witnessed in the recent past. So basis that, at least you should continue to stay put. To 1,20,000, I believe, is the very critical area to watch out for. In case it fails to hold, then probably he may consider at least booking partial profit and wait for a dip towards 1 lakh or maybe lower to re-enter.
Okay, we'll surely watch out for that. Let's move on to the next query. We have Shri Vallabh Deshpande, who's writing to us from Bangalore, and it's an investment query. He's looking to invest between Hinzinc and Vedanta. Obviously, the demerger also comes into play now for Vedanta as well. So, which is a better one for the long-term story? If you want that zinc, silver space, you want that investment coming in here through stock markets, then, Parthiv, this is something that everyone keeps looking at, given that how silver has done, how everything is moving in the world of commodities. Which one would you be looking at?
Yeah, I think it's an interesting question because we know for the fact that right now the listed entity Vedanta Limited is more like a holding company which also houses a stake in Hindustan Zinc, the copper assets, slightly in the iron ore mine, and some other strategic investments. So I believe that, if the investor purely wants to play a commodity play, then directly investing in Hindustan Zinc makes better sense, because I think they are one of the lowest cost mine producer in terms of the zinc assets. And I think their silver smelting capacities have also gone up a lot. And I think that total mine capacity is almost 1.2 million tons, and they are kind of working to increase the capacities. So operationally, I think one of the most efficient company, massive cash flow generation this company has had, and the dividend track record has also been stupendous. So I think zinc is in a good space. Even lead and silver is also doing extremely well for them because their cost of production is low. So I would believe the investors better off playing it by directly buying Hindustan Zinc.
Okay. And Ajit, a quick one, Hindustan Zinc, Vedanta, which is looking better on the charts?
So both are looking okay, but after this strong surge that we have witnessed in most of these metal names, possibility of consolidation seems high. So instead of going at one go, a staggered manner is something that one should look for an approach. And Hinzinc after this correction looks comparatively better.
Okay, that's the word there. Hinzinc getting a thumbs up there. But on that note, we're absolutely out of time on this edition of Your Stocks. So thank you so much, Ajit, as well as Parthiv, for joining us on the show, as always, helping answer all the stock-related queries that our viewers have sent. And viewers, keep sending us your queries. Email address, phone number will be at the top of your screens for you all. So do send us your queries there. But the last set of trade is still left, and you have seen that recovery in the market. Is it going to continue? To take you through all of that, the closing bell up next.
Board headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
When you look at the Asian markets, most of them are trading in the red. Whether you look at the Hang Seng.
We're going to end that war very quickly. They want to make a deal so badly.
You know, not very much different from where we were yesterday, from where we were day before yesterday, a dollar here, dollar there, but basically up 23,400 on the Nifty. So about 0.8, 0.9 lower.
In about 3 weeks or maximum 4 weeks, we should be out with a discussion paper.
If I were sort of making the policy right now, I would wait on for like maybe a month, continue with what I'm doing.
And our sense is that we have taken off about 50 basis points on our FY27 GDP growth.
About 50 points on the frontline index, but there has been a notable recovery from the lows.
This sudden rush towards 97 took people by a bit of a surprise.
Some of the measures that have already been taken by the government to protect dollar demand.
I think this is also a nice way of pushing Indian products.
We did recover sharply from the lows, but there was some selling pressure from the top. 50 points off the highs of the day.
Well, that is the day so far. We're off the lows by quite a bit. We're up about 40 points as well. 23,660. Market breadth is almost even. 1:1 advance to decline ratio. So lots to talk about in terms of single stock, lots of stuff which is moving around. Rupee's also been pushed off just from that low. We didn't quite make it to 97, but we came very, very close earlier today morning. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Afternoon.
Hi, afternoon. It's about a 250-point recovery from the day's low on the Nifty. The low was around 23,400, and now we're above 23,650. So it's looking good. The mid-cap index too has moved to the day's high. The advanced decline ratio, though, is slightly in favor of the losing side. Big boy Reliance Industries is contributing on the way up. It's had a subdued month of May, but today it's up nearly 2.5%, 2.36% actually. Auto names are higher. Bajaj Auto, M&M, Maruti. Banks, the Nifty banking index was in the red for a greater part, but now it's managed to get back into the green, and it's Axis Bank over there. And Hindalco continues to remain your top gainer since morning.
Well, that's right, Rima. You know, as you mentioned, the big boy Reliance Industries, the team is still not in very, very good shape, but you require a top batsman to come out there and play for the team, and that's precisely what Reliance Industries has done. If you look at the Nifty, we're up close to around 55 points. You pull up a contribution chart, and you'll see almost all the gains actually have come in because of Reliance Industries. That's the big heavyweight in there. And the biggest positive for me is for the second day running, we're seeing the breadth of the market so strong. In fact, that contribution chart is telling us that all the gains of today are coming courtesy the big boy Reliance Industries. So that gets a thumbs up. And the crisscross lines come up for you. Yesterday as well, the markets ended down, but that was a weekly expiry related factor. And that's the point we made earlier today. Yesterday, 100 points off the top, 200 points to start off with lower. The bulls will view this as an exciting entry opportunity, and they've lapped into that. And just take a look at it. 450 stocks were advancing when we started off trade. Now we're 1,000 more stocks, close to around 1,500 stocks. Pretty much even Stevens. Almost a midweek kiss is what we like to see between the advanced decline ratio.
Well, it is Reliance, right? I mean, which is doing a large part of the heavy lifting right now with that 3% odd pop. And you know, it's being countered with what it is doing. So 55 of, actually the Nifty's are 55 points, and Reliance is contributing 55 points, index points. So, I mean, actually it's a, single stock show, at least as far as the Nifty is concerned. Hindalco is adding about 10 points, Axis is adding about 10 points, Mahindra is adding about 8 points, Bajaj is adding about 6 odd points. So there is a bunch of auto names which are participating as well. Let me just quickly, numbers are coming through Samvardhana Madhusan, and we'll detail that out for you with Sud in just a bit. But here's what's lined up with regards to stocks and sectors, etc. So nearly 23,700 now. Mid caps, of course, are joining the up move. Small caps a bit under pressure. They've been that way after the outperformance off the lows last month. And PI Industries is down. Numbers were weaker. Godavari Power is a interesting one. Stocks up. It's been up even when the market was down earlier. and we'll have we'll detail some of those out for you in just a bit. You got Hitachi and GE Vernova. Basically, the con call highlights stood out, and I think that's having an impact for Hitachi as well. So that HVDC segment as far as power transformers go, very much the winning theme in that sense. Well, Bank of America's monthly fund manager survey shows that sentiment is rebounding, or has rebounded in the month of May. So Hormuz gets you that a little later. Apollo Hospitals is all set to report fourth quarter numbers. We'll take stock of what the street is penciling in. So that is what is coming up. How should you position yourself is the question. Mitesh is with us to answer that. Mitesh, markets, of course, not staying down, and there is a bit of buoyancy, most definitely. What would you do?
Yeah. So, Prashant, I think, very clearly, the markets are basically consolidating and chopping around in a range. I said 23,800 on the upside, and then 23,300 broadly in the downside as the range. And we still haven't got a signal of a directional move. So I think on the index, one can avoid trading. The good thing is that the Nifty IT is trying to continue with this bounce back. Yesterday's high was around 29,610. Today, I think it was 29,520. So I think this 29,600, 500 zone, once that's taken out, that's also the 34-day exponential average. Then I think you might see some traction on the upside on the IT stocks. But broadly, on the Nifty and Bank Nifty, I'd avoid trading. And trading should be, this thing should be more of done on stock-specific basis.
Back today, it's Wipro, which is doing well. So that continues to see traction. 1 3/4 percentage point up in the last 3 days. Wipro has moved up nearly 4%. And on the mid-cap end, it's Oracle Financial Services are persistent. These are up nearly 1%. And along with that, you've got strength in many of these ER&D companies like Tata Tech and KPIT Technology, all pushing higher for the third consecutive day. So that's the view coming in. But let's talk about PI Industries. That's reported a decline in Q4 performance, with revenues falling to 1,565 crore. EBITDA has come in at 337 crore. Ria joins in with the details.
Well, yes, it has been a very weak quarter for PI Industries this time around, below estimates on all fronts. And this weak quarter was expected by the street versus a relatively difficult year-ago base for the company. Revenue has declined by nearly 12% in this quarter, in line with the estimates that the street was working with. EBITDA, however, has declined by 26% versus estimates of a 19% decline. And even the net profit has seen a steep cut of around 39% compared to an estimate of a 23% decline on this front. Margins have also contracted by 400 basis points to just 21.5% in this quarter versus an estimate of 23% margins. Even the full year performance has been quite weak for the company. Revenue and EBITDA seen declining in line with estimates. The adjusted net profit has also declined by around 27% compared to the previous year. And the margin contraction of 200 basis points to around 25% this time around has been in line with the guidance that the company had given. And the company has also said that a favorable product mix this time around has supported margins somewhat for them. In terms of the segments, the agrochem exports for the company have seen a decline of nearly 19% compared to the previous year, with volumes declining by 14%. And this is largely due to a high base effect and also the contraction of the agrochem sector globally. Domestic revenues have also declined by around 7% compared to the previous year. Volumes also seeing a decline of 1% on this front, although the pharma revenues have grown by around 40% compared to the previous year. And this has contributed around 6% to the export revenue of the company overall. And overall, it has been a weak set for the company, which is why the stock has declined steeply in trade. But around 3 p.m., we will have the earnings call where we will be watching out for any further commentary on the outlook for the next financial year.
Thank you very much for that. Let me go back to Mitesh. Mitesh, you have a view on PI Industries and the stocks that you're recommending?
Which stock now? PI Industries.
This is one which has taken quite a bit of a knock, 7% down. Ria was just telling us the fundamental news, if you have a technical call on it, and then, your technical ideas, trades for the day.
Well, I think very clearly, PI is on the recommendation list today. I have, in fact, a sell call over there. There's some kind of breakdown which has taken place, and while the stock is off the days low bit, I think the structure has been damaged. So I recommend selling here with the stop just about today's high of 2950. So keep 2955 as the stop, and 2800 or thereabouts could be a good target. While Motherson is on the buy side. That's a buy with a stop just below levels of 132 and a target of 144 can be looked at.
All right. Thank you very much for joining in, Samvardhan. Motherson is reacting to the numbers positively. Stock is inching up. It's 3.5% up. There has been a revenue beat. There has been an EBITDA beat, and the EBITDA beat is quite sizable. It's 3,800 crore of an absolute EBITDA versus expectations of 3,200 crore. And at the margin level, EBITDA margins at 11% have come in higher than the CNBC TV18 poll of 9.8%. So it looks like a top-down beat, revenue growth ahead, and margins have come in significantly higher. Siddharth Khemka, Head of Research Wealth Management, Motilal Oswal Financial Services, is now joining in. Siddharth, throwing this at you, but do you all have a call on Samvardhan Motherson?
Yes, hi, good afternoon. So Samvardhan Motherson is something that we definitely cover. It is among our top picks in the auto space. And if you look at overall the number-wise and the outlook, I think they continue to benefit from the premiumization, the EV transition, as well as the company's efforts to diversify beyond auto segment into some of the consumer electronics and aerospace. Strong order book, and they generally have a tendency to give the 5-year outlook and growth aspiration. So that now stands at a staggering $108 billion US. So we expect Samvardhan Motherson to continue to outperform the global automobile sales, and we are having a positive view with the buy rating on Samvardhan Motherson.
Okay, all right. By the way, we have Grasim's numbers that are at the bottom of your screen. The operational performance is something that you look at very, very closely, and we're just waiting for a couple of those numbers that will help us analyze these details. For the time being, only the net loss number. What you should be looking at is a segmental breakup. We have a reference point out there. The VSF business, as per what Kotak threw up, they were expecting around 550 crores approximately. So let's see what they have delivered on that front. You'll have to look at the segmental breakup. And the other one we have is the chemicals business should report around 280 crores approximately. So the segmental breakup comes up. Actually, I think the cellulose fibers business has come in at around 588 crores. So the VSF business actually has done relatively better than what the street was working with. And also the chemicals business, if I look at it, it's coming at around 304 crores approximately. So on both those two parameters, actually, it's looking a little bit better. We don't have a breakup on the paints business, but we'll wait for some kind of commentary even on that business. Net, we already have, for Grasim, you already have Ultratech's numbers. So that's part of the consolidated entry. But what the street will look at is the VSF business, the chemicals business, which in this case, both of them are looking better than what at least Kotak had put out. The numbers at around 580 crores for the VSF business, which is the cellulosic fibers business. Kotak was working the number of around 550 crores. The chemicals business out there, they expected to struggle. It was expected to come in around 280 crores, which is lower sequentially. But that's come in at around 304 crores approximately. So I think these numbers, they look a little bit better. But the commentary, as I said, will be eyed, particularly with regard to the paints business, if in case there is any other kind of commentary about their ambitions on the inorganic front. So we'll wait for that as we speak. For the time being, the stock seeing a nice spike up because the standalone business, it appears, is a little bit better. The net loss number below the operational performance is actually not very important. The segmental breakup should come up for you on the screen as well. So these numbers go down as a good number. We'll try to get in further details, and as we get it, we'll keep coming back for more. There's only, I don't see the presentation out as of now. Let's focus on another name then by the time, Godavari Power. Well, that's zooming on the back of actually a good operational performance. Remember, the margins came at the highest levels we've seen all the way since the September 2023 quarter. It was driven by improved spreads because they took price increases which took effect in the past quarter. Also, higher proportion of pellet sales because the 2 million ton pellet capacity came on stream. It was commissioned in December 2025. So some part of that benefit did come in. And there's an increase in captive iron ore as well. Now, focusing on the pellet sales, the iron ore pellet sales, that was up by close to 13% on a year-on-year basis. On a sequential basis, it was up a whopping 150%. So that's good news. The revenue growth was close to around 10%, but the operating profit was up close to around 38%. Explains why the margins expanded all the way to around 27%. On the volume aspect as well, they're guiding for very good times, in the coming year. because iron ore mining, that volume is likely to come in higher in comparison to what they did last year, 3.4 million tons. Pellet sales will zoom to around 4 million tons, and spawn iron sales will be around 0.65 million tons or thereabouts. But what's really excited the street is they've given a roadmap for the next 5 years. So in FY31, they're talking about revenues of around 30,000 crores. Now, that's much higher than what they've done in the past year. That's more than 5 times higher. The EBITDA number as well, they're talking about close to around 5,000 crores, which is nearly around 4 times of what they did in the past year. And net profit number of around 3,000 crores. Remember, this is the company with the market capitalization of around 20,000 crores. So hard to justify it on the trailing numbers. But going by the guidance, it seems the street likes it. Sitting on a good cash balance as well of around 850 crores. So explains why this stock is up and about in today's trading session. Let's go across to Sid. Sid, any view on Godavari Power and Ispat? Good move is what we're seeing. Very, very ambitious plan is what they've laid out. I was just looking at an old video actually because someone has tagged me on X. We explained this company at 400 crores of market capitalization. It's 20,000 crores. At that point of time, they were just doing the run of the mill, and then they've evolved themselves. They've got the environment clearances coming as well, captive iron ore, which has helped them. And now they're focusing on the way ahead, also tilting towards BESS. Any view on the stock?
Yeah, I think definitely the tailwinds are there for the company. We had the massive upcycle for metals after the COVID. Now the second upcycle is there. While we don't have an official view, but I think the company that has given up a massive target of, you can say, top line hyper growth, targeting 5x revenue jump to 30,000 crores by FY31. Obviously, they have upped the capex guidance for FY27, FY28, and also clarifying that bulk of this capex will be self-funded. So there is no risk of dilution, which is what the market is liking. So definitely a stock in the right sector with the right targeting aggressive business growth. What they are also doing is there is a business transformation. While the core captive iron ore mining continues to generate the cash, they are getting aggressive into some of the new age businesses, as you rightly said, the energy transition, which is the BESS, plus the specialty steel, that is the CRM, and the structural steel, which will drive margins and growth, which I think should be positive for the company.
Okay, all right. Waiting for further details on Grasim. But my heart skipped a beat because suddenly it was written that they're looking at an acquisition, but that's a very small size one. So it's not the news that the street was waiting for in terms of what the Aditya Birla Group's adventurous plans that they have. It's a very small acquisition, special purpose vehicle, more towards renewable energy. Very small. So that's not something that we should be talking about too much. But let's talk about the stock. Sid, what's your view on Grasim? Bulk of the value comes in from the holding in Ultratech Cement. They seem to be getting their home in order, because they're not putting money in unrelated businesses like Vodafone Idea, which is good. Focusing on scaling up the paints business, and they're evolving as as core businesses as well. Both their VSF business, chemicals business, showing signs of improvement.
Yeah, I think if you look at the core business, the VSF looks like in a strong upcycle. We are expecting for the Q4 the VSF EBITDA to grow 83% and margins to expand by almost 5.5 percentage points, which is a strong uptick. While if you look at some of the other businesses, for example, the investments in paints, the B2B e-commerce, that is maturing and no more investment is being done. Plus the business is gaining traction. We are now hearing that Birla Opus is now gradually increasing prices. So the discounting that they used to do to gain market share, that has reached the scale, and now they are into the profitable mode. So I think if you look at selectively, they are doing the price hikes in the paint business, the improving VSF margins, the operating leverage, and the medium-term value creation all makes us positive on Grasim. Right now, we have the target price of around 3,300, but definitely we'll look at the stock once we get the details as well as the con call happens. But definitely positive upcycle for Grasim.
Okay, thank you very much for that. Another good set of numbers. Eris Life, look at the bottom line. It's tripled. 94 crore has become 282 crore. I presume or suspect there could be a extraordinary revenue growth has come in at 7.5%. EBITDA is up 8.5%, but big jump in the profitability. GE Vernova and other stocks in the transmission space and distribution space are also buzzing following the bullish commentary from GE Vernova's management in the post-earnings conference call. Vinny joins in with the highlights.
Hi, afternoon. So for GE Vernova, first let's talk about the industry outlook that they've given. They've spoken about renewable energy, the growth that India as a country is expecting here as well. 900 gigawatt of renewable energy evacuation plan by 2036. That's going to be driving grid investments as well. Now, demand, where they see it coming in from, industrialization, urbanization, data center. Furthermore, on data center, what did they highlight? Long-term opportunity that comes in for the company as well as other players, obviously, as well. Data center sector will do well. Data center currently of the Indian market, 1.5 gigawatt is the current market scenario. That's expected to scale up in the next 4 or 5 years. Means more opportunities that come in for players like GE Vernova, Hitachi Energy, Siemens Energy as well. HVDC projects, that's a big one as well. An important opportunity in terms of pipeline that comes in for these players. In India, mainly that's driven by what? Renewable energy integration as well as grid expansion. Now, there are 10 HVDC corridors that are expected to come in from Rajasthan, and this is expected by 2036 as well. There's more opportunity that will come in on the Brahmaputra basin as well. So these are HVDC opportunities that come in on the industry front. That's why all these stocks are buzzing. Now, company specific, what did they highlight? Mid-20s EBITDA margin guidance going forward is what they're continuing to maintain. Furthermore, aspiration is to improve these margins. Revenue growth will continue. Why? For the company, they're expecting the strong growth. Strong order book backlog. They have execution, which is a good pace, as which they've continued in the last year as well, and they expect that to continue. HVDC, that will be an important strategic point for them in terms of investments and opportunity, not only in India, but also the global front. They have also won some LCC HVDC refurbishment that came in from Power Grid as well. So that is an important one, and they'll keep working on the HVDC side of opportunities. Middle East, they said demand is healthy, no material geopolitical impact that came in there. So overall, very good positive commentary, good guidance for the industry as well as the company itself, and that's why all these stocks are buzzing.
Thank you very much for that. Siddharth, come in.
Yeah, sure, Rima. I think GE Vernova is the stock for the day. Pretty strong outlook there, strong performance. Q4 numbers were ahead of our expectations, strong beat on margins. Order inflows were pretty strong, up 37%. I think the company is showing a lot of confidence in securing another 7,000 to 8,000 crores of orders on base of domestic orders, plus expects exports to do much better. So what we are expecting is the company to sustain the strong margins, aided by the healthy revenue mix, adequate variable pricing clause, which will also help in the operating leverage. On back of a very high growth in FY26, earnings of almost more than 100%, we are expecting a steady 30% earnings growth for the next 2-3 years, which should sustain the premium valuation that they are currently trading at, given they are in the right space. There's a lot of excitement around this entire capex theme, especially in the power sector. So we remain positive. We have a target price of 5,200, but I think the company continues to outperform given the strong set of numbers.
Thank you very much for that. Avalon Tech is another stock which is moving quite well. Nomura today initiated coverage on Avalon Tech with a buy rating. They believe it's a good play on the entire EMS space, the global EMS space, and that stock is surging nearly 7.5%. We will slip into a very short break. We'll thank Siddharth for joining in. On the other side, Ronak Omkar of Parag Parekh Financial Advisory Services joins in. Welcome back. Hormus is now joining in. Global fund managers have sharply reduced cash allocation and put money into equities in the month of May. This is according to the latest BofA Global Fund Managers survey. Hormus is now joining in to give us the key highlights.
It's a very interesting survey from BofA, and they have interviewed around 200 fund managers over this 1 week period from the 8th to the 14th of May. Yes, they have put money, they've reduced their cash exposure, put money into equities, but there were some important questions that were asked to these fund managers during this 6-day period. You take a look at these 200 fund managers who have managed well over $500 billion. The most important question that was asked to them is, which is the biggest macro tail risk right now for the markets? And that's not oil, and that is the inflation that results because of the higher oil prices. 40% of those fund managers believe so, and then followed by geopolitics and higher bond yields, and of course the AI bubble. The second most important question, of course, when is the Strait of Hormuz reopening? That question, with the answers are yet to be found. 44% of those believe that's happening next month. Some of them believe in the third quarter. And some of them, the pessimistic ones, there are 5% of them, they believe that that might go up to 2027 or maybe even later. Oil prices remain the key talking point. Brent is well over 110. Will it remain so? Well, only 7% of those believe that over the next 12 months, the oil prices will remain above 100. Majority of them believe anywhere between $70 to $90 a barrel. Now, the bond yields have been a talking point over the last couple of days, and the 30-year bond yield right now is at the highest level in nearly 2 decades. Now, 62% of these fund managers believe that over the next 12 months, this 30-year bond yield, which currently is at 5.25%, might go up to as much as 6%, and that might become a risk for the market. The next one, of course, is the most crowded trade. Now, the no-brainers here, but because the long global semiconductor is the most crowded trade at 73% of the fund managers believing so. Long Max 7, long oil, long EMs are some of the others in the list. And of course, the most important question over the last 12 to 18 months that we've been asking, so are the AI stocks in a bubble? And well, it's right down the middle here. 50% of them don't believe so, but 40% of them say that yes, they are in a bubble. So where are these fund managers putting their money to work? Equities, yes. Emerging markets, commodities, US stocks, healthcare, and so on. But they are underweight on cash, they are underweight on bonds, they are underweight on the Japanese stock markets, discretionary, the dollar, UK, and so on and so forth. So REITs and staples are some of the other sectors here. The two most important takeaways from this is the fact that inflation currently is the biggest tail risk, and the jury is out on whether the AI stocks are in a bubble or not.
Got it. Thanks a lot for that, Hormuz. So we'll keep an eye out on the bottom of your screen. Some commentary coming in from Grasim on their paints business, which is Birla Opus. The market share again has been closer to around 90 basis points on a sequential basis. And obviously on a low base, the paints business revenue is up by close to around 50%. We'll wait by to see whether or not the losses are reducing in that particular vertical. But that commentary will come in, post-market hours, I think so. So for the time being, the street likes both the segmental numbers that have been reported, which is the VSF business, as well as the chemicals business. And now, in fact, the paints business commentary as well is pretty good, where they're gaining market share. That said, it's a good time to get in Ronak Onkar, the Head of Research and Fund Manager of Parag Parikh Financial Advisory Services Mutual Fund. Hi, Ronak. Good to see you, Ben. Are you getting a little bit more optimistic on the markets? Because the cash levels, I think, from a high of 20-25%, it's come down to around 15.5%, if I'm not mistaken. So you're deploying more?
Hi, Anuj. Thank you for inviting me. Yes, we have deployed more in the month gone by. We have brought down the cash levels a little bit, but we haven't added any new meaningful positions. We have basically added to the existing ideas that we liked, whose valuations became more attractive, namely private sector banks, some IT services, and a little bit of city gas distribution, and a bit of your PSUs. So wherever we thought there was value to be added, we basically allocated the extra cash. But we still are on 15.5% cash.
Okay, got it. All right, Ronak, and this is Nigel on this side. Learned a lot from Anuj, but, Nigel on this side. No worries.
My mistake.
All right, so 15.5% is not too bad, right? Because there was a time when you were sitting on cash and we were asking you, Ronak, are you going to deploy? You're like, no, there are challenges. So it appears, at least though the challenges persist, you're getting a little bit more optimistic going by your cash deployment. And one of the sectors you mentioned is a contra sector, that is tech. Every few days, my colleague Rima brings us some news that the globe has said this, that, and the other, and maybe our tech services companies may not be able to grow at the pace at which the street was estimating, which is actually very, very subdued. I'm noticing you all have been adding some IT stocks, HCL Tech, Infosys, TCS. So do you all believe that's the big contra trade that you all are taking?
So sorry, Nigel, I misspoke your name.
No
But yeah, on the IT services side, yes, it seems like a contra trade, but actually nobody knows where the direction is headed. A lot of the times we are seeing narratives which are on both extremes. One is on one side you see that IT services can get decimated because of automation, and you will not require the managed services that was required for the past several decades. The industry has come up on that kind of labor arbitrage, time arbitrage by sending work offshore. And the second thesis is on the other side where you're seeing that people are actually using it to become more efficient, becoming more productive. And you're actually seeing the cost of delivering the same service has gone down. So once that happens, you will see a lot more volume coming in. So we are seeing both spectrums, both examples from the companies. If you have seen the latest quarterly results, they're talking about both things at the same time. It remains to be seen whether it is going to be detrimental in the longer run. So far, what we know is the business has shown adaptiveness in the past when cycles and technology cycles have changed. We have seen that they have a good governance in place in terms of the quality of business and quality of people. And lastly, these are cash generating businesses which are basically giving out cash back to shareholders, which they don't require. And incrementally, they are scaling in areas where they have to evolve in this new era of AI services. So I don't think it is written in stone or it's guaranteed, but we will see how it goes. So far, the valuations are attractive.
Okay. Ronak, for the broadleaf on the markets per se, the reason for bringing down the cash holding and deploying money into these individual sectors that you've liked, is it purely on account of valuation, or are you getting the sense that markets themselves have bottomed out and there is upside? And are you looking to deploy more as we speak right now?
When we deploy across our portfolio, it is always bottom up. So if individual companies or individual sectors look attractive, we will build our positions over there. That's what has happened over here. So private sector banks has been a large part of our portfolio for a while. We added there because the valuations corrected and became attractive. In IT services, we have been owning them. We just little bit inched up the allocation because we thought that the valuations were becoming attractive in that area. And across the board, wherever we found the companies we already knew a lot about, and this was the right time to maybe scale the positions because the markets had corrected, we added. But broadly, if you see, the markets may look like they have derated in terms of the earnings multiple, but there are a lot of mix of businesses there. There are some businesses which are extremely expensive, which either on a lower growth profile still trade on a much higher multiple of earnings and cash flows. Maybe there is a lot of optimism over there. But we don't see the market has become extremely cheap to get very excited.
Okay, we have a couple of listed REITs, and I believe you're tanking up on both of them. As a percentage of your portfolio, what is it, 8%?
Close to 4% in the Flexi Cap Fund, yeah.
4%, okay, all right. And to tell us your thesis out there on these REITs, because both the listed ones you'll have been adding.
So REITs are very interesting vehicles to participate in the commercial real estate space, where you get a broad portfolio, diversified portfolio of commercial property, and that property is going to be rented out to maybe MNC clients or even domestic players who are getting longer term rentals and leases from these companies. And over there are two interesting things. You get a quarterly distribution of the rentals to the unit holders of the REIT, and that is at a very reasonable yield right now. At the same time, some of these rental clauses are also built on escalations of rent over a period of time. So there is also some bit of inflation hedge you can get in some of these products. And as these REITs have enough cash flow to deploy into acquiring new assets of similar quality, as long as they don't overpay for those assets, you are good. You are basically going to get the similar or better yield incrementally. So we are seeing a lot of GCCs coming in, a lot of domestic commercial property demand is going up for grade A properties. And this is a good way to participate in that trend.
Okay, I'm getting a couple of messages saying, thank God Ronak is deploying more money. People on the outside are feeling more confident as well about the market. So, not just good for your portfolio, hopefully it's good for the markets on the whole. Because you all have actually been sitting on the sidelines, and rightly so. That call has been spot on. Let's talk about a couple of stocks that you all have exited. Balkrishna Industries, I think you all have exited totally from there. What is it? Is it a sector call or the stock ran its course? You give us some rationale.
It's a business specific call. So it's a great business which has had a great execution profile in the past, and it remains to be a very good business. At the same time, the valuations had become, I think, a little bit elevated over a period of time. Considering the kind of pressure that that business will see going ahead, we thought it will be prudent to not have a holding at this point in time, but we continue to like the business. They have a great set of products and they have a good reach across the world.
Okay, all right. Let's talk about some of those slow movers. ITC. That's the stock that you'll have been holding on, building positions, I think so. View on that one. And Coal India as well. You'll have been building a position there. Probably the government will come and take some money off the table. I would think timing is pretty okay. For Coal India, ONGC, if the government wants to take some money off the table, probably the timing is not too bad. But that said, what are you all doing on both these two names?
So ITC, again, we, as much as we like the consumer space, it's very hard to find a business that grows consistently and is reasonably priced in the domestic Indian market. So ITC was the only bet we added during the COVID, and we have been owning it right since then. And the business has delivered across several fronts. One is on capital allocation. They rationalized the capital allocation a bit. The payouts have gone up, and also the contribution from the consumer business, which is the non-tobacco business, has also been going up. At the same time, a little bit of volume growth has also been seen on the tobacco side. So overall, the business has been growing. Overall, the cash flows have been positive, and they have kept the promises that they had delivered in over a period of time. But yeah, in the valuation of consumer space, this is the only stock where we found a little bit of attractive valuations. So we added there a bit.
Okay.
And
just
India,
one, yeah.
Sorry.
Go ahead.
On Coal India, you asked, again, Coal India is again a play on the domestic power demand space. Although we understand longer term, as we grow more renewable power capacity in the country, eventually coal has to have a terminal growth of 0 or maybe lower. But we don't see that happen immediately. There's going to be a transition phase where you will have to shift from coal to other renewable power over a period of time. But at the moment, it provides a very valuable part of our base load for the country's demand. And since it's our own coal that we are using for generating power, it's also good for us.
And maybe the world is under invested in that space as well, at least as of now. Terminal values were being called for too soon, so probably have some comfort out there. Very quickly, Ronak, what about the Indian rupee? And have you all found any potential beneficiaries of this big move? We already spoke about tech. But, our exports will be more competitive if you compare us to, say, China. So any sectors, any theme you like over there?
We have to understand we are part of a global supply chain. And when we look at a global supply chain, not just the exports value goes up because of all these dollar rupee currency movement, but at the same time, we also have to import some of the subcomponents or raw materials where we may not be self-sufficient. So I think we have to look at this in a measured way. Looking at just one metric of how the currency has moved may benefit temporarily for some companies, but you'll also have to measure over a period of time what is the impact of raw material, what is the impact of the inflation on the demand of some of these products. So I would not call too soon as to whether it is positive or negative, but I think some of the sectors do have short-term benefits right now. But I think over a bit of time, we have to see at a macro level at a country what happens.
Got it, Ronak. Always a good chat. Thanks for joining in. Relief, as I said, that you're deploying more money. I don't know whether the next time when we chat, whether it'll be closer to around the single digits. Let's see. Thanks for joining in, Ronak.
Thank you.
Well, let's do a quick check on the F&O market. And the markets actually from the day's high have come off. But I'll tell you what, even when the markets were a little bit lower, we are seeing signs of writing at around the 23,500 put. The premium, by the way, has come down to around 140 rupees from around 170 rupees approximately, 133 rupees or thereabouts. So there is signs of writing on this particular strike. As is the case with the 23,400 put as well, the premium's down to around 100, 105 rupees, 104 rupees now in comparison to 136 rupees. So on both these two strikes, we're seeing some writing. And that's why I've been saying that this 23,250 to around 23,350, that's the level that in fact the bulls will look as a bit of an entry opportunity. So we're still in a very much trading market because hard to get very constructive with the kind of cues you have globally. But even this morning, we went closer to that mark of around 23,350 and the dip got bought into. However, on the upside, the 50 DMA and the 20 DMA, which are both those two levels that are up for you in the screen, 23,750 to around 24,000. That's where the 50 and the 20 DMA are. And remember, yesterday, that level got rejected. So that's the important cue that you're looking at. India VIX is cooling off. That's a blessing, actually. You don't want it to run away. So that's good news as well. Big boy Reliance Industries. Difficult days call for one of the larger names to come in there, put their hand up and get counted. And today, Reliance Industries has done that. Now, remember the stock, when it has been correcting to around the 1290, 1300 odd mark, it's been seeing buy. And today as well, there's some fresh long build-up on that particular counter. As is the case with the BHEL, there as well, stock up, open interest higher. While in Info Edge, a stock that's been shorted into, that's actually come in for a bit of a short squeeze in today's trading session. Stock up, open interest a little bit lower. We take a mandatory break though, come back. On the other side, Nimish is waiting for us. He'll tell us what is he picking up in the dealing rooms, as well as we'll have our technical experts back with us. Welcome back. Well, time to get in our technical expert, Mitesh Thakkar joins us. Mitesh, what are the fresh trades you have? Get back to the call in just a bit, but give us the trades.
So, Nigel, Reliance is something, which I think you or Prashant pointed out. That's giving some kind of a reversal. So, and it's come back from those levels of 1310, 1320 zone. So that's a BTS with a stop at 1349 for targets of 1370 on the upside. I think 1370 is the target for tomorrow on the upside. And the other stock is Siemens. That's a BTST as well. We keep a very tight stop at about 36.75 for targets of 37.35.
Got it.
Got that. Thank you very much for joining in. But let's now talk about the Lal Street Chatter, D Street Chatter. Nimesh is now joining in, as always, to get us an insight. Nimesh?
Hi, Rima. So market is showing a lot of resistance and strength despite the macro headwinds for the last couple of days. And to some extent, it's backed by FI buying as well. Either it's FI buying or lack of selling, I would say, which is supporting the market at lower levels for the last couple of days. And that's the trend today as well. From a flow perspective, again, a mixed day of trade. The buy seems to be towards PSUs today. So oil marketing companies and the PSU banks is where there is a lot of bidding interest from large institutions. I guess that's going to be the trend. Selectively you're seeing one of the sectors outperforming. Today is a case for MNCs to do well. No specific reasons for MNC stocks to do well, but largely I think in the fact that the Q4 was strong for most of the names. We saw GE Vernova today after another strong quarter and some upgrades as well. So that's a pack which has done well. And again, some bit of institutional interest as well. Technically, as I've been saying for the last couple of days, 23.98 on the upside, that's a bit of resistance to watch out for. But frankly, it looks like there is a bit of strength in the market at lower levels, and CIT is anticipating some government moves as well over the weekend. So watch out for that. But broadly, I guess today's up move again from the lows is backed by some bit of institutional buying as well.
What about stocks, Nimesh? What's the chatter?
Well, the first stock is Viva Scientific. It's a demerged entity from Sequence Scientific. Up in trade today, up 11% after the earnings and the call. My sense is some large HNIs have bought aggressively post the con call. So that's the reason why that stock is up 11% in today's market. The second stock is Stellite Technologies. This is going to be interesting. A big outperformer in the last, say, 3-4 months. From the recent peak, it has consolidated, but my sense is that the company is likely to raise funds via QIP very soon. So that's the buzz in Stellite. The third name is Reliance Industries. After a long time, some buying has resumed in Reliance Industries from larger institutions today. And also, I understand some larger HNS have bought into Reliance, and that's the reason why a big up move in that name after a long consolidation. And the last is Medvist. Again, while the stock has been under pressure today, But my sense is there could be a large block deal in Medwest very soon. So that's the trigger in Medwest.
Viyash Scientific, right? That's basically the entity earlier, Sequence Scientific.
Sequence Scientific.
Big one, 10.5% higher. I think Quant is one of the holders, large mutual fund holders, but it used to be at least. But I think, as Nimesh points out, post the earnings and the con call, there has been some buying from HNIs, etc., which seems to have come in. 253, 254 on this one at this point. Well, I think, Nimesh, thanks very much for that. So let's just go back to the rupee, and the rupee, of course, pulled back right from the brink of being hitting 97. So I spoke with Sajid Chinoy of JP Morgan. So, you know, he's written a new report asking the basic question, why have capital flows into the country dried up over the last 3 years? So you can catch that entire interview on our YouTube page, but we're going to play out a small snippet of that sort of interview on what are the possible measures here and now and slightly medium term, which we need to do to shore up the capital account, because that is where the problem is. So just listen in.
I think the government is likely contemplating all instruments, withholding taxes, raising capital, how to raise ECBs. My only submission and advice from the outside would be that, you know, if the idea is to raise a large enough quantum of capital to act as a circuit breaker, we should go big, right? So if you want to raise it, raise a significant amount of capital so that you can do two things. You can significantly augment reserves, and then you change the narrative in the FX market, because you know, market participants see, oh, India's attracted a very large quantum, and exporter-importer behavior, hopefully, and investor behavior will change. So, you know, I won't speculate on specific instruments, but these are unusual times, and I think we should not rule out any instruments. I think all instruments should be on the table, and the government should feel free to choose among them.
And how do you raise that very large amount of dollars, Sajid? What's the best route?
So, you know, it's not going to be easy, Prashant, because as I mentioned, you know, US rates are elevated. This is not 2013.
Sure.
Again, we have a history here. Again, I won't speculate on specific instruments, but we did see in 2013, there was an FCNR route where there was a subsidized swap. One other alternative could be external commercial borrowings, where we know that, you know, some state-owned companies, corporates, banks, you know, would be inclined to raise dollars if the conditions were made more favorable. Should we be looking at withholding taxes so that India becomes eligible for the Barclay-Bloomberg index, which can also bring in a substantial quantum? I think operationally there are different instruments available. My submission would be, if we're doing it, we should go big, because the idea, we have a large quantum of FX reserves. I think this amount is not being raised because we don't have enough reserves. This amount is being raised to A, augment reserves, but B, act as a circuit breaker in the rupee market.
Interesting conversation there, but let's get back to the markets. And today, post-markets, Apollo Hospitals will be reporting the numbers. Ekta joins in to tell us what to expect. Ekta?
Well, yes, for Apollo Hospitals this quarter, it is expected to see operational improvement. So that's basically one of the key factors which are being worked with this time round. Revenue growth should be around 20% on a year-on-year basis for Apollo Hospitals this quarter, and the margin should probably improve to around 14.5% to 15%. That's basically the range that the street is working with at this point in time. In terms of the revenue, I just want to correct myself, 15% in terms of total revenue growth, but the hospital business is expected to outperform that 15% growth. Now, in terms of the EBITDA losses for Apollo 24/7, that is expected to narrow in Q4, and that is expected to possibly aid the overall margin improvement. To put it into perspective, the digital losses in the previous quarter had come down to around 25 to 28 odd crores. Now, in terms of the hospital EBITDA, that will be something that will be watched out for because of the newer beds as well as the capacity which has come on stream, and that could possibly weigh down in terms of the hospital margins. Now, overall commentary with regards to expansion plans, the status of the Apollo Health Co and KMED demerger, as well as the possible listing timeline, which was Q4 of FY27 or Q1 FY28. Overall occupancies, you know, in terms of what they are targeting in FY27, as well as the 24/7 expenses and GMV would be something that the street would watch out for.
Okay, thank you very much for that. NVIDIA numbers will also be out today post-market hours, and that will be tracked very, very closely. But let's talk about the insurance sector, and here is a voice right from the top on the sector. In an exclusive conversation, the IRDAI chairman touched upon lots of hot-button issues. Here is what he had to say about the insurance distribution reforms, which the industry is keenly awaiting.
On the distribution side, what we understand is that there is, I mean, you are working on a consultation paper, which is going to be comprehensive in its scope. As you said, you will travel with the industry in the sense that you will take feedback and then, of course, come up with what is to be done. Is that understanding correct?
That's correct. We expect that in about 3 weeks or maximum 4 weeks, we should be out with a discussion paper.
And it's going to be comprehensive and...
What we propose to do is present a good analysis of the sector as it is now, provide some sort of a framework where the distribution reform should travel, and then elicit feedback from the industry and the public at large. Bima Sugam is a platform which is co-owned by all insurers, regulated by IRDAI. This is not a platform of distributors.
Right.
Two fundamental differences. At the moment, irrespective of the distribution channel, price of a product or return of a product is uniform, irrespective of what the cost of that distribution channel is. Bima Sugam seeks to do it differently because it's co-owned by insurers, the least cost, but same quality or even a better quality. Second, present products in a standard manner, but with substantive value, so that the people can buy themselves. That's the second element which brings in. So moving forward, we see it that as the first phase is starting with term life, maybe ULIP. ULIP is generally considered to be a complex product, but people in this country have learned very well what the mutual fund means. So ULIP in 2026 is not a complex product, it's a simple product. Then moving on to other life insurance product later on, but on a general insurance, it's starting with motor insurance and also for a health product. So that is what it means. So better product discovery, better price discovery, where insurers compete on their performance rather than letting the distribution channels compete or push products where they get higher commission.
Okay, all right. Well, look at the bottom of your screen. Lenskart has come out with its set of numbers, and for now, we only have the net profit number, which is indicating a bit of a dip of around 9%, but the operational performance is something that we'll keep an eye out on. Just on that knee-jerk reaction, we've seen a sharp downtick on the stock. We'll wait by for further details. Revenue growth, no worries out there. A company that was doing around 1,700 crores of per quarter just a year or so ago, that scaled to around 2,500 crores. That's a big surge there. Operating leverage should have played out, but let's wait by for the operating profit. And if there is something below the operating line that has led the net profit actually to see a bit of a decline. Waiting by for that particular set. I think it should be out in just a bit. Mayuresh Joshi, Director Research at MarketSmith India, joins us on the show. Hi, Mayuresh. We'll wait by for Lenskart numbers. Okay, wait. We have the numbers actually, Mayuresh. What's your view on the company on the whole? Because it appears that after seeing a sharp downtick, the actual operating number is quite good. The operating profit is up. And I think something would have hit the profitability below the operating line, given that the top line growth is solid, 2,500 crores of a number out there. Margins have moved to around 21.5%. That's a massive 400 basis points expansion out there. But below that level, that seems a bit of a dip. Mayuresh, when the stock listed, people called it expensive. Guess what? Shut up all the naysayers, because it went from 370 all the way to 500, 530 rupees, if I remember correctly. At around 480, it's still not cheap. But what would you make with these set of numbers?
Whatever, Nigel. No, I think it seems to be a very decent set, at least on the operating front. And though I've not seen the granular details, because the numbers are just out, I think if you probably look at the 9-month performance that Lenskart had delivered, the expectations in terms of store openings, specifically in the domestic context, are going to keep it in good stead. Again, I think the entire perspective that the management is trying to put forth and bring about is also the premiumization aspect in terms of its store offerings and the product mix. which probably makes the management believe that they can probably hit margins which can be even higher than what they've posted right now. So the expectation from a long process, and would love to hear the management's view on this, is anywhere between 24 and 25%. And in fact, a couple of slides in the previous transcript that they probably put forth is the international businesses as well, specifically Japan, specifically Southeast Asian operations and the Middle East, including UAE and Saudi Arabia, where the expectation is that the market size is relatively huge and the expectations of qualitative products coming at a more affordable cost out of the Lenskart suite might actually aid in international margins also going up and aiding the overall volume of bottom line growth. Decent numbers in that way.
Got it. All right, Mayuresh, stay with us for just a bit. We're getting another set of numbers, another recent listing that has actually been a big underperformer is Ola Electric. The net loss has come down. So that's interesting to see because it's come down from around 870 crores all the way to around 500 crores. But let's keep an eye out on the operational performance. Remember, this is one of the companies that has actually got bombed out of shape. And losses have come down. Just trying to see, the net loss even in the December quarter was around 487 crores. So the losses on a sequential basis actually have been maintained at a negative, 500 crores. But on a quarter-to-quarter basis, on a year-on-year basis, the revenues are sharply lower. We know that, there has been a big decline out there. But even on a sequential basis, actually, the revenue number has actually come in sharply low. I think we should get that number up for our viewers on the screen. 265 crores, that compares with around 611 crores. And on a sequential basis, it compares with around 470 crores. The stock is, already been a big underperformer. So maybe, in fact, the reaction will not be as harsh. But for the time being, stock is holding on to its own, up 1.5%. EBITDA losses have come down, but as is the case with the revenue number as well, that's seen a big decline. We'll try to analyze that number in just a bit. For the time being, losses low, at least on a year-on-year basis, on a sequential basis, net loss at around that 500 crore odd mark. Take that break, come back. We'll focus on a few of these numbers and wind down the markets.
Welcome back. Just counting down to today's market close. We're going to close up in the green with a gain of about 0.2%, but the story is in the intraday recovery and the pullback from the day's low of 23,400. Ola Electric numbers, as you can see, the EBITDA loss has narrowed considerably on a year-on-year basis. Mayuresh, you want to quickly comment on Ola Electric and the numbers that are flashing?
No, so even the revenues have come down quite significantly, right, Rima? So I think it will be a proportion in which the EBIT has come down. But I think it seems to see how the management probably reacts because it does not seem to get out on this trend.
And Lenskart?
So as I said, decent set of numbers.
Decent. Okay. All right, let's wind down today's trading action. The Nifty is closing at the 23,663 mark, a gain of about 0.2%. Mid-caps outperform mid-caps and small-caps for the second day in a row, and the advanced decline ratio towards the close of trade turned in favor of the gaining side. About 1,600 stocks advancing for 1,400 stocks declining. On BSE, the number stands at 2,300, advancing for 2,100 stocks declining. Well, on the way up, it was Hindalco, top gainer, 3.5%, but the heavy lifting was done by big boy Reliance Industries. Reliance Industries pretty much single-handedly contributed to the gains that you are seeing on the Nifty, 3% up on that. Grasim numbers look good. The stock got excited. In the IT names, Wipro continues to see buying. Many auto names are higher in trade. So whether it's Bajaj Auto, whether it's M&M, you can see strength. Apollo Hospital closing up in the green ahead of numbers later today. In the banking pack, it's Axis Bank, which deserves mention. On the way down, Tech Mahindra was one of the big movers. Along with that, HCL Tech, Infosys, they ran hard over the last two trading sessions. So some profit booking. Eternal, Tata Steel, SBI, HUL, Dr. Reddy's, ITC. So many consumption names on the back foot today. All right, that's the action on the large cap end. On the mid cap end of trade, we had many earnings reactions coming through. So whether it's Dredging Corp or Godavari Power and Ispat, on the way down, PI Industries, Z Entertainment, GE Vernova, TND, clearly one of the stocks of the day, rallying on good volumes. Mankind Pharma also closing up. We're going to take your leave on this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. On the other side is Markets Forward.
Market staged a sharp recovery from the day's lows with the Sensex and the Nifty rebounding over 1%. Nifty reclaims the 23,650 mark even as the rupee weakened further to hit a record low of 96.96 against the US dollar.
Hindalco Industries' US arm Novelis delivers a better than expected performance despite disruptions from fires at two of its facilities in Oswego. Management guided for a return to positive free cash flows by the end of FY27. The stock among the top Nifty gainers in today's session.
Zidus Life hits a fresh 52-week high on strong Q4 results. The management announces a buyback of 1,100 crore rupees. Z Entertainment's ad revenue was hit by West Asia crisis, but ZFi turnaround continues for a second straight quarter, while PI Industries stumbled on weaker than expected numbers.
You're watching us here on Markets Forward. Good evening. This is your show where we give you all the key data points you need to get up for the next trading session while tell you what took place in trade today as well. I'm Manglam Malu, with me Vivek Iyer. Good evening, Vivek. You know, we had a decent trading session. Yesterday, the market tested the higher end of the range and ended at the lower levels. Today, it once again tested the lower end of the range to move higher. What did not change? The weakness in the rupee. But what did change is that the support today came in from Reliance. The last couple of trading sessions, it was the IT pack which was supporting the frontline index. Today, Reliance did well. And towards the end, even the Nifty Bank actually picked pace, ended about 0.33% higher. The IT index took a bit of a breather and a backseat. The advanced decline split right down the middle, but there was a formidable headway made by the bulls as the trading day progressed, with advances eventually outnumbering declines by a smidge. But if you look at the crisscross lines, you would realize that there was a fair amount of jostle through the course of today's trading session, with eventually the bulls coming on top.
That's right. What a sharp recovery we saw. You know, we came in with very weak cues. Like you said, US yields actually went ahead and ensured that most of the global markets actually ended in the negative territory, but Indian markets staged a sharp recovery. And one sector that did very well today was the entire capital goods pack, and that was one particular sector that did very well. But here's the lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Sudarshan. We'll decode while stocks like Hindalco, Zidus Life, PI Industries and Z Entertainment were buzzing in trade. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But now on to our first segment of the day. Sudarshan standing by the big wall with all the top movers and shakers of the day.
Who would have thought that Nifty at the close would be 40 points higher after opening with a downtick of more than 200 points? And the biggest support came from the Reliance Industries, which contributed more than 60 points and was one of the top Nifty gainers, closed with a gain of almost 3%. All the auto names were higher as well. Bajaj Auto was the top Nifty amongst top Nifty gainers, closed with a gain of more than 2%. And amongst IT stocks, Wipro has seen buying, closed with a gain of 1%. BEL, despite strong set of earnings, closed down today and was down almost 2%. Some of the stocks that have reacted to earnings, Hindalco was top Nifty gainer, closed with a gain of more than 3%, and it was a strong set of earnings from Novelis. That's the reason stock reacted positively. Mankind too reacted positively to the earnings, and also the outlook for FY27 was good. RB Infra came at the last hour of trade and closed with a gain of almost 5%. PI Industry, it was a disappointing set of earnings. Even outlook is not looking that great and closed with a cut of almost 8%, while Eris Life closed 11% higher after Q4 earnings. GE Vernova came with the earnings, and following that, all the capex plays today saw buying today, and Hitachi Energy closed a gain of 6%. ABB, CG Power, Siemens, all these stocks have closed sharply higher. Oil marketing companies have seen buying for second straight day after fuel price hike. You can see all the three names, IOC, BPCL and HPCL, closed with a gain somewhere in the range of 2 to 3%. And lastly, some of the stocks that have hit fresh 52-week highs. Vodafone Idea continues to be hitting the fresh 52-week high. Lotus Labs has hit 52-week high. MCX for another day has hit 52-week high, and the last name, Aurobindo Pharma, ahead of its Q4 earnings tomorrow, has hit 52-week high.
All right, Sudarshan, thanks a lot for that. You did speak about a bunch of earnings. Top Nifty gainer today was Hindalco after its wholly owned subsidiary Novelis reported its fourth quarter numbers. The results showed operational improvement, and the company guided for better times ahead. This even as there were fires in two of their plants in Oswego. There are some concerns. Nigel joins in with all the details of what did well and what the concerns are.
Novelis' numbers actually were a little bit better. It was improved on better scrap spreads, though there were a couple of one-offs. Let's run you through the numbers first. On terms of shipments, it was down by close to 12%, but that was expected because the Oswego fire hit production out there. The adjusted EBITDA, though, that's the number you look at, that came in at around $459 million. With the EBITDA per ton, this is the adjusted number, came in at around $544 per ton. Remember, it was impacted because there was the negative $53 million from the Oswego fires, there was a negative $27 million due to the tariffs, but it was offset because $41 million of flood insurance is what they recovered. Remember, the flood was in 2024 itself. But there were two problems. One is the fire, they had earlier guided that it will impact the free cash flows by around $1.3 to $1.6 billion. Now, that number has swelled up to around $1.7 billion. The second factor is the net debt upon EBITDA. That swelled up to around the 23-quarter high at around 4.1 times odd. On the plant-specific guidance, they expect the New York plant to restart in the next few weeks, which is sooner than expected. They're also expecting the full commissioning of the Bay Minette project by the end of this calendar year. On guidance, they also went on to say that they expect to return to free cash flow positive number by the end of FY27. Put everything together, the positives outweigh the negatives, which explains the stock price move.
Well, thank you so much, Nigel, for joining in and giving us all of the key details why Hindalco was higher in the session today. To take this discussion forward, we are now joined by Mayuresh Joshi from MarketSmith India and Shrikant Chauhan from Kotak Securities. Thank you so much, gentlemen, for joining us. Good evening to both of you. Well, Shrikant, let me come across to you first. We started off the session on a very weak note, taking very weak cues, but managing to end with all of the indices trading with gains. Where do you see the Nifty headed from here on?
Vivek, good afternoon, Mangalam. So, see, the market is consolidating, and it has been consolidating since the last almost 4-5 days. It is not breaking the level of 23,200 on the downside. It is not crossing the level of 23,900 convincingly on the higher side. And the way there are flows like, let's say, currency or crude, I'm of the view that market is going to spend time in the range only. In case if it breaks the level of 23,800, then there is a possibility that we may see the levels of 24,200. So in between, I'm of the view that we can see good amount of stock specific action in the market. So in case if there is any correction, then also we should look for taking some long bets in the markets with a stop loss at 23,200. So in case market breaks the level of 23,200, then we can expect next level of maybe 22,800. But till then, I am of the view that we are going to see good amount of stock-specific activity in the market.
All right, good amount of stock-specific activity that will continue. Shrikant, I just wanted to ask Mayuresh about Reliance. Mayuresh, typically this is the period where you start seeing the stock move, and this is ahead of the annual general meeting that happens sometime in the middle of June. Do you think it is that, or there's something more that is taking place in Reliance right now?
Afternoon, Mangalam. I think it's a combination of both, in my opinion. I think the markets always get enthused as the AGM date probably comes nearer. But to a certain extent, the expectations in terms of how the refining margins will move is something to be watched out for. Obviously, I think the downstream petchem product pricing, with how the delta spreads have been across product value chains, are obviously, I think, very, very volatile as we speak. But I think there is every bit of hope that as the de-escalation happens, the second half or quarter two onwards, I think numbers should be relatively better, both in terms of oil and gas as well as the refining of the petchem side of the business. When it comes to the retail-oriented businesses, I think that's on a steady state and expected to continue doing well. So I think a combination of all these factors working in favor of Reliance.
Okay, thank you so much, Mayuresh. But gentlemen, do stay on. Remember, the shares of Zidus Life hit a 52-week high after beating street estimates in Q4. The board also announced a 1,100 crore rupee buyback. Ekta joins in with the report card.
Well, yes, Zidus Life was in focus on the back of positive management commentary coming in from the company in their conference call. So, for example, a couple of key takeaways. The management has guided for US revenue base of over $300 million per quarter with single-digit FY27 growth. Key US growth drivers include cancer drugs such as Rolvedon generic as well as Copaxone generic. US revenues are estimated, in fact, to be at around $1.3 to $1.4 billion. India is expected to grow, aided by oncology as well as the GLP-1 or weight loss drug portfolio. International business overall is guided to grow around 40 to 45% in FY27. Specialty is expected to be a key focus for them going forward. So the company has said that they do have some launches in the US as well as a launch in China. Now the portfolio mix is improving and they're expecting higher contribution from other segments such as biosimilars, specialty, as well as their medtech and CDMO space. Now a couple of brokerages have written on Zidus Life. Jefferies has a buy call target price of 1,200 rupees. According to them, Q4 performance beat estimates across segments. New launches are expected to drive growth. FY28 EPS estimates are raised by 14%. JP Morgan, neutral call, target price 1,050. FY27 revenue growth guidance remains strong. Margin expected above 24%. Pipeline visibility remains healthy as well.
All right, thanks a lot for that. So that's about Zidus Life. Mayuresh, do you like Zidus Life?
Strong numbers, Mangalam. And again, I think if you probably look at how the management has probably put forth the pipeline itself, the kind of FTFs that are expected to come through, they've got around 9 approvals in the quarter gone by, 26 approvals for the entire annualized year last year. And they've got a very decent pipeline going forward as well. Now, the India business, along with margins expected to continue doing well, North America in a similar fashion should probably continue, as I said, in terms of new launches expected to do well. And the wellness part, the Zidus Wellness component, which is on 20%, I think that is showing significant signs of relative strength as we speak in the areas and the operations that they operate out of. So overall, both standalone and consolidated, I think the numbers should probably hold up. The ratings and rankings look extremely strong as we see it in markets of India. Anybody holding should continue holding Zidus.
Well, thank you so much for that, Mayuresh. Well, Srikanth, let me come across to you. Zidus Life, your view on that, street was divided, especially in terms of Q4 being a peak quarter post-Revlimid, but, the stock's done well, management commentary strong. How are the charts looking on this particular name? And within the pharma pack, where does the preference lie? Will it be the larger cap names or some of the mid-cap names?
So Vivek, while looking at the technical pattern of Zidus Life, one thing is very clear that the stock had started pullback to the recent sell-off that we witnessed in the stock. It was around 1,400 levels. From there all the way it fell to 800. Now it is pulling back to those particular losses. So maybe we can see the levels of 1,250, 1,300 in the near future. That's my view. Technically, the stock is very strong. But if we have to go through with, let's say, a few more stocks from the pharma space, then in that, 2 stocks showing a lot of strength. One is Sun Pharma, which is currently trading around 1880, 1890. There, if we see the technical pattern, then the stock had spent nearly 2 years within the range of 1900, within the range of 1500 and 1900. So on the dismissal of that, we may even see the levels of 2300. So on that particularly, we are bullish. We also like Wokhard Pharma. There also the stock is forming rounding bottom sort of formation. And gradually the stock is again heading for the levels of maybe 1850 or 1875. So I think these 2 stocks showing clear strength, and we should be buyer if there is any correction in the market.
All right, should we buy if there are any corrections in the market? That's on those 2 stocks. But let's look at PI Industries. That too plunged about 8% today after its fourth quarter results turned out to be much worse than what the street had feared. Ria joins in with the details of this one. Ria, what went wrong for the company during this quarter?
Well, yes, it has been a very weak quarter for PI Industries, well below the estimates that the street was working with. Revenue declined by roughly 12%, EBITDA down nearly 26% versus an estimate of a 19% decline. Net profit also tanked by 39% versus estimates of just a 23% decline, and margins also contracted by 400 basis points to just 21.5% in this quarter. The full year performance was also quite weak for the company, with revenue and EBITDA declining in line with the estimates that the street was working with, but the net profit that tanked around 27% compared to the previous year. Margins also contracted by around 200 basis points to 25%, but this is in line with the guidance that the company had given, and they have said that a favorable product mix this time around has somewhat supported margins for them. In terms of the specific segments that the company operates in, the agrochem export segment declined by 19% on a year-on-year basis, with the volumes declining by roughly 14% due to a high base effect and also due to the contraction of the global agrochem industry as a whole. Domestic revenue also declined declined by 7% compared to the previous year, with the volumes declining by around 1% on this front. The pharma segment did perform quite well, going up by around 40% compared to the previous year. And remember, this contributes roughly around 6% to the export revenue of the company. But overall, it has been a weak quarter and a weak year for the company, which is why the stock has tanked roughly 8% in today's trading session.
Well, thank you so much, Ria, for joining us and giving us a complete perspective of what dragged the share price of PI Industries lower in the session. Mayuresh, let me come across to you first. It's been a company, that's had dependence on a single product from a single customer for quite some time, and that's clearly played out in the last couple of years. There has been some diversification. What's your view on PI Industries? And within the agrochem space, where does your preference lie?
Afternoon, Vivek. No, I think you're absolutely right. And that is where I think the risk component comes from, where either the client concentration is high or the expectations in terms of depending on a very few supply chains might actually impact your operating performance as well. And therefore, I think the kind of numbers that are probably put out were put out by PI Industries below par. Q1 might be equally tough with the West Asian crisis going on, what probably happens with a lot of the supply chains, and therefore what kind of margins are we probably expected to see. So I think it might remain a little bit subpar as we speak. For a lot of agrochem players in general, I think our own sense is that it's a wait and watch approach. Obviously, I think a couple of names that we are keeping on our radar, Sharda Cropchem, where I think the entire business is more forward integrated rather than backward, specifically when it comes to its European operations, is one stock that we are probably monitoring as we speak. And obviously, I think the expectations largely is that the approvals that probably come through and the input cost, how does that probably lay out in terms of either repricing or taking a hit on your numbers itself. So wait and watch, but something like a Sharda is something we're monitoring very, very closely.
All right, we take that point. Thanks a lot for that. Let's talk about Z. Those shares were lower in today's trading session as well. After the company's ad revenue was impacted by its West Asia crisis, the turnaround of its OTT platform continued for the second straight quarter. But the company did report an EBITDA loss and the net loss as well. Devyani joins in with more details.
Zee Entertainment has seen a sharp sell-off in trade today, and that's primarily on the back of a weak set of results that were reported by the company during their board meeting yesterday. Now, ad revenue dropped 4% year-on-year due to March softness on the back of the West Asia crisis, while subscription revenue, that was up 4%. Now, ZEE5 has seen a second straight quarter of EBITDA profitability with revenue up 71% year-on-year. Now, other sales dropped 47% due to the weak movie business of the company, and as a result, revenue was down 7% on an overall basis on a year-on-year perspective. Now, the company also reported an EBITDA loss of roughly around 270 crores. Now, that was largely as a result of a change in the amortization pattern for movie rights inventory, which led to an accelerated amortization of roughly around 408 crores that was charged to the profit and loss this time around. But adjusted for that accelerated amortization as well, EBITDA would have come in at 140 crores, down sharply by roughly around 51% on a year-on-year perspective, with elevated ad and publicity expenses hurting profitability this time around. And the company, as a result, also reported a net loss of 102 crores versus a profit of 188 crores that was reported in Q4 of FY25. All in all, a weak set of results, and the stock is clearly taking a beating for it.
Well, thank you so much, Devyani, for joining us and giving us a comprehensive reason as to what dragged Zee Entertainment lower in the session today. Srikanth, how do the charts of Zee look? Of course, the stock has seen a significant correction from the peak that it enjoyed a couple of years back. Now, within the media space, within the channel space, some of the listed names like Zee, Sun TV, where does your preference lie?
Yeah, absolutely. I think the way the stock has fallen and it has formed a series of lower top, lower bottom, one thing is very clear that till the stock is not crossing the level of 100, we are going to see range-bound sort of activity. See, like already the stock has seen its worst when the stock was around 68, 70 sort of levels. So I am of the view that worst is over, but for the time being, stock is like going to remain in the range. That's my view. And on the dismissal of 100, we can expect trending activity. Till then, close to 80, 78 sort of levels, we should be buyer in the company. We can get some trading moves in the near future.
All right, we can get some trading moves in the near future. Mayuresh, just before I let you go, Carousel India, that was another stock which is up 11% today. Good performance coming in. The management's been guiding for improved performance from their quads division, and they've increased the capex out there as well. Do you track the stock?
Absolutely. I think they were expanding their capacities. And therefore, I think I did not have a chance to look at the numbers, but the 9-month performance was very encouraging for Carousel. The expanded capacities, no doubt, are probably going to not just bring in volumes, but better efficiencies as far as the PLN is concerned, but still need to take into the granular details of the quarter gone by.
Well, thank you so much, Mayuresh, as well as Srikanth, for joining us, giving us your view on the markets, individual trading stocks, as well as sectors that we've been tracking quite closely. But with that, it's time for a short break. We'll get you the top corporate voices, along with the key market events to watch out for on the other side.
You're watching us here on Markets Forward, a day where we saw sharp recovery from the lows, but we had a lot of corporate voices who joined us on the channel today as well. Let's start with RITES, where the CMD told us that the company is seeing a limited impact from the West Asia crisis. They guided for a double-digit top-line growth in FY27, total order book expected to cross the 10,000 crore mark this fiscal.
But BLS International Services is seeing short-term impact on its business due to geopolitical tensions. The company's management said, while core demand trends remain strong, margins in the visa business are guided to grow at 20 to 25% over the next few years.
And we also had the makers of Glucon-D, which said that unseasonal weather, this is Zidus Wellness that we're talking about, unseasonal weather patterns impacted demand at the start of FY27. The company reiterated its focus on delivering double-digit revenue CAGR going forward ex seasonality, and they are remaining confident of sustaining their strong growth for the Comfort Click business that they acquired on a constant currency basis as well.
And before we wrap on this edition of Markets Forward, we bring you some key market events to watch out for. Ria is standing by the wall with all the key events to focus on tomorrow's trading session.
Well, yes, first up in terms of economic data, we have the GDP numbers coming out from the UK as well as the PMI data coming out from the Eurozone. And in the US, we will be watching for the initial jobless claims as well as the minutes of the FOMC meeting. Back home in India, the earnings season continues. We have LIC, ITC, GAIL, Aurobindo Pharma, Nykaa, Page Industries, MTNL, Ashoka Buildcon, Honasa Consumer as well as LG Electronics among that list. And in other events, PM Modi is also likely to chair a full Council of Ministers meeting on the 21st of May.
All right, Ria, thanks a lot for that. So those are a bunch of events that we need to track for in tomorrow's trading session. With that, Vivek and I take your leave on this edition of Markets Forward.
Thank you so much for watching. See you tomorrow at the same time.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the rupee hits a record low of 96.96 against the dollar. Dealers say the RBI's dollar selling alleviated some pressure. The Nifty and the Sensex end mildly higher after a sharp recovery. Top economists warn of a deeper external imbalance building up and the balance of payments deficit widening to $65 billion. Also warn the rupee could decline further. The United States and Iran trade threats as the fragile ceasefire drags on without concrete assurances from either side. Trump claims Iran is tired and begging for a deal. Tehran says a return to war will feature many more surprises and could expand the conflict beyond the region. Russia's President Vladimir Putin and China's Xi Jinping hold talks in Beijing, hit out against unilateral bullying and call for a more multipolar world. Also reach an understanding on a pipeline that would carry 50 billion cubic meters of gas annually from Russia's Siberia to China via Mongolia. Prime Minister Modi in Italy for the last leg of his five-nation diplomatic tour holds bilateral talks with Giorgia Meloni. Trade, defense, the blue economy and the much-touted India, Middle East, Europe economic corridor top the agenda. U.S. Secretary of State Marco Rubio to visit India at the end of the month is scheduled to take part in a meeting of foreign ministers of the Quad countries. Washington says the secretary will also discuss energy security, trade and defense cooperation in his meetings with senior Indian officials. The U.S. Justice Department bars audits or tax claims related to Donald Trump, his family and his businesses for past filings. This comes a day after Trump agrees to settle his lawsuit against the Internal Revenue Service over the leak of his tax information to media outlets between 2018 and 2020. Over 47,000 Samsung electronic workers in South Korea may go on protest from tomorrow after wage negotiations between the company and the union break. Shares of the South Korean chip giant down by 3%. Google wraps up its annual developer conference, unveils its biggest search overhaul in 25 years. A 24/7 personal AI agent called Gemini Spark and smart glasses built with Samsung send a signal that Gemini is now the infrastructure layer underneath every Google product.
Prime Minister Modi brought us a gift, a very, very good toffee.
A video shared by Italian Prime Minister Giorgia Meloni thanking Prime Minister Modi for gifting her a pack of Melody chocolates has sent social media into a frenzy. Prime Minister Modi shares pictures from dinner with his Italian counterpart, triggering the much-celebrated Melody memes. Arsenal become the champions of the English football after a 22-year wait. Fans in North London erupt in celebration after rival Manchester City was held to a draw. The club's manager, Michael Arteta, is the second youngest coach to win the English Premier League. Well, let's start with the day's market action. The Sensex and the Nifty ending the day higher, recovering over 1% from their previous lows. The Nifty ending above 23,650, 117 points higher on the Sensex, 153 points higher on the Nifty Bank, and the Nifty Mid-Cap Index was higher by about 0.5%. Reliance, Hindalco, Axis Bank led the rally today. The Nifty Bank gained over 150 points, and Prashant is here now to wrap up the day's market action for us. Coming off their intraday lows, closing in the green. Prashant, sum up the market mood.
Well, it was an okay session, off the lows by quite a bit. And that's the thing. Today, the Nifty moved. The Nifty has been moving up and down over the last many sessions, but the direction of the currency has been one way. It looked something similar when we started. The rupee hit almost 97. But from, just a few paisa short of being at 97, we saw a sharp pullback. Maybe the RBI sold dollars, or maybe the market just assessed that perhaps too much has happened very, very quickly. But the rupee market pulled back, and consequently you had the equity market which responded favorably as well. So we end small, about 30-40 odd points higher, but off the lows by quite a bit. The Nifty the mid-cap and small-cap indices will come up on your screen. Here there was about a 0.5% gain on the mid-cap index. The small-cap index was more flat, about 0.1%, so barely up. The Nifty Bank Index was up about 1/3% as well. In line with what not in line, maybe a little better to what the large cap Nifty did. So just stocks to take it forward. Hindalco was the big gainer, 3.6 higher. Of course, responding to numbers, Reliance went up to 3%. So it's been completely out of the picture for a while. Bajaj was up 2.5%. There was Grasim and Bajaj Finserv, which were some of the other smaller Nifty gainers. BEL was down 2%. That was the number one Nifty loser. TechM and Eternal were some of the others which, lost ground. Now,
Prashant, many thanks. Let's talk about the rupee now hitting a record low of 96.96 to the dollar. Dealers say the RBI's dollar selling alleviated some pressure. Lata standing by now with more on the rupee. New low, Lata, but what are traders saying at this point in time?
It is a more of the same market. The rupee has been responding to the crude pressure for some time now. But, you can take pain, every day more pain, and there's more loss. But there comes a time when the pain is simply too unbearable. $110 for the last 3 days, for all of this week, and over $100 continuously from May for this entire month. That has quite clearly resulted in the breaking of spirit in the market. So the distance from 96 to 97 seems to have been covered rather quickly. We hit 96 on May 15th. And now, we reached very close to 97 in early morning trade. And we were among the weaker currencies in Asia, at least. The RBI intervention was not there in the early morning trades, and maybe that's why the rush happened. Thereafter, the Reserve Bank selling dollars alleviated the pressure, but not entirely. We can see the rupee dilly-dallying between 96.80 and 96.90 for a better part of noon trades. So really, the pressure is not going away at all. Some of the dealers say that lack of any further announcements is also kind of disappointing. The small number of rupee bulls who think that, okay, rupee has fallen enough and it's time now to sell dollars. That category of people are getting disappointed that there are no announcements. The media is speculating about capital gains tax, withholding tax, ECB announcements. All kinds of things are being speculated. But since nothing has come, that is adding to their disappointment, is one school of thought. The event happens, the rupee falls, and people are looking for explanations. So all these are coming from the chatter in the market. But the important point is that the rupee is falling a little rapidly. May 15 to May 20th, a fall from 96 to almost 97 is not a very happy thing at all.
Many thanks. In fact, let's stay with that. Leading economists warn that a deeper external imbalance is building up. They also say that the balance of payment deficit could widen to $65 billion, while adding that the rupee will find a new equilibrium. Let's listen in.
I think the government is likely contemplating all instruments, withholding taxes, raising capital, how to raise ECBs. My only submission and advice from the outside would be that if the idea is to raise a large enough quantum of capital to act as a circuit breaker, we should go big, right? So if you want to raise it, raise a significant amount of capital so that you can do two things. You can significantly augment reserves, and then you change the narrative in the FX market because market participants see, oh, India's attracted a very large quantum, and exporter-importer behavior, hopefully, and investor behavior will change.
Whatever we do on the currency, it should be something that's not just for the short term, it's also for the medium term, because this is a problem that has been with us for the last 2-3 years.
It's probably too early for the RBI to start thinking about a rate hike in the June policy itself, because as you rightly mentioned, as of now, RBI is keeping liquidity plentiful. There is no signal for tightening things, and rightfully so, because the headline inflation is still below the RBI's target of 4%. So there's probably no hurry on RBI's part to tighten things up immediately. Given the already existing challenges on the capital account, and now a 2% of GDP current account, our overall BOP forecast for FY27 is now $50 billion, which is a pretty large BOP surplus in the BOP deficit in the Indian context.
The question is, is there a sufficient condition to get through the storm? Because as I mentioned, the original pressure point is not the current account. And so demand compression through fiscal and monetary, I think, needs to be a last resort. The question is it time, if the war continues and the pressures remain, for us to think of capital mobilization? Because what you don't want to do is get stuck in a bit of a vicious spiral where a weaker rupee itself causes exporters to change behavior, importers to change behavior, and more importantly for investors to start considering hedging their stock.
Very big external BOP deficit this year of about $65 billion, sort of never seen this kind of a big deficit, and that's what's really showing up on the currency. And what's not helping over the last couple of days is that there is a bond sell-off globally, and whenever we see that, we saw that in 2022, 2023, it's not great for flows into EMs. In fact, you start seeing outflows from EMs. So you already had this energy shock, now you have a bond sell-off globally, so all of this is coming together, it's not great for the currency.
Well, top economists there on the macros and what the government may choose to do. Russia's President Putin arriving in China last night, where he was received by Chinese Foreign Minister Wang Yi. His visit came a week after President Trump visited Beijing for the first time in nearly a decade. Now, Putin and Xi Jinping held bilateral talks in Beijing, where both leaders have said that they will deepen their comprehensive strategic coordination. Addressing a gathering, the Chinese president said that both nations should act against unilateral bullying and actions that reverse history. Putin added that the driving force behind economic cooperation is their collaboration in the energy sector. In a joint statement, Xi and Putin have called out the military strikes against other countries and the hypocritical use of negotiations as cover for preparing such strikes. Russia and China also signed 20 agreements on trade and technology. The leaders also inked a declaration on a multipolar world order. Also reached an understanding on a pipeline that would carry 50 billion cubic meters of gas annually from Russia's Siberia to China via Mongolia. CNBC's Eunice Yoon is here with more.
4 days after President Trump left Beijing, Russia's President Vladimir Putin showed up here in China for meetings with President Xi Jinping. Even though the two sides announced about 40 agreements and signed 20 today, it looks as though Putin, like President Trump, didn't get what he wanted out of China either. Today, Putin was hoping to finally move forward on a gas pipeline, which is called the Power of Siberia 2. That has been under negotiations for years, but President Putin didn't even mention it during the press conference today with President Xi. Later, a Kremlin official had said that the two reached an understanding of what he described as the main parameters, but this Kremlin official said that the nuance needs to be ironed out on that pipeline. Putin has been pushing for this arrangement in order to sell more energy to China, which of course would be good for his economy, which has been isolated from the West. A lot of analysts have said that the two haven't been able to agree on the price of the gas that comes through that pipeline. Now, that is just another indicator that even though the two countries profess to have close ties, what Russian President Vladimir Putin has said are unprecedented level relationship, that is similar to the U.S., China, at the end of the day, is most concerned about its own political as well as economic interests. Now, the conversation about the Iran war did come up. The state media said that the President Xi said a comprehensive ceasefire is imperative. Restarting war is even more unacceptable, and adhering to negotiations is particularly important. The two leaders, though, Morgan, still diverge on the issue of the Iran war. For the Chinese side, they are looking to have the Strait of Hormuz open because they get a lot of their energy from there. But for the Russians, they actually benefit with the Strait of Hormuz closed.
Well, Eunice Yoon there reporting from China. President Trump claims the war with Iran will end, and I quote, very quickly because Tehran, he quote, says, is begging for a deal, while also threatening further military action. Addressing a congressional event at the White House, the president said, and I quote, Iran is tired and badly wants to make a deal, end of quote. However, he maintained that although he didn't want to attack again, he may have to. President Trump also claimed that oil prices will fall sharply once the war with Iran is over. This came just hours after U.S. Vice President J.D. Vance said that the country is locked and loaded if Iran does not agree to a nuclear deal. Iran warned that it will expand the war beyond the region if the U.S. chooses to resume military operations. Iran's Foreign Minister Syed Abbas Araghchi has said, and I quote, a return to war will feature many more surprises, end of quote. This after U.S. congressional reports suggest that 42 U.S. aircraft have been either lost or damaged in West Asia since February of 28th. Meanwhile, Washington continues its attempt to exert economic pressure on Iran. U.S. Treasury Secretary Scott Bessent has urged the G7 to help U.S.
in acting against Iran's finances. Addressing a G7 meeting in Paris, Bessent also asked countries in the Gulf and Asia to tackle Iran's shadow banking networks.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down.
We trust that your participation here today reflects a readiness to stand with us in full. That will require, for example, our European partners to join the United States in taking action against Iran by designated financiers and unmasking its shell and front companies, shuttering its bank branches, and dismantling its proxies. It will require those of you from the Middle East and Asia to root out Iran's shadow banking networks and networks of ship transportation obfuscation.
Well, that is Scott Bessent. U.S. Secretary of State Marco Rubio will be in India from the 23rd to the 26th of May. This will be his first visit to India since assuming office. In a statement, the U.S. Department of State has said Rubio will discuss energy, security, trade and defense cooperation. In those meetings with senior Indian officials, Rubio is also likely to take part in a meeting of foreign ministers of the Quad countries. However, there has been no official confirmation on that front. We will head into a break, but up next, Prime Minister Modi in Italy for the last leg of his five-nation diplomatic tour holds bilateral talks with Giorgia Meloni. More on that when we return. Prime Minister Modi is in Italy. That is for his last night and the final leg of his five-nation diplomatic tour. The Prime Minister held delegation-level talks with Italian President Sergio Mattarella. During the bilateral meeting, he was accompanied by External Affairs Minister S. Jaishankar, National Security Advisor Ajit Doval and other senior diplomatic officials. Prime Minister Modi and Prime Minister Meloni are also holding more meetings today. The Prime Minister was accorded with the Military Guard of Honor in Rome. The leaders expect to discuss wide-ranging issues, including trade, investments and boosting strategic partnerships. Sanjay Suri joins us from Rome. Sanjay, the Prime Minister in Italy and social media is clearly on fire.
Prime Minister Modi's visit to Italy has been off to a rather sweet start, beginning with a rapid-fire Roman holiday of sorts with none other than Prime Minister Meloni as guide, who took the Indian Prime Minister to the Colosseum, the iconic landmark here in Rome. And the following morning, we had Prime Minister Modi gifting Melody toffee chocolates to the Italian Prime Minister. And Melody, of course, is the word that Meloni coined back in 2024 when the two leaders met at the G7 here in Italy, Meloni and Modi together. So that melody really has been off to another start, and this melody going viral as the last one did. But past the sweet stuff is to serious stuff now. We will have 3 hours of talks between the leaders and officials from both sides. These are going to be substantive talks, and the attempt is to break the impasse over the proposed India-Middle East economic corridor, and also take decisions to step up trade and to take steps together at a lot of international events and where matters raise international concerns, as the Mediterranean, as the Indian Ocean region. And the two leaders to put together an article, and they jointly penned their view of a shared vision in this area. Following which, the Indian Prime Minister will visit the Food and Agriculture Organization here in Rome. That's nothing to do with Italy. That's an international organization. But in the food crisis in the world today, that will be a very crucial part of this visit. India not quite in a severe crisis yet, but certainly it's not too early to take precautions and to see if there can be a safety net below the safety net that the Indian government can provide. So a lot on the agenda, off to a sweet start, and everyone hopes that it will be a visit that comes to a sweet conclusion with sweeter stuff to follow.
Sanjay Suri, many thanks for joining us. Well, as Sanjay was mentioning, Prime Minister Modi and Prime Minister Meloni went for dinner in Rome, proceeded to take a late evening walk to the iconic Colosseum. In a post on social media, Prime Minister Meloni said that both leaders exchanged perspectives on a wide range of subjects, including boosting ties between the two nations. Prime Minister Modi also gifted his Italian counterpart a pack of Melody toffees and what appeared to be a playful nod to the viral hashtag Melody, an expression widely used online for the two leaders. We spoke with the management of Parle Products, the company which manufactures the Melody toffee. As the visuals went viral on social media, they called the Prime Minister's gesture a big moment for the company. That's not all. Shares of Parle Industries, by the way, which has nothing to do with the Melody toffee, an unrelated company altogether, surged sharply in trade, hitting an upper circuit today.
Prime Minister Modi brought us a gift, a very, very good toffee.
This was, I think, really big for us. Grateful to our Prime Minister. I think this is also a nice way of pushing Indian products and probably giving them a global stage.
Take that point, take Indian products and give them on a global stage as well. But just out of curiosity, what is the annual sales of Melody? And every time, the internet buzzes with the Melody hashtag, do you see an impact on sales because of that?
Well, I mean, I'm so inclined to bring in the tagline of Melody khao khud jaan jao. But if you're talking about the sales, yeah, it's one of the top confectionery brands in India today. When you're talking about, confectionery brands available in India, it's one among the top confectionery brands. It's, we don't normally share figures because we are a private limited company. But as I shared, it's one among the top brands, confectionery brands of India today.
And we're given to understand Melody toffees no longer available on quick commerce sites are being sold out altogether on the back of that viral meme. Prime Minister Modi will chair a Council of Ministers meeting when he returns to India. The meeting will be attended by cabinet ministers, ministers of state with independent charge and other ministers of state. The functioning of various ministries, key decisions taken so far and their outcomes are likely to be on the agenda. That's a big one to watch out for tomorrow. In earnings, Ola Electric's net loss is narrowed to 500 crore rupees on an annual basis in Q4. However, it has widened on a sequential basis. Revenue has declined over 56% to 265 crore rupees year on year. The company has said it will continue to sustain service consistency and focus on scaling volumes in FY27. The big global story, Google has wrapped up its annual developer conference as it unveiled its biggest search overhaul in 25 years. Rachna brings us more from Google's conference. Rachna, take us through the latest offerings, but more importantly, what is Google doing to search?
Well, Google I/O 2026 had one clear message, that Gemini is no longer a product, it is the operating system for everything Google does from here on. And that showed up in search, in AI agents, and for the first time on your face. On search, Google's head of search called it the biggest upgrade to the search box in 25 years. It will now accept natural language, images, documents, videos, and open Chrome tabs. Autocomplete is replaced by Gemini AI that shapes your question as you type, anticipating intent rather than predicting words. Behind all this would be information agents, personalized AI working in the background, around the clock, reporting back without you returning to the page. But also, let's not miss out a key detail here. Every agent answer Google serves is one less click to an external website. Now remember, the DOJ has already ruled Google illegally maintained its search monopoly and warned the same playbook cannot repeat in generative AI. Google said nothing about that on stage, so we will have to see how this unfolds. On Gemini, Gemini 3.5 Flash is live now. The company claims that it runs 4 times faster than competing frontier models. Gemini 3.5 Pro arrives next month. Gemini Omni, the new model combining reasoning with creation, is already inside YouTube Shorts, outputting AI-generated videos. The flagship product here, though, is Gemini Spark, a 24/7 AI agent on Google Cloud, executing tasks in the background even after you close your laptop. With workspace integration built in and third-party app support via MCP coming in weeks, it sits inside Google AI Ultra, priced at $100 a month for developers and power users. India pricing not announced. The money behind all this also tells us how serious Google is. $180 to $190 billion in capex this year, 6 times what Google spent in 2022. Then there's hardware. Google and Samsung previewed 2 models of smart glasses designed with Gentle Monster and Warby Parker, with Gemini voice access, real-time translation, navigation, and a built-in camera, launching this fall on both Android and iOS. No price, no India date, but the wearable AI race that Meta started with Ray-Bans just got a serious new entrant with this. So 3 announcements. One through line, that Google is building a world where you don't need to go to Google. Google comes to you, where the regulators, publishers, and users get a say in that world. Based on what we heard at the conference, it is safe to say that Google is not waiting to find out.
All right, Rachna, many thanks for joining us. That's it then on this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with more.
Let's Talk Money.
Hello and welcome to Let's Talk Money. I am your host, Surabhi Upadhyay. Here we are with another theme, and this is a rather interesting one this week. SIFs, Specialized Investment Funds, a product introduced in the Indian market about 6 months ago with the objective of giving retail investors access to more sophisticated investment strategies that up until now were the purview of only the super rich, the HNIs and the ultra HNIs. Now, SIFs are governed by a tight regulatory framework under SEBI's watch, and many AMCs have been launching these products over the last couple of months. So we at Let's Talk Money have been watching this market develop very, very closely, and we thought that given the current market volatility and the fact that we've at least got now 6 months performance track record, it's probably a good time to understand how this SIF landscape is evolving, and it's probably a good time to ask the question, are specialized investment funds actually meeting their objective? Because what was their objective? When they launched, we were told that these are products that will use more sophisticated strategies that can protect the downside in a falling market and actually even provide better risk-adjusted returns when the market is in turmoil. So are they able to meet that and do better than plain vanilla mutual funds? That's the question. We have two experts joining in to give you the SIF 6-monthly report card. Mohit Gang, CEO and co-founder of Moneyfront, who's with me in the studios. And now we have Aditya Agrawal, co-founder of Wealthy.in, joining us all the way from Bengaluru. Gentlemen, good morning. Thanks so much for joining in. So you have your task cut out. You're playing headmaster today, and you have to come out with this SIF report card. So let me start with opening thoughts. I think both of you have been offering SIFs on your individual platform to investors. So let's start by understanding what the response has been. Aditya?
Response has been actually pretty good. We are a platform that distributes through distributors. So I think the first part, I think number of people who have taken up training through the platform to distribute SIF actually has been very encouraging. And that in turn reflects the end, investors' interest. Secondly, I think the pickup from certain categories of clients, especially clients who've been investing for some time, like they have, 7-8 years investing history, in markets, have really understood the product and have tried to invest it in the right way. So we are obviously, because, we didn't have any return sorter here that, sort returns of last 12 months and decide which product. So we have seen very informed pickup by retail investors of SIFs, especially in the hybrid long short category. So I'm actually pretty surprised and, positive on the overall development that we have seen on the SIF side.
Okay, all right. Well, Mohit, with an AUM, total AUM of about, I think, 12,300 odd crores as of now?
13,000 odd crores.
13,000 odd crores.
Yeah,
okay, so it's still early days.
Absolutely.
But what are the kind of investors that you've seen come to you, say, I want an SIF?
Thank you, Surabhi, and always a pleasure being on your show. Look, I think we've always been a kind of an HNI platform. So for us, it was like a cakewalk from day zero. We had a good kickoff from the first product itself. And we have seen good uptick in our set of clients, to be very honest, because I think, the promise of the product was a middle path, somewhere a step-up ladder from what a normal retail or an HNI investor has been doing in their mutual fund portfolio thus far, and a bridge towards a PMS or an advanced vehicle like an AIF kind of a thing, right? With similar kind of strategies, with a limited restriction available now under a SEBI-regulated vehicle. I think it was a free-for-all kind of right from the word go, right? Now the whole thing is, look, in this there are three categories: equity, hybrid and debt. Under equity you have three subcategories, which is a long short, an X top 100 and a sectoral rotation long short.
Three different type of equity SIFs can be created by different asset managers. And so far, I don't think we have products on all three categories. Very few equity SIFs have come in, right?
We have the maximum number of products are on the long short equity. We have around 5 odd, if I'm not wrong. And then we have 2 on the sectoral rotation fund. On the X100, X top 100 fund. And sectoral rotation, if I'm not wrong, we've got 1 now. Right? So that's the uptick. But the third category hasn't taken off. Debt, we have 2 subcategories. There's no product thus far in the debt category.
Debt SIF,
And in hybrid, we have 3 categories. Hybrid is the one category which has taken off big time and has also delivered returns commensurate with their promise. And out there again we have 3 categories, subcategories, and we find the maximum uptick in the hybrid long short category.
So Aditya, let's start with the hybrid category. What have you noticed in the kind of schemes which are on offer, the kind of flows that are going, and what are these schemes really aiming for? Because you have hybrid mutual funds as well. So why look at hybrid SIFs?
So I think hybrid SIF are actually launched with a very clear, I would say, agenda that hybrid-like performance, but lower correlation than equity market. So it was, to an extent, steady absolute returns with lower correlation with equity markets is probably the right way to describe the mission or the objective that most hybrid long-short funds sort of started with. But we see very, kind of a very big dispersion in the overall strategy that each hybrid long-short fund has taken. So, rightly, we've sort of come to now two kind of strategies. One is sort of which is a category which is trying to be somewhere between equity, equity savings plus, or also called as income or arbitrage plus. I think that is one very clear sort of strategy that has worked. In fact, the largest AUM category in this, which is the Edelweiss Altiva hybrid long short, has sort of delivered on that promise as well. That it's a category which will sit somewhere between equity savings plus and a hybrid, but with a lower correlation to equity markets. So I think that strategy was very clearly set out, and that is, thankfully and well done by fund managers that strategy is actually delivered for investors the promise that it sort of set out for.
Okay, Mohit, you want to expand on that? I mean, the Altiva, I just want to mention here that this Altiva hybrid long short, Altiva, so all the SIFs have a separate brand name.
Yes.
And they're launched by different AMCs. So Altiva is the SIF brand for the Edelweiss Mutual Fund House. You have the Magnum brand name, which is for SBI. Then you have iSIF, which is ICICI Prudential, QSIF, which is for Quant. So all these different AMCs have come out with their brand identity for their SIF products. And, some of the hybrid, return performances are on your screen now. So how different or similar are these hybrid SIFs? And how do you rank and rate their performance so far?
The intriguing part, Surabhi, out here is they are chalk and cheese apart. Though they fall under the same category, which is the hybrid long short, the way these are operationalized and the way these are run is extremely different. So let's take Altiva for an example, which is the largest fund currently in the market, right? They have, by definition, everyone can go 25% naked short, right?
Okay.
And then you can have an arbitrage position in the portfolio, which is that you're covering your equity positions and everything. Now, what Altiva and Magnum does differently is that they have around 10 to 15 odd % equity exposure by way of special situations. So they do special situations and they have that 10 to 15% equity exposure out there. They also do covered calls, which most of the hybrid strategies do, roughly around 10 to 20, 25 odd % is covered calls. Then they have some derivative strategies. Again, as I said, you are permitted to go 25% naked short. So technically on your 100 rupee of money, the gross up value of exposure somewhere ranges around 110 to 115. That's the max these can go. And that's also very nuanced difference between what an AIF can do and what a hybrid SIF can do. AIFs can typically go around 200% gross up on the 100 rupee value which you deploy with them. But SIFs can only go up to 110%.
So the amount of leverage they can take is more restricted.
Is more restrictive. But it is much more flexible than what a mutual fund can do. Mutual funds can't go naked short. They can't take, mutual fund can only hedge certain positions and that's about it, right? So that's one part. Now, if you see the other spectrum, which is the Arudha hybrid, which is the Bandhan AMC, they are completely like a arbitrage income fund. Right, so they don't have any equity. The return profile is somewhere arbitrage plus, which is 7 to 8 odd % kind of a return band, which is what the product promises. Again, it can vary in different kind of market scenarios. But Altiva's return promise is somewhere between 9 to 11. Right, so
9 to 11% return.
Yes, because they have equity. They do special situations and they have around 10 to 20% equity, which is open equity.
By the way, has the regulator mandated a cap? How much equity or equity related instruments, whether it's derivatives or it's cash, how much equity can a hybrid SIF have? Or is it open to the fund manager's discretion?
They have to have minimum 25% equity and minimum 25% debt. Right. And they can then also have up to 25% naked shorts, which they want to, if they want to have. But the minimum 25% equity and 25% debt is a compulsion for the hybrid category.
Okay, got it. So like you're saying that the Bandhan product is very different. It's lower on maybe the risk spectrum because they're just trying to be arbitrage plus
quite
return.
low. It's a pure debt product, whereas the Altiva and the Magnum are more like the equity equity products. Let's say if you go to the titanium, which is the Tata product, they also have REITs and InvITs in it along with equity. So it's a pretty different risk profile and a different basket altogether. So there is huge variance between the strategies of all these fund houses.
I can say this already at this.
Italy विश्व में डिजाइन और प्रिसिशन के लिए जाना जाता है. भारत की पहचान स्केल, टैलेंट और एफोर्डेबल इनोवेशन के पावर हाउस की है. इसलिए हम डिजाइन एंड डेवलप इन इंडिया एंड इटली एंड डिलीवर फॉर द वर्ल्ड के सिद्धांत पर आगे बढ़ेंगे. फैशन से लेकर फिनटेक तक, लेदर से लेकर लॉजिस्टिक तक, मोबिलिटी से लेकर मैन्युफैक्चरिंग तक, हर क्षेत्र में हम अपनी ताकतों को जोड़कर पूरी मानवता की भलाई के लिए काम करेंगे. इंडिया ईयू एफटीए के समापन में इटली से मिले सहयोग के लिए मैं प्राइम मिनिस्टर मेलोनी का विशेष रूप से आभार व्यक्त करता हूं. हम मिलकर इसके जल्द से जल्द इम्प्लीमेंटेशन के लिए काम करेंगे, जिससे बिजनेस कम्युनिटीज इसका पूरा लाभ उठा सके. फ्रेंड्स, टेक्नोलॉजी और इनोवेशन हमारी पार्टनरशिप का इंजन है. एआई, क्वांटम, स्पेस और सिविल न्यूक्लियर एनर्जी जैसे क्षेत्रों में हमारे सहयोग की अपार संभावनाएं हैं. दोनों देशों के स्टार्टअप्स, रिसर्च सेंटर्स और उद्योगों को आपस में जोड़ने के लिए हम इंडिया इटली इनोवेशन सेंटर पर काम कर रहे हैं. फ्रेंड्स, रक्षा और सुरक्षा के क्षेत्रों में करीबी सहयोग हमारे गहरे आपसी विश्वास का प्रतीक है. हमारी सेनाओं के साथ साथ दोनों देशों के रक्षा उद्योगों के बीच भी सहयोग बढ़ रहा है. हमारे डिफेंस इंडस्ट्रियल रोडमैप से को डेवलपमेंट और को प्रोडक्शन का मार्ग प्रशस्त हुआ है. मैरीटाइम पावर्स के रूप में भारत और इटली के बीच कनेक्टिविटी के क्षेत्र में करीबी सहयोग स्वाभाविक है. हम मिलकर शिपिंग, पोर्ट्स मॉडर्नाइजेशन, लॉजिस्टिक्स और ब्लू इकोनॉमी पर काम करेंगे. हमने अपनी विन विन साझेदारी को तीसरे देशों तक ले जाने पर भी चर्चा की. इस दिशा में आगे बढ़ते हुए हम अफ्रीका में ठोस प्रोजेक्ट्स पर काम करने के लिए सहमत हुए. फ्रेंड्स, भारत और इटली एकमत है कि आतंकवाद मानवता के लिए गंभीर चुनौती है. टेरर फाइनेंसिंग के खिलाफ हमारी साझा पहल ने पूरे विश्व के सामने एक महत्वपूर्ण उदाहरण प्रस्तुत किया है. भारत और इटली ने यह स्पष्ट संदेश दिया है कि रिस्पॉन्सिबल डेमोक्रेसीज केवल आतंकवाद की निंदा नहीं करती, बल्कि उसके फाइनेंशियल नेटवर्क को तोड़ने के लिए भी ठोस कदम भी उठाती है. यूक्रेन, पश्चिम एशिया तथा अन्य तनावों को लेकर हम लगातार संपर्क में रहे हैं. भारत का मत स्पष्ट है कि सभी समस्याओं का समाधान डायलॉग और डिप्लोमेसी के माध्यम से होना चाहिए. फ्रेंड्स, हमारे ऐतिहासिक, सांस्कृतिक और पीपल टू पीपल संबंधों की झलक दोनों देशों में कदम कदम पर दिखाई देती है. इटली में भारतीय कला, योग, आयुर्वेद और खान-पान के प्रति आकर्षण बढ़ रहा है. संस्कृत और लैटिन जैसी प्राचीन भाषाएं एक ही भाषा परिवार से आती हैं. यह दर्शाता है कि हमारा रिश्ता केवल डिप्लोमेसी का नहीं, साझी धरोहर का है. अगले वर्ष भारत और इटली के संबंधों की 80वीं एनिवर्सरी के उपलक्ष्य में ईयर ऑफ कल्चर मनाया जाएगा। इससे हमारे सांस्कृतिक संबंधों को और ताकत मिलेगी। इटली में बड़ी संख्या में रह रहे भारतीय मूल के लोग हमारे संबंधों की जीवंत कड़ी है। उनकी देखरेख के लिए प्राइम मिनिस्टर मेलोनी और इटली के लोगों का मैं हृदय से धन्यवाद करता हूं। 3 साल पहले किए गए माइग्रेशन एंड मोबिलिटी पार्टनरशिप एग्रीमेंट से दोनों देशों के लोगों के बीच आवाजाही बढ़ी है। हम यह विन विन सहयोग जारी रखेंगे। एक्सेलेंसी, आज की बहुत ही उपयोगी बैठक के लिए और आपकी मित्रता के लिए मैं एक बार फिर आपका हृदय से आभार व्यक्त करता हूं। 140 करोड़ भारतवासियों की ओर से मैं आपको भारत आने का एक बार फिर से निमंत्रण देता हूं। बहुत बहुत धन्यवाद। ग्राजिए मिले।
So as you can see there, Prime Minister Modi's message to the world about the expanding strategic ties between India and Italy, also focusing on the fact that critical technology as well as the expansion of trade to 20 billion euros by 2029 is something that is on point when it comes to the mission of both the nations to expand their strategic edge amid the global headwinds. I'm also joined by my colleague Akanksha Swaroop on the broadcast. So Akanksha, clearly Prime Minister Modi laying down the blueprint for this strategic partnership with these technology-driven nations like Italy, especially the Scandinavian nations as well, because in the 21st century, this will be the significant economic pillar on which a lot of the future economies are based.
Absolutely. It is a special strategic partnership, as has been highlighted both by Prime Minister Modi and by Prime Minister Meloni as well. And there is going to be renewed focus, as you rightly highlighted. The vision is in fact going much beyond just 2026. And defense will be a key pillar to that, as will be AI and technology. And Prime Minister, in fact, both the Prime Ministers are very much aware of these deeply divided geopolitical times, which in fact require partnerships which are based on not just exchanges but also collaborations, something which we can expect, especially in terms of technology, where India and Italy are not just looking towards creating but also in terms of co-production and co-development of technology which will be utilized in defense sector as well, something that Prime Minister has extensively spoken about. Interesting was when Prime Minister spoke about how anything made in Italy is also known for its make, and that is why Prime Minister is looking towards getting in greater investment from Italy to India, but perhaps also in that exchange bring in Indian investment to Italy as well. As we all know that you have greater number of Italian companies in India when you compare the number to the number of Indian companies operating out of Italy. There are some, but you have over 800. So on an average, we've been given a figure of 1,000 companies across India and Italy operating, but India is looking towards, in fact, increasing its overall trade footprint as well. Maritime security will remain one key concern. We can expect the naval exercises also to increase, but it would be interesting to see Prime Minister's visit to the Food and Agricultural Organization at a time when West Asia crisis has in fact triggered and global energy crisis. Supply chains across the world have been completely disturbed. We are looking towards forging newer partnerships where fertilizers and the importance of food security kicks in and plays a tremendous role.
Right. Akanksha and Sanjay, thank you for decoding that for us. We will continue to track all those developments coming in. For now, quick break. More news and updates on the other side.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, the United States and Iran are trading threats as their fragile truce holds without any concrete assurances from the either side. Here are the latest developments. President Trump has claimed that the Iran war could end quickly because Tehran is tired and is begging for a deal. He also warned of a big hit if Tehran refuses the significant concessions that he's demanding before any peace agreement is reached. Vice President J.D. Vance has reinforced that position, drawing a clear red line saying that Washington is willing to cut a deal, but only if Iran permanently abandons its nuclear weapons ambitions. Vance added that the U.S. remains locked and loaded to restart its military campaign, though he acknowledged that neither side would want that. Tehran, however, is pushing back hard. Iranian Foreign Minister Sayyid Abbas Araghchi has warned that Iran has gained military knowledge from previous hostilities and that any return to war would feature, in his words, many more surprises. Iran's army also threatened to open new fronts against the U.S. using new equipment and tactics. The Islamic Revolutionary Guard Corps went further, warning that renewed strikes could expand the conflict well beyond this region. Meanwhile, Iranian media reports suggest that Pakistan's Interior Minister Mohsin Naqvi is heading to Tehran for talks as Islamabad leads mediation efforts between Washington and Tehran. This will be his second trip to Iran in just a week for Naqvi.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down.
Well, joining us now to help us discuss this, understand this further, is with us former Ambassador Rajiv Dogra. Also with us is Professor Madhav Nalapat, a geopolitical expert. I'd like to welcome both of our guests for joining us. Ambassador Dogra, coming to you first. Tell us, before we dive into this Washington-Tehran back and forth that we have been seeing for a better part of almost the last 2.5 months, let me bring in the dynamic of the Putin-Xi meeting that's happening as we speak in China. Great deal of proximity, warmth between the two leaders. There were comments made to the effect that one day away is like an autumn away from you. That's the kind of language that we're seeing between the two sides. A red carpet welcome being done for Russia. Both the countries, again, very close in their relations with Tehran. Let's also not forget that in the recent Trump-Xi meeting, there were no major takeaways in terms of China agreeing to apply any additional pressure. What message will that send to Washington as it's trying to rally together some form of resolution framework with Iran?
Well, as far as Putin-Xi meeting is concerned and its warmth, as you say, that's not a surprise. And in fact, America should be thanked for it, because once upon a time, especially when Nixon made his famous visit to China, the intention was that China should be developed as a counterpoise to Soviet Union. Now China has developed. Soviet Union is no longer in its original form. Russia is the weaker partner. So America's ambitions and its strategy of 70s would have been fulfilled by now. But America has done one more wrong turn and now pushed Russia into China's arms. And it all started with Ukraine. Now comes the next part of what you mentioned, Iran. Iran is a godsend opportunity to both Russia and China, because what Ukraine was doing to Russia and to the delight of NATO and USA in particular, Russia and China have now got a chance to get even via Iran. And I would not be surprised if this relationship between Iran, China and Russia keeps on developing to a maturity in times to come.
Sure. Ambassador Dogra, let's bring the focus to Washington now. Even as Trump has issued multiple threats, ultimatums to to Iran, to Tehran, to come to the table to do some kind of negotiations. Let's also not forget that in the last 24 hours, we've seen a vote, a resolution being adopted by the Senate by a 50 to 47 majority, which features 4 Republicans. If not for those 4 Republicans, probably it wouldn't have swung against Donald Trump, but it has now in terms of limiting his powers, especially with respect to these war efforts. Leave Tehran aside, how much pressure is there on Donald Trump to bring this to a swift end?
Well, there's a lot of pressure on Donald Trump. I mean, for example, his boast that Saudi and Qatari leaders told him not to sort of attack Iran is not correct. In fact, Saudi and Qatari leaders are likely to have told them that do not use our bases to attack Iran, because once this war ends, Iran is not going to forget that rule. It already is bitter about it. So they do not want their energy facilities to be knocked out for years to come. As far as the Senate vote is concerned, that is very significant because this was the 7th or 8th attempt at restricting Trump's options. And finally, they've succeeded. But whether Trump is able to find yet another way out remains to be seen. But for the moment, it seems that Trump is in a bind. Iran is not going to bend, and Trump has very little options. He has no allies at all, unless Venezuela steps in. And I'm saying that ironically. Europe,
Right. Ambassador Dogra, we'll come back to you. We have you on a patchy line. We'll come back to you. We have you on a patchy line. Your audio is not very clear. Let me also go across to Professor Nalapat. Professor, on the same question, as Ambassador Dogra was pointing out, there were 7 failed attempts. And then on the 8th attempt, the Senate has managed to limit Donald Trump's war powers. And that would not have been possible without the participation, without the vote of these 4 Republican dissenters. Tell us, how significant is that and how much pressure will that apply on his shoulders in terms of bringing this to a quick end?
Well, I'd like to say that, in victory lies defeat. Now, Trump has succeeded, frankly, in creating a civil war within the Republican Party. And he has basically gone and fought against all those who are not completely loyal to him, that who don't do his bidding. So in the primaries, it can work. No doubt about it. You can defeat good candidates by bad candidates. But once you go into the election in November, then people are going to reject these candidates, and you're going to have the Democrats in control of the Senate and the House. So very honestly, Trump has made a big mistake. Instead of unifying the party, he has divided it and caused what many party people have openly said is a civil war in the Republican Party. Honestly, Donald Trump is very weak politically. As far as Iran is concerned, the Americans are not bothered about Iran. Many of them cannot locate it on a map, but they are bothered about rising gasoline prices. They are bothered about rising inflation in general. And as a consequence, Trump is taking the hit. And Trump saying that, I don't care about price rise. That's so unfeeling. Trump saying that they're going to plummet once the war ends. When is the war going to end? What is the end game? He is not clear about that. When it will end and what is this end? So I'd like to just say one thing about Iran, and that is that Trump made a mistake of believing that Iran is like another Venezuela. In Venezuela, you remember, he carried out a decapitation strike. He managed with the help of the security detail around Maduro to kidnap him and oddly enough his wife. At least I hope that he shows the mercy of Maduro and his wife being in the same cell. Now, once that decapitation took place, then the Venezuelan opposition to the U.S. fell like a pack of cards. Now, Trump thought that he had decapitated Iran by finishing off the supreme leader, Ali Khamenei. But the IRGC is not like the armed force of Venezuela. Venezuela and Iran are totally different. As far as Iran is concerned, to my reckoning, about 20% are hardcore supporters of the IRGC. about 40%
Right.
are hardcore opposed, but they do not have the courage to come out in the open because the IRGC takes such punitive measures against them. And you know what the philosophy of the IRGC is? The philosophy is we are going to ensure that our brand of theology prevails across the whole world, including the Muslim world. And as Ambassador Dogra correctly said, that's not what is palatable to Saudi Arabia or UAE or Bahrain or even Qatar. Not at all. They don't want that kind of extreme theology. Theology which denies the Jews the right to exist. Theology which calls America a figure of a country that should be destroyed. So the fact of the situation is that, remember, the IRGC philosophy is very, very clear. If you fight and die fighting the enemy, you go straight to Jannah, an eternity in Jannat. On the other hand, if you are cowardly and you do not fight your enemy relentlessly with all that you have got, you go straight to Jahannam, hell.
Right. I just have to come in there, Professor. Like you're saying that this will be a tough nut to crack as far as Washington is concerned. Coming back to you, Ambassador Dogra, before we lost you on a patchy line, I also want to get your thoughts on Israel. As far as Israel is concerned, the lawmakers there have voted nearly unanimously for dissolving the Knesset, which in a way paves the way for snap elections to take place. I want to get your thoughts. In these final days of the Netanyahu regime, will it lead to perhaps a more aggressive posture, a greater likelihood of some form of retaliation coming in from Israel towards Iran, towards Lebanon?
Well, that should be Netanyahu's natural instinct because he's an aggressive politician who has all through believed that by distracting, by putting up a ghost, he is likely to get public's favor. But this time, I think he's gone one too far. Even the Gaza operation has not won him many loyalists within Israel, not to talk of the world. And this operation, 1 month long operation against Iraq, has not gone well. And Israelis have seen for themselves the number of missiles and number of attacks that Iran mounted on Israel in Israeli territory, which was a new experience for them. So Netanyahu is on a shaky ground. And in fact, it's interesting that he's not been seen in public, at least international media, for some days now, which is very uncharacteristic. Please remember when J.D. Vance was in Pakistan negotiating with Iranians, Netanyahu boasted that he reports to me. And in fact, the entire US leadership reports to me. Those kind of statements have not come out in the last few days. But Netanyahu being Netanyahu, engineer something which could lead to a reception of war all over again.
Right, Ambassador. Again, seems like we are facing some difficulties in getting through to you. Let's go across to Professor Nalaptal. Professor, let me get your thoughts on this warning coming in. You were talking about how tough a nut it will be in terms of Washington to crack Tehran. The IRGC are very hardened military personnel. What I want to ask is this threat that's coming in from the IRGC, that any attack from US or Israel will lead to this conflict expanding beyond the West Asia. What does that mean? What are these additional targets that Iran could potentially target in a retaliation to an attack by US or Israel?
Well, I'll give you an example. US bases in Europe. There's no question about that. And Iran has already made it clear, the IRGC has already made it clear that any US base anywhere in the world is a legitimate target of war. It is now engaged in a war. The IRGC is very clear, this is a war. And very frankly, they're not going to accept these so-called peace terms in giving up their nuclear weapons. They've seen what happened to, Muammar Gaddafi, who gave up his WMD. They've seen what happened to Saddam Hussein, who gave up his nuclear ambitions and his WMD. They've seen the way. They were brutally, captured, executed. So they're taking the example of North Korea. North Korea has now formally dissociated itself from South Korea. They have said we are a separate country We do not have any intention of reuniting the two Koreas. We are going to do everything on our own. And Kim also made a very, very important point, what is called the Supreme Commander, or whatever is called, the Supreme Commander. He made a point, which is that and now it is very clear to the whole world that he made the right decision in sticking to the nuclear and missile program. And that's absolutely right. If North Korea did not have nukes that could strike Japan, that could strike Guam, that could strike, U.S. bases in the in the North Pacific at least, possibly parts of South Pacific, then they would have been attacked by now. So, Iran is getting the right lesson. The right lesson is build a bomb. And I can tell you one warning sign. Unlike the two previous predecessors of his, Supreme Leader Mojtaba Khamenei is completely silent about nuclear weapons being haram. Both his father as well as Ayatollah Khomeini said nuclear weapons are haram. We do not want them. The new Supreme Leader is completely silent on that. And in my view, he is going to go full steam ahead on the nuclear program, overt and overt. And may I remind you again that all international atomic energy inspectors have been removed from all nuclear sites in Iran. So there is absolutely no way of finding out what the Iranians are doing. And as the ambassador very eloquently said, Iran, the IRGC, a very tough nut to crack. But having gone this far,
Professor,
obviously, you have to crack it for simple reason that now Iran is now provoked. And Iran will plan revenge and retribution. So now there is no going back. Trump has gone so far for an end game. I think Netanyahu has also gone very far without realizing that the U.S. support is so fickle. I'm told that the U.S. is now not as generous with its weapons supply to Israel, not as generous with its intelligence input to Israel as it was in the past. Probably a gesture to Iran or whatever. So the fact is that we are in a very bad situation, and that bad situation is because...
Well, Donald Trump, even more so, finds himself in a tough spot. He's given Tehran just a couple of days, has said 2-3 days is all that Tehran has to crack a deal. Whether this latest deadline will pan out, whether it will yield any results, well, many questions. I'd like to thank Ambassador Dogra, Professor Nilaptal for joining us for their valuable insight. And with that, it's time now for a short break. But coming up next, we speak with Sudhin Mathur, the CEO of Xiaomi India, on Xiaomi's diversification strategy and plans to go global with its EV by 2027. Stay tuned. Now, Xiaomi has remained one of India's most influential smartphone and consumer technology brands, navigating everything from intense competition and premiumization trends to evolving regulatory scrutiny and supply chain shifts. Now, as AI begins reshaping the consumer electronics ecosystem, the company is also looking beyond smartphones into connected devices, smart living, and ecosystem play. Now, joining us now to help us understand what this road ahead looks like is with us Mr. Sudhin Mathur, the Chief Operating Officer of Xiaomi India, to talk to us, to tell us more about the Xiaomi India story. Mr. Mathur, thank you so much for joining us.
Thank you so much for having me on the show.
And thank you for driving all the way down to our Noida studio. Greatly obliged for that. But let's begin by talking about the Xiaomi India story. We were chatting just a few moments back. You began by saying that Xiaomi just doesn't want to be known as only a smartphone company. It wants to be known as a lifestyle, as an ecosystem company. Tell us more about that. Tell us more about that conversation.
Yeah. So maybe step back a bit since the start and journey of our organization. And Xiaomi started its journey about 16 years back. In India, about 11 years back, we are still a very young company. And the journey started with smartphone. Right. And in smartphone, we rapidly grew and created an impact in the market, and especially so in India as well. Today, globally, we are among the top 3 brands in the smartphone industry. In India as well, we have grown to tremendous pace and among the top 3 brands as well in the country. Globally, we have more than 750 million active users today. And in India, also about 130 million users in smartphone alone. So the smartphone journey has done very well for us. As an organization, we have democratized 4G and 5G as the journey played out for us in India. However, we now look at our consumers at large and see that their whole expectation from their devices are changing. They are looking at connected devices. They want their phone to connect with their household appliances and things like that. And looking at these shifting trends at a global level, we pivoted to a strategy, what we call as a human times car times home. Which essentially means, human essentially means that the devices that you use, smartphone, tablets, PCs, car, and interestingly the EV, which is we'll talk about as well, and the home, which is the home ecosystem, which is the small and large appliances and AIoT, and all connected through an ecosystem or a software which we call as an hyper OS. And I think that's where we have pivoted our strategy, and we believe that Xiaomi is no longer just a smartphone company, but a complete ecosystem company in changing the lives of our consumers.
Speaking of the approach that you followed, which is human times car times home, here's the car, the YU7. We were talking about how you've driven that, this one particularly some time back. Will the Indian consumer get to drive it anytime soon? Are you bringing out here to the Indian market, or maybe just for doing a mood check on the appetite here in the India market?
Yeah. So let me talk about why we are into car and actually and why is it so important as part of our strategy as well. Cars is not just about an EV vehicle for us, but it's also part of the whole mobility and connected devices ecosystem that we want to create. This is not just a car, but it's a smart car. Which essentially means it can connect to your devices, it can do a lot of sense you're driving, the way you drive and speed and things like that, and is an intelligent car as well. So it's differentiated from that point of view. The success, and I'll come to your interesting query about being in India. Right now, we launched our EV, first EV in, I think, April of 24. It's now about 22, 23 months since we launched, and we've had great success in China. The strategy was to test this category first at our home country, which is China. And in the last 22 months, we have sold more than 600,000 EVs in China alone. And this year, we plan to sell more than 550,000 cars. 2027 is when we foray into the international market. The first market we will test is going to be the European market and test this outside. Of course, we are a global company. All our global products should go into different markets based on the market readiness as such. Along with India, there are many other markets we keep evaluating and seeing the readiness of the market, the maturity of the market, and also the product fitment as well. So I wouldn't be able to say when it will be here, but India always remains as a key market for us.
Let me labor on this a little further, just because of how glamorous a proposition this looks. I mean, the YU7 we were just discussing before this interview, the specs are quite impressive. on its highest variant, the power output goes up to almost 700 horsepower. For perspective, most compact SUVs here in the India market give you a power delivery somewhere in the range of 100 to 150 horsepower. This talks about 700 horsepower, 0 to 100 kilometers in just under 2 seconds. Do you think the India car market, mobility market is maturing for there to be an appetite for such performance vehicles here in India?
No, of course, the EV market is definitely growing, and more from a energy point of view. There are a lot of now consumers who are preferring to look at EV rather than the traditional models. But I think there's still some time to go. There is a lot of maturity which the market has to mature as well. The whole charging ecosystems and things like that. So there's much more than just launching a product in the country. And I think we will always keenly evaluate, like I said, the Indian market, because it's an important market for us. But I don't have a timeline to say at this point in time.
Given that you do cater to the large volume market as well, and therefore one expects that the margins are slightly tighter, is that a bigger challenge? Is that a concern when you look at these high memory costs in terms of passing it on to the end consumer?
Yeah. So first, it is a fact. Yes, the memory prices are going up and will continue because of this whole AI revolution that is happening. So the RAM costs are going up in the industry, which is impacting the pricing of the product. And there is a point till which you can absorb a certain cost, beyond which you need to keep on increasing as such. And we have, along with our industry folks, have been doing that as well. However, Xiaomi price increases have been still relatively far more competitive, if I can say that. Largely driven by scale, of course, the other by our core philosophy of giving honest prices to our consumers. And I think that stays with us in our DNA. So yes, the market will see price increases, but from Xiaomi's table, you would still see us far more competitive.
Speaking of the India story, one thing that really sparked this conversation about mobile phones and manufacturing here locally was the PLI. That PLI has completed. There is now a lot of conversation of what happens next. Is there a need for a PLI 2.0? So again, as an industry leader, you've been around for more than 30 years now. From an industry perspective, from a Xiaomi perspective, tell us, is the industry mature to be able to stand on its own 2 feet, or is there need for continued support from the government?
No, first of all, PLI 1 was extremely good initiative of the government to set up a local manufacturing footprint. And I know for sure that it has enhanced the local manufacturing footprint a lot with the help of PLI 1.0, and of course looking at the exports as well, which has gone up. The PLI 1.0 is now ended in March. There are conversations. We also believe from an industry standpoint that it would be good for the industry if there is a PLI 2.0 comes. But in what form and manner, it is a little too early because those conversations have to start. I think maybe more involvement of the brands this time would be a welcome change as well if that comes through. But continue on this part, localization would be one of the key areas to look at as well when we look at PLI 2.0.
Hello and welcome to another episode of the Global Reset with me, Prashant Nair. Now, India's most visible macro pressure point right now has been the rupee, a topic we've discussed quite a few times in the recent past, actually over the last many months now, here on this very program. The rupee earlier today hit almost 97 levels. It's been a fast depreciation through various big handles in short order. But a new JP Morgan report argues that the currency is really only the symptom. The deeper issue is the progressive drying up of capital flows into the country, led by a sharp slowdown in FDI, even as the current account has so far remained relatively benign. To discuss this, I'm very pleased to welcome Sajid Chinoy, Chief India Economist at JP Morgan and one of the authors of this report. Sajid, a very warm welcome to you on the program. It's great that you could join us today. Well, I'm going to come to Sajid. I'm going to go across to Sajid in just a bit, but I want to quickly take our viewers through the main highlights of the report which Sajid and his colleagues have put together. Well, the report says the rupee's weakness is the market's signal investors are seeing most clearly. The currency move is not the original problem. It is the symptom of a deeper balance of payments pressure. This is, they argue, is not yet a classic current account scare because this CAD, that is a current account deficit, has stayed unusually benign. The pressure, they say, is coming instead from the other side of the ledger, the capital account. Now, the report says that India used to rely on capital flows of around 2.6% of GDP before the pandemic, the COVID-19 pandemic. That cushion, the report says, has now thinned dramatically. And in 2025, the report says capital flows essentially dried up. The heart of the problem, JP Morgan says, is FDI, that is foreign direct investment, which has fallen to near zero levels as a share of GDP. Importantly, they say this is not just about profit repatriation. Gross inflows have slowed, while outflows have also gone up. The report draws a strong link between India's FDI cycle and US 10-year Treasury yields. By the way, as we talk about this, yields globally, including in the US, have made a sharp up move. JP Morgan says when global money was cheap, FDI surged. When US yields rose, capital began to retreat. The report's key distinction is between domestic, what they call pull factors, and global push factors. They say that India had strong pull factors during the 2005 to 2010 capex cycle, but since then, flows have become far more dependent on global liquidity, and hence, that relationship between financial conditions in the West become important. Vietnam, they say, is the comparison that matters because its FDI has stayed high and stable despite the global rate cycle. JP Morgan argues that China +1 and export growth gave Vietnam the pull factors India has so far lacked. They say the rupee can absorb part of the shock, but it cannot be the only instrument. The report argues that India may need a mix of depreciation, reserve intervention, capital flow incentives, and current account compression. That is essentially the package which is required, as they put it, as they call it, for the firefighting which is required right now. But they say beyond the firefighting, what needs to happen is we need those pull factors to attract consistent amounts of FDI every year. Well, Sajid is with us today. Sajid, great to have you with us here on the program. Thanks very much for joining us. So let's just sort of, we'll get to the rupee in just a bit and we'll sort of end the conversation there. But I want to start with what's new, right? What you point out, which is that FDI flows have dried up. And that's largely because of, it's twofold. One, of course, is global financial conditions are much tighter now. And importantly, the pull factors seem to be missing. So let's address that. What are the pull factors, which are missing, Sajid? What are the, if I can put it another way, are these roadblocks, hindrances, or just sort of, lack of appeal?
Prashant, good afternoon. Thank you. Good to be here. No, I think you summarized the key elements of the report very well.
I think the starting point here is to make a distinction about what the underlying pressures are, because the symptoms are the same. The rupee was under pressure in 2022, 2025, 26, back in 2018, 2013. But all these episodes are not equivalent because in most of these previous episodes, what you've seen is the source of the pressure was the current account. And so the current account widened, you become reliant on more capital flows, there's a sudden stop of capital flows, and balance of payments pressures rise. But then the prescription is quite orthodox. As we saw in 2013, at that point, you want to tighten fiscal, you want to tighten monetary, you want the exchange rate to depreciate, and you want to turn the current account in. This pressure point is very unique because if you look at the last 4 quarters, the current account deficit is only 0.5% of GDP. Right? It's not even 1% of GDP, much below what's deemed to be sustainable. And so our point was simply to make the case that the pressures originated 2-3 years ago when we began to see FDI flows slow sharply, A, and B, to make the point that at some level this should not be a surprise because, as you pointed out, India's net FDI flows are very correlated with global financial conditions. We saw a gush of inflows between 2020 and 22 when global yields were low. Then as central banks began to tighten, fiscal concerns rose, US 10-year yields went up to reflect that. Global financial conditions tightened, and for 3 consecutive years, we've seen FDI swing. So first, I think it's just to address the point that the slowdown in FDI, which has been a topic of much debate and discussion in the country, should not be a surprise given what its genesis is. The second implication from this is what you pointed to is that, push flows matter, pull factors matter. We saw a huge pull factor between 2005 and 2010. Remember, back then, US yields were also quite elevated. And despite that, India got a large chunk of FDI. So what are the pull factors? Well, there is no mystery to this. I think strong corporate investment typically always attracts FDI. This is an environment in which global supply chains are recalibrating and countries are looking at, China plus one to see who are the big winners over there. India's made significant progress in the smartphone assembly. We need to broaden that out. So, if you see a corporate capex cycle, if you're seeing China plus one, if you happen to be in the AI supply chain, right? Korea and Taiwan, are deemed to be central to the AI story on the hardware front, US and the software front. So we've reached a point where, because global financial conditions have tightened, US rates are elevated. The default for investors is to say, I'm getting a high return in US rates. Why do I need to leave the US? And countries will need to work consciously and assiduously on some country-specific pull factor to lure capital away from high US rates. And the last point I'll make is, I think the outlook for the near future when it comes to US rates is quite sobering, because as you've seen in the last week, on the back of high inflation, markets have begun to price rate hikes into the US in 2027. And we know the US fiscal position is very precarious. So 10-year yields are going to remain elevated. And the challenge for countries like India is in that more hostile environment where money is either staying in the US because yields are elevated or going to where AI is, how do we create country-specific, India-specific pull factors to get our FDI back?
So just a basic point there, Sajid. The relationship between FDI and the 10-year as an example of the risk-free rate, right? Now, FDI, I'm assuming, is long-term sort of investment, right? I mean, coming in for 5, 10, 15, 20 years. So does that, the 10 years, tighter financial conditions, but I'm assuming I mean, is that the correlation is there, but is that causation as well? I mean,
you can never say causation, but you can understand what the logic of this is. So if you break FDI down into gross flows, repatriation of profits, and outbound FDI, you find that in both repatriation of profits and outbound FDI, these are very correlated to 10-year yields over the cycle. Now, think of from a perspective of an investor. If you're getting almost 5% in 10-year US yield, which is again medium term, and then you have to factor in currency depreciation risk of emerging markets, 3, 4, 5% a year, and then there is some country risk premium that you associate with that. You want to be sure that over the next 5 or 10 years, you're getting significant returns in these countries to justify taking on country risk, currency risk, project-specific execution risk. Now, right, and so the benchmark rate, the opportunity cost of funds will matter at all horizons of investment, near term and medium term. What happened in the pandemic was, overnight rates were zero. 10-year bond yields were extremely depressed. The hurdle that you had to bypass to invest abroad was very low. But if an investor is assured almost 5% in 10-year US 10-year yields, there is no currency risk, there is no country risk, there is no project execution risk. You can understand why the proclivity is, you need to be convinced otherwise. And therefore, what you're saying is, where is some of the FDI going? It is going, into countries like Vietnam, where there is a compelling case that Vietnam has been a big winner in the China Plus One story for many years now. And so you can kind of justify high returns going forward, or going into where AI is, because again, the expectation is the returns from these sectors will be very large. So ultimately, when all is said and done, this does come back to a risk-return trade-off at whatever horizon. And when 10-year yields go up, the return that you need to justify the risk is proportionately higher.
Yeah. So if the point is there are those pull factors, then that helps us look beyond this. Helps us to jump over, not us, I mean foreign investors, to jump over the hurdle, the high hurdle, which is the 10-year, which is essentially moved up. Now, I asked you what are those pull factors, and the first thing you said is corporate capex cycle. Now, but that is also like it's a symptom, right? Why is the capital is capital? I mean, the private sector will invest if they see high returns. Similarly, foreign investors, I mean, the benchmarks they use may be different. So what is missing? Why is this corporate capex cycle also not materializing? I think you point out it's not been there since 2011, 12?
And Prashant, we've had this discussion before, so you're exactly right. I think the source of the issue is corporate capex. Remember, the only time we saw very strong FDI above and beyond what global financial conditions would warrant was between 2005 and 2010, when we had strong corporate capex, because corporate capex tends to catalyze a lot of foreign direct investment. So the question is, why haven't we seen corporate capex? And the answer to that has evolved over the last 15 years. For the first 7 or 8 years, between 2011 and 2019 or 20, it was quite clear that there was a twin balance sheet problem that the economy was working through. Corporate leverage was high. Bank NPAs were high, 2015, 16, 17. We were recognizing those, resolving those, recapitalizing banks. But over the last 5 years, my belief has been that the binding constraint on corporate capex has changed. Now balance sheets are very strong. One of India's great strengths is we've got very strong bank balance sheets. We've got very strong corporate balance sheets. Our profits are strong, cash levels are high, leverage is low. But I think in my mind, the binding constraint today is demand visibility, right? From a corporate capex cycle. What are the symptoms of that? Well, if you look at capacity utilization in manufacturing, that's been at around 75, 76% for the last 10 years. It hasn't moved up materially to warrant more investment, number one. Number two, what's really changed over the last 7 or 8 years is what's happening in China. China has created lots of excess capacity because production in China is on a tear. Domestic demand has been soft since the pandemic, and China is exporting that excess capacity around the world to all of Asia, including India. So if you're an Indian businessman and you're in a situation where utilization rates haven't moved up, you're competing with cheap Chinese imports. Core inflation in the last 2 years is between 2 to 3%. That's good from a household's perspective, but that also means that corporates don't have much pricing power. And our view has been core inflation is muted, both because there is still some slack in the economy. We're still about 4 percentage points below our pre-pandemic path, but also because these Chinese imports that are flooding into all Asian economies and emerging markets are creating disinflationary forces. So it's understandable why we haven't seen more corporate capex until you have more demand visibility, right? And until you believe you have enough demand so that both Chinese imports and domestic production can service that demand, corporates will be hesitant. This predates the global uncertainty. The global uncertainty, the tariff war in 2025, the global shock in 26 simply compounds this. Now, I think the part that's a little bit unfortunate is For the first time in many years, you saw in the last 3 or 4 months of 25 and early 26, the government throwing many cyclical instruments to try and boost domestic demand and crowd in private capex. We saw last year, direct taxes being cut, GST being cut, large monetary easing cycle, regulatory easing that was meant to act as a force multiplier, very low inflation, so purchasing power went up, a strong monsoon. There were these 6 factors that came together, and you just began to believe that, in December, in January, in February, consumption was picking up and was becoming more broad-based. And that, if corporates saw stronger, more broad-based consumption across rural and urban, there'd be a proclivity to invest. So just when we thought that domestic demand, consumption may be picking up, we get the West Asia shock.
We need to change the narrative, right, Sajid? I mean, that's the point. I mean, we need something that pull factor. I mean, because these, we've done tax cuts, and for corporate India, we've done lots of stuff. Right? I mean, and macros are in order. We've not spent too much, and the fisc has been in check throughout. But I mean, demand, as you say, is missing, and without growth, all these problems show up. So how do we change the narrative, in your opinion, Sajid? Is it piecemeal, a little here, a little there? And so run us through that.
Yeah, so I think there are 2 horizons here, Prashant, that we need to solve for. I think before we solve for peace times, we have to get through the storm, right? And getting through the storm means we've seen that the balance of payments has been under sustained pressure in the last few months. The rupee has been under pressure. So we first need to just get through this period. And that, in my mind, will involve to start with, the rupee will have to become the shock absorber. The Reserve Bank of India is doing the right thing. We've discussed this before. At a time where, capital flows have dried and crude prices have moved up 40%, which is an adverse terms of trade shock for India. Any estimation of the underlying equilibrium real effective exchange rate is much lower than what we had thought 6 months ago, 3 months ago, a year ago. And I think we need to guide the rupee to the new equilibrium. The hope is that you get expenditure switching, and with a weaker rupee, imports become more expensive, exports become more competitive. If the foreign investors believe the rupee is oversold and overshot, then suddenly capital flows will look at India and say maybe it's an attractive time to invest. So the rupee is a necessary condition. The question is, is there a sufficient condition to get through the storm? Because as I mentioned, the original pressure point is not the current account. And so demand compression through fiscal and monetary, I think, needs to be a last resort. The question is it time, if the war continues and the pressures remain, for us to think of capital mobilization? Because what you don't want to do is get stuck in a bit of a vicious spiral where a weaker rupee itself causes exporters to change behavior, importers to change behavior, and more importantly for investors to start considering hedging their stock. So right now we're discussing flows of the current account, capital account, but there's a stock of FDI, there's a stock of ECB, there's a stock of equity flows in India. And we don't want a situation where if investors worry about the pace of rupee depreciation, they start hedging the stock, because that then puts more pressure on the rupee. Higher pressure on the rupee creates a larger incentive to hedge, and so on and so forth. So you do want the rupee to be the primary shock absorber, but the question is, do you also want to then attract capital flows, to act as a circuit breaker and ensure that any rupee depreciation is calibrated and doesn't cause expectations to be altered? So I think that's the first thing we have to get through over the next 3-6 months. Because I'll make one point, Prashant, it's important to understand what's happening globally. We don't know when the Strait of Hormuz is going to open, but we do know the following, that the world hasn't seen the kind of supply shock that we were expecting or fearing, because even as about 14 million barrels of oil and petroleum products have been taken off stream, inventories have been run down very sharply. The good news is in the near term, this has avoided shortages. But the sobering news is, even if the strait reopens in June, demand for crude and its products is going to be so elevated to replenish these inventories that our house believes that crude prices will remain above $100 for the rest of the year, right? So in that environment, even if the strait opens, we have to budget for $100 of crude, which then means a current account which was very benign, below 1% of GDP, goes to 2.5% of GDP, and your BOP gap becomes larger. So I think the first order of business is, how do we get through the storm unscathed? Last point I'll make is, then in peacetime, Prashant, when we return to a post-West Asia world, I think, the unescapable reality is, in this more hostile global environment, the best way to protect yourself is sustained reforms. There is no alternative. And to be fair, the government had started this process last August. We saw GST, we saw labor laws, right? And so we have to get back to that reform express, so to speak, keep pushing on reforms till we can convince investors that, India is becoming structurally more competitive, and we are laying the groundwork for the next capital.
Just a 15-second answer to this. Is it possible we see a cut to equity capital gains taxation? I mean, the common pushback is, how can you do for FIs, not for locals, revenue implications? How high is the bar?
Yeah, so Prashant, I don't have a strong view on any specific instrument. I think the government is likely contemplating all instruments, withholding taxes, raising capital, how to raise ECBs. My only submission and advice from the outside would be that, if the idea is to raise a large enough quantum of capital to act as a circuit breaker, we should go big, right? So if you want to raise it, raise a significant amount of capital so that you can do two things. You can significantly augment reserves, and then you change the narrative in the FX market, because market participants see, India's attracted a very large quantum, and exporter-importer behavior, hopefully, and investor behavior will change. So, I won't speculate on specific instruments, but these are unusual times, and I think we should not rule out any instruments. I think all instruments should be on the table, and the government should feel free to choose among them.
And how do you raise that very large amount of dollars, Sajid? What's the best route?
So, it's not going to be easy, Prashant, because as I mentioned, US rates are elevated. This is not 2013.
Sure.
Again, we have a history here. Again, I won't speculate on specific instruments, but we did see in 2013, there was an FCNR route where there was a subsidized swap. One other alternative could be external commercial borrowings, where we know that, some state-owned companies, corporates, banks, would be inclined to raise dollars if the conditions were made more favorable. Should we be looking at withholding taxes? so that India becomes eligible for the Barclay-Bloomberg index, which can also bring in a substantial quantum. I think operationally there are different instruments available. My submission would be, if we're doing it, we should go big, because the idea, we have a large quantum of FX reserves. I think this amount is not being raised because we don't have enough reserves. This amount is being raised to A, augment reserves, but B, act as a circuit breaker in the rupee market.
Sajid, a lovely conversation. We'll see what happens, and we'll have you when it happens to sort of, comment on it as we track it. Thank you very much for joining us once again here on this program. Really appreciate it.
Always a pleasure, Prashant. Thank you.
Thank you. Well, it's a wrap. That's it. That's the show on Global Reset. Appreciate you staying with us. You can, if you want to rewatch, go to our CNBC TV 18 Prime YouTube handle, and of course, you'll find all our recordings, all our previous programs on it. Thank you for staying with us. More comes up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the rupee hits a record low of 96.96 against the dollar. Dealers say the RBI's dollar selling alleviated some pressure. The Nifty and the Sensex end mildly higher after a sharp recovery. Top economists warn of a deeper external imbalance building up and the balance of payments deficit widening to $65 billion. Also warn the rupee could decline further. The United States and Iran trade threats as the fragile ceasefire drags on without concrete assurances from either side. Trump claims Iran is tired and begging for a deal. Tehran says a return to war will feature many more surprises and could expand the conflict beyond the region. Russia's President Vladimir Putin and China's Xi Jinping hold talks in Beijing, hit out against unilateral bullying and call for a more multipolar world. Also reach an understanding on a pipeline that would carry 50 billion cubic meters of gas annually from Russia's Siberia to China via Mongolia. Prime Minister Modi in Italy for the last leg of his five-nation diplomatic tour holds bilateral talks with Giorgia Meloni. Trade, defense, the blue economy and the much-touted India-Middle East-Europe economic corridor top the agenda. U.S. Secretary of State Marco Rubio to visit India at the end of the month is scheduled to take part in a meeting of foreign ministers of the Quad countries. Washington says the secretary will also discuss energy security, trade and defense cooperation in his meetings with senior Indian officials. The U.S. Justice Department bars audits or tax claims related to Donald Trump, his family and his businesses for past filings. This comes a day after Trump agrees to settle his lawsuit against the Internal Revenue Service over the leak of his tax information to media outlets between 2018 and 2020. Over 47,000 Samsung electronic workers in South Korea may go on protest from tomorrow after wage negotiations between the company and the union break. Shares of the South Korean chip giant down by 3%. Google wraps up its annual developer conference, unveils its biggest search overhaul in 25 years. A 24/7 personal AI agent called Gemini Spark and smart glasses built with Samsung send a signal that Gemini is now the infrastructure layer underneath every Google product.
Prime Minister Modi brought us a gift, a very, very good toffee.
A video shared by Italian Prime Minister Giorgia Meloni thanking Prime Minister Modi for gifting her a pack of Melody chocolates has sent social media into a frenzy. Prime Minister Modi shares pictures from dinner with his Italian counterpart, triggering the much-celebrated Melody memes. Arsenal become the champions of the English football after a 22-year wait. Fans in North London erupt in celebration after rival Manchester City was held to a draw. The club's manager, Mikel Arteta, is the second youngest coach to win the English Premier League. Well, let's start with the day's market action. The Sensex and the Nifty ending the day higher, recovering over 1% from their previous lows. The Nifty ending above 23,650, 117 points higher on the Sensex, 153 points higher on the Nifty Bank, and the Nifty Mid-Cap Index was higher by about 0.5%. Reliance, Hindalco, Axis Bank led the rally today. The Nifty Bank gained over 150 points, and Prashant is here now to wrap up the day's market action for us. Coming off their intraday lows, closing in the green. Prashant, sum up the market mood.
Well, it was an okay session, off the lows by quite a bit. And that's the thing. Today, the Nifty moved. The Nifty has been moving up and down over the last many sessions, but the direction of the currency has been one way. It looked something similar when we started. The rupee hit almost 97. But from, just a few paisa short of being at 97, we saw a sharp pullback. Maybe the RBI sold dollars, or maybe the market just assessed that perhaps too much has happened very, very quickly. But the rupee market pulled back, and consequently you had the equity market which responded favorably as well. So we end small, about 30-40 odd points higher, but off the lows by quite a bit. The Nifty the mid-cap and small-cap indices will come up on your screen. Here there was about a 0.5% gain on the mid-cap index. The small-cap index was more flat, about 0.1%, so barely up. The Nifty Bank Index was up about 1/3% as well. In line with what not in line, maybe a little better to what the large cap Nifty did. So just stocks to take it forward. Hindalco was the big gainer, 3.6 higher. Of course, responding to numbers, Reliance went up to 3%. So it's been completely out of the picture for a while. Bajaj was up 2.5%. There was Grasim and Bajaj Finserv, which were some of the other smaller Nifty gainers. BEL was down 2%. That was the number one Nifty loser. TechM and Eternal were some of the others which, lost ground. Now,
Prashant, many thanks. Let's talk about the rupee now hitting a record low of 96.96 to the dollar. Dealers say the RBI's dollar selling alleviated some pressure. Lata standing by now with more on the rupee. New low, Lata, but what are traders saying at this point in time?
It is a more of the same market. The rupee has been responding to the crude pressure for some time now. But, you can take pain, every day more pain, and there's more loss. But there comes a time when the pain is simply too unbearable. $110 for the last 3 days, for all of this week, and over $100 continuously from May for this entire month. That has quite clearly resulted in the breaking of spirit in the market. So the distance from 96 to 97 seems to have been covered rather quickly. We hit 96 on May 15th. And now, we reached very close to 97 in early morning trade. And we were among the weaker currencies in Asia, at least. The RBI intervention was not there in the early morning trades, and maybe that's why the rush happened. Thereafter, the Reserve Bank selling dollars alleviated the pressure, but not entirely. We can see the rupee dilly-dallying between 96.80 and 96.90 for a better part of noon trades. So really, the pressure is not going away at all. Some of the dealers say that lack of any further announcements is also kind of disappointing. The small number of rupee bulls who think that, okay, rupee has fallen enough and it's time now to sell dollars. That category of people are getting disappointed that there are no announcements. The media is speculating about capital gains tax, withholding tax, ECB announcements. All kinds of things are being speculated. But since nothing has come, that is adding to their disappointment, is one school of thought. The event happens, the rupee falls, and people are looking for explanations. So all these are coming from the chatter in the market. But the important point is that the rupee is falling a little rapidly. May 15 to May 20th, a fall from 96 to almost 97 is not a very happy thing at all.
Many thanks. In fact, let's stay with that. Leading economists warn that a deeper external imbalance is building up. They also say that the balance of payment deficit could widen to $65 billion, while adding that the rupee will find a new equilibrium. Let's listen in.
I think the government is likely contemplating all instruments, withholding taxes, raising capital, how to raise ECBs. My only submission and advice from the outside would be that if the idea is to raise a large enough quantum of capital to act as a circuit breaker, we should go big, right? So if you want to raise it, raise a significant amount of capital so that you can do two things. You can significantly augment reserves, and then you change the narrative in the FX market because market participants see, oh, India's attracted a very large quantum, and exporter-importer behavior, hopefully, and investor behavior will change.
Whatever we do on the currency, it should be something that's not just for the short term, it's also for the medium term, because this is a problem that has been with us for the last 2-3 years.
It's probably too early for the RBI to start thinking about a rate hike in the June policy itself, because as you rightly mentioned, as of now, RBI is keeping liquidity plentiful. There is no signal for tightening things, and rightfully so, because the headline inflation is still below the RBI's target of 4%. So there's probably no hurry on RBI's part to tighten things up immediately. Given the already existing challenges on the capital account, and now a 2% of GDP current account, our overall BOP forecast for FY27 is now $50 billion, which is a pretty large BOP surplus in the BOP deficit in the Indian context.
The question is, is there a sufficient condition to get through the storm? Because as I mentioned, the original pressure point is not the current account. And so demand compression through fiscal and monetary, I think, needs to be a last resort. The question is it time, if the war continues and the pressures remain, for us to think of capital mobilization? Because what you don't want to do is get stuck in a bit of a vicious spiral where a weaker rupee itself causes exporters to change behavior, importers to change behavior, and more importantly for investors to start considering hedging their stock.
Very big external BOP deficit this year of about $65 billion, sort of never seen this kind of a big deficit, and that's what's really showing up on the currency. And what's not helping over the last couple of days is that there is a bond sell-off globally, and whenever we see that, we saw that in 2022, 2023, it's not great for flows into EMs. In fact, you start seeing outflows from EMs. So you already had this energy shock, now you have a bond sell-off globally, so all of this is coming together, it's not great for the currency.
Well, top economists there on the macros and what the government may choose to do. Russia's President Putin arriving in China last night, where he was received by Chinese Foreign Minister Wang Yi. His visit came a week after President Trump visited Beijing for the first time in nearly a decade. Now, Putin and Xi Jinping held bilateral talks in Beijing, where both leaders have said that they will deepen their comprehensive strategic coordination. Addressing a gathering, the Chinese president said that both nations should act against unilateral bullying and actions that reverse history. Putin added that the driving force behind economic cooperation is their collaboration in the energy sector. In a joint statement, Xi and Putin have called out the military strikes against other countries and the hypocritical use of negotiations as cover for preparing such strikes. Russia and China also signed 20 agreements on trade and technology. The leaders also inked a declaration on a multipolar world order. Also reached an understanding on a pipeline that would carry 50 billion cubic meters of gas annually from Russia's Siberia to China via Mongolia. CNBC's Eunice Yoon is here with more.
4 days after President Trump left Beijing, Russia's President Vladimir Putin showed up here in China for meetings with President Xi Jinping. Even though the two sides announced about 40 agreements and signed 20 today, it looks as though Putin, like President Trump, didn't get what he wanted out of China either. Today, Putin was hoping to finally move forward on a gas pipeline, which is called the Power of Siberia 2. That has been under negotiations for years, but President Putin didn't even mention it during the press conference today with President Xi. Later, a Kremlin official had said that the two reached an understanding of what he described as the main parameters, but this Kremlin official said that the nuance needs to be ironed out on that pipeline. Putin has been pushing for this arrangement in order to sell more energy to China, which of course would be good for his economy, which has been isolated from the West. A lot of analysts have said that the two haven't been able to agree on the price of the gas that comes through that pipeline. Now, that is just another indicator that even though the two countries profess to have close ties, what Russian President Vladimir Putin has said are unprecedented level relationship, that is similar to the U.S., China, at the end of the day, is most concerned about its own political as well as economic interests. Now, the conversation about the Iran war did come up. The state media said that the President Xi said a comprehensive ceasefire is imperative. Restarting war is even more unacceptable, and adhering to negotiations is particularly important. The two leaders, though, Morgan, still diverge on the issue of the Iran war. For the Chinese side, they are looking to have the Strait of Hormuz open because they get a lot of their energy from there. But for the Russians, they actually benefit with the Strait of Hormuz closed.
Well, Eunice Yoon there reporting from China. President Trump claims the war with Iran will end, and I quote, very quickly because Tehran, he quote, says, is begging for a deal, while also threatening further military action. Addressing a congressional event at the White House, the president said, and I quote, Iran is tired and badly wants to make a deal, end of quote. However, he maintained that although he didn't want to attack again, he may have to. President Trump also claimed that oil prices will fall sharply once the war with Iran is over. This came just hours after U.S. Vice President J.D. Vance said that the country is locked and loaded if Iran does not agree to a nuclear deal. Iran warned that it will expand the war beyond the region if the U.S. chooses to resume military operations. Iran's Foreign Minister Syed Abbas Araghchi has said, and I quote, a return to war will feature many more surprises, end of quote. This after U.S. congressional reports suggest that 42 U.S. aircraft have been either lost or damaged in West Asia since February of 28th. Meanwhile, Washington continues its attempt to exert economic pressure on Iran. U.S. Treasury Secretary Scott Bessent has urged the G7 to help US in acting against Iran's finances. Addressing a G7 meeting in Paris, Bessent also asked countries in the Gulf and Asia to tackle Iran's shadow banking networks.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down.
We trust that your participation here today reflects a readiness to stand with us in full. That will require, for example, our European partners to join the United States in taking action against Iran by designated financiers and unmasking its shell and front companies, shuttering its bank branches, and dismantling its proxies. It will require those of you from the Middle East and Asia to root out Iran's shadow banking networks and networks of ship transportation obfuscation.
Well, that is Scott Bessent. U.S. Secretary of State Marco Rubio will be in India from the 23rd to the 26th of May. This will be his first visit to India since assuming office. In a statement, the U.S. Department of State has said Rubio will discuss energy, security, trade and defense cooperation. In those meetings with senior Indian officials, Rubio is also likely to take part in a meeting of foreign ministers of the Quad countries. However, there has been no official confirmation on that front. We will head into a break, but up next, Prime Minister Modi in Italy for the last leg of his five-nation diplomatic tour holds bilateral talks with Giorgia Meloni. More on that when we return. Prime Minister Modi is in Italy. That is for his last night and the final leg of his five-nation diplomatic tour. The Prime Minister held delegation-level talks with Italian President Sergio Mattarella. During the bilateral meeting, he was accompanied by External Affairs Minister S. Jaishankar, National Security Advisor Ajit Doval and other senior diplomatic officials. Prime Minister Modi and Prime Minister Meloni are also holding more meetings today. The Prime Minister was accorded with the Military Guard of Honor in Rome. The leaders expect to discuss wide-ranging issues, including trade, investments and boosting strategic partnerships. Sanjay Suri joins us from Rome. Sanjay, the Prime Minister in Italy and social media is clearly on fire.
Prime Minister Modi's visit to Italy has been off to a rather sweet start, beginning with a rapid-fire Roman holiday of sorts with none other than Prime Minister Meloni as guide, who took the Indian Prime Minister to the Colosseum, the iconic landmark here in Rome. And the following morning, we had Prime Minister Modi gifting Melody toffee chocolates to the Italian Prime Minister. And Melody, of course, is the word that Meloni coined back in 2024 when the two leaders met at the G7 here in Italy, Meloni and Modi together. So that melody really has been off to another start, and this melody going viral as the last one did. But past the sweet stuff is to serious stuff now. We will have 3 hours of talks between the leaders and officials from both sides. These are going to be substantive talks, and the attempt is to break the impasse over the proposed India-Middle East economic corridor, and also take decisions to step up trade and to take steps together at a lot of international events and where matters raise international concerns, as the Mediterranean, as the Indian Ocean region. And the two leaders to put together an article, and they jointly penned their view of a shared vision in this area. Following which, the Indian Prime Minister will visit the Food and Agriculture Organization here in Rome. That's nothing to do with Italy. That's an international organization. But in the food crisis in the world today, that will be a very crucial part of this visit. India not quite in a severe crisis yet, but certainly it's not too early to take precautions and to see if there can be a safety net below the safety net that the Indian government can provide. So a lot on the agenda, off to a sweet start, and everyone hopes that it will be a visit that comes to a sweet conclusion with sweeter stuff to follow.
Sanjay Suri, many thanks for joining us. Well, as Sanjay was mentioning, Prime Minister Modi and Prime Minister Meloni went for dinner in Rome, proceeded to take a late evening walk to the iconic Colosseum. In a post on social media, Prime Minister Meloni said that both leaders exchanged perspectives on a wide range of subjects, including boosting ties between the two nations. Prime Minister Modi also gifted his Italian counterpart a pack of Melody toffees and what appeared to be a playful nod to the viral hashtag Melody, an expression widely used online for the two leaders. We spoke with the management of Parle Products, the company which manufactures the Melody toffee. As the visuals went viral on social media, they called the Prime Minister's gesture a big moment for the company. That's not all. Shares of Parle Industries, by the way, which has nothing to do with the Melody toffee, an unrelated company altogether, surged sharply in trade, hitting an upper circuit today.
Prime Minister Modi brought us a gift, a very, very good toffee.
This was, I think, really big for us. Grateful to our Prime Minister. I think this is also a nice way of pushing Indian products and probably giving them a global stage.
Take that point, take Indian products and give them on a global stage as well. But just out of curiosity, what is the annual sales of Melody? And every time, the internet buzzes with the Melody hashtag, do you see an impact on sales because of that?
Well, I mean, I'm so inclined to bring in the tagline of Melody khao khud jaan jao. But if you're talking about the sales, yeah, it's one of the top confectionery brands in India today. When you're talking about, confectionery brands available in India, it's one among the top confectionery brands. It's, we don't normally share figures because we are a private limited company. But as I shared, it's one among the top brands, confectionery brands of India today.
And we're given to understand Melody toffee is no longer available on quick commerce sites, been sold out altogether on the back of that viral meme. Prime Minister Modi will chair a Council of Ministers meeting when he returns to India. The meeting will be attended by cabinet ministers, ministers of state with independent charge and other ministers of state. The functioning of various ministries, key decisions taken so far and their outcomes are likely to be on the agenda. That's a big one to watch out for tomorrow. In earnings, Ola Electric's net loss is narrowed to 500 crore rupees on an annual basis in Q4. However, it has widened on a sequential basis. Revenue has declined over 56% to 265 crore rupees year on year. The company has said it will continue to sustain service consistency and focus on scaling volumes in FY27. The big global story, Google has wrapped up its annual developer conference as it unveiled its biggest search overhaul in 25 years. Rachna brings us more from Google's conference. Rachna, take us through the latest offerings, but more importantly, what is Google doing to search?
Well, Google I/O 2026 had one clear message, that Gemini is no longer a product, it is the operating system for everything Google does from here on. And that showed up in search, in AI agents, and for the first time, on your face. On search, Google's head of search called it the biggest upgrade to the search box in 25 years. It will now accept natural language, images, documents, videos, and open Chrome tabs. Autocomplete is replaced by Gemini AI that shapes your question as you type, anticipating intent rather than predicting words. Behind all this would be information agents, personalized AI working in the background, around the clock, reporting back without you returning to the page. But also, let's not miss out a key detail here. Every agent answer Google serves is one less click to an external website. Now remember, the DOJ has already ruled Google illegally maintained its search monopoly and warned the same playbook cannot repeat in generative AI. Google said nothing about that on stage, so we will have to see how this unfolds. On Gemini, Gemini 3.5 Flash is live now. The company claims that it runs 4 times faster than competing frontier models. Gemini 3.5 Pro arrives next month. Gemini Omni, the new model combining reasoning with creation, is already inside YouTube Shorts, outputting AI-generated videos. The flagship product here, though, is Gemini Spark, a 24/7 AI agent on Google Cloud, executing tasks in the background even after you close your laptop. With workspace integration built in and third-party app support via MCP coming in weeks, it sits inside Google AI Ultra, priced at $100 a month for developers and power users. India pricing not announced. The money behind all this also tells us how serious Google is. $180 to $190 billion in capex this year, 6 times what Google spent in 2022. Then there's hardware. Google and Samsung previewed 2 models of smart glasses designed with Gentle Monster and Warby Parker, with Gemini voice access, real-time translation, navigation, and a built-in camera, launching this fall on both Android and iOS. No price, no India date, but the wearable AI race that Meta started with Ray-Bans just got a serious new entrant with this. So 3 announcements. One through line, that Google is building a world where you don't need to go to Google. Google comes to you, where the regulators, publishers, and users get a say in that world. Based on what we heard at the conference, it is safe to say that Google is not waiting to find out.
All right, Rachna, many thanks for joining us. That's it then on this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with more.
Hello and welcome to Startup Street. I'm Ritu Singh and here are the top headlines from the startup world. Oyster Global rolls out a new 500 crore secondaries fund. The tech investor has launched ACE Fund 3, which includes a 250 crore rupee greenshoe option, hot on the heels of its previous fund being 2 times oversubscribed. The firm plans to back up to 7 high-growth startups. Analog Devices is acquiring Empower Semiconductor in a massive $1.5 billion all-cash deal. By enabling power conversion closer to the processor, the combined tech will significantly boost efficiency for hyperscalers and AI silicon developers from grid to core. Upgrad has been valued at $1.73 billion in its latest valuation report. The new pricing comes as the EdTech unicorn raised 361 crore rupees in a fresh funding round. According to its regulatory filings, Upgrad allotted over 8.9 crore compulsory convertible preference shares to secure the $38 million capital injection. Peak 15 Partners has joined a $100 million fundraise for global payments infrastructure startup Pharma, making another overseas investment for the Indian VC firm. The funding will accelerate AI investments and US expansion, where Pharma expects significant revenue growth. Google wraps up its annual developer conference in Wales, its biggest search overhaul in 25 years. A 24/7 personal AI giant called Gemini Spark and smart glasses built with Samsung sends a signal that Gemini is now the infrastructure layer underneath every Google product. And those are the headlines that we're tracking for you today. But on the hot seat, consumer electronics design and manufacturing startup Maker Technologies has raised 67 crores in its Series A round that was led by Avana Capital. The company works as an ODM or an original design manufacturer, helping brands go from product concept and prototyping all the way to mass manufacturing. Now, the company says it has already developed more than 100 SKUs and partnered with brands like Chroma, Wipro, Amazon, and Flipkart. With this fresh infusion, it plans to deepen its investments in R&D, product engineering, and strengthen export readiness for the global markets as well. So on that note, let me invite Gaurang Kuchal, who's the co-founder of the company, for the way ahead. Gaurang, thanks very much for your time here today. You described the company as a full-stack design and manufacturing platform. What exactly is broken in the appliance manufacturing ecosystem here today that you're trying to solve for differently?
First of all, thank you very much for having me here. So yeah, in the appliance ecosystem, actually, there were a lot of things which were being manufactured in India, but still a lot of appliances were there which were box pack being imported from China. No value addition was happening in India. So we figured that we can bake these things as well in India. There are certain bits and pieces of the supply chain which needed to be figured out, but still all of these things can be made in India, and that is what exactly we are doing. We are setting up supply chains, setting up manufacturing of products which were earlier being box pack imported from China. Now we are empowering brands by making these things in India.
Well, but speaking about making in India, because currently, like you even said, a lot of companies still rely on Chinese ODMs, imported components. How difficult or how realistic is it to localize a supply chain fully without compromising on cost or quality?
See, actually, the reason why these products so far were also not made in India was the supply chains are a bit of complex. I mean, in India, you will have expertise of people in their specific domains. Like there will be people who can do plastics, certain other people who can do sheet metal, some people can write software, some can do PCBs. But when we talk of these finished goods, finished products, they actually require coming together of these different varied supply chains together when we have to make a product. And that is what is the missing link. We at Maker are creating this ecosystem where we are bringing together all these expertise. We understand how plastics are made, how sheet metal processing is done, how PCB is done, some things which we as a country still don't have the capabilities to do, how we can import it from outside. So when we are able to master all of these fundamentals of building a product, then we are able to make complete products, and that is what we have solved.
You're already working with pretty big brands. You're working with Chroma, Amazon, Flipkart, and whatnot. But given what's happening globally, where countries are looking inwards, are clients increasingly here asking for India-made products because of geopolitics and also the supply chain diversification?
Yes, definitely. There is a big shift that is happening. The brands are always asking, like the procurement guys at the brands, they have a big list of products that, hey, these 5 products I am doing in India, but these are 50 other things which are on my charter, which I have to indigenize. So there is increasing ask from the brands, and the push is coming because of the reasons you mentioned, geopolitical situations. Everyone wants to be self-resilient because of the government policies also. Government has introduced BIS, because of which imports are no longer being involved. So because of all of these reasons combined, there is definitely a massive tailwinds towards localization and Make in India.
But what would you say, what percentage of your manufacturing and components are currently localized, and where do you still see dependence on imports to some extent?
So currently, there are certain parts, spare parts of the products which are like made in China in very highly automated lines, automated setups, which can like churn out millions of units a day. So those products, like India is not yet such a big market to set up that infrastructure in India and make these things locally. And these things can be made only through automation. So these are some spare parts. To give you some examples: switches, thermostats, heating tubes, maybe load cells, certain motors, micro motors, specialized motors, BLDC motors. So these are certain things which still we have as a country dependence on China. However, it's a step-by-step journey. I mean, earlier we were buying complete products from China. Now we are building some parts of the products in India, and for certain things we are still, as a country, dependent over there. And eventually, I feel going forward in next few years, these things will also come inwards.
Well, let's hope that is the case. But, just to give us a sense of how you're going to deploy this 67 crores that you raised, how capital intensive is your business model? And, now that you raised these funds, how will you be deploying it? And then when do you expect to hit profitability or operational scale?
So we are already profitably running the business. We are a profitable company doing healthy profits. In terms of deployment, the plan is to invest this business towards more R&D, more development, doing some capex investment in bringing a lot of machinery processes from China. We are basically replicating China-like setups in India itself. So a lot of those processes, machinery and technologies will be coming to India. Then we are also planning for some global expansion as well as working capital. So the utilization of funds is towards all of these things.
All right. Since you're also looking at global expansion with the funds that you raised, are you looking at exporting finished products or, building for international brands, or eventually also creating this India origin appliance brand of your own?
No. We are very clear. Our positioning is brand behind the brands. We don't want to create our own brand. We are more expert towards developing new products, manufacturing side, and we leave the part of the sales marketing to the brands themselves. So our positioning is clear. From India, we want to, Europe, US, these people are more comfortable working with the Indian brand, but the options are not there. So they are working with Chinese factories. So we are actually competing against China and giving them an alternate option. Also, in the recent times, government has signed up free trade agreements with several countries, with UK, Europe, with US. We have better deals compared to China. So we are trying to make best of all of these opportunities which our government has created, and actually create a good alternative to China compared to create a good alternative compared to China out of India.
All right, Gaurang, we'll leave it at at that point. Thanks very much for your time here today, and we wish you the best with building out your company. Thanks very much.
Thank you so much. Thank you.
Well, moving on, as AI rapidly reshapes the tech landscape, a critical gap that's emerging is not really in access to learning, but in real capability. Now, a majority of engineers believe they are AI ready, but very few are actually building with it. Scaler is betting big on closing that gap, and after engaging with about 1,200 companies, it has rebuilt every one of its programs from the ground up, positioning itself as India's first fully AI native tech career platform. Joining me now is Abhimanyu Saxena, the co-founder of Scalar. Abhimanyu, thanks very much for your time here. I was going through your study which shows that 89% of engineers think they are AI ready, but you think only 19% actually are, which is a very big gap. What's really, going wrong in how talent is being trained today for the future? And, is it a problem of overconfidence, or are we simply teaching them the wrong things?
Right. No, thank you for hosting me. And as you rightly said, I think, and most of us have experienced it ourselves, that we all have used a little bit of ChatGPT, a bit of Gemini, and we have seen that it is powerful, right? And that of course gives a feeling of empowerment. But if I look at the companies or individuals, that what are the companies that have shown a much faster revenue growth rate or much faster profitability rate? And even from the individuals, if we double click on that, where did you use AI which have measurably increased your impact at work? That is yet to come. That being said, another side is also that the bottleneck is not really the capabilities of the AI. The bottleneck is actually our capability to be able to harness it well. The parallel that I draw is that we suddenly, let's say, have a lot of electricity being produced, but we do not know how to use that electricity well. And electricity in itself doesn't make my life better, right? If I have the factories and the manufacturing that can use that electricity and produce things of value for me, that is when it really becomes valuable. So as you rightly said, that while everyone have played with AI, but most of us are yet to learn how to use AI, like applies equally for the organizations and for the individuals, that organizations and individuals both are yet to learn how to use AI to create real economic value.
But how does AI native skilling actually look like in reality? I mean, what is fundamentally different in this from, this wave of quick certifications and these Gen AI courses that are flooding the internet, flooding the market today?
Right. No, I think I see that as a good sign, that it clearly shows that most of the people, organization, individuals all realize that learning AI well is a necessity. And that is to meet that demand, the supply is being created, which is of course a great thing. That being said, to really get the ROI, there are two parts to it. How do you make sure that you learn all the skills that make you leverage AI well? And that means that your curriculum has to be updated at a very rapid span. Every month there are new capabilities emerging. And even a curriculum that was created 6 months back to really upskill on AI probably is massively outdated. So one part is that quickly, having a team of researchers. So for example, we have an in-house team of researchers working in our AI research domain, which almost every month keep bringing up what are the new capabilities emerging and how do we make sure that our learners can learn those. Yeah. And second part is using AI to really teach well. So ultimately AI is something very hands-on. There's nothing theoretical about it. If you really want to leverage it, you have to build it. You have to really, get your hands dirty, right? And we have been investing heavily on building platform that can generate the simulations rather, where people do not just learn the concepts of AI, but they can actually in those virtual environments can build the AI solution and see the impact themselves. So I think doing is must.
Well, Abhimanyu, since you work with about 1,200 or so companies, very large and startup, across the spectrum, what have you found that these companies are actually looking for when it comes to talent? Are they actually disregarding, these degrees from these big institutions? Are they looking for actual AI expertise like you're talking about?
Right. No, so I think, for example, one role that has been on the highest growth called as forward deployed engineers, right? What they mean is that engineers who have enough context of the business and know AI well and be able to quickly build solutions that show the impact, right? And then the second phase could be, roles which can then scale that solution. Even roles like testing have entirely transformed in the world of AI. How systems were tested in the previous world and how systems are tested in this new AI world is entirely different. So companies effectively are looking for people who have a strong enough understanding of business and strong enough knowledge of the AI to be able to apply AI to move the business level.
Given that AI talent itself is expected to nearly double by 2027 and only a fraction of professionals are truly skilled, like you're saying, What does that mean in terms of numbers for you, in terms of how big an opportunity this is? And, also going ahead, what would be the key growth levers for the company? I mean, new programs, are you looking at global expansion, more partnerships? What would it be?
Right. No, to share one number, just in the last 6 months, we have already seen roughly 15% month-over-month growth into our AI-related courses. Now, compounded over a year, just that 15% month-over-month growth itself gives almost 150 to 100% growth in the number of people who are enrolling in our AI courses. Now, within AI courses, of course, AI itself is not just one thing, but there are plenty of different kind of programs that get created around AI. So definitely we are launching a lot of different programs. We are launching not just online, but also hybrid programs as well, because a lot of people want to have a hybrid learning experience. We are launching programs in partnerships with some of the most reputed academic institutions. We are launching certifications in partnership with them. And we are seeing strong demand from our both enterprise and consumer clientele for such programs.
Got that, Abhimanyu. Thanks very much. I ran out of time, not out of questions, and hope to have you back again. Thanks very much for joining us here today.
Thank you. Look forward.
Okay, we'll slip into a short break, but up next, Charity Ventures has committed nearly half of its fund, 5 Capital, to deep technology. We'll tell you all about that when we return. Welcome back. You're watching Startup Street. Now, India's deep tech investment is surging, and Charity Ventures is doubling down. The firm has now committed nearly half of its Fund 5 capital to deep technology, that is AI, space, robotics, and material science. Its founder, Zidus Wellness, says the next 100 deep tech startup companies must find their market right here in India. Aishwarya Anand caught up with him at a Delhi Innovation Day Summit. Listen into what he had to say.
You've backed the likes of Flipkart before India shaped online, Lenskart before India bought glasses on a screen. Now, 20 years later, what is genuinely different about this AI movement than in every other wave that you've seen and been through?
So I think at the time when we backed some of the vertical commerce companies, those were considered to be technology and deep technology. On a website, if you can find a torn jean in 3 clicks and you found it in 1 click, that was technology.
Yeah.
So times have changed. Now product life cycles are much shorter. Technologies which are enabling positioning of stores, they are based on intelligence, and subsequent to that, that intelligence leads to an action. A lot of data is available. So effectively, companies who are going to survive and do extremely well have started to use AI, where the benefit of using AI inside their company is measurable in financial and other KPIs. I think every single company in vertical commerce which has come up in the last 15 years is going to face competition from smaller incumbents who use technology literally 5 times more better than what perhaps the bigger guys are using.
You've also closed the second tranche of Fund 5 at $150 million last September, targeting a $350 million hard cap at $500 million. So what's the investment focus from that fund? How many investments have you already made till now, and what more would we see coming up next?
So I think a broader theme for us is we typically invest in the older funds. About 20-25% of our capital was in deep tech. Our first medical device company was many years ago. But now 35, 40, 45% of our capital goes into deep technology companies, which is, with our experience, we've invested cumulatively about 300 million into deep tech companies, about 60 deep tech companies. And with the intervention of the RDI fund, I think it's a very, very big game changer. It's a sovereign intervention in the country, which will catalyze even private capital overall. And that's like $11 billion. Material science, the whole assembly line, the way of manufacturing, and the pace at which, that is where India has a huge market right now. And I think funds like us will invest in many of those technologies, either in the supply chain or in the end products ourselves.
AI funding in India has jumped 58% in 2025. The likes of Sarvam are about to raise funds at a valuation of $1.5 billion. Reportedly, you've lived through the .com busts and funding winters. So I want to understand, is Indian AI showing signs of irrational exuberance?
I think it's perhaps wrong to say irrational exuberance. There is still capital paucity in the country. 1 or 2 or 3 or 4 companies getting capital is not symbolic of everybody getting capital. So we have a long way to go. But I'm very excited about the fact that there are Sarvams who are getting capital. There are other companies who are Galaxy and Agnicool, and so I think these are the forebearers of advanced technologies in the country built where India will use them as such. And we have to find markets in India. That is very crucial. Everything can't find a market outside first, overall. And I think these are game-changing companies right now. So there's no exuberance. There is still a lot of hard work to be done. I don't think we should get ahead of ourselves overall. We need the next 100 deep tech companies to succeed, right from AI to space to robotics to humanoids to quadrupeds to whatever is available in India has to be used in India.
The last 2 years have been amazing for companies to list on the bourses. It's been, we have picked up the momentum on the IPO front. Many of your backed companies have already been through the IPO period. One of your portfolio companies in which you've been an early backer is going to go for an IPO, which is CureFit. What is the space looking like for you? What are some of the next big bets that you want to think that, you know what, this company that I've invested in could actually get very good returns?
I won't name the companies for obvious reasons, but I think the IPO market is going through its ups and downs. I truly believe that we as investors are very clear that the next couple of years are going to be of immense volatility. And I don't think we need to worry about valuations. I think we just need to make sure that companies go public, markets will go up and down. It's a different world to face the public market every quarter than private market investors. I think we as investors have never thought of ourselves as asset managers. We are thinking of them as people who support and promote the products and services which new entrepreneurs are bringing to the table. And some of them will grow, some of them will unfortunately not grow. That opportunity is available in India. There's no question about it. But I don't think we should get carried away by how much is IPOs happening or not. It's a cycle, but next 2 years, tighten our belts. I think that's the very big message.
That's a very big message.
We should not worry about valuation beyond a point. As the company is doing well, company is growing well, profitability is happening in the IPO, pre-IPO market, and it's a leader in the market, those companies will do well.
And on that note, we'll wrap up this edition of Startup Straight. Thanks for tuning in, but stay with us. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to On the Record. I'm Shireen Bhan. My guest today is a man who has a pulse check on India's real estate market, but not just India. What's happening in the region is a question that will get addressed from his vantage point as well. $30 billion of assets under management in India since 2014, with a target of touching $100 billion by 2030. Ankur Gupta, thanks very much for joining us here on CNBC TV 18. It's great to have you back.
Thank you very much for having me again, and it's a great introduction. It's a timely topic for us to discuss what's happening across our region.
Absolutely. So let's get started with that. I mean, it's volatile. I think that is an understatement at this point in time. But the larger impact of that, not just on India, but on the West Asia conflict and what it's doing as far as West Asia is concerned, on Asia in general. What is the mood right now?
Yeah. So let's talk about volatility, because that's where we start.
Yeah.
If you look at on a daily basis, everything seems always a little bit volatile.
Yeah.
But if you look at the trajectory in which economies, certainly the economies that you mentioned, from West Asia all the way to Far East, have moved in the last several years, you've had creation of a top 5 global economy in India. We've had a real emergence of the GCC region, the West Asia region, as a global powerhouse of both transactions as well as source of capital. Economies like Japan are seeing growth for the first time in several decades. Australia is on a 3-decade growth trajectory, very good demographics across the region. At the same time, infrastructure or hard asset creation is lagging the West. So if you compare the West versus the East, on a long-term basis, we are still underdeveloped and high growth. That is a perfect storm for any duration of capital to be focused on and to actually use opportunities like volatile markets of today to create large long-term businesses. So very excited about what's happening to the region on a long-term basis, on a mid-term basis, and on the short-term basis, some amazing opportunities coming our way.
So you're not deterred by the headlines at this point in time. You're not deterred by the nervousness. And I'll ask you this in the context of the fact that most people believe that, look, if oil prices continue to remain as high as they are, or perhaps even trend higher, the impact that that's going to have on growth. I get the point that you're making on the underpenetration and underdevelopment as far as hard assets and infrastructure is concerned. But if growth were to slow down in the region, what could that potentially mean for investors like you?
Fundamentally, what's happening to oil prices right now is a shock driven by certain geopolitical events. This is not a change in the way supply of oil should happen in normal course business. There's a lot of conversations around diplomacy, around pacts and deals being made, and it will come to a head soon. And when that is over, you'll have a lot of pent-up growth come through the business channels. So yes, if you look at the market today morning or the newspaper headline from yesterday, it all seems very, very volatile. But let me assure you, duration is what matters in our business. And oil prices will come to a level playing field like they were about 3 months ago. And hopefully in the next 3 months, because this is a geopolitical, it's not a global health crisis like we saw 6 years ago. There's a solution to this. And very soon we'll see the solution play out.
We're yet to see the solution play out. The blockade continues to remain in place. But then let's address the short term, because you said even in the short term, you see opportunities. Where do you see opportunities in the short term, specifically for a market like India?
So in the short term, what happens is people who do not have access to long duration capital need to take actions which they would not take in normal course operations. We invest capital in a large scale, and we have operating ability to back that capital. So what happens when there is global turmoil like this, what we see, your cost of capital goes up.
Yeah.
There is short-term inflationary pressures, and you have to make decisions if you don't have the benefit of large balance sheets to tide over the current crisis. That creates opportunities for investors like us. I think that's what I mean, that in the short term, it's an exciting time to be in the market.
i.e. better valuations, more distressed assets that you can go out and pick up at a discount?
I would say we are able to pick up high quality assets at fair valuations.
At fair valuations, is it? What kind of discounts are you now looking at in comparison to the last deal that you just got done?
The markets overall have been soft. I'm not talking about the public markets because public markets are not necessarily always reflective of where large transactions happen. But in the last, I'll talk about the last 3 months. In the Asia region, we've completed more than $10 billion of transactions. We've just announced a very large GCC built out of a very large GCC in Mumbai, the largest ever in Asia. Almost 3 million square feet of total area that we are going to construct for a very large US bank. Transactions like that don't always happen with players like us that have the wherewithal, both in terms of capital as well as operating capability. I think that really gets magnified when there is overall dislocation in the market.
So do you believe that you're in fact going to see an acceleration of deals and deal making because there is this dislocation that you see today?
See, India is one of the top growth economies in the world. So we've been in the market for 10 years. Every year our business has expanded compared to previous years. And that's true for when markets were dislocated like they are today. And that has been true when markets were on a very smooth sailing. So we invest for long term, which means our programs are also long term. So I would say that nothing fundamentally has changed in the India growth story. In fact, I would say that with technology coming through the way it has, and the democratization of the technology and faster computing, faster access to large-scale models, with the workforce that India has, our median age is still in the high 20s, that population is more adept to using that technology as a tailwind than actually as a headwind. So today, I am more bullish about the prospects of India than they were 12 months ago.
And that's interesting because that is not the narrative at this point in time. Specifically, if you look at FIIs and FPI flows, I mean, it's been a one-way out of India. It's been exiting India as opposed to coming into India. But you're saying that you're more bullish on India today than you were when you first started investing in India 10 years ago. What are you seeing that others aren't?
See, firstly, we have thousands of people today in India that work for our business. So we get a real pulse from what's happening. 10 years ago, we were the early investors into the country. Today, we have a large business. We have some amazing talent that works for us. We have operating companies that employ thousands of people, as I mentioned. So we get real pulse on the ground. And today, India needs infrastructure build out. India needs real estate build out. India needs more office spaces. India needs more hotels, more warehouses, industrial parks, all of the above. We've had a few more events of global dislocation than we would have imagined, which has led to a global shortage of supply of real assets. Now that gets magnified in a fast growth economy like India. And today when valuations do become reasonable, i.e. transactions happen at reasonable numbers, investors like us can really push the pedal.
And you intend to push the pedal? So is the 100 billion by 2030 on track, on target?
That hasn't changed for us. In fact, we might be doing it much sooner.
By when do you now get to 100 billion? What does by much sooner mean?
We said 5 years last year. So
5
years from last year is 2030. But compounding effect of our business is amazing. Again, think about which country in the world today offers the compounding at the rate India does, and multi-sector story. India is a financial services story, India is a consumer story, India is a construction story, India is a technology story, services story. India is many sectors put together. Many other large countries have only one or two sectors coming their way. Yes, we can do a lot more in deep tech. We will do a lot more in AI as a country. But the infrastructure build out of that is something that investors like ours will play. I'll answer your question on FIIs.
Yeah.
Look, FIIs are trading in stocks. So they will obviously, because the barriers to FII movement are very limited, as they should be. Our form of capital is FDI, strategic capital.
Yeah.
We're not just investing. We are investing, we are developing, we are building, we are managing. And we are creating large businesses. And that is permanent capital. That will always create a multiplier effect on economy in the country. And once invested, this capital stays for several years.
I mean, it's actually in the ground.
It's actually really in the ground. So the returns of that, form of capital will change. Private capital will make its way into REITs and InvITs and so on and so forth. But the actual capital is in the ground. It's creating jobs to create the infrastructure, the real estate. Then it's creating jobs when people use that real estate. So it's a real multiplier effect. We saw that in China. Over 2 decades of large-scale development of the critical cities, real estate, malls, offices. That is what today has become the envy of the world in many ways, that it has one of the best infrastructure to push the economy in many different directions. And that's a global powerhouse that India is on its way to become.
And people are looking at factors like the currency depreciation, the swiftness of the currency depreciation, and so on and so forth. And all of those are being factored in as people make those investment choices and investment decisions. How are some of those issues weighing on your mind today?
Look, as I said, we are investing for a long time. Nobody would factor in that currency in India will not depreciate.
4 to 5% was the depreciation that was factored in typically.
And I would say that over the last 3 months, we've seen a real oil shock. As we talked about earlier, it will come to a head. It will hopefully, demand supply will determine the oil prices, then an economic blockade. At that time, the currency will go back to its normal 3 to 5% annualized depreciation, and that's just technical. That's just the differential in the interest rates between India and the currency that is benchmarked, which is the US dollar in this case, and that's fine. In fact, we should use this opportunity right now to really push the pedal on our exports and use the opportunity that the world is providing to us by way of a little bit of advantage on the currency side to push the agenda. We should never let a crisis go to waste. And this is our time for India to really push its exports agenda beyond the services as well.
And you're right in pointing out that the depreciation has actually helped Indian exports become far more competitive. But, let's address the big bet that you're making in India, and that is the GCC bet, right? 2,100 GCCs in India today at last count. I don't know if they've added a few since I last looked at the numbers. You firmly believe that there is a structural move towards the offshoring model changing to an onshoring here in India, and that's the conviction clearly that's playing out for you, which explains the largest GCC that you've decided to do here in India in Powai. But again, there are question marks in light of AI or what happens to workforces in general, but specifically also what happens to these GCCs. Are you seeing any indications of a slowdown of growth plateauing as far as GCCs are concerned?
You have to differentiate between growth rate and growth, absolute growth. So absolute growth is on a very firm footing. We are seeing more demand from global companies to set up. I wouldn't distinguish between onshoring or offshoring. I would say global capability centers are about global delivery.
Right.
With AI, that model actually gets much more pruned, simply because you can deliver a lot seamlessly with better technology, which is explaining why companies are today more comfortable than setting up their own centers than relying on third-party operators. So that's a shift in the business model. The demand for quality workforce that's available from India has not slowed down. In fact, it's actually magnified. We haven't yet seen the large AI companies, the big 7s or the big 10 from the US, actually creating jobs for their AI businesses directly. Early green shoots. We still are heavily reliant on financial sector, large insurance companies, etc., medical companies, health companies, etc. But imagine the amount of job creation that the AI business directly will have with the trained workforce that we have in the country. While AI is an amazing term because everybody uses it right now, technological advancement has happened for the last 3 decades. It goes through ebbs and flows. But if you think about what Internet 1.0 did, the social internet that almost revolutionized the way people consumed media, and this is another advancement in technology. It needs a massive build out because the compute capacity that was required has suddenly become many times over. But even that will come online over a period of time. It's a $7-10 trillion economy in the opportunity in the world. A large part of that will happen not just in the US, it will happen in other countries as well. So that will all create need for capital in the infrastructure real estate space. Using that is not just going to impact the country that the technology is based out of. It's going to impact the whole world. And India has always proven its mettle.
Do you need more workforce at work, or the work from home conversation is back? It's back after the pandemic because the Prime Minister has put out a nationwide appeal asking companies to consider work from home. It is not mandatory just yet, but we've seen many state governments now issuing their own advisories as well. If this were to translate into, at least for a period of a year, because that's the broad number that he's speaking of mandating work from home, or at least nudging, encouraging people to work from home, what could that potentially in the short term mean?
Yeah, so again, we have to differentiate what happened 6 years ago with the pandemic to what the appeal was made. This was in response to, what's happened in the geopolitical arena with,
fuel prices
and
so
shortage and, the impact of all of that. And as I said, it will come to a head soon. We all went through a period of time where there was work from home. That was needed because of the pandemic. You needed to create social distancing. But almost all corporations today realize the benefits of working in an office setting. New models are being created. Businesses have been incubated. People have to work together. The way people worked in the past might have changed a little bit. In fact, I would say most organizations today need more square footage per person than they needed pre-pandemic. You have more dependence on social interactions in office today than they did pre-pandemic. So by and large, work from home, even if it was to be mandated in certain cases or encouraged, is a response to a very different aspect, which is about fuel, and that's specific to India again, because of the way our energy markets are today, and that will resolve itself.
So you're not seeing any nervousness at this point in time on account of that?
Absolutely not.
Even as far as the hospitality business is concerned, assuming that your conviction pays off?
We are now in the Leela business itself, more than 20 hotels, more than 10 in the pipeline. So we're going to probably be more than 30 hotels, and across the board, I would say we will do a lot more should the opportunities be available to us.
M&A there as well?
We are a large investor and developer, so M&A is always the way for us to grow, by step functions.
Let's talk about the REIT market as well, and of course that's been something that you've been championing, and 2025 was actually quite an inflection point as far as the REIT market in itself was concerned. What's the story and how is that playing out, not just for you but as an industry as well?
Look, our REIT is now more than 35 million square feet, a large enterprise. The regulations in REITs are very, very good in India, and we've always said it that they've taken the best from the world and implemented them in India. The fundamentals are very good. SEBI introduced the classification of REITs into equity, which was always the right thing to do. That led to an expansion of investor universe. We've raised more than $1 billion in our REIT in the last 12 months or so. And I think that program will continue. We'll probably raise capital because capital is the raw material for REITs.
How much are you looking to raise and when?
We just raised about $300 million this month, early part of this month or late last month. And as I said, the opportunity for the REITs for our REIT is immense. So the raw material is capital, and we look to either raise capital or issue units to expand. But the program will continue for decades. US established REITs in the 70s and 80s, and it continued for 4 decades, and we are in the first decade of the REIT market. I just characterize the market size. The size of global commercial real estate space, the rent-producing real estate space, is $60 trillion. In the US, is $30 trillion, which is 1:1 their GDP. In India, our GDP is $4 trillion, and our commercial real estate space is probably $400 billion. So we are a tenth of our fair share of GDP. Our GDP will double and double again over the next 10 years, which means we have to first make up 10x and then double and double again. And that's the market potential that we see. We've only seen office REITs and retail come through. We're going to see hotels, either IPOs or through REIT channels. You're going to see more office REITs. You're going to see apartments, industrial. You're going to see warehousing, business parks, so on, and it's a big market. We can open up the market to talk about mortgage REITs as well, to create more financing sources for the real economy. So it's early days, very, very bullish on the REIT business. We've seen early days that the government is thinking about creating sovereign programs for asset monetization or creation of holding companies which can become REITs in future. So I think the market just started off.
You know, specifically since you brought up the government and the government's asset monetization plan, and I think, again, the pushback there has been that there's been a lot of talk but little action. We've seen some action, at least as far as the InvIT side is concerned, but, you know, it could have been a lot faster, it could have been a lot more. What's the ask there, and what's the hope there, more importantly?
The ask is that we are here to help.
Have they asked for help?
You know, in terms of policy matters, in terms of how to do the right things, I think the engagement with industry is very good. I can say about Brookfield and, you know, most of the government agencies are supporting the growth of our business, and as a result, supporting the growth of the country. And in that ecosystem, when they have their own programs to launch, it just widens the scope. How we can be helpful, that they have to decide. But I don't look at the past, whether the monetization could have been faster or quicker. That's, you know, they're running a country. They have a lot more considerations to take. You know, we are running a small corporation. So whenever they are ready, we are here to support.
With just a couple of hundreds of billions in asset under management, just a small corporation. But, you know, we're also talking at a time where we've got Trump and President Xi in China, along with a whole host of top US CEOs. And since we're talking about comparisons and where India is and the potential for growth, let's talk about this India-China comparison, because very often we see long sort of, you know, comparisons being made, and some of them perhaps don't even hold true in the form of the comparisons being made. But how do you look at the India-China story and how you expect them to play out?
No, I look at it like the interstellar model, where you have to almost change the time scale and then look at it. Why compare a more maturing demography with a younger country today? Let's look at what happened maybe 20 years ago in China. And that is more exciting. That can we be part of that journey for 20 years in India? Or if you take it back 20 years in the US. So, you know, economies go through their maturity cycle. So what we sometimes do mistakenly is compare today's India with today's China, or today's India with today's US. I don't think it's a fair comparison. Free market came to India later than many of these countries. And whatever the reasons might be, as I said, I don't look back. The opportunity for us to replicate a China model, or any model that works for India, I don't think we should be replicating or copying models, but we can learn from these economies. US, China, you know, you talked about the large engagement that we are seeing this week play out. I think India can only take inspiration from some of these things, and, you know, fasten our reforms if we need to reform, and look at what the potential is, because we have a case study of you know, almost eradication of poverty in China over the last 3 decades, creating a massive infrastructure push, lots and lots of cities, opportunities for business to flourish, industrial and manufacturing becoming world class. So all these are inspirations that we can take while keeping the virtues of India intact: democracy, federalism, etc. I think all of these are important, and we'll find our own way to grow. Hopefully we'll you know, the terminal value of that growth for a young country is probably higher.
So for somebody who is putting long-term capital to work here in India, what is the most exciting thing?
The compounding of growth. You know, we are a young country. The terminal value of that growth, once compounded, is also very high, and it's a multi-asset, multi-sector, multi-pronged story. As I mentioned, we have so many things going right for India.